On Euro Stoxx 50 futures. And Tom, that really begs the question, will it be the same sectors as yesterday, those exposed to the European economy, that go weaker?
The lens is very much on the energy space, and that ties into the European picture, of course, with gas prices up now about 80%, Anna, in the last 2 days, spiking again in the session today. We're watching energy then as a sector, with the oil prices also higher on Brent by about 3%, back above $80 a barrel. The defence sector, of course, you saw that gain, particularly in the defence names of Europe and the US yesterday. That was supportive for the broader indexes stateside, along with Mag 7. But of course, we're also watching shipping, with rates there continue to grind higher. China coming out and pushing around their concern that the Strait of Hormuz remains open. So the shipping constraints on what is effectively now a closed Strait of Hormuz, if not officially. So those are the main sectors we continue to focus in on today, Anna.
Yes, and we were having a conversation about insurance in the marine space, and we were hearing that in a slightly different part of the Middle East, that the whole Red Sea conversation, that's going to be pushed to one side again, and ships are going to continue to go around the south of Africa, which again plays to higher shipping rates, and maybe is a positive for some of those shipping companies. That's what we saw a little bit of in the session yesterday, and maybe we get some more of that today. So the start of the European equity trading session, I'm talking about shipping as we're waiting for these broader European equity markets to open up. So the FTSE 100 down by 0.6% at the start of trade. Yesterday, as we've said many times, we have seen a bit more resilience coming through in London, and part of that is delivered by the exposure to energy names, the likes of BP and Shell, still heavily weighted in London, and as a result, there's a little bit more resilience. The CAC 40, of course, has Total Energies. That is down by 1.3%. A lot of focus yesterday in the French market on the consumer-exposed side of things, the autos, the consumer products, the luxury goods. The IBEX down by 1.4%. So once again, we're seeing negativity, Tom, across these European equity markets. The Asia session was pretty negative. We should say that Korea was back from a holiday on Monday, so maybe the Asia session looks even more negative than it might have been expected to do on the Tuesday of the weekend story. But certainly we're continuing to look for signals in what is an incredibly complicated picture in the Middle East.
Energy is the only sector that is in positive territory so far. So on a sector-by-sector basis, energy up 0.3%. On the downside, the biggest losses coming through for basic resources, currently down 2%. You do have slightly weaker, you have weaker silver prices and weaker copper prices as well. That seems to be weighing on basic resources. We'll see how that adjusts, though. Utilities also lower by more than 2%. Travel and leisure, and you saw the significant impact yesterday, particularly around hotels and airlines and the constraints there in the Middle East. That sector is down almost 2%. Banks were under pressure yesterday. That narrative continues today as well, currently down close to 2% as a sector for banks. And again, it is energy that is the only sector in positive territory right now, up 0.3%. European natural gas prices spiking again this session, Brent above $80 a barrel.
Yeah, really interesting that we're seeing basic resources at the bottom of the basket, and the worst performing stock in there seems to be Fresnillo, which of course is a precious metals miner. We've seen the numbers hitting the tape, but we've also seen, of course, some movement in silver prices. And sometimes in times of stress, you sell what you can and not what you want to. And so silver prices have been weaker and are down another 2% today. That's not the case for oil prices. They are up. And so to your point about energy being the only sector that's positive, energy stocks go higher, basic resources go lower, and we have that sort of divide across the European equity space this morning. Let's try and make sense of what we are seeing across markets. Stephanie Niven joins us, portfolio manager at 91. And Stephanie, nice to see you this morning. Thank you for joining us. We do seem to see a different story being told in different geographies about, well, let's start with stocks, about where stocks can go here. The story out of the US seemed to be one that was emphasizing the resilience of the US economy and maybe trying to draw a line between in the sand there. But then you look back at US history, and stocks sometimes in geopolitical tense periods go higher and are resilient, and other times they drop. I mean, what are you thinking about the stocks environment from here?
Sure. So what a week to be talking about the markets. And I think the three things we're really thinking about here at 91 are the impact on oil and the transmission through inflation and what it does to the anticipated Fed path downwards. We're thinking about broader asset classes, so the transition into emerging market debt. But you're exactly right that the impact on global stocks, the global equities, emerging market kind of businesses is something that we're really going to have to watch from here. And this kind of war hits at a very interesting time for the market. Headline numbers look like we've had a relatively calm year, and that really hasn't been the case. We've seen really significant moves within software, and we've also seen that beginning of cracks within the private market space as well. So kind of seeing how those ramifications come into the market today, I think perhaps the US won't be the same today, and you're exactly right to call out some of the impacts within Asia, and we're seeing that transition mechanism of oil prices begin to feed through.
Where are you focused then in terms of the European downside, and maybe even resilience? Where do we look then, Stephanie? Because, I mean, energy is the obvious area of resilience. We see that for a second day here. On the downside, though, yesterday the focus was on consumer goods and anything that could be hit by a slowdown in the European economy. Today's a bit more complicated. We've got insurance and utilities weaker. I note the higher yield story in Europe as well. I mean, what do you think about the sector rotation that this could prompt within Europe?
I think we could continue to see a lot of the heightened sector kind of rotation activity that we've seen year to date. So kind of dealing with that idea of higher inflation, but also lower growth, and how we think that feeds through to asset pricing. We've looked at some of the oil price kind of sensitivities across the economy. So a kind of 30% rise in oil price could lead to a 1% shock in inflation, which leads to a 0.13% decline in realized growth. And those feed through in many different channels. I think for us, we continue to look for the resiliency of business model. We've heard a lot, particularly last week, about AI and how we're beginning to transition through from that hyperscaler kind of CapEx headline focus into actually what does this mean for the real economy? How will we start to see productivity feed through in ways that rewire a lot of economic value creation?
What parts of the European equity space are most vulnerable to this energy shock that we're now seeing emanating out of the Middle East? Or is there that corporate resilience built up over COVID and supply chain hits as a result of tariffs?
Sure. I think there's a degree of corporate resilience. We always stay in those names where we think that there is that ability to generate free cash flow, where a lot of the business fortunes effectively remain within management hands. I think it will be interesting to see really some of the responses. So, what companies are out there talking about the impact on their business models going forward, and how they ultimately think about deploying strategy, deploying capital allocation, and perhaps accelerating some of the changes that AI will bring into, our global economy.
But on a sector-by-sector basis then, that area where management has more control, where does that take you? I mean, a lot of guests we've had coming onto the show have talked about the banking space, for example, and European banks continue to outperform. They've been pretty badly hit in the last couple of days, maybe on expectations the economy doesn't perform as well in a higher rate environment. Where are you seeing, where do you want to be leaning into on a sector-by-sector basis where you're finding some kind of hedge or some kind of resilience in this environment?
I think we're really interested in names like Schneider Electric, where they continue to feed that build-out of the AI ecosystem, where they continue to kind of think about how customers are going to respond and rewire their own business models. We'll look at things like healthcare as well, where the underlying sustainable kind of structural growth dynamics stays in place. We tend to stay away from some of those more precarious, more economically and commodity-sensitive names.
Let me ask you about emerging markets, Stephanie, because you referenced this earlier. We talked to a guest in the last hour about this as well. I mean, I go to the dollar and look at the strength that we're seeing in the dollar since the weekend. What is that going to do to derail interest in emerging market assets, which have been really popular with the weakness of the dollar?
Sure. I mean, you can't broad brush emerging markets entirely. There's a difference between Asia, there's a difference between Latin America, South America, and thinking about the different kind of exposures there. And obviously, Asia is a net importer of energy. I think it comes down to the business models. It comes down to that kind of degree of resilience. One thing we're looking at is how moving beyond some of these kind of hyperscaler CapEx plays, into kind of that productivity, into the factories, into thinking about how things automate and transition in an AI future.
Okay, so it sounds as if you still think that these AI themes, that the rotation that we were talking about over recent weeks away from hyperscalers into other parts of the AI beneficiaries, you still think that that is a trade that can cut through in this environment?
At the moment, we do. Obviously, the intensity of what's happened in the Middle East so far has been surprising. However, we think that, markets are resilient more broadly. It will be, active investors will have to think more deeply. They can't just remain on the kind of headlines of things. They need to think beyond, the management rhetoric and move into the exact underlying exposures. But we are pretty optimistic that this is not a catastrophe for economic markets.
What would you get? What is the kind of the metrics you're looking at, the gauge that you're looking at that would change that constructive view on equities? Is it oil above $100? Is it oil above 120? Is it a conflict that continues for 3, 4, 5 weeks and spreads in the region? What are you looking at? What would change that relatively constructive view on equities in terms of the geopolitics of seeing?
Sure. I mean, oil price is obviously the key transmission into the real economy, but we're also thinking about inflation. So when we begin to see inflation kind of move, what that might do to the labour pool, what that might do to accelerated job losses, perhaps in this world of AI. Okay, and inflation is a metric that is obviously supported by what's happening. What the oil price that is there a level? Is it going to $100? And this becomes a problem. I mean, we've been talking about, again, we've been hitting the fact through this show that this isn't just an energy shock; it's a supply chain shock as well. Exactly.
So, like, how clear are you in terms of when and if inflation comes through in a significant way, and when to change that kind of asset allocation?
So the sensitivity that we've been running through our investment institute is thinking about a 30% real rise in oil prices and what that will do. And that's the point at which you get that 1% shock on headline inflation, and that's the point at which actually real growth begins to deteriorate. So that's the kind of region in which we're focusing our efforts. And obviously we're around 73 for WTI and 80 for Brent. So kind of looking at where we go from here, and I guess we are pushing into that kind of $100 realm.
Stephanie, we have been talking a lot about private credit in recent weeks. We've been talking this week all about the devastating events in the Middle East. What are we not talking about that should be on investors' radars when they try to keep calm in the face of so much news flow? What is getting lost?
So I guess it's that underlying kind of dynamic of competitive advantages. What is happening to competitive advantages as we begin to see the economy rewire through a age of AI? A couple of weeks ago, we were all extremely focused on software, whether there was any terminal value within software, and trying to understand, the sector as a whole might be disrupted, but actually there are pockets where we are embedded, where those businesses will see resilience. That's the area to focus on as an active investor.
Okay, Stephanie, thank you very much indeed. Stephanie Niven, Portfolio Manager at 91. Let's have a look in on the Core 6 on another day, of course, of challenged equity trades and pressure broadly across your sectors. You are seeing Novo Nordisk within the healthcare space, something Stephanie mentioned there in that conversation in terms of healthcare. So Novo actually showing a little bit of resilience in this environment, up 0.6%. Everything else, though, in negative territory. Nestle, though, in the consumer staples, showing a little bit more resilience as well, comparatively just down 0.4%. You're seeing that selling pressure coming through for Electric Schneider, down 2.2%. ASML, of course, with the lithography machines and that exposure to chips, currently falling at 3%. So that's the worst performer across the Core 6. The luxury space was badly hit yesterday, and that sell-off continues again today. LVMH down 2.3%. The defence space, Rheinmetall, after gaining yesterday, currently down just 0.1%.
Coming up on the programme, Spain's Foreign Minister, José Manuel Álvarez, tells us how Europe will respond to President Trump's latest Iranian strikes. Our interview is next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Welcome back. This is the opening trade. 15 minutes past 8 here in London. And in London, we have a bit more resilience coming through on the London market, but not by a huge amount. And actually, the gains we'd seen in energy stocks, Tom, just fading. We are now seeing negativity even around energy stocks. So all sectors in Europe are in negative territory this morning.
OK, and that ties, of course, directly to what's happening in the Middle East, where German Chancellor Friedrich Merz has voiced his concerns about the unpredictable fallout from the US and Israeli strikes on Iran, remarks that risk straining ties with the White House when he arrives to meet President Trump today. Merz will have to present European interests at a time when both the UK and Spain have denied the US permission to use their bases to attack Iran, though it's worth noting that the UK has allowed the US to use its bases in a defensive manner and defensive capability. Spain's Prime Minister Pedro Sanchez said the US and Israel's actions have added to a, quote, more hostile international order. Joining us now is Spain's Foreign Minister, Jose Manuel Alvarez. Sir, Minister, thank you for joining us. Why take a stance against the US and Israel in terms of the military action they're taking on Iran? And do you plan to go further than rhetorical condemnation at this stage?
We don't go against anyone. We go in favor of international law, de-escalation, negotiation, and regional peace and stability in the Middle East. That's where we stand. And we want to be a voice of reasons and balance. And we are coherent with our foreign policy. We say the same things with the same objectives and under the same principles, whether it's in Ukraine or in Venezuela or in Gaza or in Iran. We have been very clear concerning the regime in Iran. We have condemned every single human rights violation and the brutality of the Iranian regime against its people. We have condemned the unjustified attacks of Iran to basically every country in the Middle East. But we want military actions always under the United Nations Charter and under collective effort. When we don't see that, Spain raised up its voice to signal that that's not the right way to go.
Yes, Minister, and you mentioned those Iranian attacks on other regions, other countries within the Middle East. Why not then allow the US to use Spanish bases in a defensive manner to protect those nations against that Iranian hostility?
The treaty between Spain and the United States established a scope of the bases and for the use of those bases that are Spanish bases under Spanish sovereignty, but of joint use. And at the same time, we want all actions that are carried through those bases to be and falling under the United Nations Charter. So anything that is inside the treaty and in compliance with the United Nations Charter, it's okay for us. Everything that goes out of the scope of the treaty and that has not the backing of United Nations Charter, we will not allow the use of our bases for that.
Minister, do you assess that you are taking a different position from France, Germany, and the United Kingdom? I mean, on the subject of France and Germany, does that matter that European EU voices are on a different page?
We think that every country has the right to make its own analysis and its own foreign policy. Basically, Spanish foreign policy is being coherent, is being consistent in wanting peace, de-escalation, criticizing and condemning all the violation of human rights everywhere, of course, including in Iran. We have voted every sanction to the Iranian regime, including the Revolutionary Guard from European Union. But we think that Spain and the European Union and Europe must be a voice that establishes a balance, that talks about de-escalation, that talks about protecting and defending international law, that a world that is based on predictable rules, it's better than a world in which the force is the only rule. That's where Spain stands, and there is where we think Europe must stand, and I made it very clear the other day in the Foreign Affairs Council in Brussels.
Do you think that, is there any chance that this turns into a NATO operation, Minister? I mean, under Article 5, we are seeing NATO troops being attacked, not in NATO countries, understandably, but there are attacks against NATO troops. What would turn this into a NATO operation?
No, I don't think so. No one is asking for it, and I haven't heard anything or anyone talking in that sense. The situation is already very complicated, very, very complicated. We see this instability everywhere in the region that is affecting also many of our citizens. Spain has more than 30,000 Spaniards in the region, and today we have good hope that the first one will start to get out through commercial flights, but we are struggling to get them back to Spain. We see attacks everywhere. The situation is already complicated enough as to introduce political fiction and to complicate it even more.
Minister, have you had conversations with your partner, with your counterpart in the US Secretary of State, of course, Marco Rubio, since the conflict started? And if so, has the US been putting pressure on Spain?
No, I haven't had. I've talked with him several other times. I was very kindly invited to the State Department, and we had a very good conversation there. But all that was prior to this military intervention. No, we are not getting pressure. We are allies. We are together in NATO. There is this basis here that are under Spanish sovereignty, but are of joint use. No, there is no pressure at all.
There will be those in the US who would question whether or not you are behaving like an ally. You're not allowing those bases to be used. You are not meeting that 5% target for NATO spending, and you are condemning the US. You talk about instability, Minister, but you are not putting the money where it needs to be in terms of the defence space in Europe and in NATO. That would be the accusation from some.
We are one of the most committed allies in NATO, and we are one that is contributing the most to Euro-Atlantic security. We have a historical deployment of soldiers, aeroplanes in the eastern flank of Europe, almost 3,000 soldiers. Our aeroplanes are guaranteeing the security of the Baltic states and therefore the Euro-Atlantic security. For 70 years, we have two bases here that have been of joint use with the United States. We have our soldiers in UNIFIL under UN flag. We have them under NATO flag in Iraq. We have been together for almost 20 years in Afghanistan. So I really would like to see if there are countries within NATO that are doing so much meeting the targets that are put. All the capacities that NATO asked to Spain, we are providing them.
So when will Spain spend 5% of GDP on defense?
What we are doing, and that's how we approach things, is that we are meeting all the requests of our capacities that are requested from NATO. And we think that with 2.1% of our GDP is enough. The way we do it, and we think is the right way of doing it, is we see the threats that we have. Once we see the threats, we see the capacities that NATO is required from Spain to meet those threats, and then we quantify them. And what you can be sure is that we are, and we will continue delivering all the capacities that NATO requests from us. And that means 2.1% of our GDP. Putting 5% out of the blue without knowing what capacities are required is taking resources that might be needed somewhere else.
Minister, do you have a base case assumption about how long the war in the Middle East lasts? What are you, as a government, assuming?
I really cannot answer to that question. It's more to those that are involved in this war, the United States, Israel, that they are the only ones that can know how long or what they foresee. What is very clear already after a few days of war is that we are under unpredictable consequences, certainly for the region, but probably well beyond.
Yeah. Minister, gas inventories in Europe are seasonal lows. We're seeing gas prices spiking again in the session today. Does Europe face an energy shock?
Not so far. We have very reliable suppliers, including the United States, in LNG, for instance. But what we see is that the prices are rising, and of course, it's a situation of concern for every country in the world.
Minister. Spanish Foreign Minister José Manuel Álvarez, thank you very much indeed, sir, for your time this morning. We appreciate it. Let's check in on European stocks right now, and we'll start on the benchmark. Stocks 600 is currently down 1.9%. Heavier selling that we saw yesterday, building on those losses. You're seeing every single sector in negative territory, including energy, which is down 0.6%. The DAX over in Germany tumbling 2.2%, as you can see. Over in France, the CAC 40 off by 143 points, and the FTSE 100 dropping 159 points, and gilts selling off and pretty aggressively.
Yeah, I mean, part of the energy story is about the price. The rest is about the volume, and maybe that's what markets are responding to today with those energy stocks weaker. Energy prices are much higher. When you look at UK natural gas prices up by 25%, TTF, that's the European benchmark, up by 24%. We're not at levels we saw in terms of euros per megawatt hour during the start of the Ukraine war. We're at 54 euros, not 340, but still the movement is dramatic and it is upwards. If we look at oil prices, the Brent price is up by 3.4%, WTI up by 3.2%. Interesting, we could see those diverge as this conflict continues then, Tom.
I just want to note and check in again on gilts, because the sell-off is pretty significant, particularly at the front end. So yields up 11 basis points on the 2-year. Trade is no longer pricing a second Bank of England interest rate cut this year. That is a pretty marked shift, and that ties to your point around high gas prices. There's the sell-off in gilts. US futures as well, after showing a bit of resilience in US markets yesterday. S&P E-minis pointing low by 1.3%. Nasdaq 100 futures pointing low by 1.6%. We're going to talk to Tobias Ellwood, the former UK Middle East minister, as Britain grants the US permission to use its bases. That analysis and insight is coming up. This is Bloomberg.
2026 for us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've been the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now off age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and Nuvian. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for StartupWave by empowering our customers across all our segments?
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back. This is the opening trade. 30 minutes into today's session. Let's have a look at where we are across European equity markets. And the answer to that question is in the red, down by 2% on some of these markets. So the Xetra DAX in particular, down by 2.3%. Elsewhere, the CAC 40 down 1.8%. And the FTSE 100 cushioned a little, but not really much. And that's, I think, Tom, is what sets today apart from yesterday. Yesterday, energy was much more of a cushion against the negativity. Today, we see even the energy sector in negative territory.
Yeah, less support from the energy sector, less support from the defence space. And we saw that come through yesterday. But to your point, that has adjusted in terms of that dynamic today. In terms of volumes spiking in the session today, up almost 40% versus your 20-day average. Let's break it down in terms of your members higher versus members lower. Given the significant and broad spread sell-off that we're seeing, not a big surprise to see that just 41 stocks are in positive territory so far and more than 556 in negative territory right now. Let's break it down and have a look at some of the leaders then. There are a few of them, and that is in the oil space. A couple of names then seeing higher pricing and higher stocks on the back of what we're seeing in terms of the oil price spike. BP, a beneficiary of barrels of oil, and Brent above $80 a barrel. BP up 1% in the session today. Equinor getting an even bigger boost, up more than 3% so far. Lottomatica also gaining close to 5%. So amongst the gainers is the energy space that again dominates. Let's flip the board and have a look in terms of the laggards. And it's a reminder, it's not just that energy shock that we're having to deal with, it's also the supply chain shock. And ASML is a feature there, of course, the maker of these extreme lithography machines that go into the chip sector. And there's a constraint given what is happening in terms of the Straits of Hormuz and the effective closure of that shipping route. So ASML under pressure as a result of investor concerns about how they ship their products to market. The semiconductor space also feeling the squeeze more broadly, down 3.6%. Natura Energy, they have to buy in a lot of the energy, so of course there's a constraint there. Currently falling more than 7%, and Beiersdorf falling almost 13%. That's on weak guidance. It's less about the geopolitics. That may be also a factor, but it's a guidance story coming through weaker than expected. And again, it's the supply chain challenge more broadly. There's a constraint for the likes of the chip space. Anna, what else are you looking at?
Yeah, let's go through some of the other stories that are in focus for us this morning. Blackstone Private Credit Fund has been hit by record redemptions. The firm is allowing investors to redeem a record 7.9% of shares from its flagship private credit fund. The surge in withdrawals adds to growing unease over the asset class and its exposure to software businesses at risk of disruption from AI. Russia and Ukraine are said to still expect planned US-led peace talks to go ahead this week, despite the United States military campaign against Iran. But a source in Moscow says the meeting is unlikely to happen in Abu Dhabi, with Turkey or Switzerland among possible alternatives. This would be the fourth meeting between the sides this year as the US seeks to broker a deal to end Russia's war in Ukraine. And senior gas executives say that China is pressing Iran to avoid disrupting energy shipments through the Straits of Hormuz. Beijing is urging Tehran not to target oil or LNG tankers or key export hubs like Qatar, which is a major LNG supplier to China. Tanker traffic through the critical waterway has effectively halted amid escalating conflict in the region, raising fresh concerns about global energy supplies.
The US is sending conflicting messages about the duration of that war with Iran. Defense Secretary Pete Hegseth rejecting the idea of, quote, an endless war, but President Trump has vowed to do whatever, quote, whatever it takes. This, as Bloomberg learns, the UAE and Qatar are privately lobbying allies to help persuade Trump to reach for an off-ramp. But US Secretary of State Marco Rubio insists the military campaign could be stepped up.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Let's bring in Bloomberg's Jumana Pasechi standing by for us in Dubai. Jumana, are we any clearer on the U.S.'s strategic objectives with this military campaign?
Well, I think the two questions people are asking is what exactly are the U.S. trying to achieve? And the second is how long is this going to go on for? Yesterday, President Trump said that they would do whatever it takes, quote, to achieve those objectives. And he said from the outset, we projected 4 to 5 weeks, but we have the capability to go longer than that. Later on, the Secretary of Defense, Pete Hegseth, said that this is not an Iraq situation. They're not planning on this turning into an endless war, but a protracted campaign is within the realms of expectations here. And what we know is that the U.S. continues to beef up its assets in the region. We just heard of the Secretary of State, Marco Rubio, suggesting that the strikes are actually going to intensify in coming days. Over the first 2 days of the conflict, the U.S. targeted more than 1,100 sites within Iran, military infrastructure, rocket launcher sites, nuclear sites as well, with some of those stealth bombers targeting embedded nuclear locations. And obviously, those are the more tricky ones to get access to. And they continue along as well the path of targeting senior personnel and the headquarters of the Revolutionary Guard. This morning, they took out a central command unit as well. So alongside that, President Trump and the Israeli Prime Minister have been calling on the Iranian people to rise up. There hasn't been any sign of that happening. But again, over the coming days, perhaps the U.S. calculus is that the Iranian regime will sustain so many blows that they will have no choice but to capitulate. At the same time, it is also noteworthy that overnight the U.S. has sent a message to all American citizens within the Middle East, and this is pretty much all of the countries in the Middle East, urging them to leave the region. And of course, it's very difficult for them to do that given most commercial flights have been canceled.
Yeah, I was struck by the sheer list of countries, the length of that list of countries, Jumana. It's interesting thinking about the impact that this is having where you are and other countries within the region. I noticed there's some reporting in the Middle East suggesting a fire at Fujairah's petroleum industrial area in the UAE, that coming from other TV within the region where you are. And this takes us back to the impact that this is having on the energy infrastructure, but also the lives of those in the region. And we know from our reporting that the UAE and Qatar are putting pressure on their allies to try and persuade President Trump to find an off-ramp to this conflict. And you wonder if any off-ramp is in sight.
Yeah. Precisely that, Anna. You could say that in the last 2 days, there's been a marked escalation in terms of what Iran has been targeting within the Gulf states. Energy infrastructure, logistics, key ports. We've talked about, obviously, the disruption along the Strait of Hormuz, but a big escalation on the energy side of things yesterday, targeting those LNG facilities, you know, the key Qatar LNG facility alongside the refining capability in Aramco as well. And this morning we're hearing of that fire that's ongoing in Fujairah. So as far as Gulf states are concerned, This is a significant escalation from where they thought the Iranian response could lie, which was initially directed at some of the U.S. assets in the region, but now it's become very much directed at some of the key energy infrastructure that directly and economically impacts what these Gulf states are trying to achieve in terms of overall stability. And so our reporting suggests that Qatar, UAE are trying to look at some form of a diplomatic off-ramp to thwart the possibility of this turning into protracted conflict and sustained higher energy prices. They've been reaching out to leaders, their counterparts from around the world, including some European leaders as well. But at the same time, I'd also point you to a statement that was put out by the GCC foreign ministers over the weekend, emphasizing that the member countries will take all necessary measures to defend their security and stability, including the option to respond to the aggression. And so you can read that as you will, but the point is that they are exploring all options here, and there is a perception in the region that Iran have gone one step too far.
Okay, Jumana Pasechi, thank you very much indeed with that update, of course, out of Dubai, out of the UAE. For more analysis, let's bring in Tobias Ellwood, former UK, Middle East and North Africa Minister, also former UK Parliamentary Defence Select Committee Chair. Tobias, thank you very much indeed for coming into the studio. How do you characterise this moment right now?
Well, so much to unpick here, but let's start with Iran. The fact that you've got Donald Trump, the American president, saying to Americans, get out, that suggests that Iran has much more to firepower in the bag. And that's what we're going to see. So Trump is going to say, yes, there's more to come. You heard Rubio saying that we're going to fight further. It'll last another 4 weeks. But to tell Americans to get out, that means Iran remains a viable threat. It's not going so much for Israel or indeed for those ships in the Mediterranean and in the Indian Ocean because they're protected. It's going for the lower-lying fruit, which is the rest of the Gulf. It's American assets, embassies, and other targets right across the Gulf itself. It begs that question, what does victory look like? And this is the worry. You've touched on it this morning as well. And I worry about mission creep, because any soldier, any general wants to know, what am I doing? What's the political outcome? And different people in America, in the leadership, in the White in America, in the leadership, in the White House, you get different answers. I see three outcomes potentially. Firstly is that you have a regime change and then America dials back, but that ends up in civil war. The second one, which I think is what Trump is probably pointing to, is the Venezuela approach, that the regime stays, but under new leadership, it's subservient to America. It promises to stop doing its nuclear ambitions, long-range missiles, and its proxy support across the Middle East, and it'll behave itself. But that isn't what the Iranian people want, nor is it the message Trump sent earlier to say, this is your moment to rise up. The third option is the more advanced, and what I think the people would like, indeed the world would like, is never in decades have you had an opportunity for Iran to step into a new chapter. So the regime collapses, then the international community steps in, helping support an interim government, rewrite the constitution, and move Iran into a better place. But all that last option is far too much work, too much detail for Donald Trump to get his head around.
But so, to be clear, you're not seeing a clear strategy from the US. Do we therefore end up in a situation where this becomes a war of attrition over weeks rather than over days?
It's worse than that, because it's the word mission creep, I'm afraid, is now coming in to the lexicon when we're describing what's going on in the Middle East. There's absence of clarity, and don't forget that America, indeed much of the West, are very casualty averse. As soon as those numbers start to clock up, and we will see them, I'm afraid, both civilian and military, then the domestic pressure in the United States will rise to ask, what on earth are we doing? And don't forget the American president promised not to get engaged here. It goes back to the start of this, I'm afraid, that it was Israel, Netanyahu, it seems like, Rubio confirmed this, they were going to attack Tehran anyway, So America said, well, we better move in too, because Iran's response will be hitting Americans too. We better strike first, preemptive, weaken them. But you've now opened up this Pandora's box. Where do we go next?
And then you're into the question of how other nations respond, and let's think about the UK response, Tobias. Let's just play a little clip of the Prime Minister yesterday speaking to the Commons.
To be clear, the use of British bases is limited to the agreed defensive purposes. We are not joining the US and Israeli offensive strikes.
The Prime Minister there, and of course you were in Parliament representing the Conservative Party, not his Labour Party. But I wonder what you make of the stance that the Prime Minister, the UK government, has adopted here, Tobias, because for some people this is far too nuanced. You're either with America or you're not. For other people, this is exactly the right path to be taking. It's saying you can use our bases for things that are legal and you can't use our bases for things that are not.
Yeah, I think this idea that we're either with America or not is too simplistic. It doesn't actually give justice to the scale of the problem that we face. It was right, I believe, that we questioned Donald Trump's intentions to attack Iran. Personally, there's the international laws as well. You're only supposed to attack another country if they're attacking you or about to attack you. That threat wasn't imminent itself. But a line is crossed as soon as Donald Trump and indeed Israelis went in, because Cyprus was attacked. British assets across the Gulf were attacked. Our allies were attacked there. So that opens up a new period of engagement. Yes, reflection must come. We must look back in the longer term, but that's not for now. Now is operationally. We should be putting more assets into Cyprus, protecting that, certainly supporting our Gulf allies as well, and then asking ourselves the difficult questions, as I touched on before, trying to persuade Donald Trump, where are you going with this? And my worry is that we're going to end up with a Venezuela outcome.
Right. Well, I mean, he wants a Venezuela outcome, doesn't he? He cited Venezuela as a positive.
But then why tell the Iranian population, the citizens there, rise up again, come back out on the streets again? Remember what happened last time, only a couple of months ago, when he encouraged that to happen, and the slaughter we saw from this regime. This is the other case, as I touched on, is civil war, because there's no clear leadership. The idea that you're going to bring in the Tsar's son, who's based in Washington, to somehow take over, that isn't going to happen either. It's a diverse country, and
it's divided. Yes, exactly. On whether any replacement would be more.
And the biggest force, the biggest institution with the most capability, is the Iranian military. So you then replace a theocratic dictatorship, with a military. We end up with a Saddam Hussein in Iraq, but in Iran.
You say that this is not a time for maybe deep reflection, it is a time for action. But, I mean, what was clear in the UK context is the shadow of the Iraq war hangs over everything that was said in the House of Commons yesterday. I mean, you must have reflected on the UK's involvement there and the things that the UK says, yes, it will do for American allies, and the things it says it won't. How do you think that this is playing out under the shadow of Iraq?
Well, it's not just that, it's what happened in Syria as well. I remember the vote in 2013 when Assad was using chemical weapons on his own people, but the government voted, not the government, the parliament voted against the government to provide support for the Syrian people, and so Assad survived for almost over another decade. And Iraq, absolutely right. Prior to that war, prior to the conflict, I said, no, this isn't justification to march in, partly because I didn't see a plan, I didn't see a strategy, and this idea that you can use military might. Didn't the Americans learn in Vietnam that isn't the way to do it? That you cannot bomb the regime into submission from up on high. There needs to be a political outcome that everybody is then satisfied. And that means working with the locals as to what the solution is.
Tobias, before we let you go, you mentioned the UK should be looking to put more assets into places like Cyprus. Doesn't this situation in Cyprus remind us of just how weak our military is? What is the gap? How concerned should we be about UK military ability to defend ourselves?
Oh, my goodness. I mean, this is just another big question that I'm afraid Britain has failed to address. We're in a peacetime mode in our military. Our Army, Air Force and Navy are just far too small. They're overstretched. And then there's the other domains of war, cyber and space, where we're completely vulnerable. And governments, I'm afraid, have been too slow in recognizing that our world is becoming more dangerous, not less, and not investing. There's something called the Defense Investment Plan. We had the Defense Review last year, pointed out to how open we are to attack, what we need to do, clear recommendations, and the government has sat on its response in this government investment plan. Helicopters, medium-sized helicopter, I'm sure you've discussed, is one example. In 1990, we had 50 frigates and destroyers. Today, we couldn't muster more than 6. We had 5 divisions in the Army. Today, we couldn't muster more than 1. We had 36 fast jet squadrons. Today, we only have 6. We are so vulnerable. We are not prepared for what's coming over the hill.
Tobias Elwood, on that note, former UK, Middle East and North Africa Minister. Thank you very much indeed for those views and for those insights.
Coming up on the programme, the Chancellor Rachel Reeves is set to deliver the UK spring economic forecast later today, just as we see UK 10-year bond yields climbing 10 basis points as the sell-off in government debt. That's not a UK story, that's global, but that's continuing. We'll get a preview of the spring statement. That's coming up next. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. We are 50 minutes into the Tuesday session. The European session is reminding us that the relative outperformance of European stocks year-to-date versus their US counterparts is being challenged by the conflict in the Middle East. So stocks down now across the benchmark 2.4%, some pretty heavy selling. Over 2 days, you're looking at stocks off by about 4% in terms of what we're seeing in Europe. You had seen some relative resilience when it comes to the US markets yesterday, particularly when it comes to the tech names. And today, that is being challenged. S&P E-minis currently pointed lower by 1.5%, and NASDAQ 100, with, of course, that exposure to tech, currently called lower by a little over 2%. It's not just the energy shock, of course, the equity markets are having to contend with, but also the supply chain squeeze as well as a result of the conflict in Iran.
Yeah, and repricing of inflation expectations and what that does to global interest rates certainly happening apace. We saw that overnight coming through from Australia, but here in Europe, we're also seeing plenty of it as well. We checked in on what was going on across the European bond space earlier, and they're all in the mix. But I'll focus here on the UK because we're going to be hearing from the UK Chancellor a little bit later on today. We're up by 10 basis points at the 10-year horizon and up by a little more than that, 12 basis points at the 2-year horizon. Now, the comfort might be that this is a global story. That's not to do with the UK, but maybe that comfort doesn't last too long. Rachel Reeves will deliver an update on the state of the UK economy later today, focusing on the government's economic plan for Britain with a deliberately stripped-back speech. The Chancellor is seeking to break Britain's recent pattern of fiscal statements that destabilise the market. So we're told she wants to have as little impact as possible, perhaps. Lizzie Burden joins us now from Westminster, regardless of the low impact intended by the Chancellor. Lizzie, what are we going to be hearing then from Rachel Reeves later on?
Well, this spring statement has been dubbed internally at the Treasury as the spring forecast. The Chancellor wants it to have so little market impact. But of course, it's overshadowed by the US-Iran war. And this is the first time that we'll be hearing the Chancellor's response to the economic implications of that war. We're expecting her to emphasise the need for fiscal stability, as we were anyway. As you say, it was expected to be a policy-light event. Now, of course, the market's on high alert for any lurch to the left from this Labour government, given that defeat in the Manchester by-election last week, but we're not expecting any big tax or spend measures, not on the defence spending hole that you were just discussing with Tobias Ellwood, not on how they're going to fix unemployment. All of the big tax and spend measures are expected to be punted to the autumn. We will get the updated growth forecasts from the Office for Budget Responsibility, expected to be sluggish for 2026 with higher unemployment, and we'll be able to calculate how much fiscal headroom the Chancellor has against her fiscal rules that, well, one of them is day-to-day spending should be covered by tax receipts by the end of the Parliament. Now, we know that that headroom was £9.9 billion, raised to £20 billion. The expectation among economists is that it stays at £20 billion, although Goldman analysts say it could go up to £25 billion. And we know from our colleague Tom Rees's reporting that she's had a windfall of £22 billion from stronger than expected cash tax receipts and lower than expected debt interest payments. So that should allow the Debt Management Office to slash gilt, the gilt remit, gilt sales, and that should give a boon to the gilt market with gilt yields falling lower.
Lizzie, thank you very much. Bloomberg UK correspondent Lizzie Burden with what we're expecting from the Chancellor later on today. And we'll bring you coverage of the Chancellor's spring statement from around midday UK time.
OK, let's turn back to the markets and bring in Bloomberg analyst Skylar Montgomery Coning right now. It's one of those days where you don't know where to turn in terms of some of the asset price moves. So we're seeing the dollar up about 50% on the Bloomberg, 0.5%. 50% would have been a move, wouldn't it? 0.5% move on the Bloomberg dollar index is nonetheless significant. We're seeing that sell-off, of course, in the sovereign debt. You're seeing that sell-off in gilts with yields up, and you're seeing pronounced sell-off in terms of what's happening across equities. What stands out to you? Where are we in this story, Skylar? How much is this tied to the gas price moves and the oil price moves?
I mean, that's the number one driver, right? If you look across markets, whether that be FX markets or equity markets, there's this clear divergence between those that will benefit more so from higher energy prices and those that will be punished by higher energy prices. And I think the point is, yes, we aren't at extreme levels in Brent, for example. We're at $80 a barrel versus on Russia-Ukraine, we were well above 100. But what matters for your economic situation is what the delta is. So what's the change? And if you look at Europe and the UK in particular, European natural gas prices up something like 30% from its one-year average. UK natural gas prices up 60%, and that has to have an economic consequence that'll feed into markets.
And this volatility is set to continue because we don't have a handle on how long this lasts, I suppose.
Yeah, I mean, that's exactly it, right? Your economic consequences depend on how much your energy prices rise and how long they stay elevated. And so the worry is really that it's a stagflationary shock, which is the worst environment for asset markets because equities and bonds both come under pressure. I think, too, the assessment from an equity perspective is what is the benefit to your energy producers from the fact that they have higher prices versus, the tax on consumption from stagflation, the fact that you have higher input costs, et cetera. And so we haven't fully priced the extent of those economic consequences, so there's more to feed through still.
Okay, Bloomberg's Scarlett Montgomery Koning, thank you very much indeed. With another pulse check there on the markets and some pretty pronounced moves across equities, across the bond space and in FX as well. The pound under pressure by about 0.8%, falling today.
Yeah, the dollar on the rise again. And I'm drawn to the extent of the losses we're seeing for European stocks today. So it's like yesterday, if not worse in some places. So the stock 600 down by 2.7%. You've got the Italian and the Spanish markets both down by 3.7%. So these losses are quite deep across European equity markets, and US futures also pointing lower. So we'll leave you with that as we head towards the pulse. That is it for the opening trade. Have a good day, everybody. We'll see you on the other side of the pulse. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East allies call on the U.S. to end the conflict in Iran quickly. President Trump says it will go on for as long as it takes. Iran strikes back, targeting energy infrastructure. Saudi Arabia halts operations at its largest oil refinery after a drone strike nearby. And Brent crude tops $80 a barrel, and European gas spikes again after Qatar closes the world's largest LNG export facility. So there is a lot going on. If you look at stocks and bonds, they're also tumbling. Again, the war is fueling inflation fears. So stocks and bonds falling, extending losses, heightening fears of a lengthy disruption to any large energy markets, and therefore a possible surge in inflation. The yield on the UK's 10-year gilt, but also the 10-year Treasury rate climbing, with the dollar remaining the haven of choice, gaining from 0.5%. We also have the spring statement from the Chancellor. Of course, in the UK, you can see that 10-year gilt at 4.471. European markets, again, extending a lot of of their losses. We did have these conflicting messages from the Trump administration over how long the war may last, not only pushing at yields higher, but there is a little bit more pressure on stocks overall. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the conflict in the Middle East is widening. The U.S. and Israeli forces continuing to bomb Iran, and Tehran responding with missiles fired towards Israel, Saudi Arabia, Qatar, Kuwait, and the UAE. Now, energy infrastructure has been targeted, forcing Qatar to halt production at the world's largest LNG export facility. The pressure is growing on the U.S. to keep the conflict short. The U.S. Defense Secretary has said it will not be an endless war. But when President Trump was asked for how long it will take, he replied, whatever it takes. The U.S. Secretary of State has indicated that the war is only just getting started.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Bloomberg's Jumana Bersetchi joins us now from Dubai. Jumana, so what does whatever it takes look like?
Borrowing from that eponymous phrase of Mario Draghi, indeed, that is the exact language that President Trump used yesterday when he was describing how long the war would go on for. And he said whatever it takes. From the very beginning, they anticipated it could take as long as 4 or 5 weeks. So really suggesting that this isn't going to be wrapped up in a matter of days, but actually could take weeks. And you just heard their comments from the Secretary of State, Marco Rubio, suggesting that if anything, the operations are going to intensify in coming days. We know from the Central Command Unit that over the course of the first 48 hours of the war, over 1,100 targets were struck within Iran. They're going after military infrastructure, nuclear infrastructure as well, with the usage of some of those stealth bombers to access some of those material or sites that are embedded deeply into mountains. And then continue to target some key command centers as well. Only this morning, CENTCOM announcing that they had taken out a command unit for the Revolutionary Guard. At the same time, the U.S. continues to call on the Iranian public to rise up as well. There are no signs of that happening on the ground, Francine. But again, to go back to what we were saying and what we've been reporting in the last 24 hours, what we have seen is a real expansion of this conflict, of this war. There are now 12 countries involved. And Iran took it one step further yesterday by specifically targeting energy infrastructure for many of these Gulf states.
So, Jumana, the State Department has ordered all U.S. citizens to leave the Middle East. What do we read into that?
Yeah, well, this is just another sign that they are expecting operations to intensify and, if anything, not calm down or not de-escalate in the coming days. That notice came through from the State Department urging all American citizens, residents of a huge number of Middle Eastern countries, pretty much all of them, to leave the region. And of course, that becomes very difficult and challenging in an environment where key airports in the region continue to be non-operational. The airspace is still closed. It's estimated that as many as 4,000 flights a day have not been operated or been canceled. And many of these airlines are running with very, very low, with a low capacity of something like 5% for just key essential flights here. So it is very difficult for these residents and citizens to leave, but all the signals point to the fact that the war, at least for the time being, will not be de-escalated in the coming days.
Jumana, thanks so much. Jumana Bersetchi there with the very latest from the Middle East. Now, let's bring in our panel. With me here, Bloomberg opinion columnist Mark Champion, Themos Fitakis, Global Head of FX Strategy and EM Macro Strategy at Barclays. And joining us from Dubai is Anthony DePaula, Bloomberg's Middle East Energy Markets reporter. So thank you all for joining us. Anthony, let's start off with you. It's very clear that global energy markets have been upended by this war. Is the biggest fear that the Strait of Hormuz really gets closed and so oil tankers can't go? Or is it that Iran seems to be targeting by proxy also energy infrastructure around the Gulf?
Yeah, good morning, Francine. For the moment, clearly the issue is Hormuz, and it's effectively closed because ships are really not transiting there. We've seen vessels getting blocked up inside the Gulf, not able to leave, and then other ones waiting outside of Hormuz around the UAE port of Fujairah and other areas trying to come in. Plus, we've seen a couple vessels that have been hit around those waiting areas. So that's another concern for shippers. So shippers are really avoiding that area. That creates a knock-on effect inside the Persian Gulf at a lot of these refineries and oil production facilities, is that when the ships aren't coming in, there's no one to pick up the crude oil that needs to be exported or the products. So it can't get out and it can't get to the customers, and then it's building up in the facilities there. So that takes away, of course, the concern is around the facilities, whether those get hit and get damaged, because when things do open up, those won't be able to come straight back into the market and begin resupplying the market, Francine.
And Mark, what exactly is the strategy of Iran right now? So first of all, the force is kind of unmatched to what we've seen in previous conflicts. Is it to try and get the Gulf states to put pressure on Donald Trump to finish the war quickly, or is it really spreading chaos across energy markets?
Well, I think it's going to be both those things. The Iranians are fully aware that the question is time. They have a certain number of missiles and launchers that they can use, and every time they take a launcher out to fire a missile, it's at risk. They're being degraded, so they don't know how long that will work. This kind of adding to that is the fact that the first time around last summer, when they had this a previous Israeli-U.S. attack to deal with, the Iranians fired in large volleys their most sophisticated missiles and so on right at the beginning, and then quickly realized that they had wasted a lot. Most of that got shot down. I mean, it was only later in the 12 days that they started to get through because they had saturated defenses. So this time around, they're conserving their more capable missiles, using a lot of drones and older rockets. So it's a question of time, and they don't know how much time they have. The Americans don't know how much time they have. So what they're trying to do is pressure the Americans via the Gulf states, through energy markets. The Trump's fear that oil prices might rise in the U.S. U.S. will actually probably be less sensitive to that because of its own shale production. But in Europe and so on, they want the rest of the world to start putting pressure on Trump.
But what do we know about the weapons? It's very difficult to know how much Iran has. And again, the defense systems of some of the Gulf states were, maybe not overwhelmed, but there are drones that went through.
Oh, absolutely, but they have sort of some difficult choices to make as well. So they have Patriot missiles and so on. These are extremely expensive and quite scarce. And if you know that what's being sent at you is drones, and that later on you will get more ballistic missiles because that's what's being conserved, then you really don't want to use your Patriots, because Patriots can bring down ballistic missiles. A lot of things can bring down drones. So you may just have to let drones through.
Themos, is the market behaving the way it should, given the severity of this, or is it still underpricing certain risks?
I mean, if we keep the Straits of Hormuz closed or shut for a couple of weeks, I don't think we're priced yet, either in terms of commodity prices or in terms of the implication of higher commodity price across bonds and equity markets on this front, basically.
But, I mean, the Strait of Hormuz, and again, there's almost a self-imposed moratorium, is that a lot of ships just won't go that way.
Yeah, I mean, at the end of the day, that's that. But there's a sense that there's risk going through that. So, yeah. And it is also not an endless conflict in that sense. So there's pressure from the Chinese for that passage to become safe again. So it's not an endless. That's probably why the market is not going all the way as far as to price 3 or 4 weeks of a blocked passage from there. But if that risk materializes, we're not priced fully for that.
Anthony, I mean, you look at oil, it's up. European gas was up 34% because of this Qatar LNG shutdown. Is Europe actually the region that has the most to lose in this?
Yeah, well, Europe really depends on LNG imports. They depend a lot on the U.S. imports, and there are Qatari exports going to Europe. But when those exports get shut off, that's going to bring up the prices all over the place, because a lot of those cargoes that do go to Asia, those Asian buyers there are going to draw on some of the U.S. cargoes and trying to get those. So it's going to bring up those prices all over the place. And we did see that major price reaction on European gas because we did see that capacity, the LNG capacity, actually taken offline. So far on the oil front, we haven't seen that spike as high as some people have thought, because we haven't seen the real interruption or damage to capacity. So traders still have that kind of wait-and-see attitude. Are we going to see the Hormuz open up a little bit? And if we do quickly, then we've still got the capacity. So on oil, they're still waiting a little bit to see actual impacts on capacity and production, whereas on gas, we've seen that impact. We've seen the impact of what the shutoff of really one of the top 3 producers in the world has done. So that's really put markets into turmoil, Francine.
And Demos, I mean, because there's no war, no end in sight of this war, you really see expectations of inflation going up. Is that, again, through the right lens? Because, a war could, I don't know whether we're talking about a couple of months, a couple of years, or how you view that and the impact it has on inflation, and therefore, what central bank reaction function?
I think the markets are, particularly the bond markets, are focused on inflation here now. I'm not sure that this is the most pressing angle. We have been through bigger terms of trade, bigger price shocks. We've had tariff shocks. We have had natural gas prices go to 300. There has been, the economies have seen through these shocks in a bigger way. But there are 2 main angles here that I think the market is trying to also oscillate around. The first one is, don't forget, we entered this situation, the market selling U.S. assets and buying European assets, diversifying away. Now, it is reminded of the big vulnerabilities that the European continent has in terms of reliance to energy from the most dangerous locations on the planet. The other angle here is that obviously when that resolves, when the situation resolves, we could be also in a better place. So the market is trying to oscillate between what they want to buy for a resolution and where they want to get insurance for an energy shock hitting the hardest.
Mark, is there an off-ramp for the U.S.?
That's going to be tough. So there was this very interesting exchange, over yesterday, the day before, where President Trump said, well, the Iranians already reached out to us to talk. It was supposedly Larijani, the head of the National Security Council in Iran, who is emerging as, for now, the most important leader in Iran. And he said, we are not talking to the Americans. He has to say that. I mean, if you look at the history of what happened and led to this war, multiple times when they got into talks with the Americans struck when they were supposed to go and negotiate. Of course, also the JCPOA, which the Americans collapsed, in 2018. So, he has to say this. He represents the hardline regime. The Iranians know that they're in a difficult position. Right. They need an exit. Someone is going to have to take the lead, and I suspect the way that this will ultimately work, if there is an off-ramp, it'll be via Oman and the Gulf states, all of which have a strong interest in ending this war, and they will put pressure. The Gulf states have very strong channels to Washington. They weren't able to stop the war. They tried. But I can imagine that opening up again.
I mean, it's difficult if you're living in Iran right now. So we have very little visibility of what's happening on the ground. Is there, there was an urgence from the U.S. administration for an uprising. Again, unclear how that happens because the royal guards are still, armed and have all the weapons. So is there anything that we should be thinking about a plan after? Is it when Donald Trump says whatever it takes, is it at all costs getting rid of this regime?
This is the difficult part, right? If you have if you think through the logic of this campaign militarily, how it should work out, it should be, 4 to 6 weeks of intense bombing to destroy. They've already achieved air superiority. That was number one. Then they need to, destroy all the kind of, the missile, the means of response that Iran has. Then they can move on to, just flying drones all over the country and, you know, taking out Basij or IRGC as they build barricades and so on, and show to Iranians that you can, if you come out, we will be your Air Force. That is a long process, and it involves a lot of question marks. And that, I think, is why you see this kind of utter confusion from Rubio, et cetera, as to why we're there and what we're trying to achieve. You have, you know, Hegseth and Trump saying, you know, well, we're not ruling out boots on the ground. There is no way that the U.S. is putting boots on the ground. But they need to say this stuff to, you know, to show that they have escalation dominance all the way.
And Anthony, on China, I mean, China buys so much of this Iranian crude. They kind of weighed in saying, you know, they've urged all sides to ensure the safe passage of ships through Hormuz. Is there anything else that China can do to put pressure on either side?
I mean, pretty much everyone in the Gulf depends on China as their main buyer, and China really has a stake there that the oil continues flowing. They had discussed with Saudis issues around Bab el-Mandeb before. They're discussing with the Iranians, as we understand, around Hormuz right now. The only thing they can really do is probably keep that pressure there. But again, this is a key transit route for them, not only for the oil, but also, as we said, the LNG. And it will be important for them that infrastructure remains working, remains functional, so that once this war is finished, those exports are continuing to flow and able to flow to them. The Chinese have a huge strategic reserve that they've been building up over the past several years, and that's been helping prop up some of the oil prices, even as we've seen excess production in the market. So they should be good for some reserves, but they really want that waterway open and continuing to flow. Francine.
All right, thank you all for a terrific briefing. Bloomberg opinion columnist Mark Champion, Anthony DePaola, our Middle East energy markets reporter, and Themos Fiotakis, global head of FX strategy and EM macro strategy at Barclays. Coming up, the UK Chancellor seeks to keep her spring statement a low-key affair. We'll look ahead to her update on the state of the UK economy. That's next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Rachel Reeves will deliver an update on the state of the UK economy later today, focusing on the government's economic plan for Britain. Well, Bloomberg's Lizzie Burden joins us from Westminster. Lizzie, what, if anything, is Reeves expected to announce?
Well, Francine, this is the first chance the Chancellor will have to respond to the economic implications of the US-Iran war, as you've been discussing, the impact on energy markets. And already we've seen traders paring bets on Bank of England rate cuts, so they only see 1 quarter-point cut this year. So the Chancellor is expected to frame this as underscoring the need for fiscal stability, but we were already expecting it to be a policy light affair. There's a huge spotlight on whether the Labour Party is going to lurch to the left after that by-election defeat in Manchester last week, but we're not expecting her to make any major announcements on tax and spend when it comes, for example, to defence spending or how to fix unemployment. She's expected to punt all of that to the autumn. Now, we are going to get the latest growth forecasts from the Office for Budget Responsibility. We'll be able to calculate how much headroom she has against her fiscal rules. It was £9.9 billion. It went up to £20 billion. It's expected to stay there. And our colleagues report that she's had a £22 billion windfall from stronger than expected cash tax receipts and lower debt interest payments. That should help the Debt Management Office to slash gilt sales, gilt issuance, I should say, to the lowest in 3 years, and that should be good for gilt yields.
Lizzie, thanks so much. Lizzie Burden there outside, Abingdon Green in Westminster now. For more, we're joined by Ruth Curtis, Chief Executive of the Resolution Foundation. Thank you for joining us, as always.
Thanks for having me.
We started off by saying the Chancellor wanted a low-key affair. This is certainly what she got, but it doesn't make the economy any better.
No, and what we'll get today are these forecasts from the Office for Budget Responsibility, which won't take account of everything that's happening in the Middle East. And so, unfortunately, will look quite out of date already. I think the Chancellor was probably hoping to deliver a positive message today. Inflation coming in lower than expected, government focused on the cost of living. But, of course, these changes in gas and oil prices blow a hole right through that.
Households are cautious. If you look at the labour market, it's okay, but it's not great. What do you worry about the most?
Yeah, I worry about the labour market a lot. So unemployment has come in higher than the OBR expected just in November, and we've seen youth unemployment rise to higher than the European average. I think it's good for the Chancellor not to be making huge tax and spending announcements, but there are some issues in the economy where arguably today is a missed opportunity.
If you were the Chancellor, what would you do actually and again, I've heard everything like, look, it just needs to be more radical. People need to feel a little bit better about everything that's going on. Otherwise, this growth will remain lackluster.
Yeah, so I think certainly when we talk to businesses, we've heard that it is good that this has not been an event with loads of speculation, that there are some signs of kind of a revival of confidence that this might support. But on things like unemployment, she's got a youth jobs guarantee, but a young person has to be unemployed for 18 months to qualify for that. She could reduce that to 6 months today, but I don't think she will.
Ruth, this is not a government that's strong by any means or stretch of the imagination. Does that impact policy?
Well, I think what it certainly impacts is policy uncertainty. So this Parliament has been actually the highest of any of the last 7 for policy uncertainty. And when you think about everything that's happened over the last decades, that's quite extraordinary. So the Chancellor's delivering a low-key event. She wants to persuade people that that's because tax and spending plans are stable. But obviously with political turmoil, that's hard for her to guarantee.
Can she do? There's only so much, given the fiscal constraint. There's only so much actually she can play around with.
Yeah, and we're expecting headroom to come in broadly the same as the 22 billion she had in the autumn. That was a big rise on what she had before, but it's about the average move that you see in forecasts of this kind. So it's not at all money to burn.
Is there one thing that would change the fortune? It's not only one thing, but I don't know if it's positive news on the labour market or how the UK deals with AI that could also change the psychology of households.
Yeah, and that fundamental kind of, will the UK get out of the productivity slump that it's been in, not just since the financial crisis, but barely growing since COVID. AI looks like something that could shift the dial on that. But in the short term, we've got consumers and businesses holding back. And what can the Chancellor do today to kind of really boost people's confidence that her plans are stable, things aren't going to change, and they can start to invest?
Would it be too soon for her? I'm not talking about reversal, but change to some of the things that she's announced to maybe support some of the smaller businesses more.
I mean, I think we've had a lot of chop and change, haven't we? So I actually have some sympathy for her trying to keep things on an even keel, and I think business too will appreciate in the end that. But there are definitely things that I would change. So on youth minimum wage rates, for example, those are currently due to kind of accelerate towards the rate for adult rates. When youth unemployment is rising, I don't think that's the right thing to do.
I mean, we've been covering extensively, of course, the Middle East and all of the uncertainty in geopolitics.
Yeah.
Does it mean that CEOs and households actually hold back because there's so much, concerning news out there?
Yeah, I mean, I think one of the reasons we've seen this lack of consumer confidence is because when you have an inflation shock, it has this scarring effect on consumers, on their attitude to spending. And if they're about to be proved right, if we're about to have another shock to energy prices that really hits household bills, then that will only introduce more caution.
The rates markets now don't really expect a second cut from the Bank of England. Would that make a material difference to, again, the fortunes of the UK?
Yeah, I think exactly. The Chancellor was hoping that today she'd be on that path where inflation is returning to target. The bank were telling us to expect that in April, where interest rate cuts were coming, and we could start to, the bank could start even to, play a role in boosting that confidence in reducing unemployment. But a shock of this kind will absolutely limit their ability to do that.
Ruth, thank you so much for joining us. Ruth Curtis there, Chief Executive of the Resolution Fund. Now we'll have special coverage of the Chancellor's spring statement from around midday UK time, and coming up, more analysis on the US-Iran conflict. We'll also be joined by a former German ambassador to the US and the chair of the Munich Security Conference. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. When I started to realize what was happening, it was 12 years, and we haven't done it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Middle East allies call on the U.S. to end the conflict in Iran quickly. President Trump says it will go on for as long as it takes. Iran strikes back, targeting energy infrastructure. Saudi Arabia halts operations at its largest oil refinery after a drone strike nearby. Brent crude tops $80 a barrel, and European gas spikes again after Qatar closes the world's largest LNG export facility. So France is also planning a boost to its nuclear arsenal in a major realignment of Europe's defense structure. President Emmanuel Macron says Europe needs to take more responsibility for its own security.
I have ordered an increase in the number of nuclear warheads in our arsenal. And to prevent speculation, we will no longer disclose any figures about our nuclear arsenal, unlike what we may have done in the past. Those who would dare to attack France know the unbearable price they would have to pay.
Well, joining us now from Berlin is Wolfgang Ischinger, former German ambassador to the United States, also chairman, of course, at the Munich Security Conference. Professor Ischinger, thank you so much for joining us. I mean, no one was really expecting, as we left the Munich Security Conference, to have such a huge war that seems to be spreading. First of all, is now the time for Europe really to think about, to have a nuclear deterrent? Because there are voices, especially in German, that are not fully aligned. And if not now, getting together, when?
Well, I think that Emmanuel Macron's offer to start talking about strengthening the European component of nuclear deterrence is a good idea. It's a timely idea. Actually, it's an overdue idea. In 2020, he raised it in my presence at the Munich Security Conference. That's 6 years ago. And I think we should have started talking about what could happen, how could Europe strengthen its own contribution to nuclear deterrence provided so far primarily or almost exclusively by the United States with respect to the European allies. So I think this is a good idea. It's very important that everything that we're going to be doing, discussing with our French partners, is going to be done in total transparency with the United States. We don't want to lose the solid support and coordination with the United States, which has provided extended nuclear deterrence now for half a century.
But, Professor, I mean, what's the way forward, first of all, in the Middle East right now? So we'll get on to Europe in a second. But when President Trump says, look, it'll take whatever it takes, what does that mean? How much further can this escalate, and how many countries will be drawn into this war?
Well, first of all, I think there is, of course, the good news. I hope the possible good news is that the Iranian people are being offered a chance, an opportunity to free themselves from a regime which has been really quite terribly murderous, especially in recent time. The not so good news is that many of us here in Europe are not sure that there is a good enough plan how to make sure that this is not going to end, as you just said, in an extended kind of warfare, in extended bombing campaigns. Let me put it this way. The goal of this operation should be to tell the Iranian people, we are with you. And our military campaign is not directed at you or against you. It's directed against these murderous leaders, and only against them. In other words, you are our friends, and we want to work with you. I hope that message can be made, and I hope that message can come across in a credible manner to the 90 million or so Iranians who are waiting for their freedom after half a century of religious repression.
But Ambassador, it doesn't seem that it's going this way, right? This has an end, but it's unclear what the U.S. is thinking. I mean, if there's a change in leadership, I mean, these, are leaders that have been at the top for a long time with still the royal guards that are armed. So what's the plan for the next day? And what role can Europe, if anything, or China play in trying to see a next day and exactly how everyone can help the people of Iran?
Well, let me offer one critical remark. I think it is not, the best approach, the one selected, the one chosen by the Trump administration, along with the Israelis, to start this on their own. I think it would have been a good idea to discuss this beforehand with European allies, with others in the region, including Turkey and others. The concern that this may lead to an extended military campaign over many weeks, maybe months, and that the end result may not be, as President Trump put it, a peaceful rearrangement in the entire Middle East. That concern is widespread, not only in the region, but also here in Europe. So all we can do at this moment is hope that at least some of the revolutionary guards, some of the military leaders in Iran may actually decide not to shoot at their own population, at their own citizens anymore, and may try to support the creation of a more moderate, more Western-oriented, less religiously conservative future leadership.
Ambassador, China's critical in all of this, and you had, some from the very top of the Chinese leadership speak at the Munich Security Conference. What do you think their role in this is? So far, they've just urged all sides to be careful in the Strait of Hormuz. Can they play a bigger role diplomatically?
Well, I have not had a chance to talk to my Chinese friends, especially not to Foreign Minister Wang Yi. But what I assume is that they're deeply concerned about what's been going on. Look, the takeover of Venezuela, if one wants to call it that, and the intended changes in Iran could mean, at least from a Chinese perspective, that in the future, America is going to have a say in to whom is Venezuela going to sell oil, and to whom is Iran going to sell oil. And in both cases, China has been the major buyer of huge quantities of oil. In other words, from a Chinese perspective, this is not only a question of what happens to Iran, this is a question of the U.S.-Chinese relationship with the possible outcome of enormously increased U.S. leverage over Chinese energy imports. That is probably for the Chinese a worrisome possible development.
Yeah, Ambassador, I wonder whether there's also a read across to what Vladimir Putin's thinking, seeing everything unfolding in the Middle East, and whether that makes him more resolved to get Ukraine, or whether that scares him off a bit. I don't know. If everything is linked, what kind of impact could this have on the Ukraine war?
Well, look, if the Trump administration were to show the same determination to offer, military threats, if diplomatic solutions are not forthcoming, then maybe a solution to the Ukraine conflict could be imagined within the next few months. I have not yet seen that kind of U.S. pressure against the Russian Federation, but from a Russian point of view, of course, Russia has had to abandon, was actually forced to lose a number of classic Russian allies: Syria, Venezuela, now possibly Iran. Remember, Iran is the major supplier of a certain type of widely used Russian drones in the war against Ukraine. In other words, as a secondary effect of this current military operation by the United States in Iran, Russia could be significantly weakened in their capability to conduct this drone warfare supplied by Iranian Shahed drones.
Ambassador, just a final question on, the Chancellor Merz will be in D.C. speaking to Donald Trump. What do you think he'll ask him? What should he ask him, maybe even behind closed doors?
Well, I think that the main question for Europe is the United States, is the Trump administration going to continue, as has been U.S. policy for the last 7 decades, to continue the evolution of a united Europe? Or is the Trump administration trying to pull the European Union apart, looking for nations that are willing to support a kind of a MAGA approach to international affairs? I would hope very much that the outcome of this German visit to the United States would be a repetition, a reaffirmation of a close partnership between the United States and the European Union as a historic project trying to prevent quarrels and even wars between the European partners of the United States. I think that would be a historic achievement.
Thank you so much for your time. That's Wolfgang Ischinger, the chair of the Munich Security Conference, and of course, former German ambassador to the United States. Now, the conflict in the Middle East has thrown up a lot of uncertainty. So how do chief executives navigate the business climate? Well, Michael Sen, the chief executive of the German healthcare company Fresenius, is with us now. Mr. Sen, thank you for joining us, and thank you also for being in London. When you look at geopolitics, I mean, Europe relies a lot on China for certain, ingredients that they're needed in the drug development. Does geopolitics throw everything up in the air? How exposed are you, for example, to energy prices or also just the Middle East in general?
Yeah, good morning, Francine, and great to be on your show. Look, your question already at the very beginning is hitting the decisive point. The dependency in the pharmaceutical industry, especially when it comes to active pharmaceutical ingredients and even materials which go in before, there is a high dependency. I just call it vulnerability in terms of being dependent from China and India, but particularly in China. So geopolitics today have to have a vital role in the boardroom.
Yeah.
Actually, our company is now well positioned to navigate this new geopolitical evolution of a new world order, because what you see is that it's highly transactional based. National interests are put at the priority. And when I look at the state of play between the US, Europe, and China, I see different speeds. In the US, you see healthcare and the access to essential medicine is top of priority, and not only a matter of public health, but national security.
But if Europe were to do the same, right? We put healthcare, at the top of security and sovereignty. What does that look like? Is it more subsidies? Is it stockpiling? What does that mean in terms of national strategy? What should it mean?
You see different approaches, and this fits with our strategy as a business entity, where we have been doubling down on a local-to-local strategy when it comes to local manufacturing and even building up an entire supply chain. So in the U.S., you see it's moving away only from public health, but it has a vital role in the national interest, in the national security strategy, and that's why it is accompanied by industrial policy. And that is also with the international trade policies. That's why you see we are a #1 player in IV generics, that the generics are exempted from the tariffs in the U.S. because you have a systemic drug shortage, and they want to ensure, actually restore an entire manufacturing base in the U.S., whilst Europe, I would say, has the headline with the Critical Medicine Act. They got to tighten their belt on actions, and also China is very much banking on what it can do in national interest.
But Michael said, I mean, given everything that's going on, again, with the Strait of Hormuz, energy prices going up, I think, gas prices in Europe was up 34%. What's the most complicated thing that you'll have to deal with in the next 6 months? Do prices go up from here?
Yeah, well, if I look at our company, our direct exposure in the region, I got to say the well-being and safety of our people in the region and the continuity of patient care is top priority, but the direct business exposure is limited. It depends on the scale, scope, and duration of the conflict. Yes, of course, especially in Europe, dependent on LNG, prices have been spiking. We have been pretty much hedged for the remainder of the year, but we need to see what are secondary effects if it is lasting. But again, the bigger picture of geopolitics means that we're doubling down of building up the supply chain in the U.S. We already manufacture 70% of what we cater in the U.S. for the U.S. And last week we announced a partnership with Flow Corp to have a fully vertically integrated supply chain on a drug which is very essential.
Is it difficult to move things from, because of potential closures in Hormuz and otherwise?
No, currently for us, it is not, because after COVID, we have learned that we took different routes. This is less so on the ingredient part, but more, let's say, for the medical technology business on power electronics. So we go around South Africa, if you so wish, and took precautionary action.
Okay, so interesting. Michael Sen, thank you so much for joining us today. That was Michael Sen, the Chief Executive of Fresenius. Now, coming up, Blackstone, the latest firm to be hit by withdrawal requests from its flagship private credit fund. We'll have more on the debate around risk for private markets. That's next, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, our relations with China. And that could have an effect, but it may not. So these things may diminish over time.
Well, Jamie Dimon there, the JP Morgan chief executive, speaking to Lisa Abramovitz of Bloomberg. Now, Blackstone's flagship private credit fund has been hit by record redemptions in the latest sign of unease in the industry. Now, the company is allowing investors to redeem almost 8% of shares, equivalent to $3.8 billion. Now, private credit funds have seen a rise in redemption requests recently, but of concern over their exposure to software companies at risk of disruption by AI. Now, to talk about this, but much more as well, we're joined by Elizabeth Weymouth, Elizabeth, founder and managing partner of the investment firm Graphene Partners. Elizabeth, thank you for joining us. I mean, there's just a lot going on in terms of private markets. Private equity returns have also been a little bit underwhelming since interest rates rose. Are we going to see just much more managers start new ventures because they can't quite achieve the carry they expected if they stay?
Well, it's great to see you, Francine. Thank you for having me today. Yes, there's a lot going on in the private markets, that's for sure. With respect to big strategies getting bigger, I think we're seeing that in private credit. That is what we focus on actually within private equity, sort of the antidote to that trend. But as these strategies grow, in private credit's case, going from a niche strategy now to a critical part of the capital stack, there will be issues. And it's also the structure that one has to pay attention to when we have the private credit securities, so as you're seeing with Blackstone, et cetera. But our whole thesis at Graphene is that the industries are maturing in the alternative asset management business. So private equity in particular, where we're focused, the big firms have gotten bigger. And as they get bigger, the size can become the enemy of returns in some cases. In the U.S. in particular, the top 10 firms over the last 10 years have generated a return of a 1.3x multiple of invested capital and a 14% IRR, which is fine, but it's probably lower than what one was expecting when they were looking for alpha.
Are more investment managers coming to you looking for funding?
Well, so what we looked at is this backdrop of returns contracting and said, actually, we're all here for alpha. So how might we find this unique off-market, high-quality deal flow? And the trend that we're leaning into is exactly as you're referencing. The firms are mature enough such that people are spinning out of them. And when these entrepreneurs now spin out to create brand new private equity strategies, usually sector-specific, very focused strategies, they have 15 years of senior deal experience under their belt. So for us, we can look at someone who has that kind of experience with a track record we can verify and get behind them. Because the issue they have when they're spinning out these days, you'll see the fundraising market is terrible for anything that's not in the mega fund category. So they need capital, significant capital, to exercise and complete the deals in their pipeline. And they need business building expertise. So that's another strategy. So we do that, put them in business, de-risk the startup, and get this deal flow, which is really targeting a 3x multiple invested capital or better. So sort of a pure alpha strategy in private equity.
Elizabeth, but when you look at the sectors,
yes,
are there any sectors that you're keen on that maybe are a little bit unloved, and which are the ones that you're avoiding at the moment?
It's a really important question. We have focused on the individual first and foremost, so the track record of it's almost a venture strategy, and you're finding a founder and getting behind the founder. But the sectors that we end up liking are those. Most recently, we've backed 2 different teams, both of them in the industrial space. So one could argue those are boring businesses. We don't think they're boring at all. But infrastructure services, environmental services, waste management, really core cash flow oriented businesses that aren't as impacted by technology, as an example. But that's what we've been focusing on most recently.
How do you see the software concerns playing out in the longer term?
It's interesting. We did, as this was all going down, we looked into every single portfolio company that we have, and we have about 32 portfolio companies. I'm happy to say not one was impacted by the rather large macro event of what was happening in the software sector. Because these are early businesses, we target enterprise value of around 50 million to 500 million. And they're really businesses that are usually family-owned businesses that are handing over their companies to institutional capital for the first time. So technology as a tool to maximize value is absolutely employed, but it's not necessarily a software orientation.
I mean, do you expect it's a funny market, isn't it? Because it kind of goes after, there's not necessarily much news. Maybe there's a report where there was a big sell-off, but I don't know what the read across is. Is it markets that are on tenterhooks? Is that we haven't quite figured out what happens with AI?
I think that's very fair. I think investors are on tenterhooks at this moment, and sort of the slight movement can cause a big reaction. But I think that when you have those dislocations in a market, like we've seen with respect to software, not every company is bad, and not every company isn't going to survive into the future. So this does create opportunities. You find that the dislocations create opportunities for alpha. So if you can just identify the right companies in the right place, you should stand to do well.
I mean, how do you look at the Middle East? I mean, again, there's a lot of concern about inflation, about this escalating, about what this does to energy infrastructure and prices.
Yes.
Is it too soon to say the impact on some of the companies?
I think, first of all, it's a significant issue. Geopolitics, as Jamie Dimon says, is unbelievably important, obviously, and for every single investment that we make, the investment case has the risks that you must consider, and geopolitics is one of them. When we think about what's happening today, I think it's a little too early to say what exactly the issue will be and where we need to hedge or be careful. But you can say on a broad level that it's probably the supply chain risk one should look into, and also energy security and energy prices and the impact that those will have on the companies themselves. But in private equity and what we do in particular, it's a very long-term investment game. So this could be one of those dislocations that I just talked about, that provides an opportunity for us to get some companies as an interesting entry point.
Elizabeth, thank you so much for joining us. I hope it's the first of many interviews to come.
Lovely to see you.
Weymouth there, founder and managing partner at Graphene Partners. Now, just an update. The Israeli military says they have struck Iran's leadership compound in Tehran, including Iran's presidential office and national security office. So this just coming in the last couple of minutes on Bloomberg, a reminder that this is impacting stocks and bonds across the world. Again, bonds are tumbling. The rate, for example, on the 10-year UK gilt was surging, the 10-year Treasury yield climbing as money markets pricing out a rate cut, while the dollar remaining the haven of choice is rising a touch. Again, comments from the White House suggest that a will to make the conflict more durable, forcing markets to digest the lasting consequences for inflation, energy prices, but also equity market performance, with quite a lot of question marks. A reminder also that Bloomberg Invest is taking place in New York over the next 2 days. Guests joining open interest from 2 p.m. London time include the chief executives of Apollo, of Ares, plus Mistral AI's chief revenue officer and the Fed's Neil Kashkari. Up next, Bloomberg Brief, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Good morning, this is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's 5 a.m. in New York, 10 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stock futures and treasuries extending major losses now. Oil and gas surging as the Iran war enters its fourth day. No ending in sight. The U.S. and Israeli militaries continue to bombard Iran's capital as the U.S. sends mixed signals on the timeline for the war. And we'll speak this half hour with Yair Lapid, leader of the opposition in Israel. So let's take a look at those markets then, because we are seeing a significant deterioration in futures. And as you can see, all of the futures across the board are down more than 1%. In fact, we're at session lows now for the Nasdaq 100. European stock futures also pointed lower, and it was a down session in Asia as well. But just a few minutes ago, the president put out on Truth Social a pretty long post, including the words, "Wars can be fought forever and very successfully," using just these supplies, referring to U.S. supplies, which are better than other countries' finest arms. That's not helping sentiment. Neither is the command from the State Department urging Americans to leave the region, which came out a few hours ago after drone attacks on the U.S. Embassy in Saudi Arabia. Let's take a look at treasuries, because we're seeing the same impetus there. Inflation fear is just roiling the treasury market, and oil is the problem. As you can see, oil is surging today. We have Brent crude once again around $80 a barrel, and WTI at $74.90. In fact, Brent crude has taken out that level now. European gas futures as well, up another 30% today. All right, let's get to some individual movers now. For some stocks to watch, here's Abir Abu Omar.
Good morning, Vonnie. General risk-off sentiment across global markets this morning on the back of the tensions in the Middle East. When we look at the picture in the U.S. pre-trade session, we're seeing NVIDIA down quite a bit, 3.4% almost. And that is on the back of these, the Trump administration essentially considering chip caps to China. So they're trying to limit down these H200 chips sales to China by 75,000 chip per company. So the stock is not doing well on that information, and possibly due to some of the supply shocks that we might see again as a result of the tensions in the Middle East. Moving on to possibly the one sector that is doing well across the globe, and that is the oil sector. You just mentioned Brent sitting comfortably below $82 a barrel. So you're seeing this company, Battalion Oil, which is a small oil company, but doing incredibly well this morning. And that's perhaps a reflection of the wider sector and what the disruptions in the Middle East could lead to when it comes to Brent hitting closer to 100 possibly. So you're seeing Battalion doing very well on the back of that. But then finally, MongoDB. This is a software company, and it really doesn't matter what happens in the world. Software companies are just not doing well this year. The stock is down on a weak earnings forecast for the year, 27.7% down this morning. But the software image does not look favorable to investors overall. Vonnie, back to you.
Abir, thank you so much. Abir Abu Omar will be back later in the hour. Also coming up in this hour, Nadia Martin-Wigan of Spelland Capital, and we'll speak to Julie Norman of Chatham House. Our top story, the Iran war, showing no signs of coming even close to an end.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Let's get to our team coverage now with Shimana Bersecci, anchor of Bloomberg Horizons Middle East and Africa in Dubai, Mika Solner of Bloomberg Government in Washington, and Bloomberg Markets reporter Skylar Montgomery-Koning here in studio. Shimana, the latest from Dubai, it seems like anything that we thought might be leveling off in yesterday's session really isn't, and we're seeing a lot more strikes today.
Well, I would say the intensity and frequency of the strikes has actually subsided in the last 24 hours, but the targets have become a lot more notable. And we just, this morning, we woke up to reports that the U.S. Embassy in Saudi Arabia, in Riyadh, had been hit by drones. They were intercepted and caused limited damage, but of course notable that the U.S. Embassy is now being targeted. This alongside key energy infrastructure hubs in the region. Yesterday, the whole market was roiled by news that the Qatar Energy LNG facility was also targeted, leading to massive disruptions in energy markets. And earlier in the day, we had heard of the refining facility in Aramco also being hit too. And so this marks a significant escalation. And yesterday, we heard from President Trump those comments suggesting that they will do whatever it takes, that at the outset, they had anticipated this would take 4 to 5 weeks. It could take longer. And so the feeling here is that this is not going to be wrapped up in a matter of days. We are likely looking at a protracted period of conflict. And the concern, of course, is double-fold, that once that on the one hand, you could continue to see attacks on key infrastructure sites for logistics, for travel. We spoke about the massive flight disruptions that have taken place in this region as well. It's estimated there are over 300,000 people who are stranded. But then also, it's going to start to take a toll on many of these Gulf economies. And so the hope is that there can be some form of de-escalation, but it doesn't seem like that is happening at any point in the next few days.
Mika, can I come to you on that point that Jemana made about the duration of this? Mika Sollner in Washington, the president just putting out on Truth Social that, wars can be fought forever. Is he deliberately blurring what kind of timeline we should anticipate for this war?
Yeah, Bonnie, I think the administration has really been trying to keep a lot of their plans under wraps, or even still figuring out what exactly their plan is going forward after the initial strikes. Secretary of State Marco Rubio has been briefing lawmakers, and Trump officials will again brief lawmakers on Capitol Hill today. But there's a lot of questions that members have in terms of what are the objectives here, how long is this going to be, and I think that a lot of lawmakers and potentially even members of the public are getting a lot of whiplash from 20 years ago. But of course, the administration is pledging that won't be the case.
Mika, what can we expect from the president today? What's on his schedule?
Yeah, the president has policy meetings that are mostly closed doors. He is holding a bilateral lunch as well. So I think that he'll be able to make remarks, and we'll get an update on the war this afternoon from the president, most likely.
And then, Skylar Montgomery-Koning, if I can come to you in studio, we're seeing this amazing trade, right? So obviously the market is taking this a lot more seriously today. We're seeing futures just plummet, but also treasuries, because inflation has suddenly reared its ugly head, and not just in the United States, but across the world.
Yes, that's exactly it. And I think yesterday markets were calmed by the idea that oil prices at around $80 a barrel, it's not as high as you'd have in previous escalations, Russia-Ukraine being the very notable recent example where oil prices climbed above $100 a barrel. But the key point for markets is that when you have this big delta or this big change in energy prices, there has to be an economic impact. And so particularly for Europe and the UK, where you have natural gas prices in Europe up more than something like 30% and 60% for the UK, there will be a stagflationary impulse. And for markets, that's the worst kind of economic environment, because it means that equities sell off. It means that bonds don't do well because you have central banks that turn more hawkish, and there aren't a lot of safe havens that protect you.
And we're seeing this in Japan, in Australia, in so many different places. But if you just look at the United States alone, the Fed often says, look, you have to look past energy prices. That's not a long-term, persistent problem when it comes to inflation. But that's not always true, is it?
It's not always true. And what matters really is when you have these supply-driven shocks, it's what's the demand backdrop like when that happens. Now, right now, the demand backdrop, and particularly global growth, is quite strong. And so when you have that supply level adjustment where prices go higher, it can feed more persistently into the economy if demand is strong. And I think the worry right now from a government bond perspective is what we saw with Russia-Ukraine did create inflationary pressures that concern central banks. What you also saw was that European governments, et cetera, did more borrowing as a result because they wanted to subsidize those higher prices for consumers, and that's also a negative for government bonds. And so yes, maybe aren't concerned as much about supply disruptions from an inflation perspective, but certainly now where demand is, the fact that in the U.S. you already have inflation that's quite sticky with core PCE around 3%, it should be more concerning.
Isn't it interesting, though, even as everybody is dumping treasuries and obviously government bonds worldwide, the dollar continues to rise. It's strong once again today. In fact, the dollar index approaching, it's above 99 as I look.
Yeah, I mean, the dollar is the one clear safe haven that you can see from this because government bonds are under pressure because of the inflation, central bank link. With other currencies, the yen and the Swiss franc in particular, they're both energy importers, and so they're going to get a big hit from this. And what we've seen is that the relationship between the dollar and energy has changed drastically in the last decade or so. In 2019, the U.S. became a net energy exporter from being an energy importer. So that means when you get higher energy prices, there's less of a growth hit to the U.S., even though you still get that inflation profile changing. And it means that the dollar can outperform as a safe haven as well as because of that energy impact. And it's one of the clear winners there.
Skylar, thank you so much. Always so clear. And thank you to our team coverage. We had Mika Solomon from Washington, Skylar Montgomery-Koning here in the studio, and of course, Jumana Bersachi in Dubai. Coming up, an exclusive conversation with Israel opposition leader Yair Lapid. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in London. Israel's defense ministry says it's preparing for the potential expansion of fronts. It told defense industry leaders it's looking to accelerate its defense production rate. This as Israeli forces continued attacks against Tehran and carried out more airstrikes against Hezbollah targets in Lebanon. Israel opposition leader Yair Lapid joins us now. Mr. Lapid, what is the end game for Israel? Does it align with the end game for the United States, whatever that might be?
Well, I think we are aligned with our goals. There are 3 goals. 2 of them are operative, and 1 of them is bigger. The 2 operative goals is we have to eliminate and obliterate Iran's ballistic missile program, Iran's nuclear program. And the 3rd goal is enable the people of Iran a regime change. I mean, all those courageous young people who took to the streets in January, needs a better chance. I remember when the president said help is on the way, so help is there already. And again, I'm a very small believer in the possibility of a regime change by airstrike of external forces. But at least we are enabling the people of Iran the hope or the possibility or the opportunity to take their own destiny into their own hands and change the regime. Now, after the leadership, the entire leadership has been wiped from the scrap of earth.
Well, so what should we be looking for? Are you really anticipating protesters to be out on the streets? And if so, when?
Well, again, we cannot make the decisions for them when we are still waiting. It's an interesting question whether or not there will be an Iranian Mandela or an Iranian Gandhi or an Iranian Lech Walesa. Again, we were all filled with admiration to their courage and their determination when we saw them on January. I think the feeling is still there. I think they understand that the circumstances have changed dramatically. I think that operations like the latest, when compounds of the Revolutionary Guards are being hit in the middle of Tehran, is signaling them that everybody understands what is it that they're facing, and now it's up to them. Iran is going to change. What happened in Iran? Iran is an ancient culture, is an interesting country, is a very educated country that was taken hostage by a terror organization pretending to be a government. So we are helping them get rid of the terror organization. Yes.
If you don't have anyone in particular in mind, if you're waiting for someone to emerge, what is the plan and duration that Israel will continue these strikes?
Well, nobody wants to set a timetable, and there's all sorts of external components to this. I think, again, the first and foremost important thing to us, and on this we are in alliance with the United States, is getting rid of the, as I was saying, the ballistic missile program and the nuclear program, because these are existential threats to Israel, to the region, and to the world. Think of it this way. If the United States had an opportunity to get rid of bin Laden before 9/11, have they done so? The answer is, of course, yes. So this is what we are doing now, getting rid of the threat before the threat is operative.
So if that is indeed the goal, would you say, behind schedule or in front of schedule? Where are you in the operation?
I think right now this operation is an unbelievable success.
And where are you in it?
The coordination we are having with the Americans. Of course, it's very different. In June, in the strikes of June, Israel did most of the work, and then the United States entered this towards the end. Here, we are working with the mightiest military power in the history of humanity, which is the American army. So this is very different.
Okay, so if I can't pinpoint you on where we are exactly in the operation, can I ask you? You said nothing could be worse than what we had, but what do you think of the possibility that the regime stays intact with different leadership? And I wonder what you think the future might look like then.
Well, I think it doesn't get any worse than it did before. I mean, Khamenei was a terrorist, and the people around him are terrorists, and good riddance. I think if the worst case scenario right now is already better, which is a very weakened regime with less possibilities to A, suppress its own people, and B, being a threat. Interestingly enough, it was so obvious that they made the first mistake in a long, long time when they decided to attack the countries around them, Saudi Arabia, Qatar, Kuwait, Bahrain, because they thought this will make those countries pick up the phone, call Washington, and tell them you have to stop the war. Instead, they actually created a regional alliance against Iran that is going to be very meaningful in the future history of the region.
Have you been surprised by the extent and type of the Iranian retaliation? So, for example, the Leviathan gas project is now halted, and there have been other attempts at infrastructure damage.
Well, there are two versions. The first was the attack on Israel. I've been visiting sites that were hit in Israel. This is heartbreaking. Yesterday I was next to the place where 3 children from the same family were killed, the Beaton family, so it was heartbreaking. But this is not something we didn't see before. And this actually we saw the same things happen around the same scale in the attack of June. The fact that they have attacked infrastructure in the countries neighboring them is new and different and a terrible mistake because, as I was saying, they've just arranged a coalition against themselves by not reading the map, the political map or the diplomatic map around them the right way. This is an example of what happens when all your control and command systems are failing.
We have to leave it there, Mr. Lapid, but thank you so much for your time today. Israel opposition leader Yair Lapid. Crude then soaring, natural gas prices surging. Europe's natural gas prices up another 29% right now. This as the world's largest LNG export plant in Qatar remains halted and the Strait of Hormuz remains practically closed. Joining us now is Nadia Martin-Wigan, director at Svelland Capital. Nadia, we've seen China come out and urge parties to, back down and at least let the energy flow, right? How bad does this get? What's your base case?
Well, our base case is that these straits need to start to operate again, but how quickly that happens is a question. And just following up on what you were just asking, were we prepared for these attacks on the other Gulf GCC countries? And the market was not. And that's where I think we have to remember it takes time for the market to react. What has reacted most quickly has been the shipping market. And that is both in rising freight rates and also in changes to insurance and also declarations of force majeure. China, Asia, they are most dependent on the Middle East in terms of LNG flows. That's more than 80% of where they get their flows from. So it is very important. And globally, we do not have inventories in LNG and natural gas the way we do in oil. And that includes also Asia, which has even lower inventories than we do in Europe. So at full inventories, we have around 25% of winter demand in storage. In Asia, it's around 8%. Right now, we're at much lower storage levels because we're coming off of winter. So it's very important what China is saying.
Nadia, you talked about the strait. What, other than oil and gas, gets impacted by this practical closure with, container ships basically just with anchor dropped at this point? Does, dry goods get impacted? What about consumer goods?
Everything that flows through there right now is very dangerous, but the impact is more outsized towards LNG, LPG, and then finally the tanker markets because of what is a more dangerous cargo, right? If you hit an LNG tanker, which is valued at $260 million, $250 to $260 million, an LNG vessel, it's not a tanker, and then you have the cost of the cargo. And at the same time, the explosion makes it so that your crew cannot be rescued. You then have with LPG, again, this is much more flammable. And then finally, you have tankers. And tankers, you can normally get the crew back. But that has a much bigger spill and danger to it than in terms of container ships and so forth.
You have a great statistic in your notes that freight constitutes now 14% of the cost versus the cargo, where normally that's about 2%. Who can afford this premium, Nadia? Who gets the oil and gas?
Yeah, so that refers specifically if you were to take a tanker from the U.S. Gulf Coast. And going into this weekend, the cheapest crude in the world was U.S. WTI and Venezuelan that was unsanctioned. And in particular, China, since the invasion of Venezuela by the U.S., has not bought any Venezuelan crude. So now that is the cost of flowing all the way to China. China has around more than 1 year's worth, almost 400 days worth of emergency strategic petroleum reserve in terms of their own oil demand for cover. But they are the spare refining capacity in the world when we are in refinery maintenance season in the US and Europe. So that is one to watch because this can very much affect China, but they can of course choose not to send diesel and jet fuel over to Europe at this time and only take care of themselves. The biggest impact, I think, in terms of danger is India. India only has 30 million barrels of inventories, which is about 15 days stock cover. They are an extremely important refiner. They are very close in terms of the Middle East, and they have said they're not going to buy Russian crude, at least the national oil companies. So we may see that they start to take the 60 million barrels of sanctioned crude of Russian that's floating, 30 million barrels of Iranian crude.
We just had a headline, in fact, a little time ago out of India saying that it had 8 weeks of oil left. Very briefly, Nadia, we're out of time, but we're in a pretty warm spell at the moment. It's kind of shoulder season. Is this good timing, at least?
Yes, it is in the sense, so long as we don't get a winter spell, then absolutely, it's not the worst time. But on the flip side, we're at very low storage and we don't have the excess floating storage for LNG that we have tended to have after Russia invaded Ukraine. We didn't have it actually this last year or the year before, but that is something that traders typically had. Right now, we don't have that spare capacity on reserve to fill those shorts. And when we look at the prices right now, Asia is pulling LNG towards itself rather than allowing it to be here. So we have the UK where it's trying to pull out of Europe. We're in a tough situation here. The US, of course, as a huge natural gas producer, is in a much better situation.
Absolutely. Nadia, thank you so much. Nadia Martin-Wigan of Svelland Capital, and those prices just continue to go higher. Dutch natural gas front-month futures now up 34%. Coming up, we're going to be speaking with Julie Norman of Chatham House as the Iran war ripples across the region. This is Bloomberg.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, you know, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content and never the two shall meet, but there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. You know, stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Stock futures and treasuries extending losses as the war with Iran enters its fourth day, heightening fears of inflation. Oil extending its rally and gas surging as the world's largest LNG export plant in Qatar remains shut. The U.S. and Israeli militaries continue to bombard Iran's capital as the U.S. sends mixed signals on the timeline for the war. And we just got, in the last half hour, another post from Donald Trump on Truth Social saying that wars can last forever. So that didn't help sentiment in this market that was already feeling pretty dour. NASDAQ 100 futures down 2.3%, even as we saw the NASDAQ really get calm yesterday. In fact, it finished the session higher thanks to big tech. Microsoft was up more than 1%, for example, on the day. Today, again, we're starting off on a frail footing. If we look at treasuries, that trend continues as well, with yields higher, not just in the United States, but across the board, everywhere from Japan to Australia. Look at that, the 10-year yield is up another 6 basis points. That'll tell you just how much money is coming out of government bonds, because as I said, it's not just U.S. treasuries. Obviously, traders very afeared now for inflation. The dollar index continuing to rise, and the VIX today at perhaps a more apt 26. And just taking a look at energy, this is the reason behind it all. Brent crude is now close to $83 a barrel, and New York crude close to 76 a barrel. Meanwhile, European gas futures are up 38%. Let's get to some individual movers now. Here's Abir Abu Omar.
Good morning, Vonnie. It's really hard to find a stock that is moving upward for a reason today, and that is on the back of the tensions that you've mentioned. As a matter of fact, the U.S. futures image is quite dark today. You're seeing it down 2%. NVIDIA, the biggest constituent there, is retreating by more than 3% this morning, and part of that story is perhaps because of those chip caps. Now, this is according to a Bloomberg story that cites some sources. So we're reporting that U.S. officials are considering for NVIDIA to cap chip sales to single Chinese companies to 75,000 of these H200 chips. So that is not, the stock is not behaving, or it's not responding well to that information, perhaps on those supply shocks that could come up as the Middle East tensions get heightened. Moving on to perhaps the only sector that is doing quite well this morning, and that is energy. Battalion, this is a small energy company that is adding to those gains from earlier the pre-trade session, up around 135%, Vonnie, a whopping gain to those energy stocks, especially as Brent crude prices near the $82 a barrel, and that is expected to go higher if the duration of the war was to be prolonged. And then finally, moving on to the software sector, this company, MongoDB, is losing in the pre-trade session this morning, down about 30%, 27.6% down this morning, and that is on the back of weak revenue forecasts. Now, software is one of those sectors that just have not been doing well this year, but again, today, not much is doing well, Vonnie.
Yeah, that's for sure. Abir, we'll see how the day progresses. Thank you so much to Abir Abu Omar. The U.S. State Department is urging Americans to leave across the Middle East. 2 drones struck near the U.S. Embassy in Riyadh as Tehran steps up strikes in retaliation against the U.S. and Israel. President Donald Trump says there is no fixed timeline on the war. Julie Norman is Associate Fellow on the Middle East at Chatham House, and she joins us now. A repetition of that this morning, along with the protestation, if you like, from the president that indeed the U.S. does have enough munitions. Julie, does this come down to who has the munitions that will last longest?
Well, good morning, Vani. You know, the munitions race, so to speak, is certainly part of this. Obviously, the U.S. and Israel have a lot of military pressure they can keep throwing at Iran. We've seen that in overwhelming force over the last several days. Iran going into this conflict, we estimate, probably had about 2,000 missiles. Some of those they want to be using quickly before they are destroyed by Israeli and U.S. strikes, but some they also want to keep in reserve to be able to have their own retaliation capacities. But, Giovanni, I would say there are other things beyond this at play. Also, Iran obviously has other actors in the region that are supporting it, Hezbollah, Houthis. These actors have been very weakened in the last several years, but do still have some capacity to be disruptive. Iran also has cyber options. They are obviously already sort of weaponizing the waterways and sort of saying they will be targeting ships going through the Strait of Hormuz. So there are other options beyond just munitions, but at the end of the day, I think that's where the U.S. is hoping, where there'll be some either capitulation or surrender.
Yeah, I mean, does it get to the point where the U.S. has to start taking different kinds of military measures? We had a piece out today analyzing what that might be, and one of those things was dynamic targeting, right, which is sort of not just pre-planned targeting, but that's riskier, it costs more money, and it takes human beings, well, typically, unless you're using AI, to actually be above these targets.
Absolutely. So right now, the U.S. and Israel have been relying on these pre-planned airstrikes. As the war, as the escalation continues, we probably will have to see some kind of shift to other types of military operations, some that are a bit more, I guess you could say, unpredictable. I will say on the ground in Iran, casualty estimates are over 700 right now. So certainly within Iran, this is being, felt quite strongly already, even before moving to these other types of munitions. And again, Iran itself is retaliating not only to Israel or to U.S. bases, but also to countries across the Gulf, as well as into Jordan, and not only to bases, but also to civilian infrastructure as well. So I do think we are seeing, the population is starting to feel this war in a very different way than they have in previous iterations.
Julie, it's Tuesday evening now in Tehran, and I'm curious, or at least Tuesday sort of midday, right? I'm curious as to why we haven't had any word of a new supreme leader yet.
Yeah, so I mean, this is a bit of a process to get to that point. The Ayatollah did put in a sort of a plan for what would happen if he was killed, if he was assassinated. And so there is a sort of transitional agency that's kind of working right now, a triad of individuals who are kind of working on this. But for the actual supreme leader to be chosen, that is a process that includes the Assembly of Experts, the Guardian Council, and again, really relies on a lot of the apparatus that the Islamic regime intentionally put in place for things like this, that there would be a lot of internal control over who took on that role, and that it wouldn't just be kind of an automatic succession, say, to Khamenei's son or something like this. So, but that is certainly in process right now in Iran, but again, you're talking about this happening in the midst of an extremely kinetic war where individuals themselves are being targeted consistently.
Sure, but you could argue that that's the time where you need a quick response, right, and a show of unity. Will we have any answers to any questions when we do know who the next supreme leader will be, as to, for example, whether the internal domestic situation is a united situation, whether the IRGC will be loyal to the regime and so on?
Yeah, I think it so remains to be seen what will happen internally with Iran. What we can say right now is that the IRGC, even with its leaders targeted, it's still a massive body, upwards of 1 million strong, that so far have still remained very loyal to the regime, still are showing a capacity to crack down on any attempts at protests and whatnot. And we saw that obviously en masse back in January. So we haven't seen defections from that group yet, nor from some of their supportive paramilitaries. So with that kind of very widespread, very deeply integrated security apparatus, it's difficult to see a quick changeover right away. It does seem that the regime will hang on in some way, shape, or form, even though very different from the way that we knew it.
Julie, just curious about the U.S. and Israel and, the fact that basically they started this operation together. Israel is having a little side operation with Hezbollah and Lebanon and so on, but
Is the U.S. tied to Israel's campaign here, or can the U.S. stop or pull out or do whatever to de-escalate while Israel continues to escalate?
You know, I think it'll be difficult at this point, Vani, for that kind of split. You know, the U.S. and Israel went into this together. Obviously, Israel is leading on some components and the U.S. on others, but this is very much a joint operation at this point. Certainly, Israel as the regional actor prior to this latest escalation, and certainly after this, will likely be carrying out some of its own actions. But in terms of the actual operation we're seeing now, this does look like a joint venture, and it's one, quite honestly, where Trump and the U.S. I think will have the biggest say in what was accepting to kind of end this. Trump has at some moments seemed open to a negotiation with other Iranian leaders who might be willing to negotiate or capitulate, whereas at other times it seems like they are looking for something leading to a much more significant regime change. But at the end of the day, it will be more Trump, I think, making that call even than Israel. But right now, operationally, they're very much in coordination.
Julie, do you see an end game here, an off-ramp for Iran? I mean, it's coming under more and more urging, if not pressure, from even the likes of China, one of its allies at this point, to find an off-ramp to make things good. What could it offer? Just say it were in a mind to offer anything at this point.
Yeah, I think one thought that I think Trump has gone into this with is the idea that a more pragmatic, tier 2 leader from Iran could step forward and be willing to make some of those concessions that Trump has been pushing for, declare that they will not develop nuclear weapon or have nuclear infrastructure, number one. Number two, dismantle their missile program. And number three, stop support for proxies in the region. So I think Trump thought he might be able to pressure someone within the Iranian regime to be the pragmatist and do that. I think a lot of us are very wary of that. From Iran's point of view, you have a regime that is obviously very weak, but not dissimilar to Hamas in Gaza. Simply by not surrendering and by not giving in, that's all they need to do to kind of stay in this fight and to make it look like at least a partial victory. And so I think we'll see some attempt at that for at least a while longer.
Julie, fantastic analysis. Thank you so much for your time this morning. Julie Norman of Chatham House. Now to other top stories trending on the terminal this morning. Blackstone is letting investors redeem a record 7.9% of shares from its flagship private credit fund. That's equivalent to around $3.8 billion. The fund has around $82 billion of total assets, including leverage. Redemption requests have picked up amid anxiety over the asset class and its exposure to software businesses. OpenAI CEO Sam Altman says the rush to make a deal with the Defense Department, quote, looked opportunistic and sloppy. In a post shared on X, Altman says his company was working with the department to, quote, make some additions in our agreement to make our principles very clear. This includes ensuring that AI isn't used for domestic surveillance of Americans. U.S. and Chinese trade negotiators are slated to meet in mid-March to discuss business deals that could stem from a summit between President Trump and Xi Jinping. Trump is scheduled to travel to China from March 31st to April 2nd to meet with Xi, the first trip by an American president since his visit back in 2017. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Secretary of State Marco Rubio reiterating President Trump's message of not having a fixed timeline for the war with Iran. Meantime, Defense Secretary Pete Hegseth rejected the idea of an endless war. Joining us now from Washington is Mika Sollner of Bloomberg Government. Mika, what should we anticipate hearing today, given that we got another Truth Social from the president this morning saying that wars can be forever wars?
Yeah, absolutely. I mean, we're getting mixed messages here from the administration in some ways. Initially, the president had said, and top administration officials have said that this war will last no more than 4 to 5 weeks, but they're also saying that they're prepared to go longer if necessary. Now, it's unclear to a lot of lawmakers on Capitol Hill what exactly the objectives are for the Trump administration when it comes to the next few weeks and what that's going to look like. And I think those questions are going to be answered a little bit more behind closed doors today on the Hill.
You know, the Saudi embassy was struck by drones, 2 of them this morning, and then we had the State Department also urging citizens, American citizens across the region, the Middle East, to leave. Does it suggest that the U.S. wasn't prepared or was a little bit surprised, perhaps, by the Iran retaliation as it took place?
Yeah, I mean, some retaliation was clearly expected. I think it's a question of how far this is going to escalate, and there's no doubt that this is going to intensify in the next few weeks, and the relations right now are just really challenging, and I think it's going to create geopolitical problems as well, with more countries starting to back this effort. So I think that we're going to see more what happens, but I know that the White House is really cognizant of the risks, but they're really trying to downplay any major concerns when it comes to potential retaliation.
Mika, thank you so much. Mika Sollner of Bloomberg Government. Turning to commodities now, oil extending its rally today as the war with Iran progresses through its 4th day. So we have WTI above 76 and Brent also up nearly 7% at $83. Bloomberg's EMEA News Director Will Kennedy joins us now. So Will, yesterday we obviously saw a bit of a spike, but things calmed down a little bit. Today it doesn't seem like the market is that calm again.
No, and I think that reflects some of what you were just talking about message from the administration that this war may not be over quickly, that it could go on for some time. And with the Strait of Hormuz de facto closed at the moment, with most big oil tankers not traveling through the strait, there'll be nervousness among oil traders about the possibility for disruption to oil supplies that lasts for several weeks.
China is even urging Iran now to at least not have the Strait of Hormuz effectively closed, right? I mean, is that a possibility? Can Iran, I don't know, escort ships, or how does that backlog come out of the problem?
I mean, it will be, I think, in some ways up to the United States. The US is obviously the main naval power. It's trying to knock out the Iranian Navy. It's stated that as a war aim on a couple of occasions. there may come a time where the US Navy feels comfortable enough to say that we're okay for you to start transiting the strait, and that it's possible, although there hasn't been any talk about this, that they do play some kind of escorting role down the future. But this is probably one area where Washington and Beijing is aligned, that they don't want this to become a prolonged disruption. As you say, the flow of oil out of the Strait of Hormuz is a very important issue for China, which buys an awful lot of Middle Eastern oil, much more than the US does directly.
And it's so complicated to get that all working again because, you know, you also have to have ports open so that they can dock and unload. European natural gas, it's absolutely surging. There's a little bit of a knock-on effect to American natural gas right now, Henry Hub. How bad does this get?
This has perhaps been the most meaningful thing that we've seen in the energy sector so far during this conflict, is that yesterday Qatar announced that it had completely stopped its giant natural gas plant. It supplies 20% of global liquefied natural gas, which is transported to Asia, to Europe. For Europe, it's a problem because Europe has become much more dependent on liquid natural gas imports after stopping getting gas from Russia through pipelines. And the US is the other big supplier, but the US is pretty maxed out. It's still building export plants, but it's supplying all the gas it can to the global market. So there's not an obvious place for Europe to replace that supply if this outage is prolonged.
Fascinating moves. Will, thank you so much. Bloomberg's Will Kennedy. JP Morgan CEO Jamie Dimon says war in the Middle East risks higher inflation and therefore potential shockwaves to the U.S. economy and stock market. He spoke with Bloomberg's Lisa Abramowitz yesterday at the bank's annual Leveraged Finance Conference in Miami.
One of our brilliant folks wrote a report years ago, Mike Sembles, that if you look at all these wars around the world since World War II, the market reacts, but it never had a real long-term effect other than the Israeli conflict. When oil prices tripled and went on for an extended period of time in 1973. So the world kind of takes this in stride, but geopolitics is a major issue. It's much more complex today than it has been since World War II. I'm talking about Ukraine, Russia, Iran, North Korea, our relationship with China, and that could have an effect, but it may not. So these things may diminish over time. You know, this war with Iran, you know, if it is short and oil goes to 80 or 90 or 100, but it's a short time, not prolonged, it probably won't have a major effect. If it becomes prolonged, then all bets are off the table.
Well, how offsides would this market be if there were truly a stagflationary shock, given the fact that there seems to be comfort with the idea of disinflation right now?
Well, I think that's true, but I think that was true before this war. So if you look at, you know, my view is the asset prices are kind of high, credit spreads are kind of low. There's kind of a lot of complacency in the market. I'm not sure, you know, we look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, you know, inflation. I call that's the skunk at the party. So it's been coming down, but it seems to maybe leveled off around 3%. If things make it go up, and this is only one thing, you know, you can look at medical prices, construction prices, insurance prices, wages for certain things, other things, you know, inflation is a big thing. It's not just oil. So, you know, we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot.
You know, I was surprised because things were kind of gloomy coming into today, and the mood here is not that. Actually, there's a lot of optimism. There are a lot of different companies that are building things and investing things. I mean, how vulnerable really is the U.S. economy right now to some sort of geopolitical shock?
Well, it may not be geopolitical. It may be the companies who start to lay people off. And so I look, the most important thing in the world today is geopolitical. What happens to the free Western democratic world, which has kind of been under attack by Russia and Ukraine, by Iran in the Middle East, you know, a little bit by China, who wants to, you know, divide and conquer the Western world, and, you know, both militarily and economically. You know, you have all their neighbors are rearming because of their actions, not because of anyone else. So those are the most important things. I'd add global deficits are so large, but those are like, I call them like large moving tectonic plates that may or may not affect the economy in the short run. They may be determinative in the longer run. And some of these things, when you talk about war, you know, Vietnam, you know, did it affect the economy in the very short run? No. It had a 20-year effect after that. So you got to look at these things as they're moving plates that can take 5 years to have an effect, but the effects will be real. Right now, the economy is doing fine. Asset prices are high. People are assuming things go on. I mean, no one you talk to has any idea the credit spreads can gap out a lot. And they could, just because of sentiment. And so yeah, I think there's a little bit of a little more exuberance than I think there should be, but we've had years of it. And you know, the one big beautiful bill adds to, adds to growth this year. bank deregulation, other deregulation adds to growth, and animal spirits. So we'll see. But you pointed out, I think the skunk would be inflation. So we got to keep our eye on that one closely.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg.
Futures pretty much at the lows of the session now as we continue to get headlines. And, of course, the State Department urging Americans to leave the Middle East entirely. NASDAQ 100 futures pointed down by 2.3%. Also, energy just surging. Take a look at barrels of crude in Europe, up 8% now, above $84. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion, and now we're seeing, Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
Investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
You have to price in a little bit more risk.
A regime that is now under threat does not fear consequences.
I don't think this is going to really disrupt markets.
The subdued reaction is partly due to the fact that we kind of had this move ahead of time.
I don't want to count against corporate America. They seem to be rising to the occasion on just about every single issue we've seen.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, positioning for weeks, not days.
We have the strongest and most powerful by far military in the world, and we will easily prevail. But whatever the time is, it's okay, whatever it takes.
I would never hang a time frame from our perspective. The commander-in-chief sets the op tempo in terms of this fight.
The hardest hits are yet to come.
The White House preparing for whatever it takes for as long as it takes, as Iran is threatening to fire on traffic going through the Strait of Hormuz. The conflict is sending crude through 80 and gas prices surging. Energy is going through a huge repricing.
And it's happening when it comes to crude. It's happening even more when it comes to natural gas. And Europe is very much front and focus. European natural gas prices are up about 70% since the European close. And we're getting news that Qatar Energy is stopping the output of some other minerals as well. There is a real question about what Europe in particular is experiencing, even as the United States experiences the highest bump up in gas prices going back almost 20 years.
Is it 2022, Volume 2, for the Europeans? Check out the underperformance on the equity side. Futures this morning on the S&P down by 1.8%. The DAX is down by close to 4%. Italian equities down by close to 5%. In the European bond market, look at this. Yields much, much higher across the curve from the UK to Germany to Italy. At the front end of the UK, we're seeing a move. At the long end as well, 10s are up by 15 basis points. We're pricing in the prospect of tighter policy, pricing out rate cuts at the Bank of England, and pricing in the very real risk of rate hikes at the ECB.
Because ultimately this is a supply shock, yes. However, it is going to hike the prices of goods across the region, just like we saw, as you mentioned, in 2022 in the wake of the Ukraine war. A really interesting note from Bloomberg economics analysts, where they came out and they said not only does this pressure gas and oil prices in the European region, but it also puts pressure on governments to spend more to support some of their consumers, to lower prices. We're hearing noise around that in the United States. Potentially we could get that kind of effort in Europe. What does that do to the politics of the moment when there already is so much disgruntled sentiment among the population?
Does it upend the cyclical recovery? It's an unfortunate situation for the Europeans to be in. They've decreased their dependence on Russian gas and increased their dependence on Qatar's LNG. And all of a sudden, as you point out, LNG production has basically plummeted in the region. And now we look at these moves. Are we going to see the big trade of the year upended as well? The global equity outperformance in places like Japan. Japan's trading softer this morning. Places like the Kospi. The Kospi got absolutely hammered in today's session, down by 7%. So the big winners of the year, the big losers of the last 24 hours.
What you have is a market that tends to exert the most punishment on people that it possibly can. And right now, you had people overweight international equities. You had people overweight Europe. You had people saying ex-US, the rest of the world looks good. And you're saying Samsung is going to support everything in the Kospi. And suddenly people are taking a look and saying, wait a second. The dollar is the haven, and suddenly there are weak spots that are potentially exemplified by some of this conflict.
A lot to get through this morning. Big moves. The Bloomberg terminal is lighting up, that's for sure. Crude is higher by more than 7%, 83.43 on Brent. WTI is 76. Coming up this hour, we'll catch up with Chris Verone of Strategas with global markets on edge. Jorge Leon of Rystad Energy on whether oil could hit triple digits, and Torsten Slok of Apollo as inflation fears rock the bond market. We begin this hour with stocks falling and oil breaking back through 80 as the Middle East conflict grinds on. Chris Verone of Strategas, a bed company, writing a price-first approach is about as useful of a skill set as there is to navigate the unknowns. Chris joins us now for more. Chris, good morning.
Great to be here.
Lots of unknowns to navigate. Are we upending the cyclical recovery worldwide?
I think we're going to learn here. You know, going into this, if you had to find what were some fissures in the cyclical recovery, it was the message from bond yields the last couple months, right? The expectation was bond yields would be up, they were down, we were trying to ask why. I think the other question out there was why was discretionary acting so poorly in a world where tax refunds and stimulus were supposed to be the big stories in 26. So there were already some question marks. You saw some weakness in the banks the last couple of weeks. I think the harder question is, as we look out, you know, over the next number of months, is are we returning to this environment where bond yields up reemerge as the hedge here? And if you look at the price action the last couple of days, it's bond yields up, particularly in Europe.
You mentioned discretionary and the consumer. The cyclical recovery didn't pick up discretionary stocks. And you saw that in the bank names as well, and you've talked about that repeatedly. Discretionary and anything exposed to the consumer yesterday got hammered, Staples too, and they're a big winner of the year so far. Is that a big flashing light for you right now, that those names, those sectors, that part of the equity market can't get off the mat?
I think it speaks to this idea, you know, we talk about price first, right? And you know, one of the conundrums for people was, why was energy getting better, right? Really at the expense of consumer discretionary. And energy's improvement doesn't date back 4 weeks or 6 weeks or 8 weeks. I mean, energy started to improve in our work in August, September, October. It could have been cyclical recovery, it could have been inflation pressures building, it could have been, as we maybe learn now, something war. Is the market the kind of this discounting mechanism that's saying, hey, energy was getting better regardless of this, and if we get any sell the news in energy or oil over the next couple of weeks, that's actually what you want to be buying, as opposed to any relief rally in consumer discretionary. That's where we are right here. I think energy is the leadership. I think it's been the leadership. It's certainly the leadership in Europe. I mean, even in places like Japan, it's the leadership, and certainly the story here as well.
And it's certainly leading the repricing of monetary policy around the world. The RBA said every meeting's a live meeting. We saw a headline cross the Bloomberg about 2 hours ago, pricing in the prospect of higher rates at the ECB, not lower rates at the European Central Bank. Is that where this is heading now? Tighter financial conditions?
Yeah, I think we got to be a little careful reading into monetary policy just yet. I mean, just go back 3 or 4 weeks ago. If you look at the shape of like the SOFR curve, the market's still pricing easier policy in the second half of 2026 in the U.S. I'm skeptical that you're going to see the Europeans hiking into this in the back half of this year. You could convince me on the Aussies going again. It's one of the stronger economies in the world. It's one of the stronger currencies in the world. It's where bond yields have generally looked different than the rest of the world. I would be very skeptical to the idea that the Europeans are going to be hiking into this over the next number of months.
If you really do follow the price, yesterday was a fascinating case study. Because first, the knee-jerk reaction was actually a bid into treasuries. And you saw yields come in. And what seemed to trigger it was that ISM factor, the ISM manufacturing data that came out that showed not only did it pick up in expansion territory, but you also had price pressure. So on the back end, you're looking at an economy, at least in the world's biggest, that is doing okay, and that frankly is picking up and already has inflationary pressure. How important is that to sort of fuel the potential inflation threat?
Yeah, I mean, if you look at the mix yesterday with strong PMI, like transports acted great, even with oil up. I mean, there were some oddities about the price action yesterday. And, you know, one thing we wrote to clients yesterday was, in moments like this, be very alert to what acts differently than intuition might suggest. And, you know, on that score, I think the price action in gold and silver the last 48 hours is fascinating. The fact that gold's not making new highs on this, I think should be a wake-up call that, hey, maybe the bull market here has happened, or at a minimum, you're in some type of pause period. I mean, silver had a nasty, nasty reversal yesterday. I think maybe 15% from high to low with where it's trading this morning. So, be alert to where positioning was very, very one-sided, and then the price action is not living up to the hype. On the other side of that, I mean, the way dollar has responded here, coming off the covers from The Economist and Barron's the last 2 weeks, right? So just be alert to where maybe the attitudes are to one direction and the price action is starting to suggest something different.
Well, the initial knee-jerk reaction suggests that a lot of trades got upended because there was this sort of consensus trade, oh, sell America, get out of everything but U.S. stocks, and you're seeing sort of the counter balance to that. I just wonder what we are actually pricing in. I mean, what kind of scenario do you see as currently baked in?
So I've never been in the camp, this is like a sell America moment. I think it's a buy incrementally less America moment. When you operate in a business on the margin like this is, that's meaningful. And I think it's contributed meaningful to the outperformance of rest of world versus US. Now that for us was never about Europe. That was about Japan, that was about Latin America. I don't know kind of where Europe ultimately falls in this. Something that we've been alert to the last few weeks in Europe is I didn't like the bank stocks were starting to weaken there. Right. After really a 2 or 3 year run. I think it's very fascinating that the European defense stocks have actually started to soften here. Rheinmetall in Germany was actually down sharply yesterday, down again this morning. So, in the spirit of where is your intuition not being validated by price action? I think those German defense companies, the European defense companies, are one example of that. I would also just say, this idea that rest of world just outperforms U.S. in a straight line for the next 7 years is also pretty silly. I mean, like, if it was that easy, we all wouldn't be here, right? There are moments that really test you, and I think you're going to get tested in Japan here. We love it long still. I want to be a buyer of oversold conditions in Japan as they emerge. I think it has more of the stocks that this market craves. It's a 25% weighting in industrials and robotics, all the type of stocks that we want here. I would be very, very careful with KOSPI as we're seeing this morning. I mean, when you're 70% above the 200-day moving average, as the KOSPI is, really driven by 2 stocks, Samsung and Hynix, to a lesser extent, some of the defense companies and banks. It could be anything that pulls the pin. It just happens to be this. It reminds me a little bit of back in late January, early February, when silver was 150% above the 200-day moving average, and it was the worst nomination that pulled the pin on silver. No, it could have been anything, and it could be anything in KOSPI that pulls the pin here. There is serious correction risk in the memory stocks. I think it's interesting. Micron has not made new highs here. It's 125% above a 200-day moving average. So just be alert to where some of the extremes are.
We had a move of 40 to 50% year to date on the KOSPI, and we're down 7% in today's session. What about EM more broadly? The prospect of higher energy costs, the prospect of a stronger dollar bouncing back too. Are we upending that trade?
So, the EM call for us has been more about Latin America, which I still think is in very good condition here. It's really one of the only places I can find globally, and this has been true for a year now, where the stocks are good, the bonds are good, and the currencies are pretty good. So it kind of has the hat trick here. We always look to the currencies as kind of an indication of whether there's capital flight or whether capital is being attracted, and I think in Latin America, capital is being attracted. I don't think that makes it immune from a risk-off moment here in global markets, but they're still among the better charts we can find. I think the stronger currencies in the world are found there, and the stronger bond markets found there as well.
Chris, it's good to see you.
Good to see you.
Chris Verone of Strategas working through these equity markets for us. Equity futures on the S&P down by 1.8% so far this morning. Let's give you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Israel conducting a new round of airstrikes in Tehran this morning after a pair of drones hit near the U.S. embassy in Riyadh, Saudi Arabia. Iran also says it targeted a U.S. base in Bahrain. The State Department is urging Americans across the Middle East to leave as soon as they can. Elsewhere, a planned summit between President Donald Trump and China's Xi Jinping is still on track for the end of the month. Sources telling us here at Bloomberg that U.S. and Chinese trade negotiators will meet in Paris in just a few weeks. The meeting marks the first sit-down between high-level officials from both countries since the Supreme Court dealt a blow to President Trump's global tariffs. And I'm sure this will also be on the agenda. U.S. officials are weighing capping the number of AI accelerators NVIDIA can export to companies in China. Sources telling us Here at Bloomberg, the proposed cap would limit Chinese firms to buying 75,000 of NVIDIA's H200 chips each. The limit is less than half of what firms told NVIDIA they would like to purchase. That's your Bloomberg Brief, John.
Hey, Yahara, thank you. More from Yahara later this hour. Up next on the program, whatever it takes in Iran.
We're already substantially ahead of our time projections, but whatever the time is, it's okay, whatever it takes.
Up next, we'll catch up with Major General Mastin Robertson of Academy Securities from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Risk assets very much on the back foot so far this morning. Here's a picture of things for you. Negative 1.8 on the S&P, down by more than 2 on the Nasdaq, down by 2.6 on the Russell. A notable feature of today's price action, the underperformance across Europe from the DAX to Italy. In the bond market, a similar story. Yields up big time over in Europe. This morning, stateside, Treasury yields higher as well. Up by 9 basis points this morning. Pushing 360 now at 356.77, up by 6 on 10s. Let's call this 4.1%. Off the back of this, so the epicenter of the moves, a major rally in energy, both in gas and in crude. Brent crude, 84, and up another 8.6% on the session.
A big question about what kind of disruption you could end up having, not only with the Straits of Hormuz, but also with certain producers in the Middle East getting shut down or shutting down their facilities because of attacks. This really is raising the specter of a price shock that we haven't seen since, guess when, 2022.
Feels like it might be 2022 Volume 2. We'll see. That's going to be a big part of the discussion for us on Bloomberg Surveillance this morning. Under surveillance this morning, whatever it takes in Iran.
We have the strongest and most powerful by far military in the world, and we will easily prevail. We're already substantially ahead of our time projections, but whatever the time is, it's okay, whatever it takes.
So here's the latest this morning. Strikes across the Middle East continuing for a 4th consecutive day. The president saying the conflict has no set timeline and is refusing to rule out American boots on the ground. Bloomberg's Mika Sona joins us now from Washington for more. Mika, welcome to the program. Do we have a clearer understanding of the objectives now over the next several weeks?
You know, I think that there's still a lot of questions about the administration's operation in Iran, and we're going to find out more this week. Trump officials are going to brief lawmakers on Capitol Hill who still remain perplexed in terms of what exactly the objectives are. It is significant that the administration officials have not ruled out boots on the ground, and I think that might change the posturing of lawmakers in Congress who argue that this may need congressional action if the U.S. does end up sending troops on the ground there.
Mika, what did Washington, D.C. and congressmen and women make of the explanation, the rationale for this particular conflict from the Secretary of State, Marco Rubio, just yesterday?
Yeah, I think Republicans are working really hard to try and appear supportive of President Trump's efforts because they don't want to get into the crosshairs of the president. But I think that there's privately a lot of questions that are being asked. I mean, I spoke with a couple of lawmakers who, you know, have privately raised questions about what exactly the administration's going to do here. And clearly there's polling that already shows that this is an unpopular move with the public. So there's concerns of how this may play out politically. But I think that the more transparency the administration can provide for lawmakers, that's going to give a better sense right now on the Hill.
Mika, it's good to see you. Mika Sona there of Bloomberg down in Washington. Higher energy prices, Bramo, higher prices at the pump. That's going to translate very quickly, and that will come with its own pressure ahead of the midterms.
Which is the reason why Marco Rubio is saying that they've got a plan for this. Well, what's the plan, especially because the SPR, the Strategic Petroleum Reserve, has been depleted by almost 40% since the peak in 2020. So if you can use that, great. But what else do you have up your sleeve?
Let's extend the conversation with U.S. Marine Corps veteran Major General Mastin Robertson of Academy Securities, writing the following. Iran's current ability to make clear and rational decisions is likely disrupted, but proxies are still a problem that is not easily solved. The Major General joins us now for more. Major General, welcome to the program, sir. Always appreciate your insight. Let's just start with your assessment of the operation so far.
Thanks, John, Lisa. So, I mean, it seemed to me that the number one objective was to try to ensure that the nuclear capability for Iran is off the table. And it does seem that that part of the operation has gone well. If the objective was to take down mid-range and short-range, or particularly long-range and mid-range missiles and destruction of the Navy, that's gone well. The challenge is the side effects of those, the closing of the straits, the attacks on Middle Eastern countries and their capitals, which doesn't really surprise me because you've got to believe that everything that's happened from the Iranian side of the house over the last 4 days was probably prescripted, that if we get attacked, these are the targets, these are the things you do, which probably in hindsight is not best for Iran to be attacking the other Middle East countries' capitals, because it certainly plays against their ability to have an emotional connection to the Muslim people in those countries and separate them from their governments.
So, Major General, that last point I think is quite important, that the response we've seen from forces in Iran so far has been scripted. As time goes on, how do you think IRGC forces are operating or will operate in a leadership vacuum?
I mean, that's the hard part to predict, because I do think they're operating in a vacuum. I don't think that there's a central government that is, in essence, making the decisions to say, this is what we're going to do next, these are our objectives, this is what we want to achieve in order to get the upper hand. So it is going to be interesting to watch at what point do they have the ability to name a government, and then even after they name it, does it have any control given the amount of destruction that's occurred to their network? Do they have the ability to control their military, or is their military pretty much now in isolated bubbles doing what they think are best without any centralized control? And that has a danger all to itself. But it also means that they're not going to be unified in objectives to be able to try to disrupt what the coalition right now is trying to accomplish.
Major General, I wonder what we're learning about the nature of modern warfare in terms of the way that drones are being used and deployed by Iran and the asymmetry in pricing, right? These drones are cheap. They are multiple and they are quick to produce. And at the same time, some of the missiles that we're using to shoot them down cost tens, hundreds of thousands of dollars. I mean, how is that mismatch playing out, and how could that be something that shapes the nature of war going forward?
Yeah, you're absolutely right, Lisa. We, the U.S., have to figure out a better way to do this. We've got to figure out a cheaper way to do this. It doesn't make economic sense to do what you've just described with $1 million missiles shooting down hundreds of dollars drones. So it was fascinating to me to see that President Zelensky had offered to help us figure that out better, and help Israel figure out better if they could convince, and the Middle East could convince Russia for a 30-day ceasefire. So who knows? I mean, that may happen.
Well, Major General, the way that war is being fought is so different. In this case, there's a concern that retaliation could come in the form of cyber attacks or other types of disruption. How are you monitoring that, given the fact that it could be kind of one-off events in different places? How well protected is not only the U.S., but also other Middle Eastern countries against that type of attack?
I think we're pretty well protected. I mean, there's no way that you're going to get 100% protection. But I think let's remember that even though this is a 4-day war that's been ongoing now, cyber attacks and penetrations have been a serious threat for years. And by and large, even though Iran has a capability, their capability pales in comparison to some of the other capability of nefarious actors that are out there in the world, who certainly could insert themselves into this in a disruption type style. But I'm not sure it's to their advantage. It appears at this point that the Chinas and the Russias and the North Koreans are content at this point to sit on the sideline and watch this play out. And that's our advantage if that happens. If it broadens and they become part of what you're describing, a cyber type offensive defensive war, then that does complicate things for everybody. But I think we have a better defensive architecture than probably we're willing to advertise for obvious reasons.
Major General, a serious final point there. We appreciate your time. Thank you, sir. Major General Mastin Robertson there of Academy Securities, a man with some 34 years experience of active duty across 60 countries and extensive experience in the Middle East.
And right now that experience is lending itself to a new type of war. And the point that he made there that Vladimir Zelensky is offering to help the United States and the other Middle East nations with drones just gives you a sense of how much things have changed.
That's a fight they've been fighting for a number of years. Coming up on the program, Jorge Leon of Rystad Energy on whether oil could hit triple digits plus Yahira drops by with your morning movers. Oil and gas stocks absolutely surging in certain places this morning off the back of this move in crude. Brent briefly through $85 a barrel for the first time since July 2024.
case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini.
We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Check out the price action this morning. The scores look like this. Down across the board, negative 1.8 on the S&P. On the Nasdaq, down by 2.3. On the Russell, down by 2.7. It was notable yesterday that we actually managed to finish in the green, believe it or not, even as the Europeans had their worst day for stocks going back to spring of last year. Europe underperforming again this morning. The Stock 600 is down by 3%. The DAX is down by close to 4. It's a notable feature of the price action, this underperformance out of Europe, and you see it in bonds too. So we've had a double-digit adjustment at the front end of the curve yesterday and again this morning, up 11 basis points, twos at 358.62 as we price in the prospect of tighter monetary policy, pricing out the prospect of additional rate cuts in places like the US, but also places like the UK. Check out the bond board in Europe right now. Much bigger moves. 10's up by 15 in the UK. In Germany, up by close to 10. Similar story in Italy. As we price in the risk, Bramo, the risk, and I stress the risk, not the inevitability, but the risk that we could get tighter monetary policy out of the ECB.
Ultimately, the inflation pressure coming from natural gas in particular, really significant. We saw this in the wake of 2022, and it's coming at a time of recovery. So a lack of demand isn't going to dampen that kind of inflationary boost. People say that natural gas is the most pure play on this entire conflict right now, and guess who that hits hardest? Europe.
Let's go through the energy moves. So we've got Brent and WTI rallying pretty hard. Briefly, Brent through 85 for the first time in a couple of years. This morning, 83.73 off those highs. But Bramo mentioned the move in benchmark rates for European gas. Huge moves. Yesterday up 40%. This morning up another, let's call it 30, up 90%, Bramo, in just 2 sessions.
And this is because you have Qatar LNG closing some of its production, at least temporarily. That is about a fifth of all production of natural gas comes from this region, and it goes primarily to Europe. So once again, they're constrained, akin to what happened in 2022 when they were diversifying away from Russia. Where do they diversify away from at this point, given the fact that if it's coming from the United States, how does it even get there, given the fact that there are now real threats on the seas?
So it's early days. And we don't know how long this is going to go on for, but we're told repeatedly what matters here is duration, how long this goes on for. So we can have this conversation about the risk of a 2022. Unlike Russia, I don't think this president wants to get bogged down in a war in Iran for a number of years. Let's hope this is a number of weeks for everybody's sake. But we have to explore the inevitability, maybe the possibility that this does carry on and disruptions continue. And you have a situation in Europe where they face another energy shock several years after the last one. Are we going to see scarring in pricing, and what do I mean by that? I got a message from Jeff Curry of Carlisle yesterday, and he sent out a note, and I'm sure you've read it too. And he's talking about a structural adjustment in how we price commodities, something that sticks with us, that isn't temporary and isn't something you should fade.
And you end up with that kind of structural risk premium on Europe as well. You think about the way that the market was set up going into this. People were set up for oil prices to remain low. They were set up for Europe to outperform because finally they had the chance to do something with respect to rebuilding, et cetera. Now suddenly they're facing the same shock, which is a cutting off of their natural gas supplies. At what point does this become a persistent risk premium that really doesn't put us back to before this conflict began.
Brent crude this morning, 83.88, briefly at 85. Let's get you some single names. 3 hours away from the opening bell. Yahara has more. Hey, Yahara.
Hi, John. As you said, we're seeing this risk-off mood in the market, potentially exacerbating some of these downside moves. We are seeing shares of AMD and NVIDIA lower in the pre-market. On our reporting that Washington is considering fresh limits on AI chip exports to China, potentially capping the amount of high-powered chips any single Chinese firm can buy. This, of course, could further restrict and just complicate these companies' re-entry into that critical market. And the software sell-off is back. We are seeing MongoDB shares plunging nearly 27% in the pre-market. The fourth quarter results were good. It beat consensus, but as we know, the bar has been set extremely high for these software names, and when it came to its full year revenue guidance, it just did not clear it. And we end on the only bright spot in this market, and that is oil. Take a look at Battalion Energy. This is a small oil firm out of West Texas. Shares are soaring 127% as it tracks the broader spike in oil prices due to the war. Exxon, Chevron also positive on fears of a supply crunch. John?
Yahara, thank you. Appreciate the update. On our radar this morning, our top story, the conflict in Iran entering its 4th day. The president's saying there is no fixed timeline and he'll do, quote, whatever it takes. The president's comment coming just hours after Secretary Hegseth rejected the idea of an endless war. Elsewhere, Iran vowing to close the Strait of Hormuz, threatening to open fire on any ship trying to pass through. The announcement effectively halting traffic at the critical choke point. Chinese officials calling on all sides to ensure the safe passage of ships. And finally, Secretary of State Marco Rubio indicating a plan to combat surging oil prices is coming. The Energy Secretary Chris Wright and Treasury Secretary Scott Bessent are expected to make an announcement later on today. Let's stick with energy. Crude topping 85 with shipping traffic through the Strait of Hormuz effectively halted. Salih Yilmaz of Bloomberg Intelligence joins us now for more. Salih, welcome to the program. Can you share with us the damage done to energy infrastructure in the region as things stand?
Sure thing. And I mean, as you highlighted, just in the last 10 minutes, we got the headlines on the terminal that there's a major fire at Fujairah port here in the UAE, not far from where I'm based, which is for the at least intraday pushing Brent prices up to $85 a barrel. And two key things to watch that we've been highlighting since the weekend are impact on oil infrastructure, and as you highlighted previously, Strait of Hormuz. And just in the last 24 hours, we did see some impact on other energy infrastructure, the Ras Tanura refinery in Saudi Arabia. And I mean, you could argue that that's more relevant for products, not crude. And of course, the Ras Laffan LNG exports facility in Qatar. And then you could argue that's LNG. But what we're seeing in the last hour is that, crude oil infrastructure is very much at risk as well. And this obviously would result in a much bigger spike for oil prices. And in terms of oil infrastructure, I guess a good precedent to look back at is back in 2019, when the Houthi rebels attacked the Abqaiq oil processing facility in Saudi Aramco. And this actually took out 5.7 million barrels per day off the market for about a week. And we, in that instance, saw one of the biggest daily spikes in oil prices. So, Strait of Hormuz, very important. We'll be watching whether that lasts for days. The longer it lasts, the more painful it will be, and the more it will be reflected in prices. But also, impact on this type of oil infrastructure can be very, very bullish for prices.
Salih, I appreciate your time. Salih Yilmaz there of Bloomberg Intelligence on the production and movement of energy in the Middle East. Jorge Leon of Rystad Energy writes this: there's a high risk of prices increasing in the coming days. The impact on GDP and inflation could be significant. Jorge joins us now for more. Welcome to the program, sir. What do you think is more notable, the hits to energy infrastructure or the passage of energy through the Strait of Hormuz grinding to a halt? Is it one or the other?
Good morning, John. Thank you for having me. I think it's both, but if I was to choose one, most of the price action is because of the traffic in the Strait of Hormuz being halted. Let's not forget, this is 15 million barrels per day. That is 1/3 of seaborne crude exports globally. So this is a massive disruption to the energy system, and in particularly to the oil market. But of course, recently in the last few hours, we've seen increasing hits on energy infrastructure. The recent one, the latest one, just 10 minutes ago, the Fujairah port has been hit, but also refineries and oil storage facilities in Oman, for example. So I think that we're gradually going into more and more attacks on energy infrastructure, and combining both the closure of the Strait of Hormuz and attacks on energy infrastructure, that is likely to keep supporting oil prices for the hours and days to come.
It seems like, Jorge, Iran has crossed a line that it hasn't crossed before in terms of attacking energy assets of other Middle East nations. This has crossed the line in a number of different ways. You've heard retaliatory comments coming from some of the other Middle East nations. I'm just wondering, is there analogous period in time to this one in terms of both a question around the Strait of Hormuz and how open it will remain, as well as attacks on infrastructure in other Middle Eastern nations?
That's a great question. If you remember back in the 12-day war last year, energy infrastructure was not touched. It was clear, but right now we've crossed many red lines. Now, the only historical parallel that I can think of is the Iran-Iraq war, where Iran closed or partially closed the Strait of Hormuz for a few days, a couple of weeks, and that caused quite a bit of disruption. That would be the main historical parallel. But obviously, you know, things have changed massively in the 40 years. You know, the way vessels are attacked have also changed. So I think that the impact of closing the Strait of Hormuz is actually much higher right now.
It seems like, Jorge, when I was speaking to investors yesterday, they seem pretty sanguine about this. They said always fade the moves in geopolitics. They tend to be short-lived and tend to be good buy the dip opportunities. Why do you think this is a different experience, that people are underpricing the risk of oil surging much more significantly?
I think for a couple of reasons. The first one is that we were all very surprised on our price action yesterday. We thought that Brent was going to open at $85, $90 per barrel. In reality, it was less than 80. Today, of course, oil prices are reaching $85 per barrel. But I think that the limited initial price action is driven by the fact that, don't forget, we're in an oversupply market in 2026. There's ample crude storage, particularly in China, but also in other main hubs. And one important historical parallel that I think is worth remembering, when Russia-Ukraine war started in February 2022, oil prices didn't react immediately. It took more than 10 days for prices to really spike and reach $130 per barrel. And that's the main message here, right? It's the unknown, how long this is going to last for, which is probably holding a little bit the upside price pressure.
So, Jorge, we keep hearing this, and I think it's really important. I think we have to tackle it head on now. A lot of people come on this program and say, it depends how long it lasts. It depends if it goes on for weeks or months. Where's the tipping point on the calendar where this becomes much more real and does become like 2022?
I think that the main things that I would keep an eye on is storage facilities in GCC countries. How much storage facility does Saudi Arabia, the UAE, and Kuwait have at the moment to prevent production shut-ins? We know that at current rates, they could still hold production steady for 15, 20 days. But after that, if there is no way to export crude, they will need to start shutting in production. And that's when things really become tricky.
That's the specific thing to watch. Jorge, appreciate your time. Thank you, sir. Jorge Leon there of Rystad Energy. We've heard it a lot, haven't we, in the last 24 hours? Just depends how long it goes on for. That's why time matters.
Yeah, 15 to 20 days potentially could be the tipping point at a time when President Trump has talked about this going on for 4 or 5 weeks. So how much do the pressures from some of the price appreciation in energy resources really cause an end to this, or can it? That's the other question. How do we get an end to this that's clean, given the fact that potentially this has some of the hallmarks of something that's not exactly easy to shut off?
Equity futures just off session lows. We're down by something like 2% this morning, down by 1.7. Let's keep an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Donald Trump vowing to do, quote, whatever it takes in Iran as the war enters its 4th day. The president originally projecting the war would last 4 to 5 weeks, but later saying the U.S. has the capability to go far longer than that. U.S. Defense Secretary Pete Hegseth, however, rejecting the idea of, quote, endless war. Meanwhile, we are seeing Target shares rising more than 4% in the pre-market. The retail giants posting an earnings beats for the fourth quarter. Target also forecasting better than expected profit for the full year, indicating its turnaround plans are starting to pay off. And Meta is testing out a new shopping research feature in its AI chatbot in a bid to compete with OpenAI's ChatGPT and Google's Gemini. The feature suggests products on a carousel with information and a brief explanation of its suggestions. It's being rolled out for some U.S.-based users. That's your brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, inflation fears resurfacing.
We look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, inflation. That's the skunk at the party.
Did the skunk just turn up? Torsten Slock of Apollo joins us next, live from New York. You're watching Bloomberg TV.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Holding on to losses here, we're down by 1.6% on the S&P 500, on the Nasdaq down by 2, on the Russell down by 2.4. In the commodity market, big moves in crude, up by 8% on WTI 77, Brent crude briefly through 85. A big repricing of the energy complex, including gas prices too. Gas prices in Europe, Bramo, absolutely surging.
Yeah, and this is a sort of 1-2 punch. On one hand, there's a question about just the shipping transits and how open they will remain, how under threat they will remain. And then there's a question of actual attacks on energy assets in the Middle East, which opens up a new specter of actually resources being constrained.
Under surveillance this morning, inflation fears resurfacing.
We we look at risk, we look at the broad range of outcomes, and there are negative outcomes, but one of them would be, inflation. I call that's the skunk at the party. Some of these things, when you talk about war, Vietnam, did it affect the economy in the very short run? No. It had a 20-year effect after that. So you got to look at these things as they're moving plates. It can take 5 years to have an effect, but effectively real. Right now, the economy is doing fine.
So here's the latest this morning. Global bonds seeing their biggest sell-off since May, with the Middle East conflict reigniting inflation fears. Thorsten Slock of Apollo writing the key issue is the duration of the shock. Markets may quickly get used to a situation that could last weeks or even months. Thorsten joins us now for more. Thorsten, welcome to the programme. Does this shock have the potential to become an economic issue in the months to come?
Yeah, because this is a stagflationary impulse. It's actually quite similar to what we saw with the trade war. Prices are going to go up. And ultimately, if it persists, GDP is going to go down. So this creates a huge headache for the Federal Reserve because the Federal Reserve now needs to assess the dual mandate. Where is the hit the hardest? Is the hit the hardest on inflation? Should they worry more about inflation going up? Or should they begin to worry about the downside impact on the labor market? That's why this is a complicated shock, just like we saw with the trade war, just like we saw with Ukraine, Russia, and just like we're seeing today.
Thorsten, relatively speaking, is it a bigger problem for the Bank of England, for the ECB?
Well, the challenge for Europe is that they depend more on energy. The US produces, of course, a lot more energy than it consumes itself, whereas in Europe, we do have a much bigger energy dependency, and that's exactly why markets are trading the way they are, where Europe is getting harder hit, because there simply is a bigger energy dependency in Europe.
How important, Thorsten, is it for a stagflationary shock for there to be enough economic momentum in a country to withstand and prolong price hikes?
Well, the challenge, Lisa, is that the starting point is extremely important. Inflation in core PCE today is 3.0. So if inflation today had been 1.0, it would have been a completely different discussion. But now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters, potentially, that is certainly a risk that the Federal Reserve needs to take very seriously.
Well, this is a reason why I was surprised, Thorsten, in the conversations that I've had with a number of different investors, even companies. They seem really excited, actually, about the opportunities ahead. They think the economy is chugging along. They're looking to invest. The sort of manufacturing boom feels like it's actually getting legs. How much could that amplify the risk of a stagflationary shock, because it could cause the price increases to be more significant in a way that isn't just necessarily a one-off shock from commodities?
No, you're right. And I mean, if you just think about what has happened in the last few weeks, first we were talking about, wow, the US economy is strong. Then we were talking about, oh my God, we're all getting unemployed because of AI. Now we're back to talking about, wow, inflation is going up. I mean, no wonder that the people inside the Federal Reserve are looking at this and probably scratching their heads and say, well, now there's another shock that we need to take into account. But in combination, the issue is still that the U.S. economy is doing really well. We have 3 very strong tailwinds from AI spending. We have a strong tailwind from the Industrial Renaissance. And let's not forget that the Congressional Budget Office, they estimate that the One Big Beautiful Bill will lift GDP growth this year by 0.9%. That's an enormous boost to GDP coming from fiscal policy. So taken together, it is a very strong economy, and it is an argument that has been made by many, including me, that we are at risk, of course, of seeing more upside pressure on inflation. And now you add here in the last few days, on top of that, some more upside pressure because of oil prices. And finally, let's not forget also, if this was just a few days, well, the risk is now that even today, now we're getting headlines about new oil facilities potentially also getting hit. So the challenge here is that, well, what headlines should we then expect over the next several days again? So it really is a complex situation because of this incredible risk that we might begin to see even more upside pressure on inflation from an already pretty bad starting point.
Well, Thorsten, let's unpack the bull case for the US economy and the tax component of it. Let's go with tax refunds. And you mentioned the labour anxiety connected to what's happening with AI developments. I think that's a feature of the conversation going forward. Does that hold back people when it comes to spending those tax refunds, given that they're now going to see higher energy bills, potentially, higher utility bills, potentially? Does that make them more risk-averse, conservative in the months to come?
No, you're right, John, because last year, if you go and look at, of course, what tax refunds normally are, they were around $3,000 per family. And now this year, if you think about that, the One Big Beautiful Bill is done retroactively starting in January 1, 2025. That means that we have all paid too much in taxes in 2025. That means that our tax refunds will be bigger this year. On average, they will go up from $3,000 last year per family to now $4,000. And there's 129 million households in the U.S., so if you multiply these two numbers, that's $100 billion more in consumer spending coming along here potentially in March and April and May. So over the next several months, we're going to get quite a lift in consumer spending. But you're right, if consumers are very worried, they could be saved more, but that's why the key indicator to look at on that is to look at consumer confidence. Consumer confidence has done a little bit better, but are consumer confidence indicators getting impacted by this or not? That becomes very important over the next several readings.
So, Torsten, that feels like much more of a European story, potentially, than a US one. How do you expect central bankers to guide us through this moment? We had some guidance from the Australian Central Bank overnight saying every meeting is live. What do you think the approach will be of, say, the Europeans, of the Federal Reserve, the ECB?
Well, I think it's easier for the Fed because they will probably be more two-handed and say, on the one hand, we have inflation going up. On the other hand, we're worried about what this means for the labor market. It's more challenging for the ECB and the Bank of England because they don't, quote unquote, care about the labor market. They really only target inflation. And if they only target inflation, they should begin to be more hawkish. So that's why it makes sense that rates expectations and central bank expectations are moving more in Europe because the Europeans have simply a different mandate, namely only inflation.
Torsten, does this torpedo the bull case for Europe and, frankly, for a lot of the ex-U.S. discussion? Because even though, yes, the United States could face a stagflationary shock, other places could struggle with that even more at a time where the market seems to be overly positioned that way.
Well, the challenge for Europe is that the main bull case for Europe is really that Germany has said that they will spend 500 billion euros on infrastructure and spend unlimited on defense. So the question that, of course, is immediate here is to ask, well, what are the Europeans going to do now in the form of defense spending? What are they going to do in the form of more government spending? So the policy reaction becomes very critical. How is Europe going to respond to this? Are they going to say, well, too bad, inflation is just going up? Or are they going to say, well, wait a minute, maybe we do need to do more on the fiscal front? And there is not much room to maneuver on that front, but it becomes very critical that on the policy front, the Europeans are likely going to at least say and indicate more action as a result, in particular if this does become more of a negative risk to the GDP outlook.
Torsten, thank you, sir. Always great to catch up. Torsten Slok there of Apollo. The Europeans have limited fiscal space. If they have to support the electorate, the people that vote for them, on the energy side, do they have the space to do more on defense? The answer to that is probably not for certain countries.
Well, and this actually pairs with what Chris Verone was saying earlier, which is that yesterday defense stocks in Europe sold off. Well, could that be a concern that there wouldn't be enough fiscal headroom to both support some of these defense companies as well as ameliorate some of the bills that people are going to be getting when you have natural gas prices surging to this degree?
This is early days, of course, and a great degree of this, big chunk of it, is scenario analysis, but some of it's very real. It's happening right now. You're seeing the hit to infrastructure. You're seeing the traffic grind to a halt through the Strait of Hormuz. That's happening right now. That's real.
And it's definitely affecting European natural gas prices more than anything else. I do think it's a U.S. story as well, though, very clearly, given the fact that the U.S. administration has talked about similarly supporting oil prices and supporting some of the hit that people might be experiencing after we just saw the biggest increase at the pump going back several decades in one day. So clearly it's not just Europe. It's also going to the U.S. in terms of a policy response to avoid some of the consumer anger.
Does that mean selling more LNG to the Europeans?
Well, that's a great question.
Right.
Does that actually constrain the U.S.'s desire to continue to be the export partner? I mean, there's so many questions here, and it really does create a murky situation.
Brent crude up by 8%, euro dollar down by 0.8. The euro, a break of 116, 115.97. Up next, we'll catch up with Mark Haefele of UBS, Clayton Siegel of CSIS, Jordan Rochester of Mizuho, Tony Rodriguez of Nuveen. The second hour of Bloomberg Surveillance just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies. which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We do not have any sort of threat on Iran's oil production.
These oil price spikes, and especially if we have to balance the global oil and LNG market by demand destruction, that's going to lead to a recession.
We're probably going to continue to at least run at 3% on inflation going forward.
The Fed is not going forward with an easing bias.
I think that they will look through a spike in oil prices generated by the conflict and not necessarily react.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your price action, the scores look like this. We're down across the board, down by 1.6 on the S&P, -2 on the NASDAQ. This move on crude, up 9% on Brent, just short of 85 through that level. Earlier on in the session, WTI 77 up by 8.7, and a big move in European gas yesterday and again this morning.
Qatar Energy, which accounts for about 1/5 of all liquefied natural gas supply, is temporarily closing its operations and did so yesterday. Now they're potentially closing other operations, and you're seeing not only questions around the shipments of natural gas and oil, but also the production because of direct attacks on these plants. This, to me, is a game changer, and that's the reason why slowly it's getting priced into the market as, hold on a second, maybe this is a significant disruption.
You see this as a much, much bigger game changer in a place like Europe. Check out the bond market moves today. Treasury yields are much higher. I've got that. But look at places like the UK. You've got an 18 basis point move at the front end of the curve. And I know there's some fiscal issues over there that will be discussed today. But these are big moves you're seeing across other European nations as well. German yields up by 8 basis points on 10s. And big moves at the front end. And it's notable that we're talking about the front end because that's much more sensitive to monetary policy. We're pricing out easing at the Federal Reserve. We're pricing out cuts at the Bank of England and pricing in the prospect, just the conversation, the prospect of tighter monetary policy at the ECB.
Look, we learned this in 2022, that Europe is vulnerable to a supply shock when it comes to energy, and it's on two fronts. On one hand, it's gas, but it's also it's oil, but it's also natural gas at a time when they are entirely dependent on other nations outside of Europe for these supplies. If you think about yesterday's stock action, the reason why the U.S. ended the day in the green was because of AI and because of energy stocks that did really well, because guess what? The U.S. produced produces a lot of energy and can actually be somewhat self-sufficient. Europe doesn't have that ballast of either the AI behemoths or of their own energy production, so uniquely vulnerable, not only because of supply disruption, but also because of the composition of their economy.
Some of the big winners as well getting hammered in today's session. The big winner of the year, equity market, that index, the Kospi. Huge winner for the year so far. Massive loser in today's session, down by more than 7%. And we're seeing that in precious metals too, where you've had the big gains through much of the year. They're the big losers through much of this morning.
Yeah, momentum is getting flipped on its head. I'm looking at gold prices, and they're down significantly. Silver prices down significantly. How does this jive with the idea that gold and silver are the new havens if suddenly you have a 3.4% decline in gold in one day and an even bigger move in silver? There is a feeling that this upends the narrative, and it upends a lot of trades, and it really undermines some of the price action. I keep going back to what Chris Verone said about gold. This really does challenge some of the uptrends. It makes you wonder, are we breaking through?
Coming up this hour, lots to discuss. Mark Haefele of UBS will join us as the conflict with Iran puts investors on edge. Clayton Siegel of CSIS as oil breaks back into the 80s. And Tony Rodriguez of Nuveen as the widening conflict revives inflation fears worldwide. We begin this hour with stocks lower and crude extending gains. Mark Haefele of UBS writing, historically, the impact of geopolitical shocks on markets is short-lived. Investors should maintain a long-term focus using periods of volatility to build more diversified portfolios. Mark joins us now for more. Mark, welcome. Let's think about your base case into the weekend. And given developments, whether that base case has changed.
Well, it hasn't changed yet. I think in our base case, we said this was a time absolutely to diversify, rebalance, and hedge. We've been saying that since January. We expected that there would be kinetic action. And our base case is that, if it lasts less than 4 weeks, we think this can be kind of resolved and it'll be back to worrying about AI again and other things. That said, the discussion you've been having, I think, is the right one. We now know this is not a Venezuela narrative. The administration is telling us it's not an Afghanistan narrative. So what is it? And I think in Europe, they are worried. Is this a Russia invasion of Ukraine energy spike narrative? Now, we're not there yet, but that is, the longer this goes on with Iran pushing back, the more those more extreme scenarios are going to start to get priced in.
Mark, you said 4 weeks. I've asked this question a few times. Why is that important to you? Why 4 weeks?
Well, I think at that point, is it a little bit arbitrary? Yeah, but I think that's when you've moved beyond kind of the initial estimates of what the U.S. can sustain, and certainly well beyond what Iran can sustain, and therefore it's another kind of conflict, maybe something asymmetrical, where Iran uses drones or other things to continue to cause pain in the wider region and disrupt both travel and also the energy pipeline. So I think that's, if it can't be contained by there, or the president has not decided to declare victory by then it's pretty clear we're moving towards the potential for a downside scenario.
At the same time, Mark, markets are forward pricing indicators, so the market's going to move significantly before that, and you have to be thinking, okay, well, how exactly do I arrange for all of the potential scenarios, which have changed somewhat over the past 48, 72 hours? I'm looking at the Bloomberg Dollar Spot Index. It has had its biggest two-day move going back to April, and we're seeing a flight back there. We're not seeing it into gold. We're not seeing it into silver. Is there a tell here that you think is important for investors?
Well, I think that the currencies is a very interesting area where we've been looking, this kind of flight to safety on the currency side. We're looking for opportunities in things like commodity currencies, like the NOK, Australian dollar, where, they could potentially win in this scenario if some of that flight to safety rolls off, but the strength in commodities continues. I think it's also an opportunity to perhaps broaden out your tech exposure into Asia, into tech in Europe. So that's where there's some opportunities. Now, in terms of the broader narrative, I think, we had a lot of our targets for the upside. For the year, they already got hit in January. And that's why we said, hey, let's let's use a little common sense here and rebalance some of these things. We still think gold does have upside into the year because that central bank buying continues. But some of these moves, where things go vertical, common sense says, it is time to rebalance the portfolio.
So, Mark, I'm just wondering, have you changed anything since the conflict began with Iran in terms of your portfolio?
We haven't changed anything since Friday. I think a lot of our clients went into this well diversified with enough cash on hand, and so some of them are absolutely looking for alternatives. I think we feel the same in the money that we manage on behalf of clients. There's just too much uncertainty about these larger narratives to be trying to make big moves in these very fast-moving markets.
So, Mark, are they deploying any capital? When they hunker down, is it purely in cash? Where's the money going?
Yeah, I think that where they're looking for opportunities is to diversify. I think a lot of people last year realized that currencies are a thing, and that getting caught in one currency or being overweight in the U.S. dollar can be more costly than they originally anticipated, especially for clients outside of the United States. And so looking for those opportunities to diversify is really a focus of the work that we do and what clients are asking for.
Mark, just to build on that, are they using this strength in the US dollar over the last few days to diversify away from the currency?
I don't think yet, right? I think it's a welcome sign that you don't need to, move rapidly to diversify all your dollar exposure. People are pricing in what does that U.S. military strength and the liquidity of the U.S. dollar still buy you in this world. So it's more of that this isn't a one-sided argument about diversifying out of the dollar at this point.
Is there a feeling right now that riskier assets, which have gotten a little bit heady in terms of pricing, need to reprice just a bit because of a security premium, as we were just talking about with Jeff Curry over at Carlyle, because of a risk premium that needs to get baked in at a time of what's going on in the Middle East?
Well, look, I think a lot of that already started a few weeks ago around AI. I mean, let's remember, last week, I think, was a huge week in terms of AI and the uncertainty that needs to price in around our future as well. So there's a number of these big kind of uncertainties that are coming together right now. Investors have started this process. This week is continuing that process, and we'll see how far it goes on the defense side. I think that in some ways, if there is a resolution to this, we'll be back to worrying about AI again, and what that future means. And it was almost a little ironic that we saw the NASDAQ go up yesterday. Yeah. Given the concerns about AI, it's just like, well, the market took their eyes off it, so that popped up, right?
I think that's the chaos they prefer to deal with. I never thought I'd say that, but here we are. Mark, thank you. Mark Haefele there of UBS. I think people hope we go back to all that AI nonsense of the last few weeks.
Honestly,
this is too real.
It's almost like nostalgia. People saying, we'll go back to worrying about AI. Please, can we get to that? Right now, it feels like the embodiment of macro paralysis because there's so many unknowns. You don't have an edge. You don't have any kind of positive spin on this. You're just waiting to see how it develops.
This is all too real. Big moves. We're seeing in energy. Brent crude up by another 7%, 83.55. Higher the session just through 85. WTI this morning at 76.41. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Israel conducting a new round of airstrikes in Tehran this morning. It follows an Iranian drone strike near the U.S. Embassy in Riyadh, Saudi Arabia. Iran also says it targeted a U.S. base in Bahrain. Speaking yesterday, President Donald Trump vowing to do, quote, whatever it takes against Iran. China is calling on all sides of the Iran conflict to ensure the safe passage of ships through the Straits of Hormuz. Tanker traffic has been effectively halted since Saturday as the world's largest oil and gas importer. China is among the most exposed nations to any disruption, oil surging more than 15% since the conflict erupted 4 days ago. And Oaktree Capital Management co-founder Howard Marks says investors need to avoid letting their emotions run high when making decisions on exposure to the Middle East conflict. Speaking at a summit in Australia, Marks saying, quote, "The main thing to keep in mind is how much we don't know about the conflict's duration, size, and outcome." That's your Bloomberg Brief, John.
Yahara, thank you. Thanks for the update. Up next on the program, a plan for higher prices.
We have a program in place that will begin to be implemented by Secretary Wright, Secretary Bessent. We talked about it last night. Again, about this program, we talked this morning. And starting tomorrow, you will see us rolling out those phases to try to mitigate against that.
Up next, Clayton Siegel of CSIS from New York City this morning. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Stocks slowly recovering, but still near the lows. We're down by 1.5 on the S&P, down by 1.9 on the Nasdaq. On the Russell, some underperformance again. We're down by about 2 full percentage points. The move in crude, big moves. WTI and Brent. Brent crude briefly through 85 for the first time since 2024, up by close to 7%, but just off the highs at 83. Some major moves developing in the European gas market, very exposed to LNG production at a place like Qatar, of course. They're getting shut down in the last 24 hours. A two-day move of more than 80% on European gas futures. And there is a real conversation from our European partners this morning about the prospect of reliving another shock similar to what we saw in 22.
They haven't solved the ultimate problem, which is they're dependent on exports of energy resources, in particular natural gas. You look at the Qatar Energy, which actually suspended its production on Monday. It accounts for a fifth of all liquefied natural gas production in the world. So you start to think about that, and you can understand why you're seeing such a significant move.
Let's talk about energy. Under surveillance this morning, a plan for higher prices.
Have a program in place that will begin to be implemented by Secretary Wright, Secretary Bessent. We talked about it last night. Again, about this program, we talked this morning. And starting tomorrow, you will see us rolling out those phases to try to mitigate against that. This terroristic regime, led by radical clerics, has the ability, potentially, to shut off 20% of global energy. That's the kind of leverage they have because of their Navy. We're going to destroy their Navy.
So here's the latest this morning. The Secretary of State Marco Rubio is saying the White House will work to ease energy costs as crude extends gains. Iran now threatening to target any oil tankers trying to move through the Strait of Hormuz. Joining us now is Bloomberg's Mika Sona. Mika, welcome back. Let's just talk about what the plan actually is and when we'll get the details of it.
Yeah, the White House is very aware of the need to try and control energy costs right now as this is becoming a political issue. I think that they're still working things out in terms of how exactly they can try and combat any rise, as we're already seeing these prices rise. But President Trump is very aware that he needs to focus on affordability issues this campaign season, and he can't let this be a political liability going into the November midterms.
Do you think it's becoming a political liability?
I think it could be. I think we're going to have to see what continues with these prices. But energy dominance has been one of the president's major goals and one of his major issues that he's really tried to tout on the campaign trail, and one that he continues to exert. So I think that we're going to see any mitigation potentially, and we're going to see this plan lay out in the next few weeks.
Mika Sona down in Washington, D.C. Looking forward to seeing the plan. Clayton Siegel, the Senior Fellow for Energy Security at CSIS, writing, either the traders and the administration know something we don't, or we could be sleepwalking into triple-digit crude prices pretty soon. Clayton joins us now for more. Clayton, welcome. Do you think we're underestimating the potential for severe disruption over a prolonged period?
Good morning, Jonathan. You know, in my opinion, the market is still giving the Trump administration the benefit of the doubt, and it has been since markets reopened yesterday after the start of this war. It's assuming that Washington has a plan for not letting energy supplies be curtailed enough to really cause a return of inflation and negative effects for the economy. But the sand is falling through the hourglass. And so, as you've already reported this morning, prices are continuing to march higher. I'm surprised, frankly, that they're not higher still. But nevertheless, the market is giving the benefit of the doubt and just assuming that there is a plan here to mitigate the worst case fears.
Before we get into, Clayton, how high oil prices could go, I'm just wondering what you make of what we heard from Rubio yesterday, Secretary Rubio talking about mitigation tactics to lower energy prices. What levers can the U.S. pull at this point?
It's going to be really interesting to see what's included in this package. Probably there will be consideration for short-term measures that could include potentially a gasoline tax break. It could include waiving certain regulations that add up to the cost of production and of both crude oil and refined products. So you could get some relief on the supply side. And then, of course, there are also bigger tools in the toolkit, potentially like using the strategic reserves that the United States maintains. We have a lot less than we did before 2022, only about 415 million barrels on hand, but could still cover our needs for quite a while.
What about Venezuela? How does Venezuela factor into this? Some people might say, well, actually, the fact that Middle East oil might be disrupted, the U.S. can lean on Venezuela production, ramp it up, and actually stave off some of the shortages that a place like Europe is experiencing. Is there any credence to that?
I think that there's a basic misreading of the arithmetic there. I mean, Venezuela, on a good day, now that the quarantine is largely lifted, produces 1 million barrels per day. The world uses 100 million barrels per day, and as you guys have reported, a fifth of that, 20 million barrels per day, come from the Middle East Gulf. So Venezuela couldn't hope to offset more than a small fraction of the export flows that have so far been halted coming through the Strait of Hormuz. Traders and investors are going to be looking to see when those exports can be resumed in order to have confidence that we'll stave off that worst case scenario.
Can we just stay on that important waterway? So we know the traffic is basically ground to a halt. This is the Strait of Hormuz. And we also know that Saudi has the ability to divert some shipments through the East-West pipeline. I believe it can carry something like 5 million barrels per day. This headline just crossed the Bloomberg terminal, Clayton. I'll share it with you as I read it. Aramco is exploring a plan to export crude through the Red Sea to avoid the Strait altogether. Clayton, how doable are these workarounds?
They're doable, but they're limited, Jonathan. So you're right that maybe the nameplate capacity of that pipeline, the East-West pipeline, that connects the producing region in the Gulf with the Red Sea is about 5 million barrels per day. But you got to remember, it's already about 50% in use. They're already transporting for export on the Red Sea and also offtake to several Saudi Aramco refineries along the way, about half of that capacity. So you really only have on the order of 2.5 million barrels per day that can be diverted from the Gulf, where they're exporting between 5 and 6. It's just a fraction of the daily requirements.
Clayton, as things stand, are you more concerned about developments on the crude side, oil, or on the gas side?
You know, there's a very close parallel there because the world is dependent on 20% of its total needs from that region for both oil, if we look at crude and refined products together, and then also gas in the form of liquefied natural gas, almost all from Qatar, which you've reported this morning is closed for the time being. And so we have acute concerns for the economy on both fronts. If we don't get these exports flowing again soon and reestablish confidence that the export terminals that are loading the ships are going to be secure from attack, then we're going to have concerns about running short of both oil and natural gas. That's going to drive fuel prices higher and electricity costs higher as well.
Clayton, which is the bigger existential threat to energy supplies? Is it the contraction of the Strait of Hormuz and continued closure, frankly, effectively to ships coming through? Or is it some of the recent attacks on energy facilities in the Middle East?
Yeah, I think it's the facilities are an even a greater concern than the shipping. I look at it like this in simple terms. If you go to the supermarket to buy your groceries and the exit to the parking lot is closed, you can't get your groceries home. But the exit can be reopened, probably relatively easily. If you go to the store and there's no electric power and there's also no groceries, it doesn't really matter whether the exit to the parking lot is open or closed. That's kind of what we're looking at here in the Middle East Gulf, I'm afraid, today.
Clayton, appreciate that framework for thinking about things. Thank you, sir. Clayton Siegel there of CSIS, a thoughtful conversation about the latest developments in energy. So this is the latest headline crossed on the Bloomberg terminal that Aramco is exploring a plan to export crude through the Red Sea to avoid the Strait of Hormuz altogether. We'll look for details on that plan. As we discussed there is a pipeline, an east-west pipeline that can carry 5 million barrels a day from Saudi and push that out to the rest of the world. But as Clayton's talked about just then, Bramo, effectively a lot of that is already in use. There are workarounds, but it's limited, which is why that strait, that waterway, is still so important.
Yeah, and it still is the choke point, frankly, for a lot of these supplies coming through. The issue that we have today, and the reason why you're seeing the prolonged and extended rally in some of these energy prices is because you are getting the 1-2 punch. On one hand, a question around the constriction of the Strait of Hormuz, but also, A, the workarounds aren't clean, neat, or easy. And B, the idea that you're getting these attacks directly on energy facilities does change the equation. So even if OPEC Plus wants to increase production, can they, if they have this type of damage done to their facilities?
It's production and movement. Crude at the moment just off the highs. We're up by 7% on Brent at 83. On WTI up by a similar amount. On WTI crude this morning higher to about 76.15. In just a moment we'll catch up with Jordan Rochester of Mizuho. A big moment for Europe. Is it time to pull out the 2022 playbook? We'll have that conversation in just a moment. Then Yahira's going to pop back. We'll get shares of Target for you, rising as a turnaround starts to pay off. There's a bright spot in the market. We found it somewhere. Target up by 4% this morning. The broader equity market not doing so well. We're negative 1.4 on the S&P, and big losses developing in Europe as well. The DAX, the equity benchmark in Frankfurt, Germany, down by more than 3%. In Italy, we were down by close to 5. We're now down by almost 4. From New York City, you're watching Bloomberg TV.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Equities down by 1.4%, recovering somewhat. They were down by as much as 2% earlier on in the session. On the Nasdaq, we're down by 1.8. On the Russell, holding onto losses, down by 2 full percentage points. The epicenter of the repricing worldwide is the repricing right here in energy. On crude, on gas, WTI, and on Brent. Brent briefly through 85, 83.20 right now. And in the bond market, it's leading to a repricing across the curve worldwide in bonds like treasuries, in gilts. On a 2-year, stateside right now, yields are higher by 8 basis points following a double-digit move yesterday, 355 on 2s, and that is breathing some life into the US dollar. The dollar yesterday had its best day since July of last year. The XY is up by 1.6% in just 2 sessions, and again this morning, the dollar is stronger against everything in G10, including the euro. The euro with a brief break of 116, euro dollar negative by 0.7%.
Yeah, 2 things. The U.S. dollar is a haven again, especially because it is more resilient to some of these shocks than, say, Europe, which is uniquely exposed to energy shocks. That's number 1. But number 2, when you take a look more broadly at a scenario where you have this kind of shock in the U.S., there are so many levers that they can pull, and you are seeing people really embrace that.
There are some tailwinds for the U.S. economy that will stay regardless of what happens here. The massive tech capex, the tax cuts that we're going to have, or rather the tax relief, I think is probably a better way of phrasing it, and the refunds we might see in the coming months. How that's spent, that should be a discussion, and the rate cuts already in the pipeline from the last 12 months. So the U.S. economy should be quite well supported. It's got the energy production as well. Europe is far more vulnerable, unfortunately, on this particular occasion.
Which raises the question to me whether the ECB really has to do as much, because the stag part of deflation becomes significantly more relevant than, say, in the United States, where you have more growth that can generate a little bit more inflation. Nonetheless, it is proven out in 2022. They have to respond. Question is it just going to be monetary, or is it also going to be on the fiscal side?
The euro at 116, 2 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. The Target turnaround is finally taking hold. We are seeing shares up 3.3% in the pre-market after the company posted a better than expected profit outlook for the full year. And the bar was high for Target. Shares were up 16% year to date as we've seen investors rotate into retailers and other areas of the market that they see as less vulnerable to AI. So Target bucking the risk-off trend we're seeing this morning. Also bucking that trend are oil stocks. Let's take a look at Battalion. This is a small oil firm out of West Texas. Shares are up more than 100% as these companies track the broader spike we're seeing in oil prices. Chevron, Exxon also higher on fears of a supply crunch. And of course, higher oil prices, of course, means higher jet fuel costs, and that is what's putting pressure on the airlines again this morning. But not just that, we are seeing big disruptions with airline cancellations topping 12,000 around the globe. Plus, you have this idea that if tensions continue to rise, people will think twice about booking a trip. John?
Yahara, thank you. Double whammy. 1-2 punches, you said, for some of these names, including the airlines. Energy costs 1, fuel costs And then you've got the traffic problems in the Middle East right now. All of that is just shut down. Never mind, as Yohara just mentioned, the anxiety associated with traveling, I think, more broadly at the moment. It's not a great time to be an airline, all of a sudden, just like that, in the last 48 hours.
We were talking about the nostalgia of worrying about AI. Is there a nostalgia about government shutdowns for the airlines, given the fact that this feels more existential and, frankly, comes with real fear on the part of travelers?
On a radar this morning, the Secretary of State, Marco Rubio, saying the U.S. military will step up attacks against Iran.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Lisa, Rubio denying the regime change is the end goal, stating the focus is to destroy Tehran's ballistic missile program and naval fleet, but also suggesting we might get a plan. And I think it's important to see the details of this plan to offset any potential energy pain.
Yeah, there's a real question what levers they can pull, and people have been pointing to the Strategic Petroleum Reserve. What did you call it, the Strategic Midterm Reserve back in 2022?
That's what it was. I don't think I coined that. That's the one I liked, but yes, that's what it was back then.
Well, let's take a look at the Strategic Midterm Reserve. We saw it go down from more than 600 million barrels now to 415 million barrels. It's declined by some 37% since that peak in 2020. And we're looking at potentially doing it again because guess what? It's midterm season. And you just wonder how far can you go with this type of reserve before suddenly we got nothing left and you have to pull some other moves to try to offset some of the pain that people are feeling.
So we don't know if that's the plan. But yes, the Biden administration did drain this ahead of the midterms last time around. And it has been depleted and hasn't been completely restored. And you can see it in that particular chart.
So to me, this raises a question. Do they have other things in mind? We were talking earlier with strategists who talk about removing the tax on gasoline. This is going to be a pain point at a time where this isn't that popular, and you do wonder how much people are pushing to try to get some sort of solution.
The Treasury Secretary is currently quite busy. Scott Bessent and the US Trade Representative Jamieson Greer are meeting with Chinese officials in Paris later this month. People familiar with the matter telling us here at Bloomberg that officials are laying the groundwork for the upcoming summit between President Trump and China's Xi Jinping. And finally, OpenAI, the CEO, Sam Altman, saying the company's push to make a deal with the Defense Department looked, quote, opportunistic and sloppy. Altman posting on X that OpenAI is working with the Pentagon to ensure AI isn't used for domestic surveillance of Americans.
This is because people moved to Anthropic. OpenAI was beset by a whole host of, quit ChatGPT and go to Claude. And you also had pushback from his own employees. It feels a little bit like, over here, I think, oh yeah, we should go over here because some people are pressuring me. It doesn't really scream of, significant stance or backbone.
Competence.
Yeah.
Doesn't scream competence.
Thank you.
Yes.
You said it, I didn't, but
yes,
there is
a feeling. You danced around it enough.
It's sort of figure the wind. Yeah, exactly. Thank you. I think that very much expresses it.
Yeah. Let's turn to foreign exchange. The dollar rising once again today as President Trump says there is no fixed timeline for the conflict in Iran. Jordan Rochester of Mizuho saying it will be measured in weeks, not days, adding he was, quote, flabbergasted when some clients argued against our decision to flip into short euro dollar, which told me the market had not yet fully woken up to the new reality. Jordan joins us now for more. Jordan, what is that new reality?
John, I'm surprised you went with the flabbergasted quote. I'm not sure all the listeners know what it means, but it means I was in shock and awe, essentially, to what essentially the narrative has been, which is fade this, buy the dip. That's the old narrative. I think everything you knew about the sort of geopolitical Middle East oil crisis of the past 3 years, whatever you thought was the case for the script on Friday, you need to flip it. Because this is a career-defining moment, John. This is a terms of trade shock. And whilst we can argue about that it might not last so long in terms of kinetic action, the rate of intense fire won't last at the same speed. Just imagine a world where you have a 5% hit or a 10% hit to the flows through the Strait of Hormuz, lasting longer than just a few days, but months. This is something that pushes up energy prices, all to the benefit of the US, a net terms of trade exporter of oil and energy. This is something that we can only use the 2022 playbook, John, which is when you saw massive hits to the European trade balances, the current accounts went negative, and you saw huge devaluation in the euro. Now, I do not think we're going to have the same sort of story. I do not think we're talking about the parity in the euro, because there's one man who can decide to end all of this, which is Donald Trump. He can quickly find a way to come to some sort of resolution if he wants to. He can give up on the whole enterprise entirely if he so chooses. But the problem for us right now, John, is we're in markets where we don't know what's going to happen, so we have to price in the tail risks. We have to price in that tail risk scenario. That lowers euro's valuation quite quickly. The move right now has been small versus what it could be if we're talking weeks and months rather than days.
So how well priced do you think we are at 116, and what kind of numbers are you considering?
Well, look, we've got a target, John, very, very short term, and I think we'll be there by Friday at 114. That's the sort of level we're talking about. If I'm wrong about Friday, it's next week. As long as nothing changes on the ground, if it's the same sort of story and we don't know what the end resolution is. If we're talking about something that lasts for 2 months, 3 months, then you've got energy analysts out there saying that the prices of natural gas could double, oil prices going to $100, and there's extreme scenarios where it could go to $130. In that scenario, John, the valuations of euro go below 110 very easily. We're talking the 105 levels and even the sort of levels I mentioned from 2022 with parity. I don't think we'll get there, but we have to be open to the idea of it.
Jordan, you said one person can end this. You're talking about President Trump, that he can just simply stop. Is that true? I mean, isn't there a sense that there is something else going on here with respect to a conflict that has already involved other nations in the region and frankly has exposed that Europe once again has this key vulnerability of being susceptible to energy shocks?
Indeed, the irony of the situation is to avoid the sort of Russian sanctions, most of the focus have been getting supply from the Middle East. Now you've got both Russian sanctions for Europe and Middle East outages. This is a combination where, with gas storages at the lows, Europe does not want to be in. But I think Donald Trump, yes, he does have the ability to end this because he can define how victory is declared a success. It's in Iran's favor for this to de-escalate as well, as the US and Israel are clearly having success with their sort of priorities over the past few days, with the Iranian leadership taken out. So I think eventually it will be Trump looking for a quick win. We have to remember the midterms are coming up, so he does not want this to be something that drags people into the polling booth to vote about, Lisa. But that is November. So I think we're still talking a period of time which we might be uncomfortable with.
You know, Jordan, I'm going back to the note that John mentioned that Jeff Curry wrote, as well as Admiral Stavridis over the weekend with Carlyle, talking about how there has to be some sort of security premium, at least on gas, on oil, and other natural resources, things that have to be shipped. In the same vein, doesn't there have to be some sort of security premium or a discount, I should say, put on European risk assets and, frankly, the currency as a result of this key vulnerability to an energy shock, whether it's 2022 or 2026?
Indeed, it's hard to price that in fixed income and foreign exchange markets, but that will feed through to energy importing companies and the likes. But what your previous guests were also talking about is how plans to sort of circumvent the strait using pipelines, using the Red Sea. But Lisa, I think the Red Sea is a fantastic example of what the end outcome could be. The Red Sea has about half the amount of cargo container flow that it used to have. 2 years ago, the Houthis started their strikes, or just a bit over 2 years now, and the Suez Canal has seen a 50% drop in its volumes as a result of ships bypassing that risk and using the Cape of Good Hope instead. The Strait of Hormuz is very different. We don't really have the ability to bypass it. We have these pipelines that are trying to, but they can't do the entirety of the flows that go through there. So you're going to see this is a war, Lisa, which is also a logistics crisis, because the long-term impact of this, which will take weeks and months to clear out, is the high cost of shipping through insurance term premium. That's something that will take a while to play out, and that will add to energy prices alone.
Jordan, just before you go, Chancellor Reeves, of course, as we speak, is delivering the spring statement in the UK, which I'm sure you've got one eye on as you follow the headlines dropping out. Jordan, when you look at the situation in the United Kingdom and rate pricing around the Bank of England, a lot of that has been priced out when the Bank of England has set us up for those cuts. Can you walk us through the sensitivity of these central banks in Europe to these developments?
Well, first thing is it's inflationary for all of them. So you just have to remember that. We have to think about the starting position, John. Inflation in the US is below 3%. It's pretty benign. The forecast in terms of the curve were below 3% for the rest of this year. The UK's is above target, but it's falling rapidly, is the forecast that we had as of Friday. That forecast has now shifted. It's probably going to be above target now in the Bank of England's sort of outlook. And that forecast is what was driving them to talk about rate cuts, even though inflation has been stubbornly above target for the past 2 or 3 years. So the problem now for the Bank of England pricing is the motivation to pricing rate cuts as of Friday was the forecast coming down. Everything's going to be fine. That's not the case anymore. It means that a rate cut from the Bank of England is now quite difficult to see. I think they might go ahead with March, John. It's more of a 50-50 at this stage, but it'll be one of the most hawkish cuts they can do, and it might be the last in the cycle. And the market is now flipped to saying that the risks are just like 2022, we've got to stop being dovish and think about rate hikes to come.
It's big change. Jordan, thank you, sir. Jordan Rochester there of Mizuho on rate pricing and foreign exchange. Flabbergasted. You got flabbergasted, didn't you?
Of course I got flabbergasted.
Right?
It's a fantastic word. It's onomatopoeia, if I totally butchered that one.
Translates, doesn't it?
100%. I'm flabbergasted that he thought that we wouldn't understand what flabbergasted is.
What's he talking about?
100% agree.
The president made a statement just moments ago. This is what the president had to say. Their air defense, air force, navy and leadership is gone. They want to talk. I said too late. The president of the United States just moments ago.
Yeah, coming out and talking about how it really is. He was tweet quoting or quote tweeting or quote truthing. We're witnessing the birth of the Trump doctrine. Like Reagan, the president has found a way to change the world without putting boots in the ground. It really raises a question, how is he going to execute some sort of endgame? We really haven't seen a definition of what that looks like and what the ultimate goals are. And as Jordan Rochester was just saying, that's key to figuring out when this potentially could end.
We'll keep tracking crude for you. Higher this morning by 7%. Brent at 83.26. With an update on stories worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Chinese Foreign Minister Wang Yi is calling on Iran to pay attention to the reasonable concerns of its neighbors. That's after Tehran's retaliation against U.S. and Israeli attacks included strikes on Qatar, the UAE, and Saudi Arabia. The ministry says Wang spoke by phone with his Iranian counterpart, reaffirming China's support for Iran's sovereignty and territorial integrity. Meanwhile, we are seeing shares of Target rising more than 4% in the pre-market. The retail giant posting an earnings beat for the fourth quarter. Target also forecasting better than expected profit for the full year, indicating its turnaround plans are starting to pay off. And Paramount Skydance's debt downgraded to junk by Fitch. The ratings agency making the announcement after Paramount agreed to buy Warner Bros. Discovery for $31 a share or $110 billion. The deal will saddle the combined business with $79 billion in net debt. Fitch putting Paramount on negative watch pending details of the deal. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, fueling inflation fears.
This war with Iran, if it is short and oil goes to 80 or 90 or 100, but it's a short time, not prolonged, it probably won't have a major effect. We'll see. Right now, this will add a little bit, literally a teeny bit to inflation. If it becomes prolonged, then all bets are off the table.
Up next, Tony Rodriguez of Nuveen from New York City. You're watching Bloomberg Surveillance.
For us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've been the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Revenue, for example, and Nuvian. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for StartupWave by empowering our customers across all our segments?
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Somehow, I don't know how, we managed to kick off March in the green, just about. On the equity benchmark on the S&P 500 this morning, we're firmly in the red. We're down by 1.3% at the lows at about 6:20 Eastern time. We were down by more than 2%, largely because of this move in crude. Around the same time, Brent crossed 85, just off those levels now, up by more than 6% and pulling back somewhat at 82.70, leading to a repricing in the bond market. Yields up yesterday and again this morning. 2's up by 7, 10's up by 6, a 10-year just short of 4.1%.
Yeah, and the real question here is what's driving this? The idea that there's going to be inflation, the idea that there's going to be some sort of response to it in terms of lowering prices, or potentially just in general, people are selling what they can and not necessarily what they want.
Let's talk about this moment for the bond market under surveillance this morning, fueling inflation fears.
Geopolitics is a major issue. It's much more complex today than it has been since World War II. Inflation is a big thing. It's not just oil. So, we'll see. Right now, this will add a little bit, literally a teeny bit to inflation, not a lot. This war with Iran, if it is short and oil goes to 80 or 90 or 100, but it's a short time, not prolonged, it probably won't have a major effect. If it becomes prolonged, then all bets are off the table.
So here's the latest this morning. Treasury yields rising for a second straight day as higher energy costs add to inflation concerns. Tony Rodriguez of Nuveen writing higher near-term inflation modestly reduces room for the Fed to cut rates as much this year, but may increase the scope for cuts next year. Tony joins us now for more. Tony, good morning.
Good morning,
Jamie Dimon speaking to Lisa yesterday, worried about the skunk at the party showing up, and that skunk is inflation. Did it just make an appearance?
It's definitely in the neighborhood, and I think that's what the market's reacting to.
You can smell it. I'll stop. Carry on, please.
You're killing me, John.
But yeah, the inflation dynamic has clearly changed, right? I mean, the view was that, hey, inflation is going to be sticky, but heading in the right direction. This makes it stickier for longer. So while we're not thinking this is necessarily something that at the moment requires any policy pivot, we do think it looks like it's going to generate a policy pause. So the market's reacting to that inflation is going to be maybe a little bit stickier. The growth negative implications, while they're real, they're more likely to be delayed relative to the near-term impact of those higher oil prices on near-term inflation prints.
What did that mean for pricing? So clearly we've seen a big repricing of the curve, yields up over the past 2 days, but we'd seen a big repricing of the curve the other way in the previous month. So what does 4.1% mean to you and the team?
So to us, it really puts us in the middle of what we have said would be the range for the year of 4 to 4.25, ending the year at the lower end. So we were a little surprised at how kind of expensive rates got just a couple weeks ago. So now we're just back in the middle of the range. That's not really going to be problematic for the market, in our opinion. What's going to be a problem is if oil prices continue to rise, then all of a sudden you have a stronger inflation impact, which could hurt, obviously, the Fed's ability to respond, and ultimately a much more negative demand hit from those higher energy prices as the year progresses.
Not to be too technical, but I understand why that would affect 2 years and 5-year Treasury yields. I don't understand why that would affect 10-year Treasury yields the way that it has, because ultimately, if you have that near-term shock, to your point, it suppresses growth over the long term, and ultimately, 10-year Treasury yields could provide a haven to that shock if you do believe that it is a stagflationary-like catalyst. So what's the thinking there?
So I think the thinking there is that you could still get those inflation dynamics if they get embedded in inflation expectations. When you combine that with fiscal dynamics that really provide very little room and are clearly pressuring the term premium higher, ultimately that leads to a higher equilibrium rate for the 10-year even in an environment where you might see that weaker growth.
How vulnerable would long-term treasuries be if this administration does announce some sort of program to lower prices on energy for consumers, whether it's just absolving some of the taxes on gasoline, whether it's direct infusions into households? I mean, how much would that be something that this bond market would be very sensitive to?
We think it'd be very sensitive to it because, right, we've argued that this year we're going to see a greater impact from fiscal dynamics than monetary dynamics. So anything that pushes further in that direction, to us, continues to build the term premium higher, and that is problematic for the longer end of the market. That would probably, in our minds, push it to not the lower end of our range for the year, but possibly through the higher end of the range if you really got a significant deterioration in those fiscal dynamics.
You thought we'd be talking about payrolls this morning, didn't you?
I did. But
we'll be talking about payrolls on Friday at 8:30 Eastern Time. How important is that number?
You know, I think it's only important now in the context of it creating a really big surprise, right? To the extent that we're significantly above or below what consensus looks like, then I think it can maybe get back into the narrative. But while this kind of geopolitical situation is going on, that's going to have the headlines, deservedly so.
Do you think we've become less sensitive to headline payrolls anyway over the last 12 months?
I think we probably have, because we have been in a fairly narrow range and we have had an unemployment rate that's been relatively steady, so it hasn't really been a driver of macroeconomic fundamentals in our minds. We've been far more, I think, sensitive to corporate earnings and what's happening with the AI storyline from an earnings, from a debt borrowing perspective.
To that point, could potentially a negative payrolls report have a bigger ramification for risk assets, not necessarily in the treasury market, but for risk assets, some of the riskier credit in particular, that's been holding up because people feel pretty good about the U.S. economy?
I think it could, and partly it's also because it will play into that narrative of AI replacing all the jobs. So if you get a weak employment report, it'll certainly increase that narrative as to, hey, this is happening faster than anybody thought. So the downsides of that obviously would be pretty significant for consumers.
Tony, it's good to see you. Thanks for dropping by. Tony Rodriguez of Nuveen squeezed in payrolls for you at the end, just in case you wanted to talk about it. The estimate on Friday, 59K. That's the median in our survey. The range, again, once again, is pretty wide. At the high end is 113. At the low end is -9. The payrolls report a few days away.
Yeah, I remember when it was the biggest thing that we were going to be talking about this week, exactly because of the AI replacement story.
Feels like the world's changed, right?
It feels like some of the risks have been put into perspective. Some kind of human life risk where you really do have lives and livelihoods put at risk. A very different scenario than talking about, you know, economic data and exactly what this could mean for monetary policy.
I woke up Monday morning going through the equity moves and just seeing a ton of research. We all read the same stuff. Basically saying the same thing. You fade it, geopolitics, the history of this means you fade it, you buy any dips, and you move on. On the commodity side, when you speak to people in commodities, they're not talking about the energy market in the same way people are talking about the stock market. They're not saying fade this. They're talking about repricing a structural premium because of the tension there and the scarring that you could see in commodity markets looking out several years, not looking at several days.
This isn't analogous to 2022 for one reason, which is this is the first time you're seeing Middle East nations at war with one another and disrupting each other's oil supplies. And that is a different backdrop.
Brent crude this morning just short of 83 after briefly breaking through 85. Coming up, we'll catch up with Daryl Cronk of Wells Fargo, Stacey Widlitz of SW Retail Advisors, Stephen Stanley of Santander. Plus, we'll catch up with the Flexport CEO, Ryan Pedersen.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, you know, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
You have to price in a little bit more risk.
A regime that is now under threat does not fear consequences.
I don't think this is going to really disrupt markets.
The subdued reaction is partly due to the fact that we kind of had this move ahead of time.
I don't want to count against corporate America. They seem to be rising to the occasion on just about every single issue we've seen.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's try and navigate this at a measured pace. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Off the lows, we were down by as much as 2% at the lows a few hours ago on the S&P 500, now down by 1.4%. Given that crude is off the highs, we were trading around 85 at one point around 6:20 Eastern time, now at 82.42 and up 6% on the session. Big repricing in gas prices in Europe. It continues for a second consecutive day. Yesterday, up, and today up again, up by 72% in 2 sessions. Now, once again, off the highs, but still, this is a major repricing that we're all trying to recalibrate to in the past few days.
Look, the region is a choke point for oil, but it's even more of a choke point for liquefied natural gas, with Qatar accounting for a fifth of the world's total supplies coming from one state-owned enterprise, which is Qatar Energy, which closed its production yesterday. So a real question here for liquefied natural gas. But on the whole, we are dealing with a scenario that people are grappling to get their heads around because we don't know what the off-ramp is, we don't know what victory looks like, and we don't know exactly how far the disruption will go, given the fact that not only is it a shipping issue, but it's also a production issue increasingly with the ongoing attacks.
It's not just about the strait. You're absolutely right. It's not just about the movement of energy. It's the production of energy. We saw one of the largest refineries in Saudi Arabia rather, come under attack yesterday. We've seen LNG production in Qatar shut down as well. And for the Europeans, they're far more vulnerable to this story than the US is. Far more vulnerable. And one country is even more vulnerable, and it's China. Yeah. And China is the nation coming out this morning pushing to reopen the Strait of Hormuz.
This might be the more interesting part of this entire equation. And I'm so glad that you brought China up, because a big question has been, how would China respond given that they get a significant portion of their oil supplies from Iran and are loosely partners with the nation because of that commodity resource? So a question here, would they back Iran, or would they say, hold on, hold your horses, stop it? Maybe just let's get some calm here so we can keep shipping going. So far, it seems like they're in the latter camp, which would seem to contain the conflict a bit more. This is why people are watching this so closely.
That's the pushback from China. Let's talk about the European moves. Equities down, and down hard. The DAX is down by more than 3%. The FTSE MIB in Italy is down by close to 4%. And this is off the lows. It was a lot worse a few hours ago. And the repricing we're seeing is not just in equities, it's also in rates. We've priced out lower rates at the Bank of England. We're pricing in the risk of higher rates at the ECB. And down under in Australia, they're talking about every meeting being a live meeting. Now, there are unique, idiosyncratic issues going on here for places like Australia, but globally, there is a repricing of rates leading to a tightening of financial conditions.
There is a new repricing of stagflationary risk that is coming to the market at a time when people had really taken that off the table a bit more, seeing a pathway to get to some sort of soft landing scenario. Does that torpedo this? And it's that much more the case for Europe, given the fact that they are more susceptible to energy prices, that they don't have the same kind of levers like AI and energy companies like the United States does.
So the good news this morning is that we're off the lows. The bad news is that we're still down by 1.4% on the S&P. Coming up this hour, Daryl Cronk of Wells Fargo, as tensions between the US and Iran intensify. Stacey Widlitz of SW Retail Advisors breaking down which big box chains are most exposed to a widening war. And the Flexport CEO, Ryan Pedersen, with the conflict in the Middle East restraining global supply chains. We begin this hour with stocks heading lower and energy rallying. Daryl Cronk of Wells Fargo Investment Institute writing markets will likely trade defensively in the near term until the end game becomes clearer. Hold your hedges if you have them in place. Daryl joins us now for more. Daryl, welcome to the program, and thanks for making time for us again this morning. What changed for you and the team over the weekend?
Well, obviously the reaction, John, that you're seeing, rates up, dollar up, oil up, volatility up, right? The VIX was sitting at 26 this morning, which is the highest level we've seen on the VIX since basically November, October, when we had the last kind of bout when the U.S.-China negotiations fell apart and some of the other elements hit the market. You know, what's interesting is I think later today or maybe even tomorrow, you could have Treasury Secretary Bessent and Secretary of State Rubio come out and release or make an announcement about releasing SPR, right, Strategic Petroleum Reserve, out of there. And it wouldn't shock me if they've also somewhat negotiated a coordinated IEA pact as well with the International Energy Agency, which, you know, is 30-plus advanced countries based out of Paris. As you've talked about many times this morning, Europe is most acutely affected here. Again, you know, they have limited amounts of oil they can push onto the market, but just symbolically, it would actually be really important for the oil markets. You could see oil trade even lower later today, notwithstanding it's too early to think that we're in a de-escalation moment.
So, Daryl, is that a put for the bond market or the equity market? And are you expecting the support to come from other policymakers then, away from central banks in a moment like this?
Yeah, I'm not sure that you could. It's too early to get probably a lot of policy, monetary policy support from central bankers, in my opinion, John. I mean, I think, you know, certainly the Fed is on hold here in the short term. But what it could do is if it takes some of the steam out of oil prices, it lessens the upside pressure on rates. I mean, remember, at call it 4.11 this morning on the 10-year, right? It was just January 20th we were at 4.30. And maybe more importantly, if I spin the clock back 12 months, so the beginning of March of 2025, the 10-year was at 4.32, right? So it's actually 20 basis points lower. We know the Fed had cut 3 times last year in that scenario. I do think global central banks, the ECB, maybe the BOE, are going to have to, you know, add some monetary stimulus, potentially consider lowering rates. It changes the calculus there because they're going to need to with the pressure that's going to be on Europe.
So, Daryl, are you saying that right now you're buying the long end of the yield curve in anticipation of some sort of action, not only on the part of the United States, but globally, to ease?
It's a good question, Lisa. So actually, we've walked into this year, even in our outlook before all of this, you know, erupted with Iran, thinking long-term rates needed to go higher. So we've been underweight the long side of the yield curve for quite some time. That played against us early in the year, but as you start to build in more of that inflation premium, remember, the long side of the curve is a term premium, an inflation premium, and a growth premium, right? So if term premiums are going to trend higher, and if there still is sticky upward pressure on inflation, look no further than the PPI data we got last Friday, obviously what's happening with oil prices and everything else, we think the trend still pushes hard on the long side of the curve. So the short answer is no, I wouldn't be a buyer of the long end of the curve. We think the best risk reward still is in the belly of the curve, the intermediate section of the curve, to basically, for fixed income investors, to get a good risk reward trade-off here.
So putting aside the bond market, is there essentially a fiscal and monetary put on the equity market right now? And I say monetary, not necessarily the Federal Reserve, but the central bank of NVIDIA. And I'm just wondering at what point you see right now the United States equity market benefiting from the policy response that you just laid out.
Well, it absolutely would benefit from it, but remember, we're in the process right now of walking back, right, more Fed rate cuts. I mean, we're now obviously back below 2 rate cuts, 50 basis points in Fed funds futures this morning. I think what's key for equity markets, and this is really important, right, we all know that tech makes up, call it 30% of the market cap weighted index. But if I add tech and financials together, which is where the epicenter pre-Iran, with everything happening in private credit and with the software stocks, it makes up 45% of the index. 45%, so almost half of the index. So the market, the equity market, with or without monetary policy easing and support, is going to have a hard time making that next leg higher, let's say pushing through 7,000 on the S&P, without both of those tech and financials participating again. So that narrative is going to have to change for us to kind of make that next leg higher.
Darryl, given the moves we've seen over the past few days, this has undermined the cyclical recovery and the rotation that a lot of people were really itching to get behind for the year ahead.
Yeah, I think what people are underappreciating, I mean, if you look, people have talked often about, John, the even weight, indice for the S&P is up 6%, call it year to date coming into this morning's open, right? Smalls are up 7, internationals up a blended, kind of lower double digits. What people are missing is the moves under the surface, right? I mean, obviously, if I take commodities against the S&P, 15% outperformance. If I take international against, domestic S&P, which is where everybody's had their exposure, it's 11, 12% blended outperformance. If I take value over growth, it's 11, 12% outperformance. Smalls over large, 7 to 8% outperformance, right? So there's big structural moves under the surface that I think investors, if you're just looking at, where's the S&P trading on a market cap basis, and on off of its high, which is only basically 2 to 3% off of its all-time high, you're missing all that kind of seismic move under the surface, which I think is really important. And I think investors need to really pay attention to that in their portfolios about maybe the exposure of the last 2, 3, 4 years isn't going to play all the way through in 2026 and out into 27.
Darryl, it's good to see you. Thanks for catching up with us. Darryl Cronk there of Wells Fargo, weighing in on what we could see from the administration. Interesting point that ultimately he believes you could get the administration step in and release a lot of energy to support this market in the months ahead.
Yeah, well, what else are they going to do? Is it really going to be a tax issue, or is it going to say, well, it's been done before during the midterm elections, why don't we just deplete it further, especially if we are getting an influx of oil from elsewhere and the U.S. is producing a significant amount?
The U.S. is well supported. What are we producing now, 13 to 14 million barrels a day?
Something like that.
The U.S. is well supported relative to, say, a Europe. But when those tax refunds get deployed, get dispersed, they have been already in the coming weeks, we'll see a lot more, I'm sure. When that happens, anxiety is a key feature of how consumers will behave. The confidence they have or lack thereof around the labour market, around meeting energy payments, utility payments, gas prices, that's going to be a feature of how they think about things. The psychology of how they approach and interact with this U.S. economy is going to be a key feature of the discussions we have around this table if this continues.
It's going to be a key feature of the political discussions as well, which really points to the fiscal response. This is the reason why people are pointing to sentiment, because it also points to the midterm election outcome and how much people want to affect that sentiment. I will say, so far, the U.S. economy has been holding up pretty well. Yesterday when I was down in Miami, I was shocked at how much optimism there was. Every single executive, investor, and there were 3,000 people down there who I spoke to, were excited about what they were seeing. It was a dissonance with the worry about the war and this idea of some sort of disruption to energy. And I was struck by how that could prolong inflation more than people realize, just because if everyone's so excited about growth and investment, well, you know, then they can absorb some of these prices.
Do you think that might be unique to Miami? Maybe, and the people that you were surrounded by in Miami?
Yeah, I was talking to them. They were shirtless on the beach.
Yeah.
They were very excited about the world ahead.
I don't think Jamie Dimon's got problems paying the utility bill, do you?
Well, I don't think he's shirtless on Miami Beach either.
That's true as well. Brent crude up by 7%, 83.26 at the moment. He might be, who knows? Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. Israel and Iran exchanging a new round of airstrikes with the conflict now in its fourth day. The IDF saying it struck a senior commander in Tehran and identified a wave of missiles launched toward Israel from Iran. Despite the strikes, President Trump posting in the last hour on Truth Social that Iran's air defense, Air Force, Navy, and leadership is, quote, gone. Saudi Aramco is exploring the option of delivering more cargoes to Yanbu, a port in the Red Sea, as the Strait of Hormuz remains effectively closed. The world's biggest oil exporter has a 5 million barrel a day pipeline that runs across the country, which can transport oil from fields in the east to the Red Sea in the west. And OpenAI amending its contract with the U.S. Defense Department just days after it was signed. CEO Sam Altman saying the rush to make a deal last week looked, quote, opportunistic and sloppy. In a post shared on X, Altman saying his company is working with the department to make some additions to the agreement to make its principles very clear. That's your brief, John.
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next, we'll get you some morning calls. Plus, we'll catch up with Stacey Widlitz of SW Retail Advisors, breaking down which big box chains are most exposed to the conflict in the Middle East. From New York City, you're watching Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is the market the kind of this discounting mechanism that's saying, hey, energy was getting better regardless of this, And if we get any sell the news in energy or oil over the next couple of weeks, that's actually what you want to be buying, as opposed to any relief rally in consumer discretionary. That's where we are right here. I think energy is the leadership. I think it's been the leadership.
It's the leadership for the wrong reasons this morning. Chris Verona of Strategas joining us there. Crude having a big rally year to date coming into this through February and January, higher by something like 20%, now higher by something like 30 plus. Big moves in the equity market once again. Futures negative by 1.4% on the S&P, holding on to losses on the NASDAQ. The NASDAQ and the tech players actually supported the stock market yesterday. This morning, a different story. The Russell is down by 2 percentage points. I mentioned the move in energy, so let's check it out together. Brent and WTI much higher again, up by 7%. Brent briefly through 85 about 2 hours ago. 83.42 as things stand. And in the bond market, once again, Lisa, saw it yesterday. Bonds down, yields up. See it again this morning. Bonds down, yields up.
Yeah, and it's kind of a two-pronged issue. On one hand, it will cause the Fed to think twice about how quickly they will cut rates in the face of inflation. And on the other hand, if there is some sort of fiscal response, what does this do to the fiscal side that causes the term premium to increase? So that 1-2 punch over on the bond side also taking play.
And that's not just a US story. We're seeing that worldwide and much more in a place like the UK, where gilt yields were up by double digits across the curve, up by almost 20 at the front end earlier on this morning. That's the bond market. Let's get you some morning calls. First up, Baird downgrading MongoDB to neutral and slashing its price target, saying limited AI revenue could create overhangs on the stock. Your second call from HSBC upgrading Block to buy, seeing 20% upside in the shares. The analyst saying job cuts are not coming from a position of weakness. That name is down by 2%. And finally, Bank of America lowering its price target on Lulu. The firm warning new CEO Calvin McDonald could call for an operational reset. Speaking of competence, this has not been going well over at that company.
How did they get see-through pants again? I mean, first of all, they were behind the fact that pants loosened up for the fitness trend, but then they also are dealing with, once again, saying, well, maybe people aren't wearing them well or they aren't wearing them right. That is not what people who are going to work out want to hear, that maybe your body just doesn't fit or you're not wearing them properly.
Is that what they're saying?
That was what they originally said, like many years ago when they came under fire. They were like this. But in this instance, they were see-through. The quality was in question. I mean, and then they said it was okay, that was how it was meant to be, and people were like, well, I don't really want them to be see-through, please, no thank you.
Sure.
Yeah.
Okay, Lulu not in a good place right now. Let's stick with retailers. Target shares rising after the company forecasts better than expected profit for the year. The CEO, Michael Vidalki, saying, quote, Target saw a healthy positive sales increase in February, serving as an important milestone on our path back to growth this year. Stacey Widlitz of SW Retail Advisors joins us now for more. Stacey, good morning. Good to see you.
Good morning. Good to see you.
Is the turnaround actually starting to bite?
I think it's early, but the good news, the big headline, as you just said, was February comps were positive when the quarter was down 2.5 here, and that was largely within expectations. I mean, I think the problem here is we all know Target has been losing a massive amount of their high-income consumer share to Walmart. That tends to be very sticky. They have to earn that back by cleaning up their stores, getting their people out of the fulfillment in the back and moving them to the store floor to engage the customer. So we need to see the old Target mojo come back.
There are consumer problems and then there are just execution problems. Is it fair to say that Target has suffered with the latter and not the former? This is an execution issue with this company.
I think so. And if you look at the spread between Walmart comps and Target comps, it's about 700 basis points. That's massive for a company like Walmart that does $700 billion in business. So if you look at that, you say, okay, execution here. So there's a big opportunity for them. This quarter, they did a little bit better in home or less bad. They have a long way to go in apparel. And of course, bringing back all those exciting brands that we used to see years ago, you know, that can drive the customer back.
How difficult is it to execute some sort of turnaround plan at a time when shipping is being disrupted on a global basis? We're talking about inflationary pressures from oil prices, but also just questions now. Okay, great, you've rerouted your supply chains. Well, supply chains are broken down yet again for a different reason.
We've had whiplash, right? Last week, the tariffs were supposed to get better, then maybe they're getting worse. And this week, who knows? The world is upside down, and certainly gas prices are going to increase for the consumer and for the big box retailers. That is not what you see. That is going to be a huge impact on traffic and consumer confidence. But I think for Target, the couple things that they're doing is, as we all know, they started fulfilling from their stores, in the back of the stores, and now they're starting to change that around and bring those salespeople back to the floor to re-engage. So maybe we'll see the stores be a bit cleaner. We've seen them in, frankly, disarray for the last couple of years.
Just to build on that, we've seen an increase in production costs in PPI and in products in particular, and goods inflation has come in a little bit hotter than people have wanted it to. We just got this from Best Buy, which just reported earnings that they're seeing higher memory component demand driving cost inflation. You're seeing that kind of cost inflation for goods across the board. How difficult is it to compete on price at a time when people are more sensitive to things like higher gas prices?
It's very difficult. But what's been so interesting is over the last year and a half, despite all this inflation that we've been looking at, retailers have drastically reduced their promotions and margins have really held. And I think what retailers have decided to do is say, okay, even if our top line isn't what we want, we're going to do it at a higher margin. And it seems to me that of the 60 companies that I cover, the majority have stuck to that. So as long as everybody kind of sticks to that full price, it works, but we are going to see price increases being pushed through. The question is, how much more can the consumer take?
Well, let's get into it. Who has pricing power right now?
Well, if you look at it, certainly Walmart can offer, just by sheer nature of their size, the best value in the market. So as you see consumer confidence continue to be very shaky, they're continuing to gain share, specifically, as I said, of the higher end consumer who no longer, you know, it's not a thing. Walmart is a cool place to shop now. You can get your food, you can get your apparel, you can get everything there. And for consumers right now, it's less about brand and it's about convenience and price and speed of delivery. And Walmart just nails it on all three fronts.
This has been a story for the last several years. You're either ultra high end, Hermes, Louis Vuitton, all of that stuff, or you're doing the off-price retail stuff like TJX, which is doing phenomenally well and has done for a long, long time. What's happening to the squeeze middle? How are the operators in the middle navigating that? Do they go up? Do they come down? They're in no man's land.
They're in no man's land. And what you've seen in the middle, whether it's Macy's or some of the others, Kohl's, is store closures, right sizing, and trying to figure out what does our actual store base look like. But most of these companies, like a Kohl's and a Macy's, they have not grown since COVID, right? It's been, while other companies have been up and raising their prices, like a Tapestry or Ralph Lauren, have raised their prices 30 to 50% since COVID and gotten away with it, and their revenues are up double digits, which shows you if you have the right product, you don't have to promote anymore.
There's lots of talk on this program about tax refunds. How do you think those refunds are going to be spent? We've talked about the utility costs, the bills in the Northeast for energy costs. The housing bills are going to be sky high. People are going to pay that. Is there going to be the kind of discretionary boom that some people are discussing?
I don't think so. And if you look at even the data on debt, people are taking out more personal loans to pay off their credit card debt. I think, and it's more household essentials. What is performing well? It is beauty, is household essentials. It is food. Target talked about the taste. It's people are spending an increasing share of their wallet on necessities, and also that's why Costco is just killing it. Again, another name, traffic is up and ticket. The only retailers that you see that's the case are a TJX, a Walmart, a Costco. And by the way, if gas prices go up, where are people going to get their gas? They're going to Costco, where it's the cheapest relative to the market.
True. Stacey, it's good to see you. Thanks for sharing your thoughts. Thank you. Stacey Widlitz there of SW Retail Advisors. In about 5 minutes' time, Bramo's going to head to the exit because Lisa's going to Bloomberg Investor Conference over the next 2 days. Who's coming up?
Yeah, well, I'm really excited, actually. We're going to have a lot of really good guests, in particular having to do with Soros, fund management, fund investment. Dawn Fitzpatrick, I'm going to be speaking with her about her take on private credit and some of the risks there. But obviously, the real dominant theme that was unexpected is going to be how do you handle a disruption like the conflict that we're seeing right now in Iran and the trickle out that could lead to some sort of surge in inflation, and that's what we'll be talking throughout the morning.
Taken over by events, haven't we?
In every way.
Big time this week. What happened to AI and private credit? It's still a concern, but the story and the main headline has changed, that's for sure. Stephen Stanley up next of Santander, breaking down the economic impact of the conflict in the Middle East. Plus, Yahara will drop by. More on the retailers. Best Buy, as Lisa mentioned, shares up 11%. That conversation up next.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslinda Amin in Davos, Switzerland, and this is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Keeping you on top of the story in the Middle East, some headlines just crossing the Bloomberg. A call between the foreign ministers of China and Israel, as reported by Chinese media. China opposes the military strikes against Iran by Israel and the United States. The Chinese Foreign Minister Wang Yi, speaking on that phone call just moments ago, will continue to get a readout of that, as expected, given their exposure to the region and the energy coming out of it, produced there, and traveling through the Strait of Hormuz. Lots to cover this morning, so let's get to it as we count you down to the open. Equity futures declining on the S&P 500 off the lows. The low about 2 hours and 10 minutes ago, we were down by more than 2%. We're now down by just 1.55%. The notable underperformances in the European equity market has been a story through yesterday and again through much of this morning. The Stoxx 600 down by 3. The DAX is down by 3.6. In the bond market, it's a similar story. Take a look at treasuries. Yields are higher at the front end of the curve by 7 basis points on 2s, on 10s up by 6. You see in Europe, much bigger moves in places like the UK, where gilt yields are climbing by some 16 basis points on a 10-year maturity, and at the front end of the curve, even more. Off the back of this move in energy, a repricing of crude on WTI and Brent, when you got the lows of the equity market earlier, the precise exact same time you got the highs in the crude market. Brent through 85 briefly at about 6:18, 6:20 Eastern time, back down to about 83.60 at the moment, up by more than 7% on the session. It's the move in natural gas that is really changing the conversation in Europe. 2-day surge up by close to 80% and sparking conversations for the Europeans. A reminder of 22 and a conversation about whether this is a repeat, volume 2 of the energy disruption, the disaster of 2022. That's dominating conversations in markets worldwide. As we count you down to the opening bell here stateside, 60 minutes away. Let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Best Buy joining Target and bucking the risk-off mood. We are seeing shares rising nearly 10% in the pre-market after the retailer delivered a holiday quarter that wasn't nearly as bad as some had feared. Profit was higher ahead of expectations, providing relief for a stock that has had a rough stretch, down 8% year-to-date heading into the report. Another bright spot in the market is oil, as we see shares of Chevron and Exxon positive, tracking the spike in oil prices we're seeing due to the conflict. And special mention to Battalion Energy, those shares up 134%. This is an small oil company based out of West Texas. And the escalating conflict in the Middle East is also weighing on the financials. Take a look at JP Morgan, down 1.8% in the pre-market. The idea is if this uncertainty holds, that businesses will pull back, consumers will pull back, and that will mean less loan growth for the banks. You also have this idea that more volatility means less deal making and less M&A. And remember, the sector just last week had its worst sell-off since the April scare of tariffs. John?
Yahara, thank you. There's a lot of support for this economy already in the pipeline. The rate cuts we've seen over the last 12 months, the tech capex spend we're going to see over the next 12 months and have seen over the last several years is the fiscal relief component of this, where I believe there's some real uncertainty right now. The tax refunds we'll get over the next several months, several weeks. How is that going to be spent when anxiety around the labour market is sky high? And now you've got the introduction of a spike in energy prices as well. Let's keep it on the economy. The risk of a prolonged conflict in the Middle East fueling fresh inflation fears and pushing bond yields higher. Bloomberg's Mike McKee has more. Good morning, Mike.
Good morning, John. When you ask where people might spend their tax refunds, it might be at the gasoline station, the way things are going. Interesting story on the Bloomberg and on Bloomberg.com this morning from Javier Blas, our oil energy analyst, who notes that we have only days to get something settled with the Strait of Hormuz because there's no storage for the oil that's now being produced and can't be shipped out. And that will mean declines in production, which means longer range problems for the economy. Now, this is not the 1970s, although there are certainly a lot of parallels. But you look back then and we had a much greater GDP impact. Right now, economists are saying this could take 1/10 to 2/10 off the overall growth levels because energy intensity is much lower. We've got gasoline fuel standards and energy standards for appliances and things like that that have just made our use of electricity a lot lower. And also, we're now the world's largest oil producer, and we were declining back in the 1970s. So it leaves the question of when does inflation hit and how fast and how far does it go? And what does that mean for the Fed? The Fed's had certainly some experience with this. We're going to hear from a couple of Fed officials this week, and we're also going to get the Fed Beige Book on Wednesday. Neil Kashkari sits down with me today. The Beige Book Wednesday, ISM Services and ADP then claims and import prices. The big question is, who's paying for the tariffs? And then Friday, big day, retail sales jobs and the Chicago Booth School Monetary Policy Forum. This is sort of an under-the-radar big deal meeting of central bankers, and most of the Fed will probably be there, and we'll hear from some of them during the day about how they're taking all this in. And, of course, that gives us 3 or 4 more days now to get there.
So, Mike, let's keep it on energy and talk about rate pricing. Here stateside, as you know, we produce somewhere between 13 to 14 million barrels per day. Europe doesn't have that luxury in quite the same way. In fact, they're far more exposed now because they're less exposed to Russia. They're more exposed to Qatar and the LNG that's produced there. Now, Mike, we've seen a repricing of rates throughout the last 24 hours. For the Federal Reserve, maybe slightly less easing. For the ECB, there was a conversation earlier about the prospect, the potential, not the inevitability or the certainty, but the potential of higher rates at the European Central Bank. Mike, what's your interpretation of what this energy shock could mean for rate pricing looking at the next 12 months?
I want to go back to that 1970s idea. At that point, the Federal Reserve and other central banks lowered interest rates to try to offset the impact on consumers, and then we got the great inflation. So the central banks have learned a lesson on that, and if they are looking at this and they can't figure out what a rate cut would actually do to help consumers without touching off inflation, then they probably aren't going to do anything. And both the European Central Bank and the Fed at this point think they're pretty close to neutral. So they could just sit for a while, and that's probably more likely than a rate increase. Now, what happens in the markets is going to be a totally different story, and we've seen that turn around in the last 48 hours with yields going up. And if that continues, then the Fed has got something to think about, but probably stays on the sidelines even with that.
Mike McKee, thank you, sir. And you can see this priced down through bond curves worldwide. Treasury yields high yesterday by double digits, up again this morning. You can see it play out in Europe as well, in Germany, up by close to 10 basis points at the front end of the curve of the German curve. And in the UK, up by 14 basis points and almost as much as 20 earlier on in the session. Let's talk about rate pricing in this economy. Stephen Stanley of Santander writing, the inflation impact in the US is meaningful, coming at a time when the Fed is struggling to tamp down inflation. Stephen joins us now for more. Stephen, good morning.
Morning.
It's a clear geopolitical rupture, a shock over the weekend. Does it morph into an economic shock in the months to come?
I think it could, but as you and Mike were discussing, the economic exposures are very different in different places. I mean, the U.S. is not really a net energy importer anymore. So, we're impacted because prices move. Oil prices go up and gasoline prices will move up and the like. But I think the danger is much greater for Europe, for China, for Japan, other countries that are large importers.
You and I don't know how long this is going to last, so we should say that up front. A lot of this is a guessing game, and the following conversation, much of it will be scenario analysis. We do know where we are, though. We could take a look around the economy and get a better feel for things. How different is this economy to the economy coming out of the pandemic and the one that went into an energy shock in 2022?
Yeah, well, I mean, I think we're in a different phase of the business cycle, right? We were on a rapid upturn at that point, but from a low level. Now we're kind of cruising along at what I would consider to be solid growth. We've had solid growth for several years on end. I think the prospect of very strong business investment in 2026, as you said, the AI build continues. But there's a view that the consumer is somewhat vulnerable. You know, I'm not quite as gloomy on that as some are, but I think that's the concern. If gasoline prices go up, you know, 30, 40, 50 cents a gallon, does that create a shock for the consumer? What's interesting, you know, as you were talking about, is the reaction of the markets, and in particular the bond markets around the world. I mean, we've been trained over the years that, oh, an oil shock is contractionary for the economy and it really hurts the consumer, and don't worry about the inflation because the Fed will look through that. That's not so much been the initial reaction this time around. I think people are much more focused on the inflation side, which I think is the right call given the context, which is the Fed has been trying to bring inflation back down to 2% and is struggling to do that. And you've heard, even before this weekend, you'd heard a lot, increasing frustration from Fed officials that they weren't making further progress on inflation.
So this raises a lot of questions, but let's stick with the consumer and the health of consumer balance sheets. There is a position, I would say overwhelmingly the consensus position is that consumer balance sheets are okay, but they're vulnerable. And that if you get an inflation shock like this or any kind of supply disruption, that it's unlikely to turn into an inflationary spiral for that very reason. And the hit to the economy would be much bigger because they would ultimately disengage. Are you pushing back against that this morning?
I mean, I think that would require kind of a worst case scenario for the events of the Middle East. And as you said, we can't really rule anything in or out at this point. But if we look back to last year, we had the experience of the 12-day war that was waged last year. This is likely to be bigger and longer than that was. But if the pattern is similar, then I think most of the impacts are likely to be short term. So can the consumer weather this sort of thing for a month or two? I think that should be no problem. If oil prices are, you know, over $100 a barrel 2 or 3 months from now, I think that becomes more problematic.
Stephen, as you know, there are obvious differences between what happened last summer and what's happening now. The operation last summer was very targeted. It was limited in scope. It was focused on nuclear capabilities. And it was certainly not open-ended like it is at the moment. This feels much more open-ended. It feels different, and the kind of damage we're seeing is different too, not just for the production of energy, but the movement of it as well. The commodity guys, and this is interesting to me, just tracking the different conversations that are happening on this program, the equity guys will come on the program and they'll talk about the history book, the playbook, fade geopolitical risk. The commodity guys are talking about something different. They're talking about scarring and the potential for a repricing of a structural premium in commodities now, because this whole just-in-time delivery of commodities is not the right way to play things, and you need to hoard them, because you don't know when something like this is going to happen next. Do you think about things slightly differently with regards to that as well?
Well, I think, again, what I would say about that is I think the U.S. vulnerability on that front is quite low compared to a lot of the other economies around the world.
Particularly the Europeans.
Especially the Europeans, but also, I mean, you've seen the rhetoric out of China. They're quite concerned as well because they're very dependent on Middle Eastern oil. So if that becomes a more persistent theme, I think it hits everyone to a degree because energy prices will be higher, but I think the U.S. probably sees a smaller impact on something like that than most of the other major economies would.
We're going to get lots of data in the next few days. ISM services, ADP, I think challenger job cuts as well. The big one on Friday, not retail sales, but payrolls. How relevant is that data now? How relevant is it?
Yeah, I mean, I don't think that it's going to be super important. We already knew before last weekend that the Fed was likely to be on hold in the short term. And they're even more on hold now, I would say. So, you know, the February jobs numbers is important in the context of knowing what's going on in the economy at the moment, but it's not likely to change the near-term trajectory of policy. So I think from that perspective, you can't give it the, you know, the huge highlighting treatment that you might otherwise.
Do you think Kevin Walsh is happy it doesn't start until June? Hey?
I mean, look, the last couple of weeks have been crazy, but who knows? June might be even crazier.
Who knows? Precisely. Stephen, it's good to see you. Thanks for joining us. Thank you, sir. Stephen Stanley there of Santander. If you're just tuning in, welcome to the program. Yields are off the highs. We're still higher by 6 or 7 basis points across the curve. Crude is off the highs as well. Energy at the moment, Brent and WTI. Brent crude at 83. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Target shares are higher, up 2.5% after forecasting better than expected profit for the full year. A sign the retailer's turnaround plans are finally taking hold. It's aiming to end a 3-year sales slump by investing to improve merchandise, refresh stores, and integrate new technology. The International Energy Agency is ready to help stabilize the global oil market in the wake of the Iran conflict. Sources telling us here at Bloomberg that IEA member countries are holding over 1 billion barrels in emergency stockpiles and can bring additional supply when needed. The agency is meeting today to discuss the situation in the Middle East. And airlines around the globe are suspending more flights across the Middle East as the Iran conflict expands. More than 12,000 flights have already been canceled, impacting major transfer hubs such as Dubai and Doha. Tens of thousands of passengers remain stranded, causing many carriers to run special evacuation flights. That's your Bloomberg Brief, John.
Yahira, thank you. Thank you very much. Up next on the program, we'll set you up for the day ahead, plus the Flexport CEO, Ryan Pedersen, joins us as the conflict in the Middle East is restraining global supply chains. From New York City, you're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
There's a debate going on right now in D.C. that I think folks need to start paying more attention to, and that is the yield. And the question really is, who is going to keep the yield? Who makes money off stablecoins? Well, right now, in the case of some of the large stablecoin issuers, there's a yield that on those deposits. So when there's a dollar, for example, deposited in a bank account, there's interest paid on that dollar. And so who's capturing that yield? And I think one of the really interesting things about the Genius Act is that it bans so-called yield-bearing stablecoins from giving that yield directly back to consumers. Now, that's not true everywhere. And I think if consumers have a choice, why would a consumer want an institution to keep that yield? Or would there be sharing of that yield? So right now, one of the debates going on is, will rewards be allowed? And I think these are really important questions.
Don't miss Bloomberg Crypto live Tuesdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Prices are going to go up, and ultimately, if it persists, GDP is going to go down. So this creates a huge headache for the Federal Reserve, because the Federal Reserve now needs to assess the dual mandate. Now that we have inflation already at 3, and now we're adding on top of that more upward lift on inflation over the coming quarters potentially, that is certainly a risk that the Federal Reserve needs to take very seriously. That was Torsten Slok of Apollo weighing in on the repricing we're seeing in energy and the repricing we're currently witnessing in the race market as well. Now, typically, as Mike McKee indicated, Stephen Stanley as well, these are the kind of shocks that are typically faded and central bankers, policymakers would look through. But look at the headlines that across the Bloomberg in the last 24 hours. The RBA down in Australia, the central bank down under, talking about every meeting being a live meeting. You might say that they've got their own unique issues that have led them to that position. The ECB rate pricing now shifting towards pricing the probability of a rate hike maybe later this year, and we're priced out all the easing over at the Bank of England. That's the story for fixed income. Here's the story for the equity market, and I want to spend some time on this. I've talked about it a few times so far this morning. The difference between how the equity guys are talking about the risk here and what to do with it, and how the commodity guys are talking about the risk here and what to do with it. Stocks are down by 1.8%. The Nasdaq's down by 2%. I'm not going to pick on any single one person. It's not about them. This is just the mood of the moment. This is Jonathan Kriski of BTIG. Typically, sharp moves on geopolitics are not durable. This is Osun Kwan of Wells Fargo. The playbook from the past 2 Gulf Wars was to sell the news. That's the equity bias. And we saw some of that play out yesterday. Here's the commodity bias. Switch on the board and get to commodities, and let's talk about these moves together. We've had a move through 85 briefly on Brent. We're up 7% so far this morning. Let's call it 83 as things stand. This is Carlisle's Jeff Curry, and it's not just coming from him, it's coming from others as well on the commodity market. We're unlikely going back to just-in-time energy. The security premium is not a spike to be faded. It may reflect a structural repricing driven by hoarding. When you cannot trust that supply will be there tomorrow, you secure it today. Are we going to see some scarring in the commodity market? Are we going to be conditioned to price in a bigger premium that we all have to adjust to? That's the conversation in commodities, and it sounds very, very different to what's happening in equity land at the moment. Should you fade this risk is still the central question. Is it the playbook of yesteryear, or is this different? Have things changed on the geopolitical stage? That's the price action as things stand. As we count you down to the opening bell, here's the trading diary for the week ahead. As Mike McKee mentioned earlier, the Minneapolis Fed President Neil Kashkari catching up with Mike at Bloomberg Invest at the conference at 11:45 this morning. At 2 p.m., the President meeting with the Treasury Secretary Scott Bessent and the Energy Secretary Chris Wright. Look out for that. That's important. On Wednesday, the Fed's Beige Book plus earnings from Broadcom. Thursday, another round of jobless claims plus results from Costco. On Friday, it's the big one, at least we thought it was. It's the payrolls report going into the weekend. Of course, the main focus this morning remains on the rising tensions in the Middle East. Shipments of oil and other goods passing through the Strait of Hormuz have come to a virtual standstill. The Flexport CEO, Ryan Pedersen, writing, what began as a regional security crisis has now become a direct disruption to global supply chains. Ryan joins us now for more. Ryan, welcome to the program. Thanks for making time for us. Just how much capacity have we just taken out?
Well, on the container shipping side of things, you see there's 67 ships that are inside the Strait of Hormuz right now. A lot of those are smaller ships, so it looks like zero. See, can we keep this thing up to date as the ships get diverted, as services are less reliable? We have seen that movie before, so yeah, I would expect to see the services start to degrade and be more difficult to operate.
Ryan, you've got great visibility on these things. As the dominoes start to fall, are you thinking about secondary bottlenecks that might emerge as well, and where might they emerge?
Yes, I mentioned a few of those in unexpected places like congestion, but you're going to see pricing be a global phenomenon here. Ocean freight prices, we're right in the middle as contracting season is just starting to kick off. And all the ocean carriers have told us this week, not all, but most of the ocean carriers, and I think it'll be all pretty soon, have told us that all previous discussions on ocean freight contracts for this year are out the window, that there's too much uncertainty and they expect prices to go way up from where they are today. We're already hearing rumors of $5,000 a container from China to the U.S. East Coast, which that's more than double where it's been for the last few months. So yeah, we're already seeing big spikes, and that will lead to all kinds of secondary effects.
Ryan, some of that, as you know, might just be a reflection of extended transit times as well. Could you give us an idea, as some of this traffic reroutes, what the extension to transit times might be for, say, traffic between Europe and Asia?
Yeah, well, in the ocean market, it's really just which of these strings, these services call in. Jebel Ali is the 9th largest port in the world. Abu Dhabi has a large port. There's several other important ports inside the Strait of Hormuz. So the first thing is, okay, which services call there? Those are going to be heavily disrupted because they're going to have to stop and unload all of those containers. One of the ocean CEOs I talked to said they were going to unload in Oman, but of course the port of Oman got hit with a missile yesterday too, a ship near Oman. So it's really difficult to say exactly how each carrier is going to reroute things, but that will for sure lead to service issues. Let's not forget the air freight market, whereas the Middle East is a major hub for air freight. We estimate around 18% of all the global cargo capacity for air freight has been taken offline just temporarily. We haven't seen planes get shot down, but temporarily. And a lot of, you have Emirates and Qatar, Etihad, all of these are major cargo airlines that operate in that region. And Asia to Europe flights tend to go over, either stop in the Middle East or fly directly over Iran. So just big disruptions to the air freight market as well. And there, it's a relatively capacity-constrained market in general. You can see huge spikes in price from a small disruption in capacity.
Hey, Ryan, I know you're busy, but I'd love to catch up again in the next week or so, just get an update on how things are developing. That was the Flexport CEO, Ryan Pedersen. The conversation's going to continue here at Bloomberg. Tomorrow we'll catch up with Sebastian Page of T. Rowe Price, Chris Harvey of CIBC, Mira Pandit of JP Morgan, and a view from the Federal Reserve. Go right here on Bloomberg. From New York City this morning, good morning. Have a wonderful day. This was Bloomberg Surveillance.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What some of these generative AI models look like they're going to do is they're going to reduce the cost of producing content to basically zero. So that will be a multiplier effect on the things that we're already seeing, which is that there's more people producing more content and reaching more people. And there's a lot of good and bad that comes downstream from that.
I don't know if you can break down what the average person is seeing right now in terms of stuff that's AI generated versus, maybe more traditional human generated, but what's that going to look like in a year or in 5 years?
There's actually a lot of hybrid content, and too often we talk about synthetic content and organic content, and never the two shall meet. But there's a lot of content where AI is part of the workflow, right? Like you might not even know it. It might be whatever app you're using to do color correction might be using models to do so. Stamp tool in Photoshop in the old days to get rid of a pimple, those types of things. But that line is going to be more and more blurred. So it's going to be a little bit less like what is organic content and what is AI synthetic content and what the percentages are. I think there's going to be actually more in the middle than pure synthetic content for a while. But you will also see experiences that are purely AI, right? You see this in the last 2 weeks with Vibes in the Meta AI app and with Sora 2 from OpenAI. So I think you're going to see both.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Bringing you up-to-the-minute automotive news whenever and wherever it happens. I'm Matt Miller in Detroit, and this is Bloomberg. Welcome to a special edition of Bloomberg Open Interest live from Bloomberg Invest in downtown Manhattan. I'm Matt Miller. We are gathered here with the most influential voices across asset management, banking, and private capital. Danny Berger joins me in just a few moments. She's currently hosting a panel on private credit. Coming up, we're going to bring you a conversation, speaking of, with Mark Rowan of Apollo, Don Fitzpatrick of Soros Fund, and Mike Arrighetti of Ares. Plus, we're going to hear from Mistral AI's Chief Revenue Officer, Voya's Amy Vaillancourt, and Goldman Sachs' global co-head of private credit. So a lot to come on a day when markets are moving quite a bit. Take a look at what's going on with S&P futures. Stocks are down as investors also sell bonds. You can see S&P futures off almost 2% right now. Dow futures down 875 points. This after the S&P closed in positive territory yesterday. NYMEX crude is up once again and to the tune of 7%, $76.36 a barrel right now. And there you see the 10-year yield moving higher by 6.5 basis points to 4.1% or 4.0997 if you want to take it out 5 significant digits, as Tom Keene is prone to do. You see Brent crude up as well, another 7.5%. Up to $83, almost $84 a barrel. European gas futures, this is the big one, folks. A gain of 29% right now, and this adds to a gain of 30% plus yesterday. So it's just spiked higher at a level that I don't think anyone expected, and that is clear by the sell-off in European stocks. The Euro Stoxx 50 is down 3.7%. A massive drop this morning. When I opened the WEI screen, I saw every single European major benchmark index down more than 3 standard deviations. And that's only happened since COVID a couple of times, in June of 2020 and in April of last year around Liberation Day. The Kospi down more than 7% overnight as Samsung and Hynix get absolutely crushed in the Korean trade. In terms of the stocks, other individual stocks that we're watching here, energy stocks are higher, obviously, with those gains in crude oil. You can see Occidental, ConocoPhillips, Devon Energy, all powering higher again today. Remember, this adds to the gains that we saw yesterday. Saudi Aramco is apparently exploring plans to use the Red Sea for oil shipments to try and avoid the Strait of Hormuz. Qatar Energy is shutting down more operations after halting production of LNG yesterday. That's why you see, one of the reasons you see the huge spike in gas prices. And we saw a huge jump in gas overnight. It was actually the biggest one-day jump since Hurricane Katrina back in 2005. In terms of what's going on in AI, tech stocks are selling off quickly as traders slash their Fed rate cut expectations. The White House also is weighing a cap on the amount of high-tech chips NVIDIA can sell into China. As a result, the biggest company in the world is down in the pre-market almost 3%. SanDisk is down 6%. Micron is down 6%. Of course, these companies have run up so far, so fast, especially the memory chip makers, that they can stand to lose a little bit here. Investors preparing for more intense fighting in the Middle East as both sides say the worst is yet to come. Here's Secretary of State Marco Rubio.
I'm not going to give away the details of our tactical efforts, but the hardest hits are yet to come from the U.S. military. The next phase will be even more punishing on Iran than it is right now.
Let's get to Bloomberg's Washington correspondent Tyler Kendall. She is standing outside the White House. And Tyler, you know, we've got some mixed messages. The Defense Secretary Pete Hegseth saying that this isn't going to be a forever war and we're not aiming for regime change. The president saying the war could go on forever, and indeed they want this regime to shift out. What do we know in terms of the goals of the U.S. administration here?
Well, Matt, yesterday we heard President Trump outline some of those chief objectives as he says that the military campaign is going to be sustained until those goals can be achieved. And the goals have been various, and as you're mentioning, at sometimes contradictory, but President Trump saying that the main focus is to dismantle Iran's nuclear ambitions, decimate its ballistic missile program, as well as go after those proxy militia groups that Iran supports in the region. But then, of course, we had heard from the Secretary Pete Hegseth yesterday suggesting that the original intent was not what he called, quote, so-called regime change, though the U.S. does hope that the Iranian people take advantage of this moment. Now, on the operation front, the U.S. and Israeli militaries continue to bombard Iran as Israel confirms this morning that the 9th wave of attacks against Tehran has begun. And there's a few different factors here that we are watching, but one of them I'll point you to was in a post from President Trump earlier today where he seemed to suggest that Iran wants to talk, but saying in this post that he says it's, quote, too late. Now, those claims couldn't be immediately verified, but it doesn't appear that a diplomatic off-ramp is imminent at the moment. As we know, regional allies are trying to urge this White House to outline a more specific timeline. People familiar with the matter telling Bloomberg News that nations including Qatar and the UAE are now lobbying other allies, including those in Europe, to push President Trump to keep this conflict short. Matt, I'll tell you that later on today in the president's schedule, he is set to meet with the German chancellor here at the White House. That's set for 11 a.m. Eastern.
Tyler, thanks very much. Tyler Kendall there at the White House. Let's get the market reaction now with Bloomberg's macro strategist, Michael Ball. He's with us here at the Invest Conference in downtown Manhattan. Michael, I guess you were up late watching the Asian trade. What do you make of this volatility?
Yeah, finally some blood in the water. I mean, Monday was actually somewhat constructive in the U.S. cash because we came back off a key level on the SPX and rallied and saw a lot of short covering and people reassessing sort of the risk tone off the weekend. But overnight, we just deteriorated. And when you started seeing correlations between cross assets rising, you knew people were selling winners and losers and generally moving to cash because clearly you couldn't hide out in the rates complex with this stagflationary worry reemerging very quickly and people generally scrambling to reposition for this new narrative.
What do you make, though, of just stocks being okay yesterday? Risk assets ending the day higher. Like, what has fundamentally, do you think, changed for this market that all of a sudden we've woken up to something very different?
Yeah, it's interesting, too, like to see the different regional approaches because this is a different pulse on different areas of the world. Obviously, Europe and Asia get more of an energy hurt when the prices go up. The U.S. feels more insulated, and also we have maybe more confidence that this is going to be a shorter duration campaign because we had success in Venezuela or because we're listening to a media complex that is telling us that we can win. I mean, I'm not 100% sure there, but my point is there was a more optimistic outlook on where Iran was going from the U.S., and we'll see if that continues today in the cash open here because that was the case yesterday.
By the way, that was my argument to Matt this morning, that Europe wakes up, it sells everything, the U.S. comes back online, it's like, we're fine, we got this, and then continues to buy.
We'll see what happens in 23 minutes, but I mean, if we've wiped out their Navy, their Air Force, their air defenses, and their leadership, I don't see how we could really lose in that situation, assuming you take the president at his word. What do you make of the natural gas spike? I mean, it's just unbelievable the amount that those prices have jumped.
Yeah, it's funny because I used to trade nat gas. It's the widowmaker. It was always tough in America. We saw that with the weather over the winter, and here we are again with a geopolitical shock, similar somewhat to what happened with Ukraine and Russia as far as the price action response, how quickly it reacts and how much people really get this gamma squeeze as they chase the upside. And then, of course, you have a lot of mechanical hedging that needs to occur that just worsens the move. So again, these things become living, breathing entities that just have to ramp up into higher prices because of the unknown tail risks.
All right, Michael, thank you very much for joining us here live at Bloomberg Invest. That is Bloomberg macro strategist Michael Ball. Now, the other risk this market continues to monitor is credit. Blackstone is letting investors redeem a record 7.9% of shares from its flagship private credit fund, equivalent to about $3.8 billion. I just spoke to the man behind that fund, Brad Marshall, Blackstone's head of private credit and CEO of BCred.
We're actually seeing very good credit fundamentals. The fund has delivered a 10% return since inception, 50% premium to the liquid market. So it's doing what it's supposed to do. But there's a lot of noise in the market, which we should spend time on.
Joining us now is Silas Brown, who leads our credit coverage from London. And Silas, in that conversation, he'd essentially said, look, these things are working as they're supposed to. We met 100% of our redemptions. We can do it again if we need to. And the underlying asset is very strong. So what is the concern around these record redemptions that they're facing?
Yeah, I think there is a funny sort of juxtaposition going on where private credit funds are reporting pretty strong returns and good performance, and yet investors can't seem to shake the kind of like overwhelming fears around AI and software, and I mean just broader kind of points in the credit cycle. And BDCs are the kind of vehicle through which investors can either opt in or opt out of funds, and so we're sort of seeing the flows there. And I think with Blackstone, look, I mean, B-Cred is not an insubstantial character. It's kind of like, I don't know, it is to private credit what sort of Chopin is to classical music or something like that. I mean, it's not an insubstantial figure. And so I think people are paying very close attention to B-Cred and how it responds to an uptick in investor withdrawals. I mean, it's by far the largest of the non-traded BDCs. And I think, at the moment, if you want to just hear a kind of another little thought I had, at the moment, what's happening in BDCs is effectively like a kind of, I mean, in my mind at least, it's a sort of high-stakes blinking contest going on between the funds. No one wants to be the first people to kind of restrict investor withdrawals, and yet everyone agrees with the premise of them. It's an important feature of the market that you have these kind of 5%, 7% caps, but no one wants to be the first people to use them because they don't want to take the reputational risk of being the first one and kind of all the headlines going on about the first people to gate investors. So it's a kind of fascinating time for BDCs at the moment. I think it will play out, in the spotlight over the next few months.
It's a really good point. Again, Brad Marshall on the panel I was just on, Silas, saying that no one should be buying these funds if they think they have 100% liquidity. Everyone in broad agreement that, yes, it's good to have these gates and for investors to understand that. But if investors don't understand that, Silas, and this is an industry that keeps being hit by redemptions, at what point does a technical issue turn into a fundamental issue for these credit markets?
Well, yeah, two initial thoughts. Goldman put out a shareholder letter last week, and they made the point that they never refer to these funds as semi-liquid, unlike others in the market, and they refer to them as evergreen because their view is that semi-liquid paints a sort of a somewhat misleading portrayal of what these funds are, where actually they are funds that you can have a very small amount of liquidity, and if everyone wants the liquidity, you will find that there isn't much liquidity to go around. And so I think there's a degree of framing going on in private credit and a degree of distancing one fund to another about how they kind of characterize what's going on and how they should characterize the industry. I mean, I think this is a moment where, this mechanism, which I think is sensible, which is this like 5%, the right to kind of cap investor withdrawals at 5%, my guess is, I think a lot of people in the industry's guess is that people will have to start using these gating mechanisms, although I'm sure they hate the use of the word gate. But these kind of mechanisms to cap withdrawals. But I think, as I said before, no one wants to be the first person to do it. So actually, people are kind of redeeming over and above what they, I mean, it's the level of generosity that you're seeing in funds in terms of investor withdrawals, I think will have to subside at some point. I think we'll have to subside at some point.
Welcome to Bloomberg This Weekend. I'm David Durrett.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's Jobs Day, and Bloomberg has the report under surveillance.
Labor market anxiety sky high.
Could a weak labor market report spook economists?
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
There actually are white-collar jobs right now. It's not just doom and gloom.
The narrowness of job gains has always been the question.
The stability is masking some fragility.
Let's pay attention.
The February Jobs Report, Friday on Bloomberg.
I'm Yahaira Anand, live from Bloomberg headquarters in New York. A check on markets. As Michael Ball said earlier with Matt and Danny, finally some blood in the water. We are seeing the S&P down 1.8%. Dow Jones down 977 points as we see a spike in NYMEX crude up 9%. That trading at $77 a barrel, while we see the U.S. 10-year yield up 7 basis points, a 10-year now at 4.11%. And let's get a look at some other moves on our radar. Target gave a surprise upbeat forecast on improving demand as a turnaround gains traction at the retailer. Those shares up 1.75%. Meanwhile, we're seeing Best Buy earnings blowing past estimates as demand for consumer electronics lifted results. Those shares up 4%. And activist investor Elliott is investing $1 billion in Pinterest to help fund the social media company's effort to buy back shares. Those shares up 6.5%. This is Bloomberg.
The world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Oil prices now reaching the highs of the days after this. Iraq has started shutting oil output at its largest oil field with storage filling. It's the country's largest, the second biggest in the world. Again, it's a consequence of the Strait of Hormuz being effectively closed. Oil prices, Matt, up 8.8% for Brent crude this morning.
Yeah, and we see futures continue to be deeply red here in the U.S. S&P futures are down. As Yahaira mentioned, Dow futures are down like 900 points right now. You can see I've got Brent crude there, but NYMEX also jumping, in the 10-year yield up right now more than 7 basis points, a little bit more than 4.1%. OpenAI CEO Sam Altman yesterday called the company's Pentagon deal opportunistic and sloppy after a clash with Anthropic over limits on military AI use. Joining us now to talk about the sector and the technology is Marjorie Janowitz, Chief Revenue Officer at Mistral AI, a French company that does mostly work with large institutions. And let me just first get your take on the Anthropic Pentagon debate, because it highlighted the importance of, I guess, government control versus the safety of artificial intelligence. How do you see it?
Yeah, for us at Mistral AI, we are very much focused on open weight and open source technology. We believe in equipping really the builders in having the control of the technology they need to be able to transform their business. Particularly in the private sector, we are in Bloomberg Invest in financial services institutions. So for us, what matters is empowering the builders really to have the technology and the large language model they need to achieve their business outcomes.
What role, if any, do you think government should have in shaping how AI systems are formed throughout the world?
Yeah, from a regulation perspective, for us, it's all about giving to those enterprises the controls they need to really help enable really the systems that they are trying to build. So for us, the core of that is really the open source approach to how the technology can really be spread around the world and really battle test that technology for their use case.
I was talking with an entrepreneur yesterday who said, you know, when I use AI at my company, I want control of the prompts. You know, I want my own privacy and to be able to hold the technology on my servers. How much do you hear about that from the customers that you work with?
It's such a great question. I think larger enterprises have noticed that the ROI of just chatbots in their enterprise is a little bit limited, and they're really trying to deeply transform their business. In order to transform their business, the theme of portability, being able to deploy those systems on-premise on your own walls, but also the topic of customization, making those systems their own, customizing the model to their data becomes very important. So a lot of the discussions we're having with large banks such as HSBC or BNP Paribas are all about gaining that control so that they can customize the models really to what they are trying to achieve within their walls versus just using a chatbot to empower employees.
By the way, Marjorie, I'd assume that one of the most common questions you get are your customers saying, thanks for this AI, we're now going to go fire a bunch of people. I'm sure you get that a lot. Has there been any conversation about the enterprises you're working with, about their ability to either reduce or maybe not grow headcount as much with the use of your tools?
To us and where we are today from a maturation perspective of technology, there's two ways to measure return on investment for those businesses. One is actually creating new revenue opportunities. That technology enabled those companies to do things they were not able to do before. So creating new revenue streams is the first topic. The other topic is definitely improving efficiency, but it's mostly about saving time of the employees so they can go and spend time on more strategic projects. But really, ROI is measured two ways: efficiencies of the existing employees and new revenue generating opportunities measured in dollars.
Today we heard that the government's considering once again limiting the amount of chips that NVIDIA can sell to Chinese. You saw the spat between the government and Anthropic in the U.S. here. How important is it for Europe to have its own AI companies, or each region to have its own strengths in AI?
Yeah. I think where the world is moving towards is definitely every company, every region becoming more independent in their usage of AI. So for us at Mistral, our value proposition is all around, as I mentioned, portability, deploying the technology in your own walls, and customization. So whether you're looking at a country or at a business in the US or outside of the US, those companies need to be able to rely on their own technology and build their own AI to be successful.
All right, Marjorie, great to get your take. Thanks for joining us here at Bloomberg Invest. Marjorie Janowitz, their Chief Revenue Officer at Mistral AI. Normally, I guess, in Paris, but today here with us in New York City. We are looking at U.S. futures down, S&P futures, NASDAQ futures, Dow futures all off. Dow futures down about 900 points right now as the 10-year yield rises once again past 4.1%. We have big spikes in NYMEX crude, big spikes in Brent, and big spikes in European gas, driving equities down there as well. And we saw huge drops in Asia overnight. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Make Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to Bloomberg Open Interest. I'm Matt Miller here, live from the Bloomberg Invest Conference in downtown Manhattan alongside Danny Berger.
I am so pleased to have here a lot of discussions from geopolitics to credit, Matt.
Yeah, a lot going on in markets as well as we enter our fourth day of war against Iran. You can see S&P futures down now 1 2/3%. NASDAQ futures off 2%. The small caps down even more because the concern really is about inflation and maybe not getting as many cuts from the Federal Reserve. You can see Sunbelt Rentals ringing the bell there at the New York Stock Exchange. Intuitive Surgical ringing the bell at the NASDAQ. But of course, the focus is on energy as we see big spikes in crude oil, even bigger spikes in gas, and that's what's driven European indexes down more than 3 standard deviations, really across the board overnight into this morning, and the U.S. looks to set to start much lower this morning as well on really those inflation concerns.
Yeah, if markets shrugged yesterday, this morning they are standing up at full attention. The energy stocks, the energy complex is one to watch at this moment. They are higher. Brent crude at one point touching $85 per barrel for the first time in nearly 2 years. Saudi Aramco, this is when you know things are bad. They're planning to avoid the Strait of Hormuz and instead going to the Red Sea for oil shipments. Yesterday, we learned that Qatar Energy is shutting down more operations after halting production of LNG. Yesterday, for reference, U.S. gas prices rose 11 cents overnight. That's the biggest one-day jump since Hurricane Katrina in 2005. And that, adding to that this morning, Iraq announcing that it is starting to shut oil output at its largest facility as it sees storage filled, with the inability to transport through the Strait of Hormuz.
Yeah, so a ton going on, driving energy prices higher, a bigger problem for Europe than it is for the U.S., but we're watching to see how U.S. investors coming into this market is going to affect trading on both sides of the Atlantic. Tech stocks here selling off quickly as traders slash those Fed rate cut bets, and the White House weighs a cap on NVIDIA chip sales to individual companies in China. You can see the largest company in the world in the cash trade now down about 2%. SanDisk and Micron, of course, these memory chip makers had rocketed higher at the end of 25, the beginning of this year, and they're selling off to the tune of about 7% today. Joining us to talk more about this is Voya Financial President of Retirement, Amy Valancourt. Amy, great to have you here with us at Bloomberg Invest. I wonder how you think of investing for retirees around these, incidents or around these, a war. It's hard to downplay the importance of that, but it could be over in a few weeks. It could be something that lasts a year. So how do you deal with that in a retirement account?
Yeah, so we actually measure the confidence of our millions of plan participants, and things like geopolitical risk, things like market volatility, things like inflation, all can kind of shake their confidence. However, one of the really strong parts about the retirement industry, through advisors, through employers, through solutions providers like Voya, is that we've actually enabled over the last couple of decades to help people learn the lesson about long-term investing, long-term planning, sticking to the plan, staying the course. And so while we know these are uneasy events for plan participants to be involved in, we actually track in aggregate behavior all the time, but in particular to this as it relates to high peaks of market volatility. And people really are taking those lessons and staying the course or sticking to the plan. And so we'll see in peaks of market volatility that 98 to 99% of people do not do a erratic kind of allocation investment changes. They really do stay the course. So I would expect for them to have similar behavior during this time for just those reasons. It could be a very short-term thing. It could be longer term.
What is interesting is it comes at the same time that people who are supposed to be sophisticated investors and understand the illiquidity of private credit, for example, are rushing for the exits. I mean, that doesn't seem like they're staying the course. When I hear that BCRED is getting redemptions of more than 7%, almost $4 billion, it seems like they're not staying the course right now.
It's a great point in the differentiation between an individual retail investor and then if you think about someone in the context of their retirement plan, their employer-sponsored retirement plan, you'll continue to see people staying the course. A lot of what also is involved in the retirement plan is a lot of professional management. So you'll have vehicles like a managed account, an advisor managed account, or a target date fund that are actually being professionally managed as well. But I would draw the distinction between that individual retail investor and a plan participant who is looking over the longer term of their working years.
But you still do need to have a plan. I'm assuming in moments of volatility. Lori Calvasino of RBC did a study saying that, yes, most short-term conflict stocks can rally off the back of it. But if it is a war, the majority of war risk assets end down 12 months from now. How do you think about appropriate hedges in long-term portfolios right now? Usually it'd be something like gold, but that feels more speculative. Is it bonds? How do you kind of balance out a portfolio to be able to continue to outperform in moments of volatility like that we're living in right now?
Yeah, so I'll again answer in the context of retirement, in the context of someone who has a retirement plan, as opposed to what an investment manager might be doing. And so you'll see people taking advantage of these different capabilities like managed accounts, like target date funds, where the investment manager is actually making those trades on their behalf so that they don't have to do that and they don't have to think about that.
Yeah, I have to say, I know you're not a commentator on daily markets, but to look at gold down 4% this morning, when it had been a hedge and it had been rocketing to new levels, how are you thinking about that asset specifically?
I really would have to, indicate that would be really an appropriate question for more of our investment management group, and that we are, continue to support our plan participants with respect to how they look at their assets. Most plan sponsors, most employers do not actually have things like commodities and those precious metals in their retirement plans. They actually may allow them to do that through a self-directed option, but by and large, those investments are actually not available in retirement plans. Those are choices that the fiduciaries have made, perhaps to avoid things like these swings.
That's fascinating piece of intel in itself. Really glad you could join us here at Bloomberg Invest. Thank you so much, Amy Valancourt there, Voya Financial President of Retirement. Let's take a look at what's going on in these markets, because we're seeing really massive moves in the energy space, and those commodity moves are what's driving everything else. So right now, S&P futures down only 1.5% after closing in the cash. Sorry, not futures. S&P cash trade down 1.5% after closing higher yesterday. So we're at 67.75. The Dow off 820 points. Of course, normally we're looking at the Nasdaq or the Russell, but I just wanted to put this here because it's such a plain vanilla index. This is what people think about who aren't in the markets when they look at an event like the fourth day of a war in Iran. You see a spike in NYMEX crude right now, $77.15 a barrel. And of course, Brent crude is up around 85, and the 10-year yield up 7.5 basis points. Nothing like what we've seen at the front end of the curve in the UK.
Sure.
A jump of 16 basis points in gilts.
Yeah, but we were just talking about the end of last week that we had fallen below 4%. And here we are now up at 4.1%. Also, you saw energy surge a lot yesterday, so perhaps that's why energy is not the best performer. Even though Brent crude surged yesterday, the biggest jump since March 2022. By the way, that was only the 56th biggest move in history, despite the fact that U.S. and Israel invaded Iran, killed the Supreme leader, and there's so much disruption in energy, but every single sector is down today. This is different than yesterday. Yesterday was a shrug. Today we are paying attention, and Matt, I would go back. I think gold is really interesting today. The fact people aren't moving to that as a safe haven, that it is selling off, maybe that underscores that it's just gotten frothy and it's acting more as a speculative asset. That's not being bid up today.
Yeah, I was going to say, it's run up so far so fast. And, you know, yesterday we saw another spike in gold. It was up over $5,300 an ounce, right now trading at $51.23. We saw a sell-off yesterday, actually, in silver, and silver's selling off even harder today, down now 8.6%. So really interesting moves in commodities that seem to be driving everything else. In fact, I wanted to take a look at the WIRP, World Interest Rate probability. You're seeing traders start to price out a cut in rates, an expected cut in the rates by the Fed, but still a terminal rate at the beginning of 2027 of almost 3%, right?
Yeah.
And we're at 3.6% right now for the March futures.
And by the way, it gets even worse if you go to Europe. The ECB traders only pricing in 50% odds that they get a single, that 50% odds that they're going to see an interest rate hike this year. So the conversation of hikes, at least when it comes to the ECB, has become a topic of conversation again.
Yeah, absolutely. All right, we're looking at tech stocks selling off as well today. NVIDIA down, for example, about 2%. We come back. Mandeep Singh joins us, Bloomberg Intelligence Head of Technology Research, to break down what tighter U.S. chip export limits could mean for the world's largest company. This is Open Interest Live from Bloomberg Invest.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. This is putting the between the rice air. Then make the 4 fingers curl, make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, cup the bottom, make the sushi shape more beautiful. 3. Then, you know, I mean, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up. Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
from both the U.S. and Israel that attacks on Iran would ramp up and continue at pace. This just coming from a news agency that Israel has struck Iran's Assembly of Experts building while officials were meeting to elect a new supreme leader. This is according to Cod News, citing a senior official. And the sell-off continues at pace as we contemplate an escalation of war and how long this will drag on. Shares in the S&P now down nearly 2%. The Dow down even more, 2.1%. That blue chip index.
More than 1,000 points.
More than 1,000 points. A very good point, Matt. NYMEX crude up 8%. And again, it's the move in bonds that has been consistent across last session and this one. 10-year yields now above 4.1% as we price in a lack of odds of a price cut. And in Europe, pricing in of a rate hike, Matt.
Yeah, when we woke up yesterday, the 10-year yield was on its way down, and I thought we'd hit 390 even and maybe go through that. And then when you were on surveillance with John Farrow, all of a sudden it turned around. And as Ven Rom from our MLive team in the UK pointed out, markets are waking up to the idea that a war could cause inflation.
Yeah, by the way, one of the aspects I thought yesterday that I thought everybody was shrugging it off, Israeli stocks yesterday hit a new high. The shekel surged to a new, not to a new high, but it was one of the strongest currencies. And I think that underscored this idea that maybe this would be a repeat of June. It would just be a 12-day war and we could get over it. I think, again, Matt, to your point, it's a very different set of circumstances.
Yeah, absolutely. The president coming out and saying, look, we initially planned for this to go 4 or 5 weeks, but we're going to do whatever it takes. And neither the president nor the defense secretary willing to rule out boots on the ground. So we could get deep into this. And as a result, you're seeing financial markets start to reassess what they were doing on Sunday night, on Monday morning, and now at the close yesterday. U.S. officials are also considering capping NVIDIA's AI chip sales to individual Chinese firms. That's a move that could further restrict access to a key market for Jensen Huang and Co. As a result, you can see those shares down 2%. Joining us now is our global head of technology research from Bloomberg Intelligence, Mandeep Singh, also at the Bloomberg Invest conference with us in downtown Manhattan. Mandeep, what do you make of this news? It's like they can, they can't, they can, they can't. How does Jensen run a business like this?
Well, that's where things are getting quite political for all these tech companies. We saw that with the Anthropic being designated as a supply chain risk. That was, a political event, and now this. And look, for a company like NVIDIA, they guided really strong, even taking out all the China revenues. So in this case, 75,000 chips is more than, what is baked in their guidance. But it does show that you're not going to get like hyperscale type of customers in China. So it's capped at, probably $2 billion per customer in China, which is pretty sizable, but not like a Meta or Microsoft, which are spending over $50 billion on NVIDIA chips per year.
Mandeep, how do you think about if and how this changes with the U.S. that's now on a wartime footing and the Pentagon doing these types of negotiations? Surely it changes the stakes, but do you think it changes how the American government interacts with these companies?
I do think, when I look at, how tech has done over the years, you don't see as much sort of government driving the policy, and, that supply chain risk designation is huge when you think about an American company being labeled that way. And look, a lot is evolving even amongst these companies. OpenAI getting that big investment from Amazon. So when you look at NVIDIA's prospect for next year, yes, they guided strong for 1Q, but you're talking about a changing ecosystem where an OpenAI can start using more Amazon compute. What does that do to NVIDIA's demand? At the end of the day, it's these 4 or 5 companies. You take out Anthropic, who is going to use the compute? Right? So from that perspective, it's not as if the models are all converging and Google or, a Meta can step in and start using that compute. You label Anthropic as a supply chain risk, there may not be anyone to use all the compute that is coming from NVIDIA, and that's the big risk here.
Well, the thing is, though, after what we saw happen, the theater of, Anthropic versus the Pentagon and OpenAI then coming in, a lot of people quit their OpenAI, their ChatGPT subscriptions and signed up for Claude, right?
Yeah.
It was interesting to see Sam Altman come out yesterday and say, hey, the way we did that was sloppy and we should have taken our time, because it looked to the public as if Anthropic said, we don't want you using our technology for mass surveillance and running Terminator robots. Yeah. And then the Pentagon said, we want to do exactly that. And OpenAI said, you can use our technology to do it. Now, I'm not saying that's the fact, but it really shifted, it seems like many thousands of users, to the point where Claude went down. How do you see that whole scenario?
Yeah, the optics don't look good at all for someone like OpenAI stepping in this situation, even though, I mean, I still don't understand why they can't come to an agreement. Yes, there were these two things that Dario highlighted in his interview, but at the end of the day, it's hard for me to believe like this is not something they could agree upon. With that being said, I think OpenAI has sort of created this situation for themselves where they stepped in probably too soon, like you said, and Anthropic is the most downloaded app right now. So I think they've kind of carved out a way for Anthropic to do well on the consumer side, even though Anthropic was focused so far on the enterprise side. But suddenly you find consumers starting to use Anthropic, and it reflects in the App Store rankings. So from that perspective, it is a good sort of publicity for them that they are getting, in terms of awareness around Anthropic.
I feel like it also just shows how competitive it is, that people weren't so wedded to OpenAI that they were happy to switch over to Anthropic's model.
Well, you're right. I mean, there is that history that you have in ChatGPT, but at the end of the day, it's not as if,
But they're letting people import their history in,
You can just download your ChatGPT history and put it in Claude.
Yeah, I feel like that was part of the reason that so many people switched over, that they allowed this to happen.
Yeah, and the UI stickiness is not that, people are wedded to one interface. So it's not the old software where people just get used to, using software a certain way and they will never switch.
Right.
Clearly, with these LLMs, you will go with the one that gives you the most intelligent response.
All right, Mandeep, thank you so much for joining us here at Bloomberg Invest. That's Mandeep Singh of Bloomberg Intelligence. We're just a few minutes away from John Micklethwaite sitting down with Mark Rowan of Apollo. But let's look at what markets are doing, because the sell-off is deepening, Matt. The S&P 500 now down 2%. Crude moving higher. Just to take a stock of where we are, it is clear that the escalation has ramped up with a new attack, it appears, from the U.S. and Israel as the IRGC was meeting, or at least the new council was meeting in order to elect a supreme leader. We've seen more oil shortages, a rock the latest after LNG was shut from Qatar Energy. 10-year yields, they are backing off the worst of it. They are up about 6.5 basis points, Matt.
Right. As I understand it from my conversations with Claude and ChatGPT, there's an assembly of experts, 88 experts that will decide who the new supreme leader, pick the new supreme leader, and it'll be interesting to see. They've said in a couple of days they think that they'll have made a choice. We do see spot gold falling as much as 5% now, and you highlighted this earlier.
Super interesting.
And I thought it was very interesting because is it investors selling gold, or is the dollar getting priced higher as people pile into that as a safe haven trade?
Well, how many people are being wrong-footed by this? We came into 2026 saying the dollar is going to weaken, EM's more interesting, you can get that carry from there. And by the way, gold is red hot and it keeps hitting new record highs. So how many people were long gold and short the dollar now getting punished?
All right, let's get over to Bloomberg Editor-in-Chief John Micklethwaite. He is here at the Bloomberg Invest Conference, and he's speaking with Apollo's CEO, Mark Rowan.
Mark, thank you for doing this.
Always a pleasure.
I was just saying outside that when I just looked back in 2010, you had around 70 billion in assets. Now, as we said, closing in on $1 trillion. Should we start with kind of current affairs? You've got the conflict in Iran. I suppose we can talk about the geopolitics, but on the basic question about what it's doing to the markets and the economy, how do you look at that?
It's disruptive. I mean, we've had this, our refrain on this has been, if you look at the numbers, things are great.
Yeah.
Everyone has a job, the capital spending is off the charts and very conducive to future employment. Government policy is very accommodative, capital markets are wide open. That's normally 95% of what you need to worry about, but now, as we've been saying, it's only 70% of what you need to worry about. The other 30% is geopolitics, it's government borrowing, it's excesses in capital markets, and it's technological change. None of this is unexpected. It's just here.
How do you rate those? I mean, do you worry about the Iran thing, say, more than all the trade disruption?
Personally, not really.
Yeah.
I mean, we always have an overreaction to the confrontation of problems. But this is a problem that needed to be dealt with, and if it were dealt with in other years, it would have been more difficult. And so the notion that it's being dealt with today, in some ways, is reassuring, notwithstanding the current instability.
Just going through that list of things you had government borrowing. Is that something that worries you particularly at the moment?
It's not something to worry about, but it is something to watch. We have seen points in time when investors have called countries to account for their fiscal picture. We saw it most recently in the UK.
Liz Truss.
The departure of Liz Truss. And we have pretty much every government in the West spending more money than they are bringing in, with no sign that they are letting up. And so there is nothing that says this will end soon. Japan did it for nearly 3 decades. And so it's just something to watch. Normally, that kind of borrowing is inflationary. Normally, the restriction of the free flow of goods is inflationary. Normally, the restriction of the free flow of labor is inflationary. But we just haven't seen it. Having said that, if you're a credit investor wearing your credit hat, you don't get paid other than your coupon and your principal.
Yeah.
You look at the surrounding facts and you say, this has been a good time for risk off.
Yesterday, Jamie Dimon talked about inflation being the skunk at the party. Is that the way that you look at it?
Not so much the skunk at the party, but let's face it, we've had very accommodative capital markets, notwithstanding the backdrop that I've mentioned of things that can be inflationary. We've seen rates go down. We've actually seen curve steepening. To the extent we saw a tick up in inflation, that would probably handicap the Fed's ability to further push rates down.
We just go into credit, these big arguments, and it strikes me there's kind of 2 levels of it. The first question is, do we think that there is more kind of laxness in the overall credit markets? That's what people, Dimon talked about, Lloyd Blankfein talking. Then there's a particular...
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. The reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas.
It's maybe not as sensible an underwrite, and good underwriters pick good credits, and bad underwriters pick everyone.
You and I, though, have lived between us through a lot. I think we're almost identical ages, rather strangely. But we've lived through many iterations of kind of credit coming and credit going. So when you talk about these individual decisions, like, is it good to be in digital infrastructure at the moment or not, that matters. But so does the overall picture. And the one you just explained, where you said there's all this money going into energy, going into AI, going into all these different bits. Does the bill for that either end up with taxpayers, or does it end up with banks and credit institutions?
So, again, a longer answer than you probably want here, but the banking system is incredibly delevered and very diversified. I think it's in the best shape I've ever seen it in my 42 years of professional career. And then we get to the so-called public and private markets.
Yeah, that's
private and public are just variations of the theme. The vast majority of the private market is investment grade. There's a $40 trillion market, and 99% of the headlines are focused on a little slice of $1.5 trillion called levered lending. Levered lending is a below investment grade activity. If you trace the history of this, in 2008, levered lending was on bank balance sheets. Post-GFC, banks distributed this credit. On the one hand, you had the CLO market, which took credit off bank balance sheets, particularly less than investment-grade credit, and distributed the risk to investment-grade buyers on a senior basis and to below investment-grade buyers, high-yield buyers on a junior basis. Then credit was also distributed to private market BDCs. Banks, again, supported them, but at a very safe tranche, and investors, private investors, retail investors, institutional investors, came in to support private BDCs. And now we look at it and we say, well, credit is going through a cycle. Is that good or bad? And the answer is relative to what? And this is the point that people often miss. Credit is the formation of credit, particularly in these private BDCs, is a de-risking activity for the economy and for individuals. It's de-risking because it moved it off bank balance sheets and essentially democratized it throughout our economy. And it's de-risking for individuals because people are not funding their investments in these BDCs with their treasury portfolio. They're selling their equities. Last I looked, first lien debt is senior to equity. They are making an intelligent decision that they can earn equity-like returns without equity-like risk and take money off the table. That does not guarantee success. You can have, if you own software stocks, you're really unhappy. If you own mostly software first lien, you're really unhappy. You're just less unhappy than if you own the equity. We can't legislate out of existence stupidity.
But the underlying system you're arguing is safer because it's allocated to individual companies and it's not leaking back into the fully leveraged part of banks.
And that's what, in some ways, we can say the post-regulatory reform of the GFC worked. It's doing exactly what it was supposed to have do. It has socialized this risk. It has given investors another thing to invest in, which is actually de-risking for them. And it has moved it out of the levered, government-guaranteed portion of our economy because we made a choice, and we've made a choice going back to the formation of Drexel. Below investment-grade companies have been a massive source of growth. Private companies have been a massive source of growth, 80% of jobs. How are they financed? Well, they weren't really financed. They were cast out from the marketplace. If we want them to be financed, there's only two places they can get financed. One is the banking system. The second is the investment marketplace. If you're concerned about what's happening, you don't want it in your banking system. You prefer it in your investment marketplace where people can price the risk.
So to the extent there are problems in private credit, you would argue it's a little bit more like the dot-com problems of years ago, where it's really an equity play rather than a debt one. So there isn't that gelignite of leverage going through things.
Almost every investor is not a levered investor in the private credit ecosystem, but we've also we have this habit of throwing the baby out with the bathwater. All the press is focused on this levered lending portion of the market. As I sometimes remind my partners, as a deal shop, we don't get to be that big. Yeah. Because although we're doing something from an efficiency point of view, we use up a lot of social capital. On the other hand, the vast majority of the market is private investment grade, which is also called private credit and has almost nothing to do with what we're talking about today. So I think I try to be careful in using my language to make sure that we understand most of the capital going into private companies is actually going to finance this global industrial renaissance, which is taking place around the world. A lesser amount of capital is going into the deal business, which is primarily being funded by investors or by institutions who are making a decision to sell their equity portfolio to invest in credit because they offer about the same rates of return. And by the way, we have 10 companies that are 40% of the S&P. We're not even a, quote, qualified market at this point. We're too concentrated.
There is this issue, though, isn't there? That private people, consumers, are trying to get involved in this, and you've pushed into kind of retail 401ks, things like that, which they're investment grade. That's what they're looking at. Some people say that Apollo was a buccaneering shop. It was all about being at the forefront. The more you get pushed back into these investment grade debt and stuff like that, or you might say expanding into it, do you worry that limits the kind of risk appetite of the kind of people you want to bring in?
I don't think so. I think what happened in our market, if you go back again to the history, going in the 80s and the formation of Drexel created the high yield bond market. It basically provided capital to these companies. The banks responded with levered lending. All of the brain power in the financial marketplace left the investment grade market, and everyone wanted to do levered lending and high yield bonds because that's where the money was. That's where the excitement was. And it didn't come back into the market. The investment grade market is a drive-by market with very low compensation, with very low creativity. What we've done starting 17 years ago with the need to create investment grade for our captive insurance carrier, Athene, and for others in the insurance market, was to put creativity and intelligence back in the investment grade market. No one is bored. I can tell you that this is not now a question of they're no longer buccaneering, so they don't enjoy being there. The ability to be creative in the investment grade market is at a scale that's almost hard to imagine. So if you think last year we originated a little over $300 billion of new investments, mostly credit. 80% of that was investment grade. I assure you, no one is complaining about the lack of buccaneering.
But there's one good thing about what's happening out there, is you could argue that finance has moved into private markets, moved into non-bank. What's happening is consumers are now getting a chance to participate. But there is a kind of trade-off, isn't there? That the more this is giving them a chance to participate in these higher yielding areas, which you've pioneered. But some people will say there is a degree of risk in that, and at some point that could cause problems.
There's always a degree of risk. Yeah. So I come back and no investment offers you a free lunch. There is no free lunch. You can take equity risk, you can take credit risk, you can take duration risk, you can take all sorts of risks. The question is what's appropriate. But if you look around the world, every place that private assets have been added to public portfolios, you've gotten better outcomes. And if you go to the extreme and you take retirees, for instance, in 401k, an extra % compounded over the duration of how long you're going to be in there is a 50 to 100% better outcome by having better investments. And what are they invested in today? Well, they're invested in daily liquid index funds for 50 years. Is that risk-free? No. We have 10 companies that dominate the S&P. We've essentially, as I sometimes joke, we've levered the entirety of the retirement system of the U.S. to NVIDIA. So far, that's been good. It's not always going to be good. Public is not safe or risky. Private is not safe or risky. They're both safe or risky. They're just differing degrees of liquidity.
I suppose it's this, is that traditionally this kind of slightly riskier on the face of it lending has been outsourced to professionals like you and to people who know what they're doing. The worry is that suddenly you're now getting, in Britain we call Aunt Agatha, coming into these markets. That's more worrying.
Look, we're going to have a correction, but it's no different than the correction that's happening in banking. If you look in banking, the dominant banking institutions of today were not as dominant pre-crisis. Those that sat out the subprime lending have arisen and become magnified in terms of their fortress balance sheet and market share because they were good managers of risk and good managers of underwriting. I believe the same thing is going to happen in investment markets. Investment markets, people made choices. If you wanted a higher dividend, you could take more risk, you could lend to smaller companies, you could do more PIK, you could invest in equity and preferred, not just first lien, and you could run with a lot of leverage. That felt really good on the way up. That's not going to feel so good on the way down. And there are companies, of which we are one, but not the only one, who went all first lien, who went almost all cash pay, who went large companies, who work with low leverage. I like where we sit. And Jamie Dimon said it, there's always going to be fraud. There's always going to be underwriting mistakes. But the question is, who's a good risk manager and who's not a good risk manager? If 30% of your portfolio is in one industry, and that one industry is being impacted by technology, you have not been a good risk manager.
I think that I just looked at Blue Owl. I think it was 70% in different versions of tech. There is a parallel, though, isn't there? The way you described the banking industry, it has consolidated, particularly at the top. That would imply the industry you're in is going to consolidate as well, that you will end up with fewer people because, as you said, there is a reckoning coming. Some of those people will have to...
We have fewer people. I mean, you started. I mean, we were... The entirety of the companies that you see that are public today, everyone was $40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk. We actually create. And therefore, if we grow too fast, we start commoditizing our business because we're forced to take things we don't want. And so judging our industry should be judged by our capacity to originate good investments, not by our capacity to raise money. But the second piece of this, and they're directly related, is culture. We are, at the end of the day, an origination-driven organization. Whether our peers say this or not, they are origination-driven organizations. Often we're doing the first of everything. It's very hard to feed the first of everything into a model and get the right answer. We will be more efficient because it will not ignore us, technological change. But the ability to attract the best people, have them want to come to work, have them spend their whole careers at Apollo, is the primary job that I have.
On that, it strikes me, if you look at all the things we've talked about, you're lending money, you're trading private credit assets, we just saw the headline up there, you're building a kind of retail business. At some point, you begin to become look very like a bank, with the one exception that you're not taking deposits. Is that really what it's coming down to in the end?
Not really. I mean, what you look at is a bank works with a government guarantee. They take deposits, they do maturity transformation, and they primarily make money from the capacity of their own balance sheet. We do 2 or 3 different things. One is we don't take deposits, we don't have a government guarantee, but we originated investments and we distribute them. And for a small portion of the investments, generally, as I say sometimes, 25% of everything and 100% of nothing, we keep on our balance sheet to match with our retirement obligations.
Banks do a lot of those sort of things. They will originate loans and then distribute them. It's not that different.
I'll make the comparison slightly differently for you. If you're a public asset manager, you come in every day and you make a decision to buy something, and then you distribute it amongst the accounts that you manage, and then you go home. We kind of do the same thing, except we don't get to buy something in the public market. We have to go find it in the private market. We structure it, we originate it, we distribute it amongst the accounts that we manage, and then we go home. And so everyone in the financial market, if you're not solely a trader, you're an investor. That's what we are at the end of the day. And in the broadest sense, if you think about the drivers of our business today, there are 2 drivers of our business. One, global retirement crisis. Everywhere in the world, we are short retirement income. Guaranteed lifetime income, retirement income, is a fixed income obligation. On the one hand, we need to produce retirement income. On the other hand, we have this global industrial renaissance primarily taking place amongst investment-grade companies, and we find ourselves in the middle. We originate risk, we put some of it on our insurance company balance sheet, and we distribute the rest to investors and source it for them without maturity transformation, without government guarantees. And I believe we are playing a more important and a different role than most people perceive. And it's not just Apollo. This is the private market firms who have gotten to be size. You don't get to be sizable in the deal business. The deal business can only get so big. You have to serve some fundamental public good. Otherwise, you don't get to be big.
You talked about culture, and as you know, Apollo's been drawn into the Epstein thing because your fellow founder, Leon Black, who left in 2021, was part of it. Apollo's done an investigation, said everything was to do with him, and I'm sure this eats up a lot of your time. Just as a sort of general question for you, well, a strange one. If you look back at that whole period, regardless of individual meetings and things, when you look back, now looking at it, what would you have done differently, other than perhaps not having had Leon as a partner?
Look, Leon made his own decisions, and I will not do that. But the answer is nothing. This is, whether through good judgment or good fortune, this is not someone I built a personal or business relationship with. It's not someone that Apollo did business with. If a relationship is, one meeting over 20 years and a couple of unreturned emails, then that's a relationship. But other than he was Leon's tax advisor, we ran a partnership, not a company back then. Leon's tax position was relevant to my tax position. Other than that, I'm very sorry and didn't see what Jeff was doing. Me, I didn't like him for my own reasons. He wasted my time.
But now it does occupy time and questions as well.
Even from the grave, he's wasting my time.
Mark Rowan, thank you very, very much for talking to us.
Thank you. Thank you for having me.
Thank you.
All right, that was Apollo CEO Mark Rowan speaking with the Bloomberg's news editor, Mr. Micklethwaite, from the Bloomberg Invest Conference in Lower Manhattan. A fascinating conversation about private investing across private equity, private credit, and maybe someone where the risks and the opportunities are. But certainly Mark Rowan at Apollo, one of the biggest alternative asset managers out there in the business. Right now, let's get a little bit of a reset on this market, and it remains challenging Alexis Christophers joins us with a Bloomberg Business Flash.
Yeah, that's a word for it. And this Bloomberg Business Flash is brought to you by IBKR. Financial advisors switch to interactive brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest. Learn more at ibkr.com/RIA. Markets from stocks to bonds to crypto all taking a major hit today as the Mideast conflict widens. At the same time, we have oil prices pushing higher. Let's start with equities. We've got the S&P 500 down 158 points at 67.24. Dow Jones Industrial Average now down nearly 1,200 points, a loss of about 2.5% at 47,712. NASDAQ 100 now down nearly 600 points, a loss there of 2.33% at 24,396. The Dow, by the way, is on track for its biggest one-day slide since April. That's when the markets were sent into a tailspin after President Trump imposed those tariffs. The ongoing conflict in the Middle East is denting the appetite for risk, and so we have Bitcoin down 4% at 66,604. The Bloomberg Dollar Spot Index 1469 now up 1.25%, and oil prices surging right along with diesel and gasoline futures. Brent crude at $83.70 the barrel, WTI at $77 the barrel. All of this, of course, could lead to higher prices at the gas pump and higher overall inflation. A couple of stocks bucking the downward trend. Target is higher after the big box retailer forecasts better than expected profit for the year. Target up nearly 3%. Best Buy rallying nearly 5.5%. Quarterly sales and outlook disappointed, but its earnings for last quarter came in stronger than expected. And shares of Pinterest up 5% after Elliott Investment Management made $1 billion investment in the social media company. To recap, the Dow Jones Industrial Average now down 1,212 points. That's your Bloomberg Business Flash. Paul and Isabel.
All right, Alexa Christophers, thank you so much. We appreciate that. Scarlett Fu is out this week on holiday. Isabel Lee sitting in for Scarlett today. Thank you so much, Isabel, for sitting in for the next couple
Definitely.
hours.
Such a big day. So much happening, Paul.
Yeah, exactly. Boy, you don't see it down 1,200 very often, 2.5% on the Dow. That certainly gets your attention. A lot of uncertainty in a very fluid situation over there in the Middle East. Let's try to get the latest reporting right now. We can do that with Ethan Bronner, Israel Bureau Chief for Bloomberg News, based in Tel Aviv. Ethan, you know, the difference between yesterday and today in the markets might just be President Trump saying, hey, we're in this for as long as we need to be. And so if you want some assurance there, probably didn't get it. And we're starting to see this conflict kind of expand across the Middle East. Probably not what you wanted to see here. What's the latest reporting you have from Tel Aviv?
Well, as you say, I think it's, I mean, a lot of the decline of the market and the general sense of fear around the world has to do with the way the Iranians have responded to this war by attacking a half a dozen or 8 or 9 countries around it and really expanding this sense of conflict. And it is also true that, you know, in the first day or so, a kind of shock and awe, the assumption is that maybe this will end. And now we see that, of course, the Iranian regime is able to hang in there and is doing so. And so there's no clear next day plan. And I think there's a lot of uncertainty, as you said, you know, on all sides.
Is there a credible back channel for talks, Ian, or are we past the point of really any de-escalation?
I don't know. I mean, I think that the Americans are hoping that the president of Iran, Pezeshkian, can be maybe used as a channel to discuss some kind of de-escalation. I've heard that from the Israelis. I haven't heard it from the Americans. I don't really know how serious it is. I mean, the American-Israeli view is basically no enrichment, no ballistic missile systems, you know, a kind of conquered Iran. And it's hard to see anyone in Iran in charge agreeing to that. They're looking for a kind of Venezuela model here, a Delcy Rodriguez equivalent, but it's a very different situation. So I don't know. I mean, that is the hope, and I have no idea how legitimate a hope it is.
How big of a, I guess, a development was it, Ethan? You mentioned earlier about how Iran has retaliated against other countries in the region. How big of a development is that for the region in general?
It feels to me very big. I mean, one of the things that's happened in the last few years is these Gulf countries kind of coming to some arrangement with Iran and no longer be its firm enemy. And it's fascinating to me that Iran felt that the way to bring this war to an end would be to go after those countries and get them to ask the United States, to demand of the United States that they stop this war. And I'm not sure that it's partially had that effect. I think Qatar has said that to the U.S., but the Saudis and the Emiratis and others have said, whoa, these guys are really bad news for us, and we need to stand up for ourselves. We need help in fighting against them. I don't know where this is going. It's very unclear, but it's not clear to me that this was a wise move on the part of Iran at all, just as I don't think, it's bombing of Cyprus and affecting the British that way. It's a very strange thing to do from my perspective.
What about the White House? How much political runway do they really have for maybe a 4 or 5 week campaign or even beyond that?
I think that's a great question. I'm in Israel, and it's very difficult for me to say anything smarter than what you could say about it. It seems so counterintuitive to begin with that President Trump would become this kind of foreign policy actor. He ran on such a different platform, and his base is so uninterested in this kind of stuff. And yet here we are. And for the moment, it seems like the Republicans in Congress are backing him. And so, how long is I would if I had to guess, I would guess we have 2 weeks before it gets problematic politically. So it's been 4 days. We shall see.
Ethan, just about 30 seconds left. What's the feeling for the folks on the street in Israel? How much support do they have for the actions here, both by Israel and the U.S.?
So the Israelis are thrilled by what's going on. They just couldn't imagine a better scenario from their perspective of the greatest superpower in the world, helping them take down a regime that has called for their destruction, that has funded and armed proxies in the region to come after them, that has put a clock in the middle of Tehran counting down the days before Israel is destroyed. So there is a lot of patience here for what's going on, believe me.
Ethan, thank you so much. We appreciate getting your perspective. Ethan Bronner, he is Israel Bureau Chief for Bloomberg News based in Tel Aviv, just giving us the great perspective of the average person on the street in Israel as this conflict unfolds. Getting back to these markets, this sell-off continues here, gaining some momentum with the S&P down 2.4% and the NASDAQ off 2.7%. Let's check in with Frank Monken. He is head of macro trading at Buffalo Bayou. Frank, you see these times of a dislocation here. This one caused by geopolitics. A year ago, almost to the month, we saw this from some of the trade policy here. With some hindsight here, how do you deal with these periods of dislocation?
Hey there, guys. Thanks for having me on. Well, listen, here we are again. It's another geopolitical flare-up. This one is a pretty serious one here. I think the key really is, especially for people sitting in commodity spaces, is that the Strait of Hormuz has been kind of the tail risk that everybody has feared. Now we're here. That tail risk has been realized, and usually when tail risks like these get realized, the next step is really policy response and what that's going to look like. And that basically means, how long is this, conflict's going to take? Are we talking 2 weeks? Are we talking 2 months? And I think that's going to dictate, what policy, goes from here onwards. But I think it's very important to kind of differentiate this particular flare-up versus, the Ukraine-Russia war, for instance, where the U.S. wasn't really an active participant. Now the U.S. is an active participant, is actually one of the key instigators of the conflict. So there's a lot of responsibility in the U.S. to make sure that this thing doesn't really escalate, especially when it comes to the prospect of higher energy costs here in the U.S. And that's an item that, on the administration agenda that they ran on to make sure to rein in inflation. So that is a problem. And if you add on top of that, the fact that we're in the midterms year, I think it complicates the calculus even more. So I think, the question really is, where's the threshold for this administration to start looking for ways to find an off-ramp to this situation and try and de-escalate things to make sure that things don't unravel, particularly when it comes to inflation.
And in your note, you did say that the length of the disruption matters more than the severity. So if the conflict lasts for 4 to 5 weeks, which is what is consensus right now, although no one really knows what will happen, what asset classes are most vulnerable in your view?
Well, yeah, that's exactly that. I think these conflicts, when you get a spike like this, if it's temporary, 2 to 4 weeks is fine. But when we start getting into, a month and a half to 2 months, that's really when, you're seeing sort of the reaction functions really getting really convex, meaning that they're not linear, right? If now we're seeing a bit of jitters, some jitters in the rates market, for instance, with a 10-year, backing up about, 15 basis points since the weekend. But if we start getting out to 6 to 8 weeks, and we're still in the status quo in terms of more infrastructure assets, more energy infrastructure being hit out in the Middle East, you can really see a convexity move in rates and clearly equities. I think we've seen some of the vulnerability around equities even prior to this, and when bond volatility spikes, it tends to lead equities volatility. So I think the concerns around the equities market, to me, if we see a shallow crisis here, I think the equity market gets bought. But the real question is whether we're going to see escape volatility in bonds, and that could be very problematic for equities over the next couple of weeks.
Alex, about 30 seconds. About 30 seconds left here. What do you think how do you think the Fed views this right now?
Well, I think the same convexity argument in terms of reaction function also applies to the Fed. Right now, the swaps market is clearly making up its mind here. We went from 2.5 cuts being priced in between now and the balance of 2026 to now 1.5 cuts, and I think it's justified. You're seeing PCE now still north of right around 3%, clearly above the Fed target. Now you got a PPI number last week, that was also above consensus. So if you're going to add a spike in energy costs in addition to the stimulus package that we're expecting from the fiscal and monetary, I think it's just makes for a cocktail that the Fed is going to have to respect and probably recalibrate monetary policy. So we're keeping an eye on that, and I think it's going to be very tricky again, and especially the Fed being meddled with all the political wrangles that we're seeing going into the midterm this year.
All right, Frank, thanks so much. Really appreciate it. Frank Markham, he's head of macro trading at Buffalo Bayou. And one of the things, Isabel, is for the president to also deal with is the negative political ramification of higher energy prices. I mean, Alexis was just reporting that gas prices at the pump went up a dime just overnight. And that's going to start, people are going to notice that, even if they don't pay attention to geopolitics.
Yes, and what will it mean for inflation? This is the thing that the Fed and the government is really just trying to get a handle of. And I think economically, UBS came up with long-term issues, and I'm just going to name two: warfare and associated risk. It's magnified by sensationalism on social media. And the second they brought up is just the fiscal cost to the U.S. It seems to be rising. I mean, these are expensive to fund.
Absolutely. One of the big movers obviously out there is global energy. Brent up 8% here to $84 a barrel. We touched 85 just a moment ago. Alex Longley, oil trader reporter for Bloomberg News, joins us from London. Alex, I guess the latest question is just the Strait of Hormuz. This thing is closed. How much of an impact is that on global oil flows?
It's an enormous impact. The Strait handles about a fifth of the world's exports. As you know, the Middle East is a major producing region, and really, what's impacting markets here isn't the notion of kind of a closure in the sense that oil markets have long feared about Iran deciding unilaterally that it would do something like mine the Strait of Hormuz and make it impossible for ships to transit. The issue here is that from the moment this conflict began, the risk of sailing through the Strait of Hormuz was too great, and even the U.S. military, to a certain extent, has advised ships in the region about that risk, and that is preventing both ships inside the Arabian Gulf from getting out and ships outside from getting in. And that's why we're starting to see an impact in oil markets of this kind of lack of availability of ships to transport oil from the Middle East to the rest of the world.
What risks do shippers face in the Red Sea, especially given threats from, let's say, the Yemen's Houthi force? And how might that impact freight rates, insurance costs, and others?
Yeah, the Red Sea is obviously a kind of huge associated risk to this. I think for a lot of people, whether that's ship owners, whether that's insurers, whether that's oil traders, at the moment, so much of their focus is on what's happening in the Persian Gulf and the Gulf of Oman, that they're probably not spending quite as much time looking at that Red Sea risk. There is clearly a risk that we see a kind of a renewed set of attacks from the Houthis, and that kind of threat freshly threatens vessel traffic through the Red Sea. volatility. But I think the main thing to keep in mind on the Red Sea side is that we never saw a return, even after Houthi attacks slowed down, of the kind of original levels of traffic that we saw before those attacks began in late 2022 and early 2023.
Alex, about 30 seconds left. What do you think the next milepost the energy traders are looking for, do you think?
This is a situation that's going hour by hour and day by day. I think we've just gone past one of the big sort of milestones that we're seeing, which is reduction in output from Middle Eastern nations. I think the next thing that traders are looking for are whether we see more widespread reductions in production from countries nearby, or whether we see some kind of move to help open up the strait, particularly by the US, and whether we're seeing any tangible steps in either of those regards. It's certainly unclear at the moment, but that's exactly what traders, ship owners, insurance companies are all kind of scrambling to find out literally as we speak at the moment.
Alex, thank you so much for joining us. Really appreciate your reporting. Alex Longley, oil trader reporter for Bloomberg News. He is based in London. And again, we're seeing big moves in global energy. WTI crude oil, that's the U.S. benchmark, that's up 8.5% here to $77.22. Brent, the global benchmark, that is up 7.7% to $83.78. Again, WTI, $77. We were at, below 60 just a couple of months ago. So a big surge in the cost of oil, which is finding its way to the pump. And again, the pump price up a dime overnight on average across the U.S. So it's starting to be seen and will be felt by consumers. More coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Alexis Christophers from the Bloomberg Interactive Brokers Studio. Stocks, bonds, and crypto all taking it on the chin. Wall Street worries the conflict in the Middle East will drag on, disrupting oil supply and sending inflation higher. The Dow Jones Industrial Average now down 1,143 points at 47,776. The S&P 500 down 147 points, while the NASDAQ 100 is down 575 points. Each of those indexes down more than 2%. The Russell 2000 is down about 3.5% right now at 2564. Elsewhere, the Bloomberg Dollar Spot Index 1206.78. Brent crude at 83.80 the barrel. WTI crude 77.15 the barrel. And Bitcoin is down 2.5% at 67,645. Spot gold slipping nearly 5% now at $5,066 the ounce. In stock news, Paramount Skydance sliding 7.5%. Its debt was cut to junk by Fitch after it merges with Warner Brothers Discovery. The combined company will have a $79 billion debt load. It also plans to combine the Paramount Plus and HBO Max streaming services into a single platform. And shares of the database software company MongoDB sliding 24% after its full-year outlook disappointed. And we've got shares of the Swiss running shoe maker On Holding down 13%. Profit and sales climbed last quarter, but its outlook for the current year underwhelmed. That's your Bloomberg Business Flash. Paul and Isabel.
All right, thank you very much, Alexa. We appreciate that. Isabel Lee sitting in for Scarlett Fu, and I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City, and we're streaming live on YouTube. Head over to youtube.com, search Bloomberg Podcast, and we're also on Bloomberg.com/video. The U.S.-Israeli war on Iran has entered its fourth day, with oil and gas prices surging and the world adjusting to a conflict that President Donald Trump says has no fixed timeline. And now we're seeing other countries in the region being pulled into the conflict, with Iranian response hitting a number of countries in the region. Our next guest has 20 years of experience working in the Middle East through various forms of the U.S. government and private practice. Kirsten Fontenrose joins us here, Senior Fellow at the Atlantic Council, joining us via Zoom from Washington, D.C. Kirsten, what do you make of the U.S. action against Iran here, just from your experience in the State Department and other areas?
If the question is, why are we doing this now, or why is the U.S. getting involved, there are two answers. One is that during the talks that people were tracking on the nuclear file, the U.S. team assessed that Iran was not actually making concessions. We heard encouraging things about movement being made, but the reality is what Iran was offering was not to enrich uranium for 3 years. This time period is what the International Atomic Energy Agency, the IAEA, told us same time frame it would take Iran to restore their uranium enrichment if no restrictions were placed on it. So the U.S. team said, Iran is just toying with us. This is the same delay diplomacy they've been displaying for several U.S. administrations. This is a problem. Back in D.C., the military and the National Security Council and the president and her team said, when the regime revealed this, that they were not willing to truly make concessions on the nuclear file or on their missile file, even though the U.S. had a massive military buildup on their shores, it caused the U.S. administration to say they intend to build out both programs to the point where the international community would lose any leverage to negotiate with them. They would either build up their nuclear program to the extent that you could no longer safely go after their missile program kinetically, or they would build up their missile program to the extent that it made it too risky to destroy any of their nuclear facilities. So if the current threat on their borders was not enough, nothing would be. And therefore, the time was now or never. The other pressure that was in was the U.S. got signals from Israel that they were going to strike potentially unilaterally because of their own feeling of this being a small window of opportunity and it being an existential threat. The U.S. knew that that would mean that the U.S. would be receiving attacks. Our bases would be on the receiving end because the Iranian regime had made it clear that any strike by Israel would also be considered a strike by the U.S. So combine those, then sprinkle in intelligence that told us that there would be clustered meetings of senior Iranian leadership, almost too good to be true, and you wound up with the recipe for strikes when they happened.
So with Iran signaling readiness for a long war, Where does that leave the U.S. when it comes to reshaping their strategy? We have some people saying it'll be 3, 4, 5 weeks.
It's not really a reshaping, however. The U.S. battle plan has been laid, these contingencies have been on the shelf for quite some time, and of course they've been updated, massively updated. But the intent is to wipe out the military, wipe out the Navy, and prevent Iran from having a nuclear weapon, and create a pathway for the Iranian people to govern themselves, to decide whether they want that to be someone new or to be levels 3 or 4 down within the regime. It's on them. But this kind of operation to destroy an entire military, an entire Navy, including underwater assets, all the ships, all the bases, any missile facilities, drone facilities, factories, manufacturing, stockpiles, the like, it takes some time. So the US and Israel started with those air defenses that would prevent Iran from being able to guard against these kinds of strikes. And it went then to long range, medium range ballistic missiles, things that would threaten our bases and Israel. And it's moving on then to leadership, to things like the short range ballistic missiles that Iran barely touched in the June war, and is what we're seeing them fire along with drones onto their Gulf neighbors now. So there's kind of a tiered hierarchy of places that were first priority to hit and now moving down. But the US operations won't finish until they hit all of their high value target list. Some of those being individuals, but mostly being regime assets, the ways they exert control.
So, given your experience there, Kirsten, is this something that can be achieved in the space of 4 to 5 weeks, as President Trump was suggesting, or could it go perhaps even longer?
It depends on the state of Iran's air defenses, which right now we assess being pretty low, and then on intelligence, because we know Iran moves things around. So right now, satellite imagery, for instance, is helping our jets that are doing launcher hunting. They're literally scanning the air to look for launchers being moved from the places where they are secretly stored to the places where they are intended to launch, taking them out that way. How many of the stockpiles underground can we reach? Is the leadership on that list moving around? Do we know where they are? So the battle plan is there. It's just whether or not intelligence shifts day to day that lays out whether or not the timeline stays solid or not. It also will depend on some geopolitical factors. How is the economy reacting around the world? What kind of damage is coming to Gulf partners? It's not that things like damage would cut short U.S. operations. In fact, if anything, it would probably speed them up.
What are the odds that Gulf states like Qatar or UAE will be pulled deeper into a direct confrontation, perhaps?
Well, the U.S. may not even want that. These Gulf states have a lot of assets. They have standoff weaponry. They have great air defenses that the U.S. is interoperable with. But you don't want to clutter the airspace. You don't want more situations like we had in Kuwait, where turning on Kuwait's air defenses wound up crashing 3 U.S. fighter jets. So anything would have to be well coordinated. The U.S. has planned the battle plan around those territories and that airspace not being available. So it certainly won't be a message, hey, everybody pitch in when you're ready. All of that would be integrated. The Gulf also tends to have a lot of their air defenses on auto mode. So it expends quite a bit of interceptor stockpile on perhaps one drone and its remnants and the like. So the U.S. would want to say, before you get involved directly in anything offensive, let's really watch your defenses and make sure they're being well strategically expended. And then if we're going to use things like your standoff weapons, let's coordinate targeting. We want to really limit civilian casualties here. That's a big percentage of the planning has gone into how to limit those civilian casualties. But when you look around, even them participating in air defense is a contribution. And now that you have their civilians being hit, they're much more likely to say, we would like to participate on the offensive side. You saw Qatar already take down 2 jet fighters. That's more than just turning on a jammer, for instance. And now that Saudi has had embassies hit in their capital, they're rethinking. The Saudis, prior to any engagement, messaged to the Iranians very clearly, we're not allowing the U.S. to use this as a base for launches, but if you do anything that strikes civilian architecture, we will consider it an act of war, and everything's on the table then.
All right.
So we could be seeing the Gulf being drawn in.
All right, Kirsten, thank you so much. We really appreciate it. Kirsten Fontenrose, Senior Fellow at the Atlantic Council, giving us her latest perspective on what we're seeing in the Middle East, which is widening out. We're seeing that in the market with the S&P down 2.25% and the NASDAQ off 2.4%. Oil significantly higher.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Isabel Lee sitting in for Scarlett Fu. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube and streaming live on Bloomberg.com. We are all about the geopolitics, front and center here. But there are earnings, companies reporting earnings. And one of the companies we want to focus on here is Target, because it goes to the consumer here. Emily Cohen joins us, consumer team leader for Bloomberg News. Target reported some numbers, better than expected profit for the full year. What'd you learn from the Target, and what's the management saying?
So on management, it's important to remember this is a new CEO, Michael Fidelki's first earnings call. And there's some optimism here. There's an upbeat forecast on the coming year, and he's talking about this improving the store experience and bringing shoppers back with that cheap chic appeal that the stores have definitely lost in recent years. So the stock is responding quite positively.
I love the term cheap chic. I do agree that when I go to Target, I find some quirky finds, and I'm like, is this really this cheap? But how does Target plan to differentiate itself from competitors like Walmart and Amazon, especially as consumers remain price sensitive and their spending is shifting towards more essential, so not anymore the random things that I find?
Yeah, you nailed it. I mean, what what Target used to do really well is you'd go in for some rolls of toilet paper and you'd come out with sweatshirts and sweatpants and fun things that you didn't know you needed. That was that Target appeal. It attracted wealthier clients to Target. That was its advantage over Walmart for many years. It's lost that appeal. A big part of it is partnership. So we heard Fidelki just now speaking about increasing the pace of partnerships. They have a partnership with Roller Rabbit and more to come. That's part of it. Bringing in brands that you know and love into Target at a good price point. They have a partnership with other brands coming out over the course of the year. I think that's part of the way they want to differentiate themselves for sure. Food and beverage we heard about this morning too.
Who do they really compete against day to day, do you think?
I mean, I think it's obviously Walmart and Amazon. I think one of the reasons Target is struggling right now is because they haven't invested as much in grocery as Walmart has. So one of the reasons that Walmart is seeing higher income shoppers come to Walmart increasingly is because they've made their grocery section a lot more appealing. You can find organic there. You can find a lot of fresh products. You go to Target, it's just not there. So I think you're going to increasingly see Target try to get more competitive in the grocery aisles, which would put it up against lots of other grocery companies.
So does Target then plan to expand their food and essential assortments to, I don't know, maybe stabilize traffic? Or do you think it'll double down on more discretionary or style-led categories maybe?
Yeah, I think we'll see a bit of both. I think that they called out beauty and food and beverage this morning as some bright spots, and I think we'd expect to see more of that.
So what's Target saying about their consumer? How's their consumer behaving?
Yeah, I mean, the word of the, that we're still seeing like very picky consumers who aren't spending as much in the discretionary categories. So I think Target is focusing on what it can do to bring people back. The CEO just said that they're going to be investing in hiring more workers and raising pay. That's pretty key to making the stores more enjoyable to shop in.
Because that's what Alexis Christophers was saying earlier about her Target experiences. Not enough help on the floor. Is that something that's a shared concern is the company aware of that kind of issue?
It sounded like it. I mean, raising pay is key. I think, they're going to spend $1 billion on making the stores more pleasant. I think they laid off a lot of corporate employees too. Perhaps that investment is going into making the stores better. So yeah, that is a problem. Slow lines, lots of things locked up in cages when you try to...
Don't get Matt Miller started on this stuff.
Oh my gosh, I know. Yeah. So then, with a new CEO, any cultural or operational changes that signal that the company is truly turning a page after recent challenges? Because you have probably skeptics saying maybe this is a one-off.
Yeah, I mean, he's been in the job for a month. We've seen a reshuffling in leadership. We've seen some layoffs. But the company is hosting its investor day later today. So we're hoping to learn more about what that turnaround strategy is and any specifics on new initiatives. How big are these investments in stores? Those are the things we're looking for later today with the event that's kicking off shortly.
Where is that event?
It's in Minneapolis.
Minneapolis. Yeah. All right, that's it. That's the home base of Target, so good stuff there. Emily, thanks so much for joining us. Emily Cohen, Consumer Team Leader for Bloomberg News, giving us some update on Target. Stock's up 3.4% on news today. The market likes the earnings. It stock's up 20% year to date, so maybe the market's giving it a little bit of a thumbs up here on that turnaround, so we'll see. And again, when they have their investor day in the afternoon, maybe there'll be some more news on there. But it is all about geopolitics here, really putting a weight on the market. We're seeing it pushing down equity prices pretty substantially, more than 2% looking across the indices. Even more in Europe. I'm looking at the stocks 600. I'm looking at the DAX out of Germany, and all down over 3%. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in moments with, again, the S&P, the Dow, the NASDAQ, all trading off more than 2%. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
All right, Isabel Lee is sitting in for Scarlett Fu here. I'm Paul Sweeney. We're live in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube and Bloomberg.com as well. Well, airline cancellations topping 12,000 as Iran targets more sites. We're going to get the latest from Benedict Kamel, Bloomberg Global Aviation Editor. Another angle to the story. Vince Piazza, Bloomberg Intelligence Senior Equity Research Analyst. He covers all the global energy companies. He's going to have us focus on something we haven't focused on, which is natural gas. Nat gas is just surging here. So we'll talk to Vince on that. He's the expert on all things global energy. Lee Klaskow, Bloomberg Intelligence Senior Transport Analyst. He's going to talk to us about the war with Iran could inflate freight costs and lengthen delivery. We've heard that before. All right. Then we talk to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. I'm just going to ask him to fix everything down in Washington. That's how we do it with Nathan. He's down there for Bloomberg Intelligence. He knows everything that's coming off at Capitol Hill, so we'll check in with him. But right now, let's kick off this hour with Charlie Pellet, Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. And this Bloomberg Business Flash is brought to you by Gold and Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. The Dow, the S&P, NASDAQ, steep losses for the U.S. equity market today. All about what's unfolding in the Middle East. Day 4, the S&P right now down 148, drop there of 2.2%. Dow Industrials down 1,120 points. That is a decline of 2.3%. The NASDAQ Composite Index also down 2.3%. The NASDAQ 100 Index down 2.3% as well. Small cap shares hit particularly hard with the Russell 2000 Index of small cap shares now lower by 3.3%. Big jump in the VIX, now surging to above 26. The 10-year, 4.07%, with the 2-year, 3.51%. Gold is tumbling $222 the ounce, down 4.2%. West Texas Intermediate crude oil, a major story unfolding. Right now, we've got WTI up 8.2%, 77.07 the barrel. Brent up 7.9%. Brent, of course, the global benchmark now at 83.88 a barrel on Brent. Bitcoin down 2.5%, 67,685 on Bitcoin. So oil, as I mentioned, major story there. Michael Shaul is chairman and CEO of Ion Macro Management. He told us he is closely monitoring what is happening with crude.
I think it's all about energy for the rest of this half of the year. And I think what's going to surprise people is that even if this particular episode calms down in the next 2 to 3 weeks and energy has a pullback, it doesn't pull back to where it was a couple of months ago.
Michael Shaul of Ion Macro. Right now, ExxonMobil shares, they're down 1.3%. Chevron, though, higher by 0.3%. ConocoPhillips up by 1.5%. Again, recapping here, West Texas Intermediate crude is surging 8.3%, 77.14 a barrel on WTI. Keep it locked into Bloomberg Intelligence for the latest on these fast-moving markets, with the S&P down 2.1%, the 10-year at 4.07%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Isabel Lee is sitting in for Scarlett Fu today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming as well on YouTube and at Bloomberg.com. As Charlie was just mentioning, hard sell-off in the stock market here. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Christine Aquino. Christine, what are you looking at today?
All right, Paul, let's take a look at Palantir. So ticker PLTR. Those shares are actually down at the moment more than 3%. But prior to Tuesday, it did complete a 4-day rally. That was the longest streak since Christmas Eve 2025. And a lot of analysts turning bullish now on Palantir, given that it does have a defense business that a lot of them are getting more optimistic on. And it does get half of its revenue from U.S. government and military contracts. And so at the moment, of course, given all the geopolitical tensions that we're seeing, a lot of investors kind of seeing Palantir as a beneficiary of that. So we've seen analysts upgrading their ratings on Palantir's stock. 22 of 31 analysts that Bloomberg monitors now rates it a buy. And remember, it's had quite the challenging past year. Like for 2025, that stock was down, or rather, that stock was up a lot. But you know, it's also seeing a lot of volatility. But yeah, now analysts are saying that this recent bout of strength is something to be optimistic about.
What about Best Buy? I feel like there's a lot of news coming out of that company as well.
Absolutely, Isabel. So we did get earnings from them earlier, and that stock very much in the green. So ticker BBY. We're now seeing those shares up about more than 4% at the moment. So trimming some of those opening gains, but still very much in the green. We did hear from the company, of course. They told us that their holiday shopping season was better than expected. That's likely because of a blockbuster Nintendo Switch to release and a robust replacement cycle. The revenue forecast for this year did meet Wall Street estimates. Though Bloomberg Intelligence weigh in, they're saying that same-store sales declines probably likely in fiscal 2027, given that they're forecasting a 0.5% gain in 2026. So pretty modest by most standards, and so perhaps a little bit of a negative heading into 2027 for the company.
All right, how about the insurer Cigna?
Yeah, let's look at...
do our dental.
They do, yes, they do our dental. That is right.
Love you, Cigna.
But not necessarily invest in that stock, but yes, and you know, that stock not doing particularly well today. So ticker CI, those shares are down more than 6% at the moment, so extending some of those earlier declines. And you know, we're seeing a leadership change for this company. Their chief executive officer, David Kodani, is going to be stepping back from the top job on the 1st of July, and he's going to be replaced by current Chief Operating Officer Brian Ivanko. Now, remember, Cigna actually had a bit of trouble in October because they told investors they need to do a business overhaul. They're going to be moving away from drug rebates, and they told investors that that is going to squeeze margins over the next 2 years. So in October, when they told investors that, they saw the worst sell-off in shares since 2008. So now the new CEO or the incoming CEO is going to have to carry out the business overhaul and keep it from spooking investors further.
All right, Christine, thank you so much. We appreciate that. Christine Aquino, Bloomberg News, giving us the latest there. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Airline cancellations top 12,000 as Iran targets more sites. To give us the latest color there, Benedict Hamel joins us, global aviation editor for Bloomberg News. He's based in Berlin. Benedict, what's the latest with air travel in and around the Middle East and the greater, I guess, European area?
Well, the latest is that we are still looking at a big hole, really, on the map, and where you would normally see all these planes crisscrossing places like Dubai, like Doha, like Abu Dhabi. There is literally no movement at the moment, and that's been the case since Saturday when the airspace over these areas closed down. There are some very sporadic flights that are leaving, mainly evacuation flights that are taking place. Some fringe areas remain open. Saudi Arabia is open. Oman, Muscat Airport is open. So those are possible sort of escape routes for people. But you have to imagine, you just mentioned the number there, 12,000 flights. We're talking hundreds of thousands of people literally that are stranded in places like Dubai, like Doha, and that are now really desperate to get out. So that is still the situation on the ground, and it doesn't look like it's going to ease anytime soon.
Are airlines suspending routes temporarily, or are we seeing deeper scheduled cuts that could impact summer travel demand?
I think it all depends on how long this will take. If this disruption and if this war, frankly, is over relatively soon, then things might bounce back fairly quickly. If this drags on and the headlines we're seeing are not very positive at the moment, then things could get very difficult for the industry. The aviation industry, if you think back to 9/11, you think back to the financial crisis, it's generally very resilient. It does bounce back, but it does leave a mark and it takes time. So whatever happens, you can imagine that a lot of people will have second thoughts about transferring via Dubai or even going to places like Dubai on a vacation. So it will leave a mark. But again, whether this is something that will have a long-term effect really depends on just how long this conflict will drag on.
So I guess, Benedict, this really came to a head over the weekend as we saw Iran start to retaliate, and that just opened, or I guess widened, the theater of potential risk out there for the airlines. So I suspect this is a case of airlines just being, as cautious as they can be or should be.
Yes, absolutely. I mean, there's always a great sense of caution vis-a-vis sort of what's happening on the ground. We saw it in Russia. We've seen it in Ukraine. These are two large areas that many airlines are circumnavigating that they're not using. So, and you can't underestimate the importance of the Middle East as a sort of trajectory for East-West movement, both in terms of airlines landing in Dubai, for instance, but also then flying through that part of the world, through Iran, through Iraq, as they head from places like, say, London Heathrow to Singapore. Those are very important routes, and now these airlines have to find alternative means of getting from A to B. That's going to drive up the cost because they'll have to take longer routes. It's going to make the journey more expensive and potentially more treacherous. But safety is always sort of the number one guiding feature of aviation, so they're obviously keeping it very close at the moment.
All right, very good. Benedict Kamel, thank you so much for joining us. Benedict Kamel is a global aviation reporter for Bloomberg News. He is based in Berlin, joining us via that Zoom thing. And again, one of the themes of this morning that Isabel and I have been bringing to you is that we've seen the big movement in the energy markets. We had WTI and Brent crude up over 8% each. Natural gas also moving higher here. So we wanted to get the latest on kind of what we can expect in those global energy markets. We can do that with Vince Piazza. Vince Piazza is a senior equity research analyst. He covers all the global oil and gas companies and industries. Vincent, we've seen the big moves in oil and gas. Is there more, I guess, upside to go in these commodities?
Well, if you think about the conflict, the initial reaction to the conflict, Russia-Ukraine back in 2022, we saw that initial pop, and then sentiment settled down. This is really no different in my view. I understand it's very treacherous right now, but I would suggest to you this, that the markets seem to be reacting fairly rationally to what we are seeing with this volatility. Keep in mind that the equities, the energy equities, are lagging this pop in over the last 2 days for both crude and also for natural gas. Natural gas here in the U.S., Henry Hub benchmark, that seems to be much more tame relative to TI and Brent. Of course, the dynamics there are somewhat different. But I think if you would have asked me Sunday what I would have expected, the volatility is definitely there. This seems to be fairly in line. I would say that if the infrastructure gets destroyed, if marine logistics become an issue, supply chains become an issue, a more permanent issue, then I think all bets are off and the uncertainty will prevail over rational minds.
Talk to us about China's role in all of this. They are the biggest buyer of Iran's LNG, and they tried or have been trying to persuade the country from targeting vital energy export infrastructure. How do they fit in here, and what are the best case and worst case scenarios for them?
Well, we spoke on this over the weekend, and if we were to look at China's preparation for this, there is roughly, call it 50 million barrels of floating storage right now. in the Asia corridor. That's a significant supply that is available to not only China, but also the Asian buyers. China has been stocking oil significantly. There's roughly 2 billion barrels of capacity. I think there's somewhere around 1.5 billion in storage at the moment. The IEA suggests somewhere around 90 days of demand. I believe that China is somewhere north of 120 days at the moment. So there seems to be sufficient stockpiling at the moment. Now, as we move forward, again, if we're talking more about destruction as opposed to delays or disruption, then I think all bets are off, and we could see a triple handle on Brent and TI. But when we talk about natural gas here in the U.S., we just put out a note this morning talking about how the U.S. operators are somewhat more isolated and insulated from all that's going on right now, and how we should not expect any incremental barrels coming into the market or incremental molecules coming into the market to take advantage of this price rise. If anything, you'll probably see the opposite happen, more hedging by the U.S. operators, since capital discipline, the mantra of capital discipline that shareholders desire, that remains persistent for 2026 in our view.
Hey, Vince, when and to what degree will we see higher prices at the pump?
Well, you would most likely start to see it as we move into the spring session. Of course, summer is just around the corner as well, so it does take some time to funnel through more sustainably across the U.S., but you would see that bleeding in, considering that wholesale prices are now up as well.
So, Vince, what's the role in OPEC here? Are they just going to open up the spigots and take advantage of higher prices?
So earlier, they suggested that they would delay any action. I believe, considering where we stand today, you could see them propose loosening balances, providing additional capacity. Of course, Saudi has the most excess capacity, and you could see it introduce barrels into the market, or suggest that they will introduce barrels into the market to sort of calm the market somewhat.
All right, Vince, thanks so much for joining us. Always appreciate getting a few minutes of your time on the global energy business. Vince focuses as much on natural gas as he does oil, because that is a big source of fuel and energy going forward. So we're seeing movements, but I'm looking at, it's funny, the Henry Hub natural gas, that's the U.S. one, it's only up 5.7% today versus what you see over in the UK, up over 20%. And you see oil up about 8%. So that U.S. natural gas a little bit more insulated, as Vince was saying.
And shipping could still be a problem. I feel like that's also supply chain issues. That's what we saw during the pandemic, safety concerns and surging insurance rates. I mean, it's really going to probably force tankers to halt travels through maybe the Strait of Hormuz or even other waterways.
That is a wonderful segue, as Tom Keene would say, because we have Lee Klaskow. He covers all the global logistics, including the big ship carriers, the tankers, all that kind of stuff that gets the goods over the water. So he'll be a perfect person to chat with and see what's going on with the global shipping, global supply chain, in a part of the world's very uncertain. S&P off 108 points. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for the U.S. equity market with the Dow, the S&P, NASDAQ all declining, all three negative on the year as the war in Iran shows no signs of de-escalation, heightening fears of a lengthy disruption to energy markets and a surge in inflation. Right now, the S&P 500 index is down 1.6%. Year to date, the S&P is down 1.2%. The Dow lower by 893 points, well off session lows, down by 1.8%. We've got NASDAQ down 1.8%. The NASDAQ Composite Index plunging today by 3.9%. The Russell 2000, right now, by the way, the NASDAQ Composite Index correcting that down 1.7% year to date. It is down 3.8%. Again, keeping it all in context here, the S&P down by 1.6%. The Russell 2000 Index of small cap shares down 2.7%. We've got the 10-year yielding 4.06%. A VIX trading above 25. Spot gold down $205 the ounce to 51.16, down 3.9%. West Texas Intermediate crude is surging 8.2%. Brent, the global benchmark, up 7.9%. An earnings surprise this morning out of Target. Shares are higher on a down day for much of the market. Target advancing right now by 4.7%. The retailer forecasting a better than expected profit for the full year. So again, S&P 500 index down 1.6%. The NASDAQ Composite Index right now down 1.7%. And the Russell 2000 Index down 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Isabel Lee sitting in for Scarlet Food today. I'm Paul Sweeney. We're live in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube and at Bloomberg.com. This military conflict in the Mideast cannot be good for logistics, the global supply chain, all that kind of stuff. We learn about this every time there's something wrong in the world. It impacts global trade, which means we need to check in with Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. Lee, what do you make here of what we're seeing in the Middle East and how it may impact global trade? How are you thinking about it?
Yeah, so I mean, at the end of the day, it's going to put upward pressure on rates because there's now a premium on capacity, especially as it relates to the tanker industry. We've seen tanker rates get close to almost $500,000 a day. That is just being driven by the fact that if people want oil, they're going to have to pay to get it. The ripple effect really for my world, because, you know, I cover marine shipping, air freight guys, and also the folks here in the U.S., the railroads and trucking companies, the biggest impact is going to be the inflationary aspect and the higher diesel prices. When diesel prices rise significantly, it tends to weigh on margins because there's a lag effect on the fuel surcharges that they charge their customers. So you're going to see margins getting pressed, and also the 1-2 punch from that is going to be if consumers have less discretionary money to spend on goods, that means there's going to be less stuff shipped around. So, there's really kind of a ripple effect going on with the events unfolding in the Middle East.
If disruptions persist, do you think we could see supply chain bottlenecks similar to 2021 to 2022? And if so, which sectors do you see will be falling first or will be affected first?
I don't think you're going to see what we saw during the pandemic, because at the end of the day, the biggest impact really is the crude and energy markets. So, container liners that are leaving Asia are still going to go to southern California to unload their goods. The only time it's going to become a problem is that if this is really prolonged and just people just don't have the energy to manufacture stuff. But let's hope we don't get there.
What about vessels? With vessels stalled and rerouting around choke points, how sharply are freight and tanker rates going to rise in your view?
My colleague Ken Lowe out of Singapore, he just put out a note on the Bloomberg terminal earlier today, and he was calling for over $500,000 a day in time charter rates. Again, what it's not so much the diversion, it's the kind of the demand. So people are willing to pay up high. A lot of insurance companies are no longer insuring in the region. So the Strait of Hormuz is pretty much, the Persian Gulf and the Strait of Hormuz is pretty much shut down no matter what the Iranians do.
So, Lee, if I'm a FedEx pilot, I'm not flying anywhere near that airspace, so I'm going to fly around it. Isn't that going to raise costs for everybody?
Yeah, and so like the ripple effect, after the ocean markets, probably the air markets are most impacted. A lot of the airspace in the Middle East has been shut down. A lot of commercial flights are no longer going in and out. And, what the commercial airlines do is, where we put our luggage, they also take cargo. So that capacity is not available. And, it is going to impact FedEx, UPS, and DHL. DHL is more exposed to the Middle East than the other two. But I think right now it's kind of a de minimis impact to UPS and FedEx. The real question is how long does this go for? Is it going to be days, weeks, or months? If it's just going to be weeks, the impact to earnings probably won't be that significant for the FedExes and the UPSs of the world, and slightly more for DHL. Right. And then also, a lot of these businesses, they have freight forwarding businesses as well. And when you have these supply chain disruptions, shippers will lean heavily on the freight forwarders to help them navigate these new situations. So you might see, the freight forwarders also could benefit. They can benefit from A, higher rates, and B, also getting more customs business.
All right, Lee, thanks so much for joining us. Always appreciate it. Lee Klaskow, he is the logistics analyst globally for Bloomberg Intelligence, giving the latest on what's happening with the freighters and air freight and all that kind of stuff. Let's get back to these markets here. A little bit of an improvement here. We're off our lows. Got the S&P off about 1.5%. Again, we're off about 2.2% at the low here. Let's talk to a money manager here who has to navigate these uncertain times. Gus Scacco, portfolio manager, Advisors Capital Management. Gus, thanks so much for joining us here. We know we get these crazy days every once in a while. Geopolitics or other kind of black swans pop up here. How do you navigate these days? Do you just keep the blinders on and keep to the long-term strategy? What are you doing?
Well, obviously this has just happened. We only got a couple of days into this, but we keep a look at when there's a lot of volatility. We keep an eye on, are there changes to GDP? Are there changes in earnings? And where are rates? And we keep an eye on the VIX. So the VIX usually trades somewhere around 18.7 has been the average going back, 40 years, 40 plus years. And 9 is a standard deviation. So you're kind of there. That's when the market started to pull back a little bit. Now, everything's in flux as we speak, but GDP might be changing the longer this goes on. But, the U.S. economy has been pretty resilient. In terms of earnings, we've continued to see earnings upticks. And now, obviously, that might be subdued a little bit. When we look at rates, we're looking at spreads breaking out a little bit, but they're pretty much contained. So, we're going to take this day by day, but, we buy businesses and look for the long term. We're owning companies for longer than, 2 to 3 years in our funds. So, we're looking at businesses, good cash flows, where, dividends are paid and that there's, bright outlook and that there's moats. So we're kind of staying the course.
Staying the course, so do you then start rotating into defense stocks, energy stocks, and commodities, or are you in a wait-and-see mode? And if you do, what do you think of those trades? Are they already crowded?
Well, we already have, exposure to those areas. That's why you own a portfolio. We're going to, we can't always be in, just one group. So we're holding names, and generally when you're looking at our portfolios, you're generally owning more than, 40 plus names to give you diversification. Obviously, this has come out of, it's not a total surprise, but somewhat in terms of the timing on it. But we're owning companies that range from, staples names like Hershey's. We own companies such as eBay and retail. It's not one group. It's not one beta area. We're looking at a pretty diverse portfolio. So where are we sitting right now? We continue to have overweight in tech because we believe that that's the place you want to be long term. We own some of the Mag 7, which we think you have to be there, but we also own names that are beneficiaries from that. And especially if you look on the industrial side, we own names like Deere. And if you were to look at Deere, here's a company that if we're looking at Venezuela, Cuba, Ukraine. Eventually, we're going to end up having to rebuild in these areas. And this is a company that's going to benefit from it, whether it's on the farming side or construction. In terms of other areas, we've been long-term owners of Lockheed Martin. And the company is basically working right now at capacity. They're adding robots to their manufacturing facilities that will be in place by the back half of this year. And it's not just the U.S. You have companies or countries that have seen our technology as far superior than the Russian or China technologies that were bought by the Iranians. So, there's a benefit there, and they can probably look at upward push in terms of earnings over time, because we have to replace a lot of stockpiles on the missile side. And then other names, Williams, which is a pipeline company, but you're talking about LNG flowing through, and they're the largest pipeline that we have here in the United States, but also for export, as well as they also are a back-ended energy play in terms of AI, because you can get 18 months, you can basically flip a switch, a turnkey solution for energy and power to a direct area, whether it's a data center or a major manufacturing plant. So we're pretty diverse. We have names that, transcend from staples to, tech. And we stay the course because, you can't really look at a 2 to 5 month period and say that's where we want to be. You're going to maybe change things around the edges, but we constantly are reviewing our portfolios. We're lucky enough to have 2 former people that worked at the Federal Reserve, on the economic side, and people that have worked in industry designing chips. So, we have people that are in the weeds, so to speak, in terms of understanding economic impact as well as, industry impact. So we're comfortable where we sit today.
All right, Gus, thanks so much for joining us. Really appreciate it. Gus Scacco, he's portfolio manager at Advisors Capital Management. Diversified portfolio, defense, energy, industrials, consumer finance, consumer. You hear that from a lot of the pros. The value of diversification, particularly when you come to periods like this, where you've got this, these uncorrelated or type of, uncertainty that comes into the marketplace, volatility that comes into the marketplace. Diversifications help.
Definitely, it is key. Every time I talk to a portfolio manager and I try to write a story, I do get bored when they say diversify. I'm like, no, give me something exciting.
Right.
But when it comes to events like these, few and far in between, but very relevant and can move the needle so much, diversification is indeed the way to go.
Yeah, absolutely. Risk assets, speaking of risk assets, which I can include Bitcoin, it's off about 1.5%. 68,000. The low today was 66,000, so it's come back a little bit off of the low here. And we look in the commodity space. Again, we're seeing that gain in oil across the board. WTI and Brent, the 2 benchmarks, both up about 7.5% here. So again, off of the highs, but still severely elevated relative to the last 3, 4, 5 weeks, and that's priced into that. The stocks off the lows. The S&P down 1.6%, had been down 2.2%. The NASDAQ off 1.6%, had been off about 2.2% here as well. So coming off the lows a little bit, but again, some concern in the marketplace. The VIX, 25 and change. It was up at 28 earlier today. Anything above 20 just kind of suggests some angst in the marketplace, and that's clearly what we're seeing here. We're going to have more coming up. This is Bloomberg Intelligence. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. Losses for the U.S. equity market. Oil is surging right to the numbers. S&P now down 1.6%, a drop of 108 points. The Dow is down 829, now a decline of 1.7%. NASDAQ Composite Index also down 1.7%. The VIX at 25, 10-year yield 4.05%. Gold is down 3.7%, 51.25 the ounce. Crude, though, a major story, up 7.5% on WTI, 76.61 a barrel. Brent, the global benchmark, up 7.2%, 83.32. Airlines are suspending flights to additional destinations across the Mideast as the scope of the war expands. Benedict Kammel follows the airlines for Bloomberg News out of Berlin. He was a guest earlier this hour right here on Bloomberg Intelligence.
Well, the latest is that we are still looking at a big hole, really, on the map, and where you would normally see all these planes crisscrossing places like Dubai, like Doha, like Abu Dhabi. There is literally no movement at the moment, and that's been the case since Saturday, when the airspace over these areas closed down.
Bloomberg's Benedict Kammel following the airline industry for us out of Berlin. Among U.S.-based carriers with significant overseas routes, we've got shares of American down 2.3% down, United down 2%, Delta lower by 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Scarlet Fu is out today. Sitting in for Scarlet Fu is Isabel Lee, which we appreciate. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and streaming live at Bloomberg.com as well. Congressional war power votes aimed at blocking President Donald Trump from further military action in Iran will likely fail. That is the assessment of our next guest, Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. He's down there in D.C. I mean, this is just for show, isn't it, Nathan? I mean, the Congress has given up the whole, war powers thing a long time ago to our U.S. presidency, haven't they?
Yeah, absolutely. I mean, this is essentially a symbolic vote here. I mean, in order to get this through law, you would have to have both chambers pass it, and you'd have to pass it in a way to get a veto-proof majority, because President Trump would obviously veto this measure. So I think what, Senator Tim Kaine, who is the sponsor of this legislation or this resolution, and he did something very similar to Venezuela, is aiming to do is just essentially just put people on record ahead of the U.S. midterms, because current polling suggests that 60% of Americans are not on board with President Trump's strategy in Iran. And, as you can do in an election year, people like to play politics, and so this is something that I think just generally is more so about political aspects as we get closer and closer to November.
But even if passed, resolutions would need a supermajority to override Trump's veto, and so that leaves them with, to Paul's point, something largely symbolic. So what is the ideal situation in your view?
Yeah, so there's two reasons why Senator Tim Kaine is pushing this. The first is Congress doesn't like it when presidents start conflicts. And you don't even have to have a Republican president or a Democratic president. You go all the way back, over the last 50, 60 years, Congress doesn't like when president starts conflicts without going for congressional authorization. So this is the first reason. The second reason is that, just going back to my point about politics, all 435 members of the House of Representatives and 1/3 of the Senate are running in November. And this could be a situation where Senator Kaine wants to put people on the record so that if that 60% of the American populace isn't on board with President Trump's Iran strategy grows larger, you can have some very difficult conversations. I mean, this is not going to change President Trump's, strategy. When he says that he doesn't need to even think of the polling numbers, he's correct. But, he's also not running on the ticket in November. There are going to be some Republicans, on the other hand, who are looking at this and looking at the chances the Democrats take the House in November. And I'm not going to say they're going to speak in opposition to this, but they certainly would be a little bit more wary, or at least their uneasiness would rise as a result of this vote.
Nathan, realistically, is the Senate up for play here in the midterms?
So right now, the prediction markets have it about a 40% chance that the Democrats are going to take the Senate. And a lot of it hinges on today, specifically what's happening here primary day in Texas. Now, you have two races. You have the Republican race and the Democratic race. On the Republican race, you have Ken Paxton, the Attorney General, who, according to the prediction markets, has an 85% chance of beating the incumbent, Senator John Cornyn. On the Democratic side, a similar number, 82%, suggests that James Talarico, the moderate Democrat, has a good chance of beating Jasmine Crockett, the progressive on the that is the ticket that the Democrats want to see if they have a chance of beating taking the Texas race. But again, like I think most people, at least according to the prediction markets here in Washington, are sort of just taking into account as their scenario. The Democrats have a really decent chance of taking the House, about 80 to 85% according to the prediction markets. The Senate is still going to be very difficult despite what happens today.
What's the most likely geopolitical scenario your sources are telling you? Say in the next 30 days, what are they preparing for? Maybe best case or worst case scenarios? Best case depending on the view you're taking.
Yeah, obviously, I think it's the timeline of Iran. I mean, our colleague from Bloomberg Economics, Becca Wasser, has been looking at this. Our colleague Wayne Sanders has been looking at this. And there's this idea, if you look at the prediction markets again, in terms of where this is going to end, Kalshi has a contract here that essentially says the majority of folks think that this is going to be over this month. That's very different to this idea of the geopolitical risk will continue for months, especially in terms of like the Strait of Hormuz and all that other stuff. So I think that's the number one thing here to keep in mind from the geopolitical perspective. But I would also just say from the U.S. domestic perspective, keep in mind that there's going to be a rush to push legislation out this month and next month because Congress, like I said, is going to really focus on the midterm elections, and that generally stops them from passing legislation.
Great stuff as always. Appreciate it. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. He's down there in D.C. Right now, let's go to the Bloomberg Invest panel in Lower Manhattan. Neil Kashkari, Minneapolis Fed President, speaks with Bloomberg's Michael McKee, and they're sitting down right now. Let's take a listen.
Who Neil Kashkari is. He obviously is a well-known central banker, but I did want to point out that you started your career as an aerospace engineer.
I did.
And maybe that's why you got the superhero entrance stuff there. Then you went into finance, worked at Goldman, worked at PIMCO, and ended up in this lousy job. So I was checking my phone just a minute ago, and we always have to do that with Fed officials now because there's always a tweet, something that's going to come up. Neil and I talked about what we were going to talk about on Friday, and since then there's been a little news. The president's war has obviously disrupted oil prices, and they're way up over the last couple of days. That means gasoline prices go up, so that means inflation goes up. But the Fed has some experience dealing with this, right?
So I think the question is, obviously, when Russia invaded Ukraine, it sent a commodity shock wave all around the world. And I was go back a few years, I was on Team Transitory, which said, hey, I think that this inflation that's coming out of the pandemic won't be that bad and will be short-lived. Obviously, we adjusted that view. That was not the right call, and we raised rates aggressively, in part because of that commodity shock wave. That was one of the contributing factors for why inflation got so high. But now if you fast forward a few years, when Hamas attacked Israel, I was ready for a commodity shockwave that didn't come. And so now the question I think that we are wrestling with and markets are wrestling with is, how long is this going to last? How bad is it going to get? Is it going to look more like Russia-Ukraine, or is it going to look more like Hamas attacking Israel? And that's going to have effects on monetary policy. I don't think anybody thinks when Russia invaded Ukraine and the inflation that resulted that the Fed should have just ignored that. I mean, that would have been the true transitory call. It's a one-time effect. Just look through it. I think right now it's just too soon to know what imprint this has on inflation and for how long.
Well, there's a follow-on question to that in that we've seen a sort of hockey stick action in gasoline prices since gasoline futures went up and oil prices went up over the last 24 hours. It's also used oil in many other manufactured products, in pharmaceuticals, in plastics, et cetera. How long do we need to see elevated prices before this becomes not just a headline spike, but it gets into core inflation?
Yeah, I mean, that's something we think about all the time. We obviously, Mike, we focus on core. Our target is headline inflation, but we focus on core because core is a better indicator of where headline is going. But even when you strip out food and energy, though they do eventually affect core, because just as you said, energy goes into producing core goods and services as well. So I think that process takes a while. For me, though, the bigger issue is just if headline inflation is going to be elevated for an extended period of time, coming off of 5 years of elevated inflation, boy, that's a scenario that we need to pay a close attention to, and we have to pay attention to what happens to long-run inflation expectations as well. And so there's a lot to pay attention to right now. Coming into this moment, I was feeling pretty good. Inflation is still too high, but I feel like it's been slowly heading in the right direction. The labor market is pretty good, a little bit getting softer, but generally speaking, we're around the bands of our dual mandate. And so I felt like policy was in a pretty good place, and we have the luxury of just letting it gradually glide back to neutral. Now we need to see with this new shock, potentially new shock hitting the global economy, how long is the effect and how big is the effect?
Well, as Rosanna Dana used to say, it's always something. And years ago, before we started the war, we were worried about tariffs. Remember tariffs. The consensus of the Open Market Committee seems to be, in listening to people speaking, that we're kind of in peak tariffs now. And you've basically said the same thing. Inflation should begin to come down in the second half of the year. But since the Supreme Court ruling, has that changed in your view in terms of we're not going to know what tariffs are for a while now, and we're not going to know when they're going to put them on or how they're going to affect the economy, so you can't really have confidence that inflation's going to come down?
Well, I think there's no question that the Supreme Court ruling and now the uncertainty about what is the new tariff regime, which authorities are they going to use, how close can they get back to replicating what they had originally imposed, that's introduced uncertainty, and uncertainty is a drag on the economy broadly. I haven't seen any evidence that the new tariff regime, whatever it is going to lead to a new round of elevated inflation. It seems like, based on their commentary from the administration, they mostly want to try to recreate what they had before. And the question is, how close can they come to that? So I would expect that inflation, just on that one factor, is likely going to be on the same trajectory or maybe a somewhat lower trajectory if they're not able to fully replicate the tariffs that they had before. I haven't seen a lot of evidence that tariffs are going to go much higher from here, but we need to see.
Well, does this push out the time frame for you to be able to have confidence that we're not seeing a tariff impact?
Just on the tariff effect, setting aside geopolitics in Iran, just in the tariff effects, it isn't obvious to me that it's going to delay the expected deceleration of inflation, because I don't see a lot of scenarios where they're going to substantially increase tariffs from here.
So where do you put yourself now? Obviously, you have to put a new dot plot together for the next meeting on March 18th. What do you think? Do you think, first of all, there's going to be any move in March? I would assume you would say no. But after that, when do you think it's more likely that you might consider it as a live issue?
Well, in December, if you look at my December SEP, I had preferred us not cutting in December, but the committee did. If you just do the math, I effectively had one dot now for 2026. I basically had 2 and 2, and because they did 3, then I brought one dot forward. So that leaves me with one dot coming into recent events, so one expected cut later on this year. Now with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. I think housing inflation is trending down. I've got a lot of confidence in that. Core goods inflation has been trending up because of tariffs. Services inflation, I think, is trending.
This is breaking news from Bloomberg.
We've got some breaking news here. President Trump from Washington, D.C. making some remarks on Iran. Let's listen in.
I think they were surprised. I was surprised. I think and now those countries are all fighting against them and fighting strongly against them. Someday they'll write a story and they'll say why they did that. But they hit countries that had nothing to do with what's going on. They were sort of leaving everything alone. All of a sudden they had missiles shot in, which shows you the level of evil that we're dealing with. They'll hit people that were actually at least somewhat friendly. And they had no problems with it. Also hitting only civilian places, hotels and apartment buildings, and we're hitting them where it is much more appropriate. We're hitting them very hard. And the big scale hitting goes now. They no longer have air protection. They no longer have any detection facilities at all left. And so they're gonna be in for a lot of hurt. These are bad people. These are people that killed. I guess it's 35,000. It's coming out 35,000 over the last 3 weeks. Protesters, 35,000 violently killed. So these are bad people. And the leader of the pack is gone. And as you know, 49 people were taken out in the first hit. And I guess there was another hit today. on the new leadership, and it looks like that was pretty substantial also. So they're getting hit very hard, and we'll see what happens. A lot of people are coming forward. A lot of the people you would least suspect want to quit. They want to have immunity. They're asking for immunity, and probably at some point they'll be dropping, as you would say, laying down their guns. We'll see what happens. In the meantime, we're just continuing to go forward. Our military is the #1 in the world by far, and we are. Everything's big in my book. Venezuela was big. This is big. The original hit, Midnight Hammer, was big. Everything you view is big, but it's not considered very big by some standards, by some of our standards. We have a military like no other military that's ever been built.
Mr. President, what's the worst-case scenario that you have planned for in Iran?
Well, I don't know if there's a worst case. We have them very much beaten militarily from the military standpoint. They're still lobbing some missiles. At some point, they won't even be able to do that because we're hitting all of their carriers. We're hitting all of their missile stock. You know, they built up all these missiles over the last few years. They had a lot of them. They've shot a lot of them, and we're knocking out a lot. I guess the worst case would be we do this, and then somebody takes over who's as bad as the previous person, right? That could happen. We don't want that to happen. That would probably be the worst. You go through this, and then in 5 years you realize you put somebody in who was no better. So we'd like to see somebody in there that's going to bring it back for the people. And we'll see what happens with the people. You know, they have their chance. And we've said, don't do it yet. If you're going to go out and protest, don't do it yet. It's very dangerous out there. A lot of bombs are being dropped. But I would say that would be about the worst.
Do you have someone in mind right now? Because you said all the people you did have in mind have been taken out. What do you think?
Well, most of the people we had in mind are dead. So, you know, we had some in mind from that group that is dead. And now we have another group. They may be dead also, based on reports. So I guess you have a third wave coming in. Pretty soon we're not going to know anybody. But we have, I mean, Venezuela was so incredible because we did the attack and we kept government totally intact. And we have Delcy, who's been very good. We have the whole chain of command, and they've been, you know, look, the relationship's been great. We've taken out 100 million barrels of oil already, and a big part of that goes to them, and a big part goes to us, and it's been great. We paid for the war many times over, and we're going to be running the oil, and Venezuela is going to make more money than they ever made, and that's great for the people. The relationship has been great. It's been seamless. Nobody's actually ever seen anything like it. If you look at Iraq, where very stupidly everybody was fired, the generals were fired, the military was fired, the police were fired, the fire departments were fired, and all of the government workers were fired. So after, you know, people would call, they had no idea. And by the way, ISIS was formed. That's where ISIS came from, all of the fired people. We don't believe in that. So we'll see what happens, but first we have to finish off the military.
What do you think about Crown Prince Reza Pahlavi? Is he an option at all in your mind?
I guess he is. Some people like him, and we haven't been thinking about too much about that. It would seem to me that somebody from within maybe would be more appropriate. I've said that. He looks like a very nice person, but it would seem to me that somebody that's there, that's currently popular, if there's such a person. But we have people like that. We have people that were more moderate. You know, these were radical lunatics, and you know what they get? They get nothing. All they do is kill people.
Mr. President, what exactly was the imminent?
You've asked, not your turn. Not your turn, please.
Mr. President, you've been to take the heat off the Europeans to pretend to be helping Mark Rutte called on the allies to also help you.
What does that mean?
Well, you have to ask Mark Rutte if he said not as part of NATO, but to be helpful to you in this.
Well, some of the European nations have been helpful and some haven't. And I'm, you know, very surprised. Germany's been great. He's been terrific. Others have been very good, terrific. I think that the head of NATO, Mark is fantastic, okay? Mark Rutte. I think he's fantastic. But some of the European, like Spain, has been terrible. In fact, I told Scott to cut off all dealings with Spain. Spain, first of all, it started when every European nation, at my request, paid 5%, which they should be doing. And everybody was enthusiastic about it, Germany, everybody. And Spain didn't do it. And now Spain actually said that we can't use their bases, and that's all right. We could use their base if we want. We could just fly in and use it. Nobody's going to tell us not to use it, but we don't have to. But they were unfriendly, and so I told him we don't want to. Spain has absolutely nothing that we need other than great people. They have great people, but they don't have great leadership. And as you know, they were the only country that in NATO would not agree to go up to 5%. I don't think they agreed to go up to anything. They wanted to keep it at 2%, and they don't pay the 2%. So we're going to cut off all trade with Spain. We don't want anything to do with Spain.
What is the expectation towards?
And I'm not, by the way, I'm not happy with the UK either. That island that you read about, the lease, okay, he made it for whatever reason, he made a lease of the island. Somebody came and took it away from him. And it's taken 3-4 days for us to work out where we can land there. It would have been much more convenient landing there as opposed to flying many extra hours. So we are very surprised. This is not Winston Churchill that we're dealing with.
Mr. President, what's your expectation towards Germany? What can Germany do and what should Germany do to help you in this moment?
Well, I think they're doing it. I mean, they're letting us land in certain areas, and we appreciate it. And they're just making it comfortable. We're not asking them to put boots on the ground or anything. I mean, we're just they're a respected country. I have a very good relationship with the country. We have, in particular, now with this leader, with this new leader. I think he's an excellent leader. I had my differences with Angela. I said, "You're hurting your country with immigration, and you're hurting your country with energy." And we have a man sitting on my right that is, I think, pretty much the opposite of her on energy and the opposite on immigration. And I think he's doing very well.
Commercial air travel right now is severely restricted in the Middle East, and thousands of Americans are stranded. Why wasn't there an evacuation plan, and will you send planes to get people out?
Well, because it happened all very quickly. We thought, and I thought maybe more so than most, I could ask Marco, but I thought we were going to have a situation where we were going to be attacked. They were getting ready to attack Israel. They were getting ready to attack others. You're seeing that right now. And a lot of those missiles that are hitting in, those are stationary. Those were aimed there for a long period of time at these other countries. So I think I was right about that. We attacked first. And if we didn't, it could have been, look, we're really decimating them. They're being decimated. And if we didn't, and by the way, we have massive amounts of ammunition. We have the high end. A lot of it was given away stupidly by Biden, very stupidly, for free. And I'm all for Ukraine, but they gave away a lot. As you know, when I give away ammunition, everybody pays for it. The European Union's paying for it. Then they can do what they want with it, but they are giving it, let's say, to Ukraine, and it's okay. But we gave away a lot of high-end, but we have plenty. But we have unlimited middle and upper ammunition, which is really what we're using in this war. And we have really an unlimited supply. We also have a lot of the very high-end stored in different countries throughout the world. We're literally storing it there, which is actually something that I insisted on in my first term. I rebuilt the military in my first term. The military is great. Unbelievable amount of ammunition or munitions, as they say, we've given away to. The Wall Street Journal incorrectly covered the story when they said that it was given away to the Middle East. Not to the Middle East, it was given away to Ukraine. Very little was given to the Middle East. Middle East would buy a lot, and some of the nations, because they're rich, they have a lot, but it was given away to Ukraine. And it just should have been done. Look, it's a war that should have never happened. If I were president, that war would have never happened. but we have a tremendous amount of munitions, ammunition at the upper level, middle and upper level, all of which is really powerful stuff.
Mr. President, a question to both of you. How worried are you that the rising prices for gas and oil are damaging the American economy and also Mr. Chancellor?
Yeah, do you want to go ahead?
Yeah, sure. This is, of course, damaging our economies. This is true for the oil prices, and this is true for the gas prices as well. So that's the reason why we all hope that this war will come to an end as soon as possible. And we are hoping that the Israeli and the American army are doing the right things to bring this to an end and to have really a new government in place who is coming back to peace and freedom.
Yeah. Something had to be done. And it's been 47 years. They've been killing people all over the world for a long time. They were the kings and fathers of the roadside bomb. Soleimani, we killed him last term. If we didn't, I think it might be a different story today. They would have been much stronger and smarter than they are. But they did the roadside bombs. 95% of the people lost their legs, arms, had their face wiped out, just wiped out. I've seen some young people that it's so sad to watch. And that was almost all, 95% comes from Iran and with Soleimani. Soleimani loved it, his favorite weapon. He loved the roadside bomb. And when you see people walking around with no legs and no arms and a face that's been blown to hell, these people, what they have to go and the way they have to live, this is Iran. When you look at the barracks, the famous barracks, when you look at the hostages, when you look at a lot of hostages, when you look at all of the problems, they were really a purveyor of terror all over the world for many, many years. And it's something that had to be done, something. And I believe that if we didn't, because I see where Congress, you know, if I didn't do this, guys like Schumer, who are losers, the Democrats, they're losers. That's why they're not here. Guys like Schumer would say, well, you should have done this. In other words, if I did it, it's no good. If I didn't do it, they would have said the opposite, that you should have done this. But most people feel, I'll tell you what, I have never had more compliments on something I did. People felt it's something that had to be done. So if we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than even before. Go ahead, please.
Mr. President.
Yes.
How do you want to solve the conflict on tariffs between the EU and the US?
Between who?
The conflict on tariffs between the EU and the US. How do you want to solve it?
And U.S. and who?
EU.
European Union. Well, we won on tariffs, actually. Somebody said you actually won the case. We won on tariffs. We had a decision that was wrong. It was a very bad decision from certain standpoints. From other standpoints, a very powerful decision because it reaffirmed all the fact that we have all these various forms of tariffs that we felt right, but it totally reaffirmed it. It said you can use all of these tariffs. So we have all these vast menus of tariffs. And tariffs have made our country very rich. We have to charge tariffs to nations who play with their money. You know, they move their money up and down like a yo-yo. We have to take care of nations that have been good to us and fair to us, and we're going to take care of them. Other nations, they haven't, and we haven't let them take advantage of us. But the whole thing with tariffs is we had a decision that, like, as an example, we have a license situation, and the license is something that allows us to immediately stop all business with, nobody even knew we had this power, but we do now because of the decision. We have the right to stop all business having to do with a certain country. If a certain country is not treating us well, the president, without going to Congress, has the right to stop. Sort of interesting. I have the right to stop, but under that one law, I didn't have the right to charge them. So I have the right to license them, but I don't have the right to charge, which is frankly ridiculous. But the right was given to us by the Supreme Court. And we have the right, as an example, we talked about Spain. I could tomorrow stop, or today, even better, stop everything having to do with Spain. All business having to do with Spain. I have the right to stop it. Embargoes, do anything I want with it. And we may do that with Spain. What do you think?
Well, sir, I think we're going to talk about it with you. I know that you have strong power. The Supreme Court clarified. We know you can use it, and if you need to use it to assure national and economic security, we'll do it.
Scott, do you have an opinion?
Sir, I agree. The Supreme Court reaffirmed your ability to implement an embargo, and as we've talked, from your first term, the Section 301s and the 232s have withheld more than 4,000 lawsuits, and USTR and Commerce are going to begin investigations, and we'll move forward with those.
And we've instituted a 15% tariff on everybody, as you know, and just used. I'll tell you, we had a couple of paragraphs written in that opinion that were really incredible. Justice Kavanaugh wrote a fantastic dissent, but in his dissent, he said what we should do, and we knew that too. We just wanted to simplify it, and for some reason, I think, very, very foolishly, the courts decided no, but they said you can do it many other ways, and that's what we're doing. And what we've done is we've gone to a very simple, straight 15% tariff. We've taken in hundreds of billions of dollars in our country because of tariffs. So we've taken in all of this money, hundreds of billions of dollars, and honestly, it's made us very rich as a country. Right? So it's been doing good. When will you have the full plan implemented? We have a 5-month period, up to 5 months, where we can go at 15%. And while we're doing that, as you know, we're doing the various studies and things, and we'll be coming out with different tariffs on different countries. Do you want to talk about that first?
Yes, sir. By the time the 5-month period has elapsed, we'll have completed investigations under Section 301, which Secretary Bessent talked about. We know there are countries out there with deals who are very interested in keeping the deals. We need to go through and investigate all these unfair trading practices, the kinds of things you talked about, and make sure that we're protecting U.S. economic security. We know there are countries.
How are we going to treat Germany?
Well,
I think you should hit them very, very hard.
You knew he was right there when he said that, Mr. President. They have expressed an interest. Germany's been quite constructive in wanting to move forward and be helpful. The rest of the EU will talk to them as well. But obviously
I will say every single country wants to make the deal they already have. In other words, a deal that we have using the other authority, they want to make the same deal. And we'd like to see, actually, we're going to adjust it somewhat upward, actually, but they all want to stay in the deal, and so we'll probably be able to do that pretty easily.
Mr. President, for Ukraine, after all, Iran won't be able to deliver drones to Russia anymore. So what does it more mean to Ukraine? And having Chancellor Merkel sitting next to you, who would you call if you want to talk to Europe? And Chancellor Merkel, you've just been in China. The president.
Who are you? What country are you from?
I'm from Germany.
Okay, I thought so. I could see.
So, Mr. Chancellor, you have been in China, and the president.
She likes you.
In China soon.
I don't know.
Will you be talking about China as well?
We'll be talking about China, yeah. Sure.
And what about you?
I'll be going to China in a little while. Every time you meet, you talk about China. We respect China. I do. We both do, I think. But it's always a topic of conversation. We've had a very good relationship with China. We used to lose a tremendous amount of money with China, and that's no longer the case. We have a very, very good relationship with China, and we have a very good relationship with Germany. All right.
Mr. President, we've seen countries around the world, many of whom don't usually work together, working with the United States on Iran, whether it's Saudi Arabia working with the United States, Israel, Qatari shooting down Iranian aircraft, and we've also seen European countries step up. Why are we seeing such unity around the world against Iran?
That's a great point. Look, they're just evil. They're it's not the politics; it's their whole philosophy. It's their whole where they come from. It's terrible. Where they killed 35,000, I thought it was 32. Now it turns out it's much more than 35,000 people, and in some cases using machine guns with people that have no that have no weapon. They have no weapon, and they're being machine gunned. They're being sniped from buildings. They're hitting the people with snipers right through the eyes. It's just a very evil ideology, and nobody's really seen anything like it. As I said, even the fact that they've attacked all of their neighbors, and the neighbors weren't attacking. They thought they'd maybe sit it out or what. They've hit Qatar, they've hit UAE, they've hit Saudi Arabia, they've hit Oman. They were helping us negotiate. They got hit. Everybody got hit because they're evil and they're bad. It's a bad seed, and somebody had to do it, and it should have been done sometime during a 47-year period, because so much death has been caused by them, so much unbelievable death. From Germany too. Germany's been hit. Everybody's been hit by them. It's an evil ideology, and I've never been. Look, I've done a lot of good things. So many people are saying thank you, thank you, thank you. You see it in the streets of Los Angeles. They have thousands of people. I saw it the other day. Pictures of Donald Trump, and I'm looking. I'm on the phone, probably talking to you, and I'm looking, and I see my picture. I say, oh no, it's another, protest. I see and then I started saying, boy, they were very friendly people. And then I saw a woman hugging the picture of me. I said, what's going on? And it turned out to be these are Iranian people that live in the United States.
So many.
Thousands and thousands. You saw the rallies. And in New York, too, they had a big rally. My pictures all over the place. The fact is that people are happy what we did. And you could never, and I've always said it, you could never have had true peace in the Middle East if Iran was allowed to go, even beyond the nuclear. If Iran was allowed to have look at all the missiles they built. A lot have been now taken out by us, and a lot have been expended. But they have thousands of missiles in a fairly short period of time. And I'll go two things. The attack that we did, known as Midnight Hammer, had we not done that, Iran would have had a very powerful nuclear weapon within 1 month. We did it. It was great timing, but, and you've been able to see that too. The other thing was Barack Hussein Obama made maybe the worst deal I've ever seen, because he gave all power in the Middle East to Iran. He went the exact opposite way, and I terminated that. If I didn't terminate that deal, they would be sitting with a massive nuclear weapon 3 years ago, which would have been used already on Israel at least, and other countries also. And we wouldn't be talking about it right now. But if I didn't terminate the deal that Obama made, giving them everything, including plane loads of cash. You remember the airplane flew over there? It was a Boeing. Cash. You remember the airplane flew over there? It was a Boeing 757. It was two of them, loaded. They took out all the seats. It was loaded with green cash. So much cash that it was in Virginia, Maryland, and Washington, D.C. They got all the cash from all the banks. They put it, and they flew it to Iran. I never knew a president had that power. I'm going to maybe try it sometime if it's okay. I think I'm going to do it. I'll fly it somewhere. Nobody's ever seen anything like it. 2 planes loaded from floor to ceiling, big planes, Boeing 757s, taken over there and given cash. In addition to that, he was giving them billions of dollars. But worse, he was giving them the right to have the path to a nuclear weapon. And that deal expired. A lot of people said, oh, you terminated. Well, it was going to be terminated anyway because it expired. It gave them the right to have top-of-the-line nuclear weapon. If they had, because they're crazy, just like the people on my right during the State of the Union. I looked at them, I said, you're crazy? These people are crazy. And if they had a nuclear weapon, they would have used it. All right, how about 1 or 2 more?
Mr. President.
Go ahead, please.
Jean-Claude, you just heard that the president is thinking about punishing Spain. What are your thoughts spontaneously on this, and what can you do to
Well, the answer on that is quite simple. We are trying to convince Spain to catch up with the 3% or 3.5%, which we agreed on in NATO. And as the president said, it's correct. Spain is the only one who is not willing to accept that. and we are trying to convince them that this is a part of our common security, that we all have to comply with these numbers, and this is 3.5 for military and another 1.5 for our military infrastructure. So Spain has to comply with that.
Spain has been very, very uncooperative, and so has UK. Now, the second one is shocking, but this is not the age of Churchill. I will say the UK has been very, very uncooperative with that stupid island that they have, that they gave away and took a 100-year lease, having to do with perhaps indigenous people claiming the island that never even saw the island before. What's that all about? And they ruin relationships. It's a shame. It's and that country, UK, and I love that country. I love it. My mother was born there. I love it. My mother was born there. My father was born, right? He knows all about my father. My father was born there. So, you know, very places that you sort of automatically very feel warmly about. But the UK, what they're doing with energy and what they're doing with immigration is horrible. You have the North Sea. Somebody said yesterday, what would you do if you were the UK? Open up the North Sea. They got windmills all over the place that are ruining the country, ruining the landscapes, ruining the beautiful fields. Open up the North Sea. It's one of the greatest. Think of it. They buy their energy from Norway, which gets the energy, the oil, from the North Sea. So Norway drills in the North Sea and sells it to UK. And UK has a better part of the North Sea. Open up that. And number two, illegal immigration. They got to solve that problem. And I must say, that's not only UK, that's other parts of the European Union that have the same problem. Immigration and energy. The energy is through the roof, the highest in the world. And the immigration is, I mean, you know, look, you have places where in the UK, you have a terrible mayor of London, terrible. He's an incompetent guy. But you have Sharia courts. You don't have Sharia courts. You don't want Sharia courts. You have Sharia courts adjudicating law. So it's very simple. Immigration, very importantly, immigration and energy. And you bring it back. Otherwise, you're not going to bring it back. Okay. One more. Go ahead.
I have a question for the Chancellor.
Yes, please.
To the Chancellor, Chancellor Merz.
Yeah.
You've called for unity and joint force in this moment against Iran. What does that look like to you? And then, Mr. President, where is getting a deal with Russia and Ukraine on your priority list right now?
Okay, where you go.
So we, as I said, in Germany the last 2 days, we are supporting the United States and Israel to get rid of this terrible terrorist regime. And we are looking forward to a day after, and we have to talk about the strategy. What is following after this regime is away, and we have to strategize on this entire region. And we are having a high interest in common approach and common work and what we can do. And this is important not just for the Americans. This is extremely important for Europe and extremely important for Israel and their security. So we are really looking forward to find ways how to deal about the day after.
And as far as Russia, Ukraine, where is it on my priority list? Very high. We thought that, I thought it was going to be one of the easier ones. I've settled 8 wars, and actually maybe one more than that. But minimum 8 wars, big ones, potential India, Pakistan, big wars, very important, big ones. I thought this was going to be much easier than it is. There's tremendous hatred between President Putin and President Zelensky, tremendous hatred. I've seen a lot of hatred in my life, but I think this is about top scale. I believe it's going to happen. Sometimes I blame one, sometimes I blame the other. I think it's going to happen, but it's high on my list. Not in that it affects the United States so much, because it's very far away, but last week and for the last 4 weeks actually, 32,000 soldiers died. 32,000. And it's been averaging 25 to 30,000 soldiers a month have been dying in that stupid war. And I'd love to see it ended. It's the worst that there has been since World War II.
If you can't get a deal, what will that mean for you?
All you can do is do your best, you know. It takes two to tango, and they have to get along. They have to be able to talk to each other. They hate each other a lot. That has an impact, you know. It really has an impact. It's bad for both. The saddest is that if the election weren't rigged, my election, that war would have never taken place. And you know what else wouldn't have taken place? Allowing 25 million people to pour through an open border, that wouldn't have taken place. A lot of things would have been different. But we're doing very well, and I think a big factor in this world and future factor is what we're doing right now with Iran. If we don't stop them, or if we didn't stop them, or if we didn't start, they've been decimated. But if we didn't do what we're doing right now, you would have had a nuclear war, and they would have taken out many countries, because you know what? They're sick people. They're mentally ill, sick people. They're angry. They're crazy. They're sick. Thank you very much. Thank you very much, everyone.
All right, President Trump, as the media is shown out of the Oval Office live on Bloomberg Radio and streaming live on YouTube. Thanks for joining us here on what is the Tuesday edition of Balance of Power. We got a good half hour, a little bit more than that, out of the boss, with a lot of questions about, of course, the situation in Iran, the next moves, and the justification for this war to begin with. The president taking a range of questions from not only American but German reporters who are here, of course, with the Chancellor of Germany. And the president making some news. He was asked right off the bat if Israel forced the hand of the U.S. in this case, as both Marco Rubio and the Speaker of the House suggested yesterday. The U.S. felt it had no option but to act as Israel was preparing to strike Iran, and they knew that, according to the Secretary, retribution would be aimed at the U.S. He said, based on the way the negotiation was going, a direct quote, "I think they were going to attack first, and I didn't want that to happen. So if anything, I might have forced Israel's hand," unquote. Asked what his worst case scenario would be, the president said he guessed it would be somebody takes over who's as bad as the previous person. He said that could happen, direct quote. And asked about oil prices, with crude oil futures reaching higher today in both contracts. Right now, West Texas Intermediate is up about 6% to trade above $75 a barrel. He said, if we have a little high oil prices for a little while, but as soon as this ends, those prices are going to drop, I believe, lower than ever before. The president has also cut off, apparently, all trade with Spain. He said he directed the Treasury Secretary to do so after the country denied access to its military bases for the bombing campaign against Iran. Quote, "I told Scott to cut off all dealings with Spain," unquote. We're going to talk to Jamie Tarabay here in our Washington bureau about what the president is facing in Iran coming up. We do want to check what's happening in the markets, though, because this has been a rough ride today. We are well off our lows. We saw a Dow Industrial Average down over 1,000 points this morning. It's down about 600 and change. Charlie Pellet has that for us covered, live from World Headquarters in New York. Charlie, take it from there.
Thank you very much, Joe Matthew. And indeed, let me put that rebound in context. At the worst level of the day, we had the Dow down 1,277 points. That was a drop of 2.6%. Right now, the Dow is down 611 points on the Dow, a drop now of 1.2%. The S&P 500 index, keeping it all in context, have been down 171 points. Right now, we've got the S&P down 85. That is a drop of 1.2%. And while NASDAQ, the composite index, down 301, down 1.3%. The NASDAQ 100 index also down 1.3%. And the Russell 2000 index of small cap shares, hard hit today, right now down by 2%. The VIX just above 24 with a 10-year, 4.06%, the 2-year, 3.50%. Spot gold trading lower by 4.4%, $5,086 the ounce on gold. West Texas Intermediate crude, as you mentioned, Joe, up 6.5%, $75.84 a barrel. Brent up 6.5%. Brent, of course, the global benchmark at $82.77 the barrel on Brent crude. Meanwhile, diesel prices around the globe have surged to multi-year highs as the war on Iran expands across the Mideast, pressuring markets already already grappling with low supplies. Briefly, earnings news. On a down day for much of the market, we are seeing Target shares gain. Target up now by 5.7%. And Apple has updated its two main laptop computer lines, adding faster processors to the MacBook Air and MacBook Pro. It's also raising prices amid an industry-wide memory crunch. Apple shares today, right now we got Apple down by 1.1%. So again, recapping here, S&P 500 index down 1.2%. West Texas Intermediate crude here in the U.S. up 6.4%. Lots going on. He's got it covered. Back to go to Washington. Balance of Power continues. Once again, your host, Joe Matthew.
All right, Charlie, fascinating, decidedly negative, but what a change in sentiment there while the president was talking. Did he just help the markets? Sometimes it does help just to be present, even if you're saying things that the market doesn't want to hear, and it had been a couple of days, right? Everybody wanted to hear the president answer questions, which is why we brought you into the Oval Office for that important moment. The Chancellor of Germany barely got a word in. I'm not sure that this visit has played terribly well for him, but the president certainly made his point here. Asked again if Israel forced the hand of the United States on this, knowing that the Secretary of State suggested yesterday that the U.S. found it had no choice but to act in advance of what it saw as an inevitable Israeli strike on Iran that would prompt retribution against U.S. assets. Here's the president just a few moments ago.
We were having negotiations with these lunatics, and it was my opinion that they were going to attack first. They were going to attack. If we didn't do it, they were going to attack first. I felt strongly about that. And we have great negotiators, great people, people that do this very successfully and have done it all their lives very successful. And based on the way the negotiation was going, I think they were going to attack first. And I didn't want that to happen. So if anything, I might have forced Israel's hand.
And what is interesting, of course, is hearing from the likes of Senator Tim Kaine and others who say, well, there's no evidence to that extent. In fact, Senator Kaine had an op-ed in the Wall Street Journal 2 days ago saying as much, based on all the classified information that he sees. There was no evidence of an imminent threat. It's where we start our conversation with Jamie Tarabay. I'm really glad that we can do this right now. Bloomberg Capital Influence national security reporter with us live in our Washington bureau. Jamie, it's great to see you. Before we get into some of your reporting on what the president is facing here in terms of potential regime change or not, what do you make of the framing of this essentially new justification? This is really just in the last 24 hours we've heard this.
The two words that just jumped out at me during this this press availability was that they were going to attack first.
Yes.
And I don't even know what that means.
How about that?
And was it launching some kind of attack on Israel?
Mm-hmm.
Like what, just the sort of the lack of specificity that we're getting. And like you said, the sort of the chopping and changing of the mission, the sort of the scope. Mm-hmm. We're hearing all kinds of different things. We're hearing this, this is not going to be like Iraq. We heard the president call when he announced the attacks were happening on very early Saturday morning, that he called on the Iranian people to overthrow their government, saying this was a once-in-a-generation opportunity. Now we have Secretary of State Marco Rubio on the Hill saying the mission is to destroy their ballistic and nuclear capabilities. So this is obviously a very fluid, very quickly developing situation, yes. and like the goals keep changing as well.
Well, which is an issue, and you're in the throes of this initial attack here. Indeed, we heard from Marco Rubio, the Speaker of the House, suggested this as well, and other Republicans have been using this line. Did talking points go out on Sunday night? How is everyone on the same page with that yesterday?
It's interesting that they are kind of starting to say a lot of the same things, and this isn't the first time. We've watched repeatedly whenever there've been briefings that are classified or closed door, that they are all in lockstep. They're all getting the same talking points and the same playbook, and there are Republicans who are resolutely behind the president, regardless of what they hear in a lot of these briefings as well. That we really need to kind of note that as well.
Let's go back to that moment that stopped us in our tracks yesterday when we heard from the Secretary of State on Capitol Hill. He, of course, had been up there briefing lawmakers. He was greeted by reporters in the hallway. Listen to what he said.
There absolutely was an imminent threat, and the imminent threat was that we knew that if Iran was attacked, and we believed they would be attacked, that they would immediately come after us. And we were not going to sit there and absorb a blow before we responded. We went proactively in a defensive way to prevent them from inflicting higher damage. Had we not done so, There would have been hearings on Capitol Hill about how we knew that this was going to happen and we didn't act preemptively to prevent more casualties and more loss of life.
He went back to that line a couple of times that, you know what, and then I'll be up here in hearings on Capitol Hill. Let's get back to Tim Kaine's op-ed. Quote, as a member of the Senate Armed Services Committee, Foreign Relations Committees, this is where the hearings would take place, with access to ample classified information about threats from Iran and others, I can state plainly there was no imminent threat from Iran to America sufficient to warrant committing our sons and daughters to another war in the Middle East. There you see it on your screen if you're with us on YouTube. Will the administration be compelled to provide that evidence?
There are more classified briefings happening today on the Hill.
Yep.
It really, really depends on the level of intelligence that gets shared by the administration with lawmakers. What really struck me about what Marco Rubio said, he said something about if Iran was going to be attacked, then we would be attacked.
Right.
So who would be attacking Iran?
That's Israel, right?
Right.
Okay.
So would Israel be doing something like not in lockstep with the U.S.? Would Israel be doing this against American wishes? And I think that really speaks to the sort of the coordination and the timeline of how these decisions were made. Like the idea that there was an imminent threat, which, by the way, Senator Mark Warner, who is a senior member of the Intelligence Committee, said that he has seen nothing in all of his classified briefings that has told him that there was an imminent threat. What was the imminent threat? Was it Israel attacking Iran and then Iran responding by attacking the U.S.? I mean, so if that's the case, why, then that we need to think about, the sort of the ability for Israel to do that unilaterally and what that relationship and the alliance with the U.S. really means.
Really something, considering that we're working together on this. Jamie, your reporting has called into question the idea, and by the way, the president acknowledged this in one of the questions he was just asked about his worst case scenario. He said, look, if somebody takes over who's as bad as the previous person, right, that could happen. I guess the worst case scenario would be we do this and somebody takes over who's as bad as the previous person. You're reporting and what you've been bringing to the conversation is that this is different. This isn't Gaddafi. This isn't Saddam. That this isn't about a figurehead, that there is a much larger apparatus here, which is why we're still seeing drones flying today, right?
I mean, I think that it has been extraordinary to see that military retaliation, the scope and the scale of the drones and the missiles, the short, medium, and long range that we have these amazing experts at Bloomberg who have been sort of laying this all out for everyone over the last couple of days. But it really tells you that, this is not one person. This is an institution, and there is a chain of command. And if the first 1, 2, 3, 4 layers are eradicated, there is still more to come. And this, I spent a lot of the time on the weekend speaking to so many intelligence people who have been watching and studying Iran for 4 decades, 40 years. Yes. And they say that this system is deeply, deeply, deeply entrenched on every level. The security services, the surveillance state, the grip that the Shiite, sort of the religious council has on the country. This isn't something that is going to be easily wrested from power in the way that people are hoping it will be. I mean, one of the biggest differences between what happened in Syria or in Libya or in Iraq is, number one, in Iraq, U.S. ground forces launched an invasion. Led, with their international allies. And what happened after that was you saw an abandonment by the Iraqi army of their duties, right? So that's number one. That is really unlikely to happen in Iran if there aren't ground troops. And we're already seeing casualties on the U.S. military side. I don't know how long that is going to be sustainable and maintain political will for that to continue. And even with the idea that ground troops is not going to be sort of ruled out, there's still so much political cost that comes with that. Syria was a decade in the making. And again, armed forces ousted this regime. Yeah. So, the protesters in Iran, as we saw in January when these protests were like brutally suppressed, they don't have weapons. They're not armed. So for them to come at this this heaving force. I was speaking to an Israeli general yesterday who ranks the numbers in at least 1 million, security forces, revolutionary paramilitary. Wow. It's a lot for these people to come up against. Yeah. If one of those forces choose to switch sides, there may be a chance, but outside of that, this is a really remote possibility, especially in the short term.
Well, as someone who's done extensive reporting from war zones, Jamie, is there any way to get to these hundreds of thousands of drones, to discover them, to secure them, or to find the highly enriched uranium without having actual human beings on the ground?
I'm based off everything that we saw with Iraq and the search for weapons of mass destruction, I would say no. The drones are definitely a new calculus. We're seeing they fly low, they fly fast, they're impossible to get all of them. At some point, I think people are expecting the Iranians to run out, but the damage that they will inflict before then is something that I think we will all be watching for a while, and it's obviously providing a lot of uncertainty and instability to all of the allies in the Gulf as well. I mean, we've seen the disruptions.
Drones. Yeah. I mean, if we're going to shoot $1 million missile at each of these things, we got a lot of money to spend and a lot of missiles to buy. Just lastly, before you go, to that end, what did you make of the president's post this morning, the forever post? He used the word forever. The United States munitions stockpiles have, at the medium and upper medium grade, never been higher or better. As was stated to me today, we have virtually unlimited supply of these weapons, he writes. Wars can be fought forever and very successfully using just these supplies. When does this logic run into some headwinds?
One of the things that I think is really important in moments like this is opportunity cost. Yeah. And we spent a lot of time in Iraq and Afghanistan at the cost of developing weaponry or saving our resources, saving our blood, saving our treasure, while China, for example, was developing and enriching and militarizing. So if the dedication of these resources here for something that doesn't seem particularly threatening versus what people have described as an imminent threat in the Pacific, for example, especially regarding Taiwan, and especially with the support of Ukraine, I question that. I also question the sort of the determination to maintain so many different fronts and so many conflicts, and the drain that we'll have on our resources. The buildup in the Mediterranean and in the Gulf is as big. Don't forget, we also had the same situation in the Caribbean. So that's a lot of strain on the military, and there's families, there's veterans, there's injuries and wounded, and just the sort of the ripple effect that I witnessed coming out of Iraq. We are still feeling the effects of that today. The Iraq and Afghan veterans are still dealing with these things, and they have become, these forever wars have now been forgotten wars. So I really think that we need to remember, because we can only learn from history.
I'm so happy that you could spend some time with us today, and keep your eyes on the terminal and the website for Jamie's great reporting. Jamie Terabay, Capital Influence, National Security, and find more from her at Bloomberg.com. We want to take a look at the markets here. We're going to assemble our panel next, but we've got a market day here, and it's actually been improving with time. Remember, the Dow is down well over 1,000 points a couple of hours ago. Charlie Pellet is back with us from World Headquarters in New York to update things. Charlie, what are you looking at?
Right now, looking at a Dow that is down 630. Joe Matthew, down 1.3%. At the worst level of the session, it was down 1,277. A drop on the Dow of 2.6%, but as you correctly point out, we are recovering, with the Dow now down by 1.3%. S&P, putting it all in context, down 1.3% right now, lower by 90. NASDAQ, the composite index, down 1.5%, with a VIX just above 24. 10-year yield, 4.06%. Spot gold down 4.5% at 5,080. Focus very much on crude oil. West Texas Intermediate crude here in the U.S. up 6.4%. Brent, the global benchmark, up 6.2%. And Bitcoin now down 1.9%. That is now trading at 68,092 on Bitcoin. So again, recapping here, we are seeing a recovery for the U.S. stock market, but still a drop of 1% or more for the S&P, the Dow, and NASDAQ. Balance of power continues right now. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. We'll have more from Charlie Pellet. Watching Wall Street coming up at the top of the hour, 1 p.m. Eastern time. But we want to dig a little bit deeper under the hood right now because this has been a doozy of a session. As Charlie was just illustrating, to think that the Dow is down over 1,200 points. The president just spoke for over a half hour. I don't know if that was the salve that gave us some improvement, or if we hit some sort of technical level, but we saw quite a bit of a bounce. And Christina Aquino is with us now, managing editor for Bloomberg Markets Live Blogs. Probably been pulling her hair out since this all started on Saturday morning. Christina, it's great to see you. Thanks for taking some time for us here on Balance of Power. What are you chalking up this bounce to, or am I reading too far into this?
I mean, very interesting, Joe, that you're highlighting. That is indeed what we're seeing, a bounce. And it's specifically against this level of 6,800, at least for the S&P 500. And it's a little bit of a technical thing where we have seen that level really serve as a bit of a floor for the index over the last couple of months. And so the activity that we're seeing today very much following the pattern of an initial decline in the S&P 500 to begin the week, only for that to turn around the following day and bounce against that specific level. And so it really formed a formidable base. Now, zooming out to what's kind of happening more fundamentally here, I think, investors are very quickly focusing now on the length and duration of this conflict. Already we're seeing betting markets putting the highest odds of a conflict that lasts well into April of this year. And so now perhaps you could see investors kind of weighing their options as far as pricing war or conflict that lasts at least a couple of months from now.
Yeah, we see really interesting though to see stocks tumbling here, and a lot of the havens are lower as well. You find gold down 4%. How do we rationalize all of this, or does it get to be a sell everything mode when the headlines get too scary?
Yeah, I mean, it's very interesting what we're seeing in gold and havens in general, as you say, Joe, because, yeah, it really seems like the argument for investors at the moment is very much focused on the immediate inflation risk that we're seeing primarily because of higher oil prices, and that has been very much the focus, versus kind of the longer-term impact of higher energy prices on things like consumption and people's ability to buy food, that does require energy to produce. And so at the moment, inflation risks are winning. And gold specifically, of course, has been the beneficiary of a massive, massive speculative move. And I think what we're seeing at the moment is not so much a degradation of its haven status. It's more some of that speculative froth still coming off in the market.
This is what I thought Bitcoin was built for, too. And it's also lower, down 2%. What's up? Oil, crude oil, and the VIX, now at 24. Christine, let's stay close today. We'd love to hear more as we make our way through the session. And thank you so much for stopping by. Christina Aquino runs a very important team here on our Markets Live blog, and it's always special to get a couple of moments with her. As we assemble our political panel, what Rick and Jeannie must be thinking coming off this weekend. And I'll point to something that nobody's mentioned yet this hour. Obviously, we started the program in the throes of a conversation in the Oval Office with the president, but another conversation on the other end of Pennsylvania Avenue is one that we're watching very closely. With the first testimony today from the head of the closed Department of Homeland Security. Yeah, how many days are we into this shutdown? No one's even keeping count anymore, the partial shutdown, to be clear. This is the first time that Kristi Noem has been before lawmakers since the two deadly shootings in Minneapolis. And I'll remind everybody that there are big questions right now about the potential for terror and securing our homeland as we prosecute this war against Iran. Here's a taste of the back and forth with Senator Dick Durbin from a short time ago. Listen.
Many times, our agents have been faced with violent
the victims of that violence domestic terrorists as a way to calm the scene?
These violent terrorists have put them in a situation where it's unprecedented what these agents have faced. So that situation on the ground that day was chaotic. And it was something that they were transpiring and sharing information with us. Senator, we are working in those situations where there's a tragic loss of life and that there is something that our agents are involved in, that we continue to deliver information.
Well, that's how that went. Senate Judiciary Committee oversight hearing this morning, and she'll be in front of the House Judiciary tomorrow. Let's assemble our political panel. As I mentioned, Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. She is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick, our Republican strategist and partner at Stone Court Capital. Jeannie, I suspect before the strikes against Iran began, this hearing would have had much more attention paid to it. But there's so much happening right now in Washington that we wanted to stop down and just get to some of what we heard today. Kristi Noem says there are no plans to deploy ICE at polling places. She said she did not halt the probe into the Minnesota shootings. This is a department, though, that is still closed, Jeannie, and I'm wondering how concerned you are about this timing here with DHS closed and a new war underway against Iran overseas.
Yeah, and Joe, you just reminded me, where are the countdown clocks, the shutdown clocks? We don't get those, I guess, in a partial shutdown, so they're gone. Too much news going on. This has been, and I've been following it all morning, this has been quite a hearing. And you played a bit from the Democratic side of the aisle, also from Republicans. Now, granted, Tom Tillis is retiring, but he hit Noem pretty hard, even mentioning her killing of her dog. I mean, that's how personal this got. And of course, also John Kennedy, he was very tough on Kristi Noem. He got into this issue of her spending $200 million in taxpayer money on ads. He said he was skeptical that the Trump administration had approved that spending. He also talked about the issue of what she said about Alex Preddy and Renee Good, saying that she tried to falsely blame Stephen Miller for some of that, calling them domestic terrorists. So it was tough on both sides of the aisle. And I think it's just indicative of what you heard from that clip you played, that she is unwilling, and we heard this from Pam Bondi, to say she is sorry for what she said, particularly about these two Minnesotans killed on the road, when she called them domestic terrorists and inflamed this entire situation. So a really ugly day on the Hill for the Secretary of Homeland Security as she sits in a shutdown.
Rick Davis, was the debate over DHS funding helped today? I remember there was a time when we were talking about this leading up to the partial shutdown where you suggested, hey, maybe this thing stays closed all year. ICE has funding for the next 4 years. Maybe they'll figure out a way to move money to FEMA, to the TSA, to the Coast Guard. Where's your head on this now that we're underway with Iran?
Yeah, I don't think Iran has impacted it directly, but for instance, today's hearing showed no progress whatsoever in solving some of the issues that Democrats wanted to have some attention on. I mean, the administration basically said, hey, we sent Homan to Minneapolis to fix the problem. You know, a lot of your concerns are being addressed by him. But like Minnesota Senator Amy Klobuchar asked the secretary specifically, you've got 350 or more ICE agents still in my state. When are you going to draw them down to the agreed upon? We cut a deal, and that was supposed to come down to less than 150. When is that going to happen? So you see the same negotiations taking place, maybe partial movement in the right direction, but only partial. I mean, there's no real progress after, yes, Joe, 16 days and this government.
There you go.
And, but I'm not counting.
You can always count on Rick Davis to bring us back home. Jeannie, are we less safe with DHS closed?
It's hard to know. I mean, you know, a lot of people talking about that shooting, that mass shooting in Austin over the weekend. There may be some connections. Certainly, we can't be any safer with DHS closed. But of course, you know, we don't get good information on that publicly. And so I think it's an unknown. And I would say one of the highlights of this hearing was Chris Coons pinning her down on an issue that should concern everybody as voting begins in the primaries in Texas and North Carolina today. And that is this suggestion that's been going around sort of in the right-wing blogosphere, which is that ICE agents could be sent and deployed to polling places. She said that she wouldn't do that, that's not going to happen. But that remains an enormous concern of many people. And it's Steve Bannon and others who have been pushing for this. And I'm not sure that we have a clear sign yet that that is off the table.
House rules teeing up a funding bill vote this afternoon. They're going to be back in the hearing room at 4 o'clock this afternoon. Do any votes change here, Rick, or we just keep doing this for our health?
I think right now, because there's not a significant pressure point on the funding, you're going to just see Groundhog Day in the House of Representatives, right? It just keeps going on and on and on. But something's going to break, right? As you pointed out, there could be an event, an attack that happens. And it doesn't have to be directly related to Iran, but obviously if it is, it heightens the potential to make the argument that we need to have this agency fully operational. I mean, there are groups like Cybercom who are on the front line of our defense, and Iran is one of the most pernicious hackers in the world, and we've had infrastructure really affected in our country by Iranian hackers. So, absolutely we need to get this agency back open and defending our homeland.
Yeah. Rick Davis and Jeannie Shanzano, thank you. They'll be back again in our second hour as we drill down more on the update we got from the president today in the Oval Office on the current attacks against Iran and what brought us to this point. It's all ahead on the Tuesday edition of Balance of Power, only on Bloomberg Radio.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
It's D+3. Welcome to the Tuesday edition. As the White House warns, the war with Iran could last much longer than many first thought, with the president saying we have the munitions to fight forever. I'm Joe Matthew alongside Kaylee Lines in Washington on this day 4 of the war. Kaylee, the markets woke up very worried about all of this, but we've actually seen some real improvement in the midday trade.
Well, at least when it comes to equities, you are still seeing a massive amount of upward pressure on commodities prices, oil, natural gas, especially in Europe, surging today as we contend with the notion that there could be something of an energy supply shock if we continue to see the Strait of Hormuz effectively closed and more damage to energy infrastructure in the Middle East. President Trump, though, when pressed on that in the Oval Office, where he actually took questions from the press as he met with the German Chancellor Friedrich Merz, said, yes, prices may be higher for a while, but he thinks when this is all over, they will go back down to lower than before. The question we all have is, when will this all be over?
Well, that's true. And he used the word forever in that Truth Social post, which really spooked the markets earlier. And you're right, oil prices have been stubbornly higher. We saw big increases as well in a lot of energy stocks. Those have all faded away ever since then. The one thing that's up right now is the VIX, Kaylee, at 24. But to have seen the Dow Industrial Average down over 1,200 points, it is at least somewhat reassuring to see that loss cut in half. That all seemed to coincide with the president's remarks in the Oval Office. We carried him live here on Bloomberg TV and radio. He didn't answer a lot of questions specifically, but I feel like his confidence, his optimism may have rubbed off on the markets in a good way. We'll have to see where we end the session.
Yeah, his suggestion that Iran's naval capability, its missile capabilities, its radar capabilities, he says, in his words, everything basically has been wiped out.
That's right.
Though he did note that there is a worst case scenario here in which someone else comes into the leadership vacuum that is even worse or as bad as the previous supreme leader.
Pretty candid remarks there. He took a lot of questions, and we'll walk everyone through it over the course of this hour. We're going to check with Alexandra Semenova on the markets. Tyler Kendall will join us from the White House, and Kelly Grieco, who's an expert in asymmetric warfare, is going to be with us a little bit later on this hour. I'll be very curious to hear what she says about this idea of hundreds of thousands of drones facing off with our $1 million missiles.
Yep, we have a lot to get to this hour, but let's begin with the market action. We'll check in with Charlie Pellet before we get to Alex in New York. Hey, Charlie.
All right, thank you very much. And here's what's going on. We got the VIX just below 24 right now. The Dow, the S&P, NASDAQ, all declining, down 1% or more. Right to the numbers with the S&P right now down 82 points, drop there of 1.2%. As Joe mentioned, you got to keep that drop in perspective because at the worst level of the day, we did see the S&P down 2.5%, down 171. Right now, just about half of that, 81 points lower, down 1.2%. The Dow had been down 1,277 points. It is now lower by 513. The Dow down by 1%. NASDAQ down 1.3%. The VIX bears repeating right now with a 23 handle. The 10-year, 4.06%. The 2-year, 3.50%. Spot gold down 4.3%, 5,093 the ounce. Crude, major story today. West Texas Intermediate crude had been up 8%, right now up 5.5%. WTI at 75.19 a barrel. Brent, the global benchmark, up 5.6%, 82.12 now on Brent. Bitcoin down 1.5%. 68,381. Among oil majors today, ExxonMobil lower, down 1.3%. Chevron up 0.1%. ConocoPhillips up by about 0.8%. We got you covered here on markets. The Dow, the S&P, NASDAQ all lower again. The VIX with a 23 handle, 10-year 4.06%. Cannot ignore crude one more time. West Texas Intermediate up 5.8%. Kaylee and Joe, I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much, sir. We'll be back with Charlie in about 20 minutes' time to keep tabs on these markets. Indeed, a barrel of crude selling for $75, a little over, up $4, up a little more than 5%. West Texas Intermediate with great concerns about what type of supply interruption we could be talking about in the days ahead. If that happens, it's obviously a great moment of uncertainty, but the S&P 500 has been clinging to that 6,800 level pretty stubbornly, and we explore this all a bit more with Alexandra Semenova, Bloomberg News equities reporter, with us also live from World Headquarters in New York. Alexandra, what has your attention here in a day that has seen stocks recover somewhat, but still huge concerns about what's happening in the energy space?
Hey, Joe. Well, it is a firmly risk-off day today with stocks and bonds deepening their losses since attacks began on Iran over the weekend. Definitely a stronger reaction today than we saw yesterday. About 450 shares shares in the S&P 500 were lower. And of course, the Dow dropped as much as 1,200 points at some point in the trading day today. It is worth it pointing out that the S&P did pair a significantly deeper decline at some point, falling as much as 2.5% to an October low. Much has to do with soaring energy prices, casting a doubt on the ability of the Fed to cut interest rates given the risk it poses to inflation. We had Fed President Neil Kashkari today at Bloomberg Invest saying that the attacks on Iran put into doubt his call for an interest rate reduction later this year. Now, investors are contending with some cross currents here. On one hand, if you look at past geopolitical volatility, it's typically proven to be a good buying opportunity for stocks given as long as oil prices have been contained. Now, in the aftermath of past escalations in the Middle East, the S&P 500 was higher by 2%, 6%, and 8% on average in the 1, 6, and 12-month periods that followed. This is according to data from Morgan Stanley. But the big caveat is when energy costs substantially surge, the level that crude oil prices would have to reach for it to become a pain point for equities is $100 per barrel. That is the threshold that typically becomes associated with negative equity returns, given it starts to weigh on consumer sentiment, on corporate earnings. We're not there yet, but investors today are signaling that they are worried that this could be more prolonged than expected yesterday.
Well, and what should we make, Alex, of the idea that we're not seeing a traditional flight to the havens that you would at least expect? Where can safety be sought right now?
That's the big question, Kaylee, and I've been asking traders that all day long, and I really haven't gotten a solid answer from them because it seems to be a lot of folks trying to figure that out. Now, typically, tech used to be the safe haven trade given its strong balance sheets, but now we have all these concerns around artificial intelligence and CapEx spending, so that's not the traditional defensive play anymore. The common denominator that I've gotten from conversations I've had is people are looking at companies with strong balance sheets. There's been this flight to the halo trade, so looking at tangible assets, metals, kind of the companies that are building out AI technology versus the coders, and then also looking for companies that aren't necessarily tied to economic growth, given the risk that we could get a spike in inflation if this conflict persists.
All right, Bloomberg's Alexandra Semenova, thank you so much for joining us from New York. And we want to go to the White House next, where, again, as we mentioned just a moment ago, earlier this afternoon, President Trump was joined in the Oval Office by the German Chancellor Friedrich Merz with the war in Ukraine and trade issues on the agenda, but first and foremost, the ongoing conflict in Iran that the U.S. and Israel, of course, is continuing to prosecute this bombing campaign against Iranian targets, which the president contends largely have been wiped out in terms of Iran's military capabilities. But he was also pressed on this notion that we heard from the Secretary of State Marco Rubio and the House Speaker Mike Johnson yesterday, the idea that Israel was set to strike first, and the U.S. joined in out of concern that Iran was going to retaliate against U.S. assets in the region. The president suggested that wasn't the case.
We were having negotiations with these lunatics, and it was my opinion that they were going to attack first. They were going to attack. If we didn't do it, they were going to attack first. I felt strongly about that. And we have great negotiators, great people that do this very successfully and have done it all their lives very successful. And based on the way the negotiation was going, I think they were going to attack first. And I didn't want that to happen. So if anything, I might have forced Israel's hand.
For more, we turn to Bloomberg's Tyler Kendall, who is live on the North Lawn of the White House for us. So, Tyler, not necessarily a consistent narrative we're getting from the president and others in his administration close to him.
No, though, Kaylee, we have heard consistently from senior administration officials starting this weekend when the attack started that they are calling this a preemptive defensive attack, which it appears President Trump was alluding to there, despite his Secretary of State, Marco Rubio, as you mentioned yesterday, telling reporters on Capitol Hill that they were confident that Israel was going to launch a strike that would very likely mean retaliation against U.S. targets. So an interesting back and forth there, I guess you could say, as we've been working through some of those other statements from the administration, including the objectives of this mission, as well as what the ultimate goal is going to be, right? We heard from the Defense Secretary Pete Hegseth yesterday saying that the original intent was not going to be what he called, quote, so-called regime change, though they are hoping that the Iranian people take advantage of this moment. In their words, President Trump went on in that Oval Office meeting to talk about how what the worst thing would be was if the regime stayed in place in the same sort of era that it has been fostering. And President Trump wants to see leadership change when it comes to Iran. The question then becomes, what does that actually look like? The president had said before that there were a few options that they were eyeing that the U.S. felt that it could work with, but that all of those people have been killed in the strikes. That's something that we're going to be watching really closely as this ultimately develops, because from an operational level, the U.S. and Israel are continuing their bombardment of Iran. Joe and Kaylee, we got confirmation this morning from the IDF that this is now the 9th wave of strikes against the country.
Straight from the Oval Office, Tyler Kendall, Bloomberg Washington correspondent, live at the White House. Tyler, we thank you, and thanks for being there for that incredible conversation with the president. Here's a little bit more of a taste of what the president said about what's been accomplished in just the last 4 days. Listen.
They have no Navy. It's been knocked out. They have no Air Force. It's been knocked out. They have no air detection. That's been knocked out. Their radar has been knocked out. And just about everything's been knocked out. So we'll see how we do. But we're doing very well. We have a great military, and they're doing a fantastic job.
And even if that remains the case, there are great questions about our supply of munitions. What the president on Truth Social earlier today said could in fact last forever, the word that he used. We could fight forever. But there's a fascinating story on the terminal that questions Iran's missile math. As Bloomberg News puts it, $20,000 drones taking on $4 million Patriots. Something we wanted to talk to Kelly Grieco about, who specializes in asymmetric warfare, senior fellow with the Reimagining U.S. Grand Strategy Program at the Stimson Center. Kelly, thank you for joining us as we face the prospect of hundreds of thousands more drones potentially being sent to us, to our allies, in attack by Iran. There are questions about whether, in fact, this is the right approach or we should be using a different technology to fight them. What do you think?
Well, first of all, thank you for having me. I think you hit the nail on the head in that there is a real issue here in terms of the sustainability of cost, particularly if you're going to use exquisite systems to intercept these relatively low-cost Shahed drones. I think the United States is probably trying to not use things like its Patriot interceptors for this and holding those in reserve only when it's absolutely necessary. It's probably trying to rely on some other methods, but they're still fairly costly. Like we've seen F-16s, for example, or F-15s flying in the air and using anti-air missiles against these. We're now seeing Apaches that are also being used in this role. Traditionally, they hunt tanks, but now they're hunting Shahed drones. But we don't really have a lot of low-cost sustainable options at the moment.
Well, so when we consider that then, Kelly, when expensive as these things may be, when we consider the quantity we have of them and where they are, do we have adequate capacity in the Middle East right now, or are we going to have to be pulling these assets from other theaters?
Oh, well, I think when we combine both the missile threat, because there's still the ballistic missile threat and the drone threat, there's sort of a race going on right now between the ability of the United States and Israel, and now it seems Qatar, to be able to find, locate, and destroy the infrastructure for its missiles and the launchers, the drone facilities, to try to destroy that so they can't get as much in the air and take off the pressure on the interceptors. But if you look at the basic math, particularly against the war, before the war, it certainly favored Iran and just sheer numbers. The question becomes, how effective is it being at degrading those capabilities? But the reality is, even what we've done so far, we've actually gone in significantly into our own stockpiles of these interceptors. And the important thing to really understand is that you can use these interceptors and buy down short-term risk today by using more of the inventory, but you can't remake these overnight. You can't replace them overnight. You're not probably going to even be able to replace them this year. We're talking about years to be able to replace these interceptors.
Well, then I'd love for you to help us interpret the president's post on Truth Social. Decode this for us, Kelly Grieco. He writes, the U.S. munitions stockpiles have at the medium and upper medium grade. You can qualify that for us. Never been higher or better. He writes, as was stated to me today, we have a virtually unlimited supply of these weapons. Wars can be fought forever and very successfully using just these supplies. Is that true?
Well, I am not sure what he means exactly by medium grade. I have a few, two different thoughts in response. One is that it is true that when you're talking about shorter range things on offense, particularly if we're able to not rely as much on long range munitions and we're able to get closer to targets on Iran, you can rely on shorter range things. We have that in larger numbers. So on the offensive strikes, we can sustain this for quite a while. The air defense, missile defense issue becomes much more challenging. There are just certain realities around those stockpiles that we can't really escape.
Kelly, obviously, when we're watching the markets today, we are seeing major upward pressure on commodities, oil and natural gas prices surging as we consider whether or not the Strait of Hormuz is going to be safely navigable for tankers in order to get that product and crude out of the region. Is it possible for the U.S. or Israeli forces to do what proved very difficult to do with the Houthis in the Red Sea and make sure that the strait is secure for transit with the resources we have, and knowing we also actively are trying to play defense with the drones and everything else that Iran is sending out right now?
Yeah, I mean, this is a very tall order for the reasons that you highlighted, that we've, did this earlier with the Houthis, and the Houthis have, also been threatening that they're going to resume their strikes as well. The question is that it's not even one threat at this point. Then, one of the challenges here is you're going to have to start making some acute decisions, because if you want to protect commerce in the Strait of Hormuz, then those same, missile defense ships are not going to be able to provide some level of coverage for, the carrier strike group itself, or to help protect some of the ports of Gulf states. And so it's these kinds of trade-offs that are just that are acute, and we can't escape them. That's just the reality.
We understand that Iran was estimated to have about 2,000 ballistic missiles after last year's conflict with Israel. Based on what's taken place over the last 4 days, drones aside, Kelly, what do we think that might leave behind?
Yeah, I mean, it's a little hard to estimate because there's a lot we don't know. But I did see that a couple days ago, the Israelis announced that they thought they had destroyed about half the launchers. They were believed to have about 200 launchers before the war, and so they may be down to about 100. That's still significant. I haven't heard as much about the stockpiles of the missiles themselves. My sense would be that we'll know over time. I think particularly the next couple of days, as we start to see to what degree they're able to sustain these salvos. If we start seeing a drop off, then we could have a higher degree of confidence that we've actually managed to destroy some of this capability. But it is challenging. We're talking about trying to find things that are on trucks that can blend in. These are widely dispersed, and the Iranians were smart enough to realize that they shouldn't rely on a centralized command and control in Tehran for leading its forces. And so local commanders have been authorized to conduct these strikes. It makes it harder. It makes it much more resilient as a target.
All right, Kelly Grieco, we so appreciate your insight and expertise. She's senior fellow with the Reimagining U.S. Grand Strategy Program at the Stimson Center, here with us on Balance of Power. And we have more coming up. We'll take you live to Capitol Hill, where Democratic Congressman Bill Foster of Illinois will be joining us. He's a PhD physicist. We'll talk more about Iran's nuclear program next on Bloomberg TV.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks and bonds lower as oil surges. That is rattling investors. We are, however, well off session lows. Right now, we've got the S&P 500 index down 500, a decline of 1%. At the worst level of the day, we have the Dow down 1,277. Right now, the Dow is down by 1%. S&P down 1.1%, down 73. NASDAQ down 1.1%. The VIX now with a 23 handle. The 10-year 4.06%. Spot gold down 4.2%, 5,098 the ounce. And West Texas Intermediate crude 75.40 a barrel. That's a gain of 5.8%. Brent, the global benchmark, also up by 5.8%. An earnings surprise this morning out of Target. Shares up by 7.1%. And Apple has updated its two main laptop computer lines, adding faster processors to the MacBook Air and MacBook Pro. It's also raising prices amid an industry-wide memory crunch. Apple down 1.3%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet tracking the markets for us. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, tracking the developments we are seeing in the Middle East as the U.S. and Israel continue now for a fourth day strikes against targets in Iran. We know thousands at this point have been hit. The president outlining the targeting of the Iranian Navy, Air Force, radar systems. He said all of these things have effectively been wiped out. And this is after, remember, back in June of last year, the president said the U.S. had successfully obliterated Iran's nuclear program, though there's been reporting of nuclear targets being involved in this as well. And we wanted to drill in on the nuclear aspect here as we turn to the only PhD physicist in Congress. Democratic Congressman Bill Foster of Illinois is joining us live now from Capitol Hill. Congressman, welcome back to Bloomberg TV and radio. It's good to have you. When we consider what we do know and what we don't know about what Iran's remaining capabilities and stockpiles were after the June strike, how confident are you that we can successfully and finally obliterate it now?
Well, the key question that we have not yet heard an answer to from the Trump administration is what has become of Iran's extensive inventory of 60% enriched uranium. There is a misunderstanding a lot of people have that unless it is quote-unquote weapons grade, 90% enriched uranium, that it is not usable to make a weapon. But people should understand that the Hiroshima atomic bomb was a mixture of 50% and higher enriched uranium. The 60% enriched stockpile that Iran was seen to have been producing by the IAEA was, a lot can be done on that. And the administration has been forthcoming with us in terms of getting technical briefings. I have bipartisan requests that got answered very well by NNSA about what exactly technically could Iran do with the stockpile of 60% enriched uranium. And it was pretty much what had been predicted by a large number of pundits, where they say, look, you can make a large number a significant number, a handful of Hiroshima-style devices with their 60% enriched uranium. It's a straightforward thing. The fact that we've obliterated their factories to make large inventories of weapons-grade material doesn't mean much unless we have destroyed or seized or brought under inspection the inventory of 60% enriched material. And at least we have not in Congress got any accounting for where that is and what we know about it.
So has Congress also seen evidence that there was, in fact, an imminent threat posed by Iran, a nuclear threat to the United States?
I have not seen it. And I've talked to members of the Gang of Eight who said, among other things, that they had no indication that this was intended to be a decapitating strike, a clear act of war. And the problem for a large number of members of Congress, including essentially all Democrats, is that the Constitution provides a way that this should have happened. If the nuclear negotiations were actually stuck, then Trump should have gone to Congress, explained the situation, asked for an authorization for the use of military force, and then waited for a target of opportunity. That did not happen, and that was a breach of our Constitution.
Well, I'm not sure, Congressman, if you still see a path forward for negotiations over the nuclear program, if there is a remaining diplomatic path here. But if there were one, knowing how the president has railed against the JCPOA agreement that was reached during the Obama administration, do you see areas in which what was that agreement should be tightened, should be changed, if there is to be another one?
Well, the thing that you have to do is to put in any agreement at this point that will be, worth signing. There has to be a very intrusive inspection throughout all of Iran by the IAEA and other trusted authorities, snap inspections to make sure they haven't restarted it. But there is an opportunity to have a well-prescribed regional reprocessing and enrichment capability that Iran could participate in. One of the interesting proposals for that is to put it on one of the islands in the middle of the Gulf that Iran owns some of them. And if you had a very well-defined enrichment facility and nuclear, essentially a pipeline for manufacturing nuclear material, but it was on an island where everyone could see what they're doing and anyone unhappy with it could flatten the place, then you could have a satisfactory agreement where Iran would be able to tell its citizens that our nuclear program continues and that anyone from Saudi Arabia to Israel to the United States could destroy it at a moment's notice if they found the material was being diverted. And then you could have very severe inspection. So this has been proposed by Ernie Moniz, who is responsible for the negotiation of the Iran nuclear deal. And I think there is room for an agreement there that could meet everyone's requirements. But my biggest question at this point is they have essentially obliterated the top level of leadership. One of the only positive things about the Ayatollah is he apparently had a very strong fatwa against production of nuclear weapons. I have no idea who his successors are, what his successors' attitude toward production of nuclear weapons. Because if we have not locked down or destroyed their inventory of 60% enriched uranium, they could very rapidly make a handful of devices, not small compact devices you could put on a missile, but things that could be put into container freights and delivered through other means. And there's a very credible threat there that we have simply not been willing to talk about or certainly respond to.
So it sounds like in our remaining moment here, Congressman, that's your priority right now. The United States must identify that missing, highly enriched uranium that is still somewhere in Iran. Do you not believe we know where that is?
I cannot talk about it, but I will say that I personally have not been given the information to give me confidence that we know what we're doing in this area.
I'm really glad you could join us. Congressman Bill Foster, Democrat, Illinois' 11th District. As Kayleigh mentioned, the only PhD physicist in Congress. So we wanted to get to that nuclear issue specifically before we assembled our political panel, and they're with us right now. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis. She is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist and partner at Stone Court Capital, and we've talked, Rick, about that missing stash of highly enriched uranium. Can we presume that the CIA has a good sense of where that is, and how important is it to find it?
Yeah, I would think the combined intelligence capabilities of Israel and the U.S. would have a pretty good sense and have been tracking for a long time the storage and location of that uranium. I think, one of the things that you have to consider when you hear the president's talking about using potentially ground troops is the ability to go and safeguard that uranium. Obviously, the only thing worse than having it in the hands of a bunch of terrorists like the Iranians is having it in the hands of other terrorists who you don't know. And so, I would think that there's got to be some kind of a war plan in effect right now, not only identifying it, but also with a couple of options on how to spirit it out of the country, because I can't imagine a scenario with this scale of activity where the U.S. would allow that uranium to stay in place.
Well, so Jeannie, I'd love for you to weigh in here on this notion that we're hearing mixed messaging from the administration around what exactly the goal was or what the remaining nuclear capabilities were of Iran, if it was really about the nuclear program or about the ballistic missile program or about the Iranian Navy or about regime change, when President Trump told reporters today the worst case scenario is that someone comes in who is just as bad as the supreme leader. Is there enough clarity, not just coming from President Trump, but the varying members of the administration who have also been put out there to address the press right now? Or do you find yourself just more confused?
More confused, and the answer to your question is absolutely no. This is about as clear as mud, and that is what makes it so incredibly dangerous. And I think your conversation with Representative Foster just encapsulates the danger here. They have stockpiles potentially 60% enriched, which can be incredibly dangerous and damaging to the world. We have no evidence, as far as we have been told yet, of an imminent threat that required us to go in, and yet we took out and decapitated their leadership. And by every stretch of imagination, we have no plan in which to change this regime. And even if and when we take out this regime, who gets replaced? Who goes in there? They are likely to be just as hardline or more hardline than the previous regime. And so that is the problem. Then what are they doing, Kaylee? They are sitting there on top of 60% potentially enriched uranium and whatever else. Moreover, they will completely reconstitute whatever we take out. And that's why this is a really ham-fisted approach to doing this. And I think the reason we're not hearing clear objectives is what the Secretary of State said yesterday in Congress, which was stunning, or to the Gang of Eight, which was that we went in because we were concerned that Israel was going to strike. Well, that's like, me concerned that, Joe is going to strike you, Kaylee, and then you're going to strike me, so I shoot him first. It makes no sense, particularly.
Wait a minute.
We don't get violent here on Balance of Power.
And you don't get violent, so I'm sorry to use you two kind folks as an example, but it makes no sense.
Yeah, I'm under fire here, Rick. I am curious to know what your thought is, though, on this line that we heard again from the Secretary of State yesterday and how the president responded to it today. He was asked, did Israel force your hand? And he said, based on the way negotiation was going, I think they were going to attack first. And I didn't want that to happen. So if anything, I might have forced Israel's hand. We've got a minute left. Rick, how do you read that answer?
I just am amazed by the lack of message discipline coming out of the administration, and it may be all of the above, right? I mean, there's a lot of reasons to do an operation like this, but you have to have a very clear and consistent message to the American people as to why are we in the process of bombing this country and taking out their leadership, as you pointed out. And look, I think it probably is some combination. But remember, those ships were brought from different theaters to surround Iran for months. This has been an effort in the progress. There's been a plan. Yeah. Now that plan is being carried out.
All right, Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, our political panel today. Thank you so much. I would note a red headline across the terminal. Spain says Trump must respect international law over trade after he threatened to cut all trade ties with that country. We'll have more still ahead here on Balance of Power on Bloomberg TV and radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We continue to see a recovery for the U.S. stock market with the Dow, the S&P, NASDAQ lower but well off session lows. S&P right now down 53 at 68.27. That's a drop of 0.8%. Keep in mind the worst level of the morning. We had the S&P down 171, down 2.5%, narrowing that loss now to 0.8%. The Dow had been down almost 1,300 points at one point, down 343, now down 0.7%. The NASDAQ Composite Index down 183 for NASDAQ. That is a drop of 0.8%. The NASDAQ 100 Index down 0.9%. The 10-year 4.04%. The 2-year 3.49%. And the VIX continues to move lower, now with a 22 handle. Spot gold down $188 the ounce to 51.32. That is a drop of 3.6%. West Texas Intermediate crude now up 4% at 74.14 a barrel. Brent crude up 4% as well at 80.82 the barrel. Airlines have been suspending more flights to additional destinations across the Middle East and Europe as the scope of the war expands during its fourth day. But right now we have got American Airlines down 0.3, United down 0.1%, Delta up by 0.6%. All three have significant overseas routes from the U.S. I'm Charlie Pellet. Kaylee and Joe, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. I'm Kaylee Lyons in Washington alongside Joe Matthew, where, of course, the conversation is dominated by the ongoing war the U.S. and Israel are conducting against Iran. But on in any other circumstance, we might have led the show today with the fact that primaries are opening across the country as we get closer to the midterm elections in November. The primaries being held today in North Carolina, Arkansas, and perhaps most interestingly, in Texas, where the Senate race on both the Democratic and Republican side in particular is incredibly hot. On the Democratic side, you have Texas State Rep James Tallarico up against current Democratic Congresswoman Jasmine Crockett, and it's a three-way race on the Republican side. The incumbent John Cornyn up against Texas State Attorney General Ken Paxton and Congressman Wesley Hunt. None of the three, mind you, have an endorsement from President Trump, who was in Texas just this last Friday in Corpus Christi, calling some of these guys out by name, but not necessarily saying he'll support them.
We have a great Attorney General, Ken Paxton. Where's Ken? Hi, Ken. Hi, Ken. And we have a great Senator, John Cornyn. Hi, John. Thank you, John. They're in a little race together. You know that, right? A little bit of a race. It's going to be an interesting one, right? They're both great people, too.
So for more, we turn to Julie Fine, who's Bloomberg's Texas bureau chief. Julie, the president says this is a little bit of a race. I would wager it might actually be more than a little bit. Is there any way, without a Trump endorsement for either of these candidates, that this doesn't end up going to a runoff?
I mean, that would be very surprising. The polls, of course, have been all over the place, but that's more on the Democratic side. Most of the polls on the Republican side have shown this race about 5 points apart. We received a press release from John Cornyn's campaign last week, and it gave the date of the primary. It also gave the date of a runoff. So obviously this is what the campaigns expect, even if they're not openly saying it, but it is very likely that you will see a runoff on the Republican side.
Julie, first of all, I've got to say happy primary day. This is supposed to be like Christmas morning for politicos. So happy primary day. They're celebrating in North Carolina as well. I'll also remind everybody that John Cornyn was considered as a front runner to be the Senate Majority Leader just a couple of years ago. This is the incumbent who somehow doesn't have the endorsement of the Commander-in-Chief. How come?
I mean, this is an incumbent who right now doesn't have the endorsement of the governor of this state. I think right now with the state of politics that it's difficult in this race. Ken Paxton has really said that John Cornyn is not conservative enough for Texas. John Cornyn, who at one point said he didn't even think that if Trump was the nominee could be the president, is now being, he's in a battle where they're saying that he's not conservative enough, even though if you look at John Cornyn's record, it is extremely conservative. So now he is touting his relationship with President Trump, but I think that's been somewhat of the problem here. I would imagine that many of the Republicans in the NRSC and around would like to see somebody get the endorsement in this race. They'd like to see it be John Cornyn because they think that that could end it much quicker. But where we are right now, it looks like that this one will be headed to a runoff.
All right, Julie, good luck down there, and keep us posted on things. She'll be watching closely tonight, and we'll be comparing notes on results tomorrow. Our Texas Bureau Chief, Julie Fine, real pleasure to add the voice of Jessica Taylor, the senator and governor's editor at the Great Cook Political Report. It dawned on us this morning, Jessica, we've never had a chance to do this in person. So welcome to our bureau. It's great to see you, and happy primary day. I'll share with you as well. We've been talking about some very challenging geopolitical news until this moment that's kind of clouded this whole story, which to Kaylee's point would have been our screaming lead on any other day here. So what's got your view this evening, or are you resigned to a runoff on the Republican side?
I do think it's going to be a runoff on the Republican side, but what's really surprising to me, you mentioned not just that Cornyn, how far he's fallen from coming just very short of being the Senate Majority Leader just a little over a year ago, is that this really comes down to style more than politics. When you look at sort of the ideology, John Cornyn still votes with Trump. Almost his ads are emphasizing he votes with him.
Right?
Right, exactly. But this is about. It's about who sounds more MAGA, really, and that's Ken Paxton. Ken Paxton has been with Trump. He sued to try to overturn the results, but also that DC Republicans feel like. And I agree that John Cornyn would be the most electable in a general election, and that they would have to spend a lot of money to kind of carry Ken Paxton over the finish line. But they've already spent over $67 million to try to boost John Cornyn, and his numbers in polling are somewhere in the 30%. Now, they've driven down Ken Paxton's numbers, and that's why I think we'll see a runoff, and because Wesley Hunt is in there too. But in a runoff, is it really going to make much of a difference? I think that's the real question. Ken Paxton would be favored in a runoff because we see in Texas those bring out the more conservative, more sort of stalwart conservatives.
Well, and to your point, the reason why groups, including the NRSC, is throwing all this money against Paxton to try to support Cornyn is because they are worried about general election politics, right? And the idea that Paxton would have a much tougher time actually retaining Republican control of this seat. That said, Democrats have been dreaming about flipping a Texas Senate seat blue for some time now. Is this moment actually different if Ken Paxton ultimately wins the runoff?
I think it depends on what happens on the Democratic side as well.
Okay, so Tallarico or Crockett?
Tallarico
Which one has
or
the better
Crockett?
chance against it?
I think it's Tallarico, and that's what national Republicans think too. They sort of trolled Jasmine Crockett almost into this race, putting out polls showing that she would win a primary. But Tallarico has the better ground game on Election Day. He's had more money. He's also spent more money on sort of traditional methods. But we're seeing historic numbers of Democratic primary turnout that might actually even exceed Republican turnout when all of the numbers are in, which would just be record-breaking. And so that tells me that there's quite a bit of enthusiasm for Democrats on the ground. Now, I agree. They have not won a state. Democrats have not won a statewide election in Texas since 1994, and they haven't won a Senate seat since 1988. And so I've been doing this for almost 20 years, and I've been hearing for that entire time that this is the year Texas is going to turn blue. It's sort of like Lucy in the football. Every time they hold it out there, and then they fall just short, just like Beto O'Rourke fell just short in 2018. But they've also flipped a state Senate seat recently in Fort Worth that was a heavy Trump seat. So there are some evidence of Democratic enthusiasm, and I think that Tallarico, sort of similar to for the Republican side, it's also more about style than ideology. They're both actually very liberal candidates, and it's not that Tallarico is necessarily more moderate than Crockett. He sounds more moderate. He's a Presbyterian going to seminary.
Minister.
He's talking about his faith. He's saying we need to reach out as a party to independents and Republicans versus Crockett's theory of the case, which hasn't really been tested though in Texas, and could, in this year of enthusiasm, could be a salient argument as well that they need to get out voters of color, that they need to get out base voters, and even concerns that maybe Tallarico could have a problem with black voters as well in a general election. So
there's been some heavy racial rhetoric in this primary. Just to be clear, though, we kind of brushed up upon this. Do you see, as some do, the conventional wisdom that Crockett would be more of a force in a primary, but Tallarico would be more of a force in the general? So, in other words, Democrats might need to be careful what they ask for tonight.
In a state like Texas, you've got to win over Republicans and independents. That's just the way that the math is.
at least in a general election, to be a more likely success story.
And just the fact that Republicans are hoping and praying that it is Crockett. That we've seen Governor Abbott spend money trying to boost Crockett. We've seen Tallarico's super PAC emphasize that Republicans would rather run against her. So these are questions about electability, but it will tell us about something about the direction of both parties tonight.
And finally, Jessica, on North Carolina, which also is holding a primary today. The primary itself isn't interesting. We know basically for certain it's Michael Whatley up against the former governor, Roy Cooper. What about those two up against each other in a general election? Is it too early to consider whether or not we're going to see the flipping of Senator Tillis' seat?
Well, early polling certainly shows that it's Roy Cooper, the former governor, who has a slight advantage there. Voters just don't know Whatley yet. He's the former state party chairman, former RNC chairman, but voters don't know him in the state versus they've elected Roy Cooper twice. And if this is turning out to be a strong Democratic year, I've heard from Republicans even that they're concerned about the way the independents are going in that state. And so we have this race rated as a toss-up. I think it is too early at this juncture, but I would rather be Roy Cooper than Michael Whatley right now.
All right, Jessica Taylor of the Cook Political Report joining us on this primary day. Thank you so much. We appreciate you being here in our Washington, D.C. studios. We continue to track what's happening here at home, but of course also what's happening in the Middle East, how that is influencing the markets. Equities are off the lows, but there is a lot of broad-based selling still today, including, interestingly, in some defense names. Lockheed, RTX, both actually lower on the day. I want to talk about another defense name, though, a defense tech company that Bloomberg's Ed Ludlow is making some news about today. Anduril, about to raise another $4 billion in funding. Ed Ludlow is joining us now from San Francisco for more. So, Ed, interesting that Jared Kushner's brother is helping lead this round.
Yeah, look, Thrive Capital, very active at the moment. They've just raised a new $10 billion fund. Anduril in particular, it's interesting that they're raising $4 billion at a post-money valuation of $60 billion, almost double their last round. But they're going with venture capital because the round's been co-led by Andreessen Horowitz. And, you know, this story is not new. The idea that the U.S. military apparatus is much more closely aligned to Silicon Valley and being willing to do business with more nimble startups that are growing very quickly and are very focused on, you know, next generation systems, autonomous in the context of terrestrial, maritime, and air, wearables for fighting infantry, mixed reality, etc. So Anduril is growing very fast. It has a number of defense contracts with the U.S. and its Western allies, gets a lot of grants from various U.S. agencies and defense agencies. But right now, they're using that capital to expand, particularly in the United States, their manufacturing footprint.
What do we make of the timing here, Ed? And it's great to spend some time with you here on this scoop. You know, we're obviously launching a new war against Iran here, which is throwing hundreds of thousands of drones at the U.S. and its allies. Not lost on us to see AeroVironment up 12% today, bouncing back from that tough sell-off yesterday. But it's getting all of the attention almost as a proxy for companies like these. Is an Anduril IPO inevitable? And what do you think of the timing?
Yeah, really appreciate the question. You know, we reported this round had kicked off last month. So, you know, the timing, it's just, you know, when they've made progress. No evidence, no reports that Anduril technology was used in Iran. They do have deployments in the Middle East at U.S. bases for anti-drone systems. That's well documented. They have, you know, contracts with SOCOM. But again, like why I put emphasis on the venture capitalists backing them is that this is probably one of the last big pre-IPO rounds where Anduril wanted to attract some crossover investors. You know, again, proxy, yes. Last thing, Anduril gets a fraction of what the legacy primes get in contracts for missile defense, right? So they have some way to go.
Ed, just quickly, before we run out of time here, there's been reporting from CBS today about the use of Anthropic's Claude in the operations against Iran, despite the Pentagon having ruled them a supply chain risk with the breakdown over the kind of security and ethics guidelines that Anthropic wanted the Pentagon to agree to. How should we consider this idea that the Pentagon still very much needs access to these systems, at least in the interim?
Yeah, what CBS reported, citing two anonymous sources, is not just that the Claude technology was used in the mission over the weekend, but it continues to be used. And that right now the status is that there is a blanket ban on Anthropic technology as directed by the President and Secretary of Defense. So, you know, it's fluid. You know, this all happened at the end of last week, and one would imagine, reading the Bloomberg coverage, that, you know, the planning and listening to the President earlier for this Iran operation was happening contemporaneously with with Anthropic's relationship with the Pentagon playing out. But that's what CBS is saying, that it's still in use, and we wait to hear from the company.
Amazing. Ed, it's great to see you. Thanks for bringing that news to us here. Ed Ludlow with us live from San Francisco, the co-host of Bloomberg Tech. I'm Joe Matthew alongside Kaylee Lyons in Washington, and we'll meet you back here for the late edition of Balance of Power, with much more to follow after the president's meeting today with the German chancellor. Bloomberg Business Week Daily ahead on Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Welcome to Bloomberg Invest. We're downtown in the heart of the financial district. It is a gathering of a who's who in the financial management area. A lot of voices talking about the trends, the narratives, and really kind of the macro and kind of breaking it down and what it means to the investment landscape.
Yeah, we got everyone here. Asset management, banking, private capital, wealth, and more. Just some of the headlines that have already happened here is we're, let's say, 25% of the way through or 30% of the way through Bloomberg Invest. Apollo's Mark Rowan speaking earlier saying a shakeout is underway. There will be a correction in private markets. Soros CIO Don Fitzpatrick says we're in for a painful 18 to 24 months as private credit confronts a cash crunch. And some turmoil stemming from investors' misunderstanding that retail private assets funds aren't supposed to be liquid. That's at least according to managers.
All right, so just a few headlines. We're going to tap into all of this. We're going to talk private markets. We're going to talk real estate, energy, so much more with Connor Teskey. He's CEO of Brookfield Asset Management, sitting right next to me, so we're getting ready to chat with him. Lynn Martin, too, president of the New York Stock Exchange. We're going to talk about the SpaceX IPO and just what's going on in terms of the public markets. A lot going on, especially when we think about prediction markets and how that might play into the public market activity.
Also, John Rogers, founder and CEO of Ariel Investments, on finding value. All that and more coming up over the next hour right here on Bloomberg Business Week Daily.
All right, let's toss it back to Bloomberg headquarters in New York City. Uptown from us, Charlie Pellet with a check on the trade.
Thank you very much, Carol Master. I got you covered on markets. We are well off session lows. At one point today, we had the Dow Industrials down 1,277. Right now, that loss still in the red, but the loss has narrowed to 350 points. We're down 0.7% on the Dow. S&P 500 index down 55, now at 68.28. That is a drop of 0.8%. NASDAQ also down by 0.8%. The VIX at 22. We've got the 10-year 4.05% with the 2-year yielding 3.49%. Spot gold down 3.5%. Gold now at 51.36 the ounce. West Texas Intermediate crude oil has been a major story today. At one point, WTI was up 8%. Now looking at a 5% gain on crude, 74.80. That's WTI. Brent is at 81.51, up by just about 4.9%. Right now, Bitcoin down 1.1%. Bitcoin 68,670 on Bitcoin. I mentioned crude oil. Mixed bag for a lot of the oil majors today. ExxonMobil down 1.6%. Chevron down 0.1%. ConocoPhillips up by 0.4%. So again, recapping, S&P narrows its loss now to 0.8%. The VIX below 23. The 10-year 4.05. And West Texas Intermediate crude up by 4.9%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg Invest in downtown New York City. Want to get right to our first guest. Connor Teskey is Chief Executive Officer of Brookfield Asset Management. They've got over $1 trillion in assets under management, touching into many different parts of the investment universe, and he joins us here at Bloomberg Invest. Nice to have you here with us.
Thanks for having me.
It's been a while. And you now officially are CEO of Brookfield Asset Management. What's changed in your life?
Very little. At Brookfield, we run a lot of businesses around the world. We like to run those businesses well. We like to run our own business quite well. And full credit to Bruce and the other senior leadership team. This was a very thoughtful, methodical, incremental transition.
Well telegraphed.
Nice to get the announcement out of the way and just back to business as usual.
All right, so that went as expected. But the world is kind of crazy, to say the least. And I think about the volatility we see as a result. We see it playing out to some extent in the markets today. But we do have an environment macro where things can change pretty dramatically, as we saw this past weekend with U.S. and Israel, the attacks on Iran. So I'm just curious, for you, is it too soon to rethink kind of strategies at this point? Like, what will it take to maybe say we've got to start rethinking differently about the macro?
We're very long-term investors. We focus on long-duration assets that are essential and critical in the communities and businesses that they operate in around the world. And these are assets that produce cash across a cycle. They're downside protected. They're inflation-linked. So we will take a very, very long-term view. And despite the headlines over the last weekend, our focus is on our people who are safe and our assets that are operating. So we continue to look forward, and the fundamentals for the key themes we're investing in continue to be positive.
Does the geography change at all? And I bring that up because data centers, energy, infrastructure, big investment play for you guys. you teamed up with Qatar Investment Authority on a $20 billion venture to invest in AI infrastructure. How does the war with Iran, the instability in the region, does it change that specific investment at all?
It does not. And again, when something like the past weekend happens, the focus is on our people who are safe, both at Brookfield and our portfolio companies, and then our focuses are on the assets, and those are all performing. When you think longer term about our focus on the region, it's an incredible region. It's got very significant growth. It's got an increasing presence on the world scene. Those are the types of asset classes and geographies that we want to be investing in long term.
Could this make the region even more attractive? Is there an idea? I mean, look, the president spoke from the Oval Office today. It's obvious that there's not a clear person who is going to take over for the supreme leader or with regard to Iran's leadership at all. Nobody knows what's going to happen. But is there a chance that Iran becomes a more stable force in the world, and that opens up opportunities for you in the region?
I would say when we think at Brookfield and the types of things we invest in, they tend to have durations far beyond single administrations, political parties, individual leaders, and therefore we focus on the fundamentals. And when you think about things like data centers, like energy, the two you just mentioned, the fundamentals today are better than ever before, and that's what's going to drive our investment decisions.
Connor, one of the things that we love talking with you guys specifically is, I mean, I think about Brookfield Asset Management. You've got $273 billion in assets under management when it comes to real estate, infrastructure, $247 billion, renewable power transition. This is something that you have been overseeing for a while at the company. $143 billion in assets under management, credit, $363 billion. Where are you seeing, though, any signs of stress? Are you going to tell me the whole portfolio is fine?
So I think the topical one today is credit.
Right.
And the first thing we would say is everyone needs to take a step back. Credit, private credit, and direct lending are almost used synonymously in today's market, and they represent very different things. Our view is credit markets are actually in very good shape. Corporate balance sheets are strong. Banks are great. Capital markets are incredibly liquid today. Then you can move to private credit. Mm-hmm. Our private credit focus is on three things: asset-backed lending, real asset lending, and opportunistic credit. All of those are seeing very strong fundamentals. And then there are some concerns in direct lending today, and there are concerns about tightening credit spreads, corporate credit quality deterioration, maybe some concerns about liquidity. It's important to recognize that direct lending's a very small component of the broader credit market.
So, but are there any situations that your guys are concerned about or no? I understand it's a small in proportion, but...
We've positioned the business really well over the last few years, and we've been very cautious and incremental about our exposure to the headlines, the themes that are dominating headlines today, whether it be software or retail funds. Well, we have some, it's de minimis. What's more important is we've positioned our entire business to be a net beneficiary from AI penetration. And then the other exciting thing for us is we've recently announced our full partnership with Oaktree, right, a very contrarian credit investor that's extremely well placed to go to work in this environment.
We'll get to Oaktree in just a second. One more on credit, though, outside of your portfolio, and when you look across the credit landscape, what gives you pause? Not Brookfield's assets, but out there in the environment.
In the environment today, I think the thing that we look at is sometimes there is issues with underlying credit quality, and sometimes there is issues about liquidity in which these credit investments are held. And those two things are very different, and in today's environment, they're sometimes being conflated. There's a lot of talk about perpetual credit vehicles. We think these vehicles long-term are great. They offer a unique private market exposure to a wider spectrum of investors that can offer diversification, that can offer growth. But those vehicles are perpetual in nature. They need to be managed, they need to be invested appropriately, and they need to be executed in a way that is thoughtful given the liquidity requirements they will have over time.
Your understanding and Brookfield's understanding of like the financial markets, this push to kind of spread those things like private credit to a wider investment pool, if you will. Do you think that still makes sense?
Absolutely. Absolutely. Private markets offer an incredible opportunity for investors of all type. It gives them diversification versus what they can get in the public markets. It can give them exposure to some of the most exciting growth themes that are sometimes difficult to get in public stocks and bonds. And historically, private markets have offered a premium return. It comes down to a very simple fact that when they are offered to the individual investor, it needs to be through a structure that is well understood on both sides and is managed appropriately from both an investment and a liquidity standpoint. And
so understand it's not liquid. So understand what you're investing in.
Understand, and there is an onus on the manager to appropriately manage those vehicles. I'll tell you from the Brookfield standpoint, we've been very incremental and thoughtful of our growth in this space, at times restricting capital to avoid any situations that there could be a liquidity crunch.
Can we squeeze in one real quick one, about 45 seconds or 60 seconds? On AI, in terms of the data center build, what do you continue to see, and has anything changed versus what we've seen in the last 6 to 12 months?
No.
You're starting to smile, so I'm assuming no.
It's exciting. And the reality here is the demand is being driven by the largest, highest quality credit counterparties, the best corporates in the world, and the best sovereigns in the world. And this is creating what is going to be a productivity enhancement for economies and businesses going forward. It needs large-scale capital. It needs operating expertise across energy, real estate, and digital infrastructure. We're excited because we think there's a big role for us to play.
So nothing's slowing down.
Nothing's slowing down.
That's pretty amazing. Connor, thank you so much. I really appreciate you taking some time for us.
You'll have to come back. We didn't have time to touch too much on Howard Marks and Oaktree, but we can do that another time. So, Connor, thanks a lot. Always good to see you.
Thank you for having us.
All right, Connor Teskey, of course, Chief Executive Officer of Brookfield Asset Management here at Bloomberg Invest. We're going to stay on the markets. As we heard from Charlie Pellet, we're definitely off our lows of the session, but nonetheless, 2 months into the year, the S&P has pretty much gone nowhere. Kind of a huge knock if you think about the shocks that the markets have endured, from geopolitical unrest to AI disruption threats. And if you take a look at kind of Wall Street expectations for the market this year, they're pretty still holding on to those bullish
for now
outlooks.
We'll see. I want to bring in Eric Weiner. He's Bloomberg News Senior Editor, Equities Americas. He joins us from New York. Eric, why has the market been so resilient? Why don't we see dip buyers getting tired of coming in and buying these dips?
All right, we're having a little bit of difficulty hearing Eric at this point, so hopefully we can get to Eric Weiner in just a moment. In the meantime, just a reminder of kind of where we are, definitely off our worst levels of the session when it comes to the equity trade. S&P, though, still down about 65 points at this hour, 68.16 on the S&P 500, so that's down just about 0.9%. Dow is off about 400 points, and you've got a NASDAQ 100 that's down 1.1%. Eric Weiner is... We're going to go to him in just a moment. He's Bloomberg News Senior Editor of Equities America, and he's been certainly watching all of the twists and turns because it was very much a much more negative tone, if you will, today compared to what we had yesterday, coming right off the weekend and the U.S.-Israeli strikes on Iran, which I think many of us thought the markets were going to come undone, but we didn't really see that. Equity market didn't. We certainly saw an interesting trade in terms of the bond market as yields moved up, and that was because of inflationary concerns.
Yeah, we look at oil too. WTI crude up another 5%, Brent up another 4.5%. We're seeing gas higher. We're seeing diesel higher. We're seeing gold actually go lower by 4% today. Let's go back to Eric Weiner. He's standing by in New York City. Eric, why has the equity market been so resilient over the past couple of months?
It's been pretty remarkable the last couple of days, I have to say. I mean, we spoke to a lot of people yesterday, and they did not understand what was happening as things just peeled off. Today, we're getting a bit of that. Things are still down, but it appears, I mean, it's hard to tell exactly why things go the way they do, but it appears that equities have really bounced off of oil. The announcement that we may protect energy supplies in the Middle East really kind of gave oil a bit of a move down, and stocks came back up. But there's just this belief that, you know, the U.S. market is where you're going to be when there's a disruption. And, we're seeing buying in financials. We're seeing technology kind of moving with the market. These are all risky kind of areas, and people are happy to play them.
Yeah, it's really kind of fascinating, right? We did see WTI crude. We saw it up as much. West Texas Intermediate up about 9.5%. We're still up about 4.8%, but certainly not as bullish as we saw before. In the meantime, you've got Bitcoin backing off here. So I don't know whether to throw that into the metric. Investors, how much of kind of the idea of war or the U.S. at war, we talked about this a lot yesterday, is priced in at this point. And so investors are going to wait and see the duration of this and whether or not there's a longer impact.
I think it's the second part. So the war itself, I don't think people are expecting this administration to get us involved in something very long held. So the idea is this will be a temporary disruption and we'll get back to business as usual. If it were to prolong, if it were to expand, if there were attacks outside of the Middle East, and it really were to impact supply chains and things like that, then you would start seeing a retrenching. But for now, I really feel like it's almost being treated as if it's a blip. It's a crazy blip, but this weird blip nonetheless. The other thing, I just saw a note come across from Jeffries, and they're talking about flows, people selling out, and a lot of pressure being applied on the downside, but everything's pretty orderly. Not a lot of panic, not a lot of crazy trading moves that are disruptive. And as long as that's going on, the market sort of adjusts to that, and you don't see these outside swings and crazy volatility. Even the VIX, while over 20, isn't going nuts. So it does look fairly orderly for a time where you would think things wouldn't be exactly orderly.
Well, so Eric, if we just think about the way that stocks are valued, and we use discounted cash flow analysis or whatever we want to do, and kind of go old school there, wouldn't the concern be with a prolonged conflict? There could be inflationary concerns. There could be a changing of the view of the consumer. There could be a changing of the way that the government is spending money. There could be a reordering of different types of equities that are getting more support versus others. Very briefly, how does it play out in an extended conflict?
That's the whole game. Right now, if you look at, let's take tech. Big tech has actually come way in. So if you look at the biggest, hyperscalers for AI, they're actually fairly reasonably valued. They're trading roughly in line with the S&P 500, meaning that's usually cheap. However, if there is a long-term, a prolonged war in the Middle East, everything is going to be repriced.
Yeah.
And that's the change. That's the bet.
Yeah, right. Yep, time will tell.
The repricing.
That's how it works.
That is how it works.
All right, Eric Weiner, thank you so much. Good to just check in with you. Bloomberg News Senior Editor of Equities Americas. Coming up, we know investors are super excited about the SpaceX IPO. We'll get more on the opportunities for new issues. We're going to check in on that. We're going to talk about also prediction markets a little bit when we come back.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks and bonds are retreating as the war in Iran shows no signs of de-escalation. We are, however, well off session lows. Right now, looking at a 53-point drop on the S&P. Now it's 68.28. That is a decline of 0.8%. Keep in mind, at the worst level of the day in the early going, we had the S&P down 171 points. That was a decline of 2.5%. But bears repeating, right now we are down by just about 0.8%. The Dow, which had been down almost 1,300 points, the Dow now down by 320, a decline there of 0.6%. The Nasdaq Composite Index down 0.9%, and the Russell 2000 Index of small cap shares down 1.3%. The VIX at 22, the 10-year 4.05%, with the 2-year 3.49%. Gold is down 3.8%, 51.17 the ounce. Crude continues to be a major move there, higher by 4.7%, 74.55 a barrel on WTI, and Brent, the global benchmark, now up by 4.6% at 81.35 a barrel. On a day when stocks are moving lower, we've got Target shares higher by 7.3%. The retailer forecasts better than expected profit for the full year, indicating that the big box retailers' turnaround plans are starting to generate results. Rival Walmart up 0.7%, but again, the move for Target up 7.3%. Recapping the Dow, the S&P, Nasdaq, they're all well off session lows. S&P down by about 0.8%, and West Texas Intermediate crude oil right now, WTI up by 4.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stanovic, live here at Bloomberg Invest in downtown New York City and across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals. So companies planning IPOs, they're definitely maybe thinking a little bit maybe should we ride out some of the volatility set off by events in the Middle East over the past weekend. Bankers looking for ways to finish the jobs, though, on deals nearing completion. Now, firms with less advanced processes, what we're hearing is they might have their feet kind of hovering over the brakes as the U.S. and Israel's operation in Iran plays out. We have the perfect guest to talk to about public markets, the IPO market, and more.
Lynn Martin is with us. She's president of the New York Stock Exchange. She joins us here at Bloomberg Invest in downtown Manhattan. It's interesting because it seems like there's been this sudden change in sentiment. We saw an IPO pulled this week already. Is this conflict enough to materially change how companies are thinking about IPOing?
I don't think so. I mean, there's always going to be geopolitical events happening, and the political framework is always going to continue to evolve. And if you're a good company, you can always go public. I mean, you look at the volatility we saw in 2022, 2023, 2024. We had some amazing companies go public and do really well, raise a ton of capital to fund their operations, to build R&D capabilities, and they're trading at levels that are multiples of where they IPO'd. You look at a company like Reddit, for example, that IPO'd around this time in 2024. It's done extraordinarily well. So I think companies need to be mindful of how anything that's occurring on the geopolitical landscape is going to affect their businesses in the short term, medium term.
What's more difficult, Lynn, or what's the thing that kind of makes you kind of want to pull your hair out? Is it the geopolitical? Is it stuff out of Washington? Or is it the constant and increasing growth of private markets that allow companies to stay private longer? Like, it's pretty staggering.
I think the thing that makes me want to pull my hair out is, the narrative around what we could do to fix the fact that companies don't necessarily see a quick exit in the public markets. If you take a couple of steps back, our public markets are the envy of the world. You look at the amount of capital that gets raised there, secondaries, IPOs, whatever the case may be, it's extraordinary. It is why more and more companies are looking towards the U.S. as the most desirable geography from a capital formation standpoint. When you think about why a company isn't going public, a lot of times it is the areas that Chair Atkins covered in his Make IPOs Great Again speech. Simpler disclosure frameworks, looking at mitigating some of the litigation risks that face public companies, those types of things, significant shareholder reform, proxy reform, things of that nature. That's really what keeps companies off to the sidelines.
Is there something, though, Lynn, to be said that by having, though, a pretty deep private market and allowing companies to stay private a little bit longer, that when they finally go public, they're a much healthier company?
Absolutely. Absolutely. I've been saying this for years. Companies being private for longer, that's a great thing. Because, to your point, when they come out, a clear path
about ending quarterly reporting. Does that prevent
blasphemy?
Well, I mean, the president pushed for that in the fall.
I know.
The SEC chairs is what would that do in your view?
It's a bit of a two-edged sword because what
Oh, we hear you there. That's like our job, right?
But if you're a newly public company, should you have to report your first earnings call 45 days, within 45 days after you've IPO'd? You've just given investors